Good morning to, I guess good morning to all U.S. East Coast and perhaps other American time zone Motley Fool members, and welcome to our next hour, Fool 24. For the rest of you international Fool members, this may be an afternoon or a good day, or hey, you know what? Whatever time it is, I hope it's going good for you. Welcome to Fool 24. I'm Tyler Crowe. Rachel Warren will be joining me, both of us in Europe. So we've had a whole day to be watching the news stories coming in. Obviously, we have both Fool.com membership, people who are watching on Fool.com, and members or people who are just watching on YouTube Live. And so welcome to both of you. As we start every hour, the customary reminders, Rachel and I are here to give our thoughts, our wisdom, our expertise, our experiences, maybe some personalized advice on something not financially related. I don't know, maybe Rachel's got some European fashion ideas. I could maybe give you a few things on Georgian wine, but financial advice is a big no-no here, and so we won't be touching that with a 30-foot pole. If you are looking for financial advice, please seek out the advice of an actual paid professional. That's what they're there for, and they will do a much better job than we could anyways. And for people who are watching on YouTube TV, you'll probably notice, or YouTube Live, excuse me, you'll probably notice that there is no comments on this one. It's because we keep all of our questions over on Slido.com. It allows Rachel and I to kind of see everything consolidated on one place and don't have to be chasing web page after web page. So go to Slido.com, enter the code FOOL24, and that will allow you to get your questions in there. We have a moderator kind of help smooth things along the way. And with all of those customary disclosures and whatever, Rachel, how are you doing today?
Doing pretty good, Tyler. How's it going?
That's going pretty good. The rain just came in. I had to close my windows. I was like, I wanted to be nice outside, but then I heard a big thunderstorm, and I was like, what if there's like really loud lightning crashes? People might start wondering what's going on here. So, other than that, it's going quite well. Obviously, it is Monday morning. It's 8:00. Everyone's kind of wondering what the week ahead is going to be all about. So as we're waiting for questions to come in and members to join us here, people or non-members on YouTube, as we get started, week ahead, Rachel, is there anything you're watching or things that you think should be brought to anyone's attention?
Yeah, well, there's a few things I'm watching this week. We've talked about how we're somewhat in a lull with earnings, but there are some stragglers kind of coming in at the tail end of this round of earnings before we have a whole new round of earnings that starts up in April with some major companies that I think a lot of us follow here at the Fool, and maybe we'll get into some of those later. But there's a couple things to be watching for this week. Obviously, we have talked a lot in recent shows about much awaited announcements regarding new tariffs, reciprocal tariffs that might be announced tomorrow and then the day after and in the coming days. So those are definitely numbers that I think I will be watching and a lot of investors and consumers will be watching. But beyond that, there's a couple other things coming in as well. For example, today we are getting earnings from the company that owns brands like Calvin Klein and Tommy Hilfiger. That is a PVH stock. And this is, one of many of these major companies operating in the retail sector. We've seen a lot of mixed results from retail-centric businesses in this earnings season, for sure. There have been a lot of sort of moderated comments from management of a wide range of companies that have been trying to, I think, set expectations for the time ahead. PVH in particular, they own well-known brands like Calvin Klein, Tommy Hilfiger. They sell their products as well to major retailers like Macy's, JCPenney's, Kohl's, as well as some online retailers like Amazon. They have a significant number of franchised and licensed stores, particularly in the Asia Pacific region. And they also own some other brands like Van Heusen and Arrow. they have been struggling in recent years with growth. There's definitely been some decelerations in terms of revenue and earnings, and even ahead of earnings, there has been some predictions that have been slashed by analysts. So I don't know that I would be expecting this company to beat estimates, but we'll see what those numbers turn out to be. And then obviously, on Wednesday as well, the new expected, although not fully fleshed out as far as we know, new tariff increases are set to take effect. That's something that I think we'll be watching. That day also, we're going to be seeing earnings come in from another retail business, Restoration Hardware, which is now known as RH. This is a business that primarily sells high-end furniture, home furnishings, related products through its online platforms and physical stores. They operate in a range of channels, very much targeting the high-end luxury market, and a significant portion of RH's sales come from business-to-business transactions with interior designers and architects. And they have been working to expand their footprint and open, new galleries and go into new markets. But like a lot of other, businesses in this sector, they've been dealing with headwinds. There's also been concerns about how efficient management is being with the capital that they do have, particularly as they've been seeing declines on both the top and bottom lines. The luxury housing market, the broader economy, as well as overall shifts in consumer spending habits have presented a range of ongoing challenges for a business like RH, and RH in particular, with mortgage rates remaining at sort of record highs in many areas, and just also the fact that we're seeing sluggish trends in areas like home sales and home building. These are a lot of different factors that are impacting a business like RH. But they report on Wednesday. Might be worth seeing what those earnings are like. And as we progress through the week, I will probably talk about that business. One other one that's reporting this week, maybe a little bit less widely followed, is a company called Conagra. They're basically a leading food brand retailer. They have a range of brands under the family of Conagra brands, including Healthy Choice, Marie Callender's, Duncan Hines, Slim Jim, which I did not know was owned by them, Hunt's tomato products, a wide range of other sort of consumer staple household name brands. This is a business that has been pretty habitually profitable, but revenue growth for this type of business and margins are quite slim and have been decreasing in recent quarters, although its dividend yield has been on the higher end in recent times. So that's another one to watch. Friday is when we're going to be getting the non-farm payrolls report from the Labor Department, which is a pretty key inflation metric, for the Federal Reserve. Obviously, we're going to have to wait and see how those numbers bear out. There's also the concerns of how inflationary tariffs, could impact some of those numbers and may already be impacting some of those figures. So we'll have to see what that looks like on Friday. So some different things coming out this week. I think that there's a lot to watch as investors, but even as we are heading into a little bit of a lull before things pick up again, it's also interesting to note, as you and I are both over here in Europe and broadly watching, the state of the economy globally and how it impacts some of the companies we follow. There was critical data that came in regarding the state of inflation in Germany, one of the leading countries that is driving overall growth in the Eurozone. German inflation eased to 2.3% in March, which was slightly lower than expected. This is obviously a time that is really critical for the German economy, as there's sort of the looming threat of tariffs and also shifts in fiscal and economic policy. So lower than expected, 2.3% inflation in March. That compares to 2.6% in February, which was revised lower from a preliminary reading. And there was also a poll of Reuters economists that had been expecting inflation to come in at 2.4%. Trade is a major pillar for the German economy, and the German economy is one of the more robust needle movers, if you will, within the Eurozone. So given the importance of trade, it's obviously more vulnerable to uncertainty and changing trends and dynamics that are occurring right now that could impact global trade policy. So that was another thing of note that caught my attention as we start out the week here.
So you shared a couple of these stories with me before we got started here, and I was able to read through them. And there was one thing that, and I'll just put this out as kind of the thing that I felt like it broke my brain a little bit. It was on the inflation stuff and the jobs numbers coming out on Friday. This was obviously there were some journalist reports from CNBC, talking with like Wall Street analysts and people on the floor and things like that, and they were looking for weaker job numbers or slower growth because they were so worried about, not getting interest rate cuts that they have been, kind of plugging into their models. And this just like, it kind of broke me. I was like, so wait, you're hoping for bad job numbers
and bad wage numbers. Yeah.
bad job numbers and bad wage numbers so that your interest rate cut, bullish thesis on interest rate cuts actually goes through. It's like, but doesn't the bad job numbers seem to like be like a countervailing? I just read that and my head hurt. I was like, wait, so it's bullish that we have low job growth or no job growth and low wages? I was like, oh, I don't know. It really felt like one of those missing the thread sort of moments on that one. And then on the German inflation one, as you mentioned, I've one of the things that has been a recent theme, I guess, if you will, is, that, hey, maybe European or international stocks might actually start finally outperforming the American markets for the first time in seemingly over a decade. And so part of the reason for that too is there's kind of been thoughts of fiscal spending, debt spending, especially from Germany, a country within the Eurozone that has been much more loath to taking on debt and spending. So I don't, maybe this gives it legs. I don't know. This is just kind of like, talking head financial stuff. I don't know how much it's going to impact businesses too much, but it'll be interesting to see, like, with lower inflation, despite the, talks of ramped up spending and stuff like that. So it's just a, if investors are looking at European companies, and actually I mentioned it yesterday, this is one of the things I've been looking at, is like AI picks and shovel plays in Europe, because I think they're going to go through one of those, like, they're going through their like defense spending thing right now, but I think coupled with that, there's going to be like a big effort in Europe over the next couple of years to like boost their AI capabilities. And so that will involve, like, a lot of those picks and shovels, like data centers and things like that. And so I think investors that may be looking at like the European industrial stocks and companies, this might make it just kind of gives a little bit more support to that idea that, Europe may be a conducive area for this sort of stuff. So those were like the two big takeaways that I had. You mentioned earnings. We have some stuff coming up, and the old man me, if somebody's been doing this for a long time, I was shocked to see that Alcoa wasn't the first one reporting, because that used to be like a staple of the earnings season. Like, it meant when Alcoa report, it meant it was time to like gear up for earnings seasons, but that doesn't seem to be the case anymore. I wanted to talk about a company that was actually reporting today, and kind of in the background here, and maybe people have been seeing my shifting eyes, I've been like trying to refresh the page for a company that's supposed to be reporting before the market opens today. They haven't done so yet, so I'm frustratingly like refreshing and seeing when it actually happens.
You're like, where is it?
Yeah, this is the company's called Loar Group, or Loar Holdings. The ticker is LOAR. It is a aerospace and defense manufacturer. I I don't want to say that it is like, because that's always, I think, a bad comparison. I'll say like shades of, reminiscent of companies like TransDigm that make a lot of like aftermarket parts for commercial airliners, for the military, things like that. Tends to be relatively high margin business, because aftermarket parts can be those are typically in like commercial aerospace and defense. Aftermarket parts are like things that people need right away. And so tend to pay up a little bit more than you would normally expect. And that's been the case with Lohr Holdings. This was a business that was started from people, 3 or 4 founders that, have started like commercial aerospace manufacturing companies before, that got rolled up into other various companies previously. I think one of the companies that one of the founders created was actually acquired by TransDigm in the distant past. So, this is a kind of company that can do incredibly well. Like there's those in the background commercial aftermarket space of commercial airplanes defense. There's very strong profits. This is a business, like 21, 25 times operating earnings. It's fantastic. It IPO'd last year. Obviously, IPOing lately means you're probably coming to the market with some really, really expensive debt. And that's been the case with them. They had debt that had somewhere like 11 to 13% interest rates, depending on, because they were variable rate interest. So when this company reports this particular quarter, there should be some update on like refinancing some of that debt, how they plan to do that, how they can kind of get to a level of profitability. In the third quarter of last year, they had announced that they were going to be it didn't seem, based on their earnings, it was adjusted, of course, because everyone puts out adjusted numbers and they're never that great, but they were expecting like a double on an earnings per share basis, which is not much. This was a barely profitable company on the bottom line basis beforehand. So I'll be interesting to see like what the plan is now that 2025 is a little bit more in view, like how they can address their debt, how they can kind of get up to a more respectable level of profitability, because right now, in my opinion, the biggest constraint is that interest rate sort of thing. And so whether it be like some refinancing, whether it be paying it down, I don't know if paying it down is really a thing, because they still want to be a very acquisitive company. There are tons of really, really small parts manufacturers, distributors in this space. And I think Lohr still wants to be one of those like consolidators. There's certainly room to do that. And so I would love to talk about their earnings coming out, but hey, you know what? We're 20 minutes into the 8 o'clock hour and they still haven't reported their pre-market earnings. So you know what? How about we check in about 20 minutes and see what happened there?
Yeah, there's another story that also caught my attention this morning. We were talking, of course, earlier about the numbers that are expected out on Friday, but there is, CNBC's Rapid Update Survey, which tallies the forecasts of a range of economists, in this case, 14, and what their projections are. So this survey came out, the results were just published a little bit ago. So I thought it might be interesting to look and see what are some of the predictions we're seeing for what Q1 as well GDP growth will be. So according to CNBC's Rapid Update, which tallied the forecasts of 14 economists, economic growth in Q1 was just 0.3%. The survey also shows core PCE inflation will remain stuck at around 2.9% in their estimation for most of the year. And obviously these numbers are coming in as we see, the backdrop of shifting consumer and business sentiment. A lot of it centered around, concerns of a trade war. So again, Q1 growth based on forecasts from 14 economists for GDP and inflation is estimated to be at around 0.3% compared with the 2.3% reported in Q4 2024. That would be, if these figures are correct, the weakest growth since 2022 as the economy emerged from the pandemic. And then again, you've got core PCE inflation, which is the Fed's preferred inflation indicator. They're estimating that will remain at around 2.9% for most of the year before resuming its decline in Q4. And behind these GDP forecasts, which are less than stellar, is the range of data we've been discussing in recent shows, showing the state of consumer and business sentiment. We had, for example, information out from the Commerce Department just this last Friday that showed that real or inflation-adjusted consumer spending in February rose just 0.1% after declining by negative 0.6% in January. Action Economics dropped its outlook for spending growth to just 0.2% in this quarter from 4% in Q4. There was a note that Barclays put out over the weekend saying signs of slowing in hard activity are becoming more convincing following an earlier worsening in sentiment. Now, there's another factor as well, which is that a surge of imports, which subtract from GDP, appear to have poured into the US ahead of tariffs. Something that this report notes is that, according to them, the good news is the import effect should abate, and only 2 of the 12 economists surveyed see negative growth in Q1. None forecast consecutive quarters of economic contraction. Oxford Economics, which has the lowest Q1 estimate, expects a continued drag from imports, but still sees Q2 GDP rebounding to 1.9% because those imports will eventually end up boosting growth when they're counted in inventory or sales measures. On average, most economists are forecasting a gradual rebound. They're forecasting for Q2 GDP an average of 1.4%, Q3 at 1.6%, and the final quarter of the year rising to 2%. There's obviously concerns that if, in fact, the economy only grows 0.3%, that this could slip things into negative territory. And with new tariffs set to come in the next few days, not everyone is so sure about a rebound. We have some analysts from Moody's that are targeting also anemic Q1 growth of just about 0.4%. They're looking for that growth to rebound to 1.6% on the upper end by the close of 2024, which is still somewhat below trends. So those are some estimates we're getting in from a lot of these different types of firms and analysts and economists ahead of more firm data that comes out later this week.
Well, we're still a little light on questions, and so we're hoping for people to get in. We'll try to answer some older questions as we get in here. And as I said, hopefully Laura will actually report when we're doing this, and I can do like a live reaction to it, because that would be fun. But again, no update as of now. I want to hit Ed's question, and I want to kind of do it I'm going to pivot it and kind of shape this in a little bit of a interesting way, because Ed asked 5 minutes ago about basically administrative policies by the Trump administration being rather unpopular, perhaps being a little detrimental to some of its voting bloc, and if they're going to change course. And the reason I don't want to answer it specifically, because it's ranging a little too far into politics, and to be honest, I don't have an answer. I don't know who does, actually, to be frank. But what I want to do is create an investing lesson out of this. And it's the idea of kind of preparing your portfolio, preparing your financial holdings to handle such situations. I think a lot of time, when we get into like our biases and things like that, we think about, our investing biases. Often it can be shaped by our political views, by our economic views, by our strongly held views on business or anything like that. And it can cause us to anchor to certain ideas. Talking about people might really, really want to invest in renewable energy for this, because Democratic policies have always been to expand renewable energies, giving a lot of subsidies in that regard, and kind of seeing it as a bright, promising future in energy. When in fact, to be honest, there's a lot of crappy renewable energy companies out there. It's a very cyclical, challenging business, and so just investing in renewable energy for the sake of renewable energy can be pretty detrimental. Same thing, sometimes political policies will go against what we thought were going to happen. Sometimes trade, inflation, all of these, external factors that are completely out of our control are going to happen at any given moment, whether we like it or not. Even if they are unpopular, sometimes you will get an administration that will be a little bit more stubborn, forthright, very like set in their ways of what they want to do, that could be detrimental to what you're looking at in your portfolio. These are all very possible things. And the when positioning ourselves financially, I think a lot of times we think about investing in stock markets. We want to keep investing, and often investing in the same things because it's been working for so long. But that isn't always the case. I like to think of it as like, for those who, are listening, or like played sports. It could be basketball, it could be soccer, it could be football. You can name almost any sport, a team-related sport, where it's like when you play defense in sports, it's all about basically positioning yourself to react quickly to anything and not being too anchored one way or the other. You're trying to quickly react to the things that are going around you, and not be caught, off balance or caught in the wrong position, trying to be too aggressive or something like that, because those are the moments when you get burned. And, in the same thing in our portfolios. When we're investing, when we're looking at stocks, when we're analyzing businesses, we don't want to be putting ourselves in positions where something that we didn't expect could, completely detract our, financial goals, financial future, things like that. We still need to, come from a position, I would say a defensive position, which allows us to react to the market and not being totally committed to, one policy or one trade deal or, one direction of interest rates. The more you can give yourself that optionality and being positioned to react to that optionality, I think it's a very valuable thing. It's one of the reasons that we talk about in the Motley Fool is buying. I think the general consensus that Motley Fool advice is about 25 companies, and to take that one step further, not just 25 software companies, but like 25 companies in diverse array of industries with different drivers that, the hope is all of them will obviously go up, but you also want them to be somewhat uncorrelated, where they're not all betting on AI. Maybe some are utility companies, maybe some are energy companies, maybe some insurance or healthcare, where you have that, that ability to react, and some things can do well in other situations. And at the same time, having a decent cushion of cash so that you can make timely reactions and make opportunistic moves when the market is panicking. And those are like, when, again, using that defensive sort of analogy, this is allowing yourself to be in a good position to react to what is going on when people are panicking or when people are euphoric, to allow you to succeed much, much further down the line.
Yeah. Well, and the thing is, and I agree with everything you said, it's also very difficult to make any type of investing decisions based around changing whims of policy, which, we can't control, either as citizens of our respective countries or as, retail investors that are trying to divine how some of these movements are going to impact the businesses that we own or follow. I think it's important, as we talk about a lot of the data that we do on these shows, it is helpful to understand how that correlates to the performances of different industries and sectors, and then potentially trickling down to businesses that we own or have, in our portfolios. But broadly speaking, this information is helpful, it's beneficial, but it's not always investable. And that's where it's really important, I think, to continue to focus on great businesses that have the ability to adjust and stand the test of time in our portfolios, because it is very easy to get sort of, drowned by the noise of all of these different factors that we see operating in the backdrop. And of course, that's a natural response and inclination, particularly when you see the type of market volatility that we have in the last weeks and couple months, as a lot of the news that we discuss on the daily here continues to be announced, and different stocks react accordingly, and also different management teams of different companies have their own comments, and various industries are sure to be more impacted than others by some of the changes that we're seeing. But that being said, I still think, and I've said this before, I think fundamentally great businesses remain so, even when we do see these shifts in policy. And I think that these shifts can have a big impact. I think that there are going to be situations where there are going to be companies that are going to go through perhaps very difficult transition periods. And it's sometimes unclear and difficult to define exactly what that's going to look like, because we don't necessarily have that on the ground view into the inner workings of these companies, despite the range of public disclosures that we get as individual investors. So I think to a certain extent, it still is really important to focus on that core strategy of really investing in businesses and not just share prices, and continuing to focus on companies that make sense for our respective portfolios and financial goals and risk tolerance, and understanding that the noise is there, not necessarily tuning it all out, so to speak, because it is important to sometimes understand how that impacts our investments, but fundamentally focusing on businesses and not what the market is doing in a period of a few months or even a year, because we know sometimes these volatile periods can be very brief. They can sometimes last for a much longer range of time, but the market has a really great habit of consistently rising over the long run. And because we can't predict exactly what those really good days are going to be, or even what the really bad days are going to be, it's best to keep consistently investing and growing one's portfolio. And there's also I've talked about this as well. Sometimes the best thing to do is absolutely nothing. I've had periods of time. That's what I've been doing the last couple of months. I have completely left my portfolio alone. And that has been my approach. That will probably change.
Not even opening the brokerage can be sometimes a nice.
That can be a little victory lap, right?
Yeah.
So just some thoughts.
Yeah. So in addition to the comments here, and what we're talking about here, Sergey Zechenko, I hope I pronounced that right. Apologies if I got it wrong. Along these lines, is saying to me, another way of putting what I was mentioning with like defensive positioning is making your portfolio anti-fragile. Yes, I think that's a common phrase a lot of other people use. However, I don't want Nassim Taleb to actually like sue me by using anti-fragile without perhaps his permission. So I just try to avoid that when I can. And and the question on the follow-up of that is curious as to how you're preparing your portfolio for short to midterm. To be frank, and I think Rachel hinted at it in her response of like, maybe I'm just not going to look at it for a little while. On the short to medium term, portfolio management. I'm going to make a small confession here, at least in my personal investing portfolio. I am not great when it comes to portfolio management. Sometimes it's a little bit of a, hey, this is a business I want to own, I'm going to buy it. I tend to be more disciplined on the stock picking and stock acquisition portion of my portfolio versus the portfolio management itself. I am like aware every once in a while where I'll look at my portfolio and go, oh man, I really have a lot of oil and gas stocks, or man, I've got a lot of home builders, and I'll try to maybe consciously go make my next couple of acquisitions elsewhere. But in terms of like, am I being very active in my selling because I'm thinking like, oh, we're headed for recession or we're headed for really high inflation? I don't tend to make like big portfolio wide decisions at that level. I might make decisions on the stock based level for certain things, like some of the companies I've actually been looking at, and this kind of gets to a question we had yesterday from Sanjar about like Polaris, is kind of these like big ticket item discretionary things. Polaris obviously being snowmobiles, four-wheelers. I was thinking also along the lines of like boats and RVs, because these are businesses that are very discretionary spending based, and at the same time often take a lot of financing to actually pay for. So these tend to be businesses that get absolutely hammered in recessionary times. And so these are like, if I have been looking at them for a long time, I was like, do I want to own them? Do I want to own them? But a lot of them went through incredibly good times just post pandemic, where everyone wanted to get outside and use RVs and boats as an excuse to, be outdoors and socially distancing appropriately. But with that kind of pull forward, I've been curious, like, well, we could hit a pretty tough patch for big ticket discretionary spending. And those are businesses where, I may make a decision based on some of those macro things in that regard. But again, in terms of short to medium term, it's more or less, again, just keeping a defensive stance of like keeping a good cushion of cash, having a rough direction of like diversified portfolio, and just being able to react when the companies that I want to own are on sale. And that's best way I can do it. And maybe less from the portfolio top down sort of view, but that's how I do it. Rachel, is there anything in terms of like short to medium that you're doing portfolio positioning wise, or not really?
I think that my approach is somewhat similar to yours. I think because I have a much also longer investment horizon than perhaps some viewers might, in terms of my retirement is quite a long ways away, and I do have medium and short-term financial goals, of course, but a lot of my bigger goals are much more over the long term. So I am much more comfortable with having periods where I'm either totally leaving my portfolio alone, or continuing to invest in maybe seen as higher risk, growth oriented businesses that I think are great investments for me over the long run, because my horizon is quite lengthy at this point. But I do think it's not so much that I generally adjust my investing strategy based on what the landscape is at the time. I really tend to gravitate towards the same types of businesses, really, regardless of what's happening with the market. And sometimes that might mean I'm investing in those businesses when perhaps it's not the most favorable time for share prices, because I do tend to gravitate towards a lot of growth oriented businesses, which I do pair with healthcare stocks as well. So it is much more of a situation where it's more that when I have the ability to add to my portfolio, whether, it's a question of capital or, having met certain disclosure requirements or whatever the case may be, then I do so. And that's really regardless of what's happening in the backdrop of the market. I don't necessarily find myself gravitating towards certain companies because I think, oh, well, maybe in the next year or two, this will help anchor my portfolio if things get rough. It's more that I'm thinking, well, do I want to own this business 5 years from now or longer? That's been more of my mindset.
Do you want to hit a question here? Because I want you to hit a question because the company that I mentioned, Lower Holdings,
did they finally report?
They posted. So why don't you give me like 2 to 3 minutes to read over?
They're keeping you waiting.
Yep, I'll do an update while you answer a question.
Yeah, well, there was a question that had come in before that listed a few tickers, and I'm not sure where it went, including Chewy, Trex, and Warby Parker. And then there was another question from about 14 hours ago asking about Chewy with sort of a similar angle. So I'll hit that one. Newbie was asking, is Chewy, have they reached their market capacity? Do they have the potential to keep growing? Now, this is a business I've talked about a lot in recent weeks, and I absolutely do not think that they have come anywhere close to, eclipsing, their market opportunity. And I think that this is a business that has really proven its ability to expand very intentionally within what is a massive and growing addressable market. I mean, there's some estimates that show that the total pet services, pet spending market is valued at well over, 100 billion. And this includes a wide range of different subsectors, many of which Chewy is targeting. They have their flagship e-commerce platform that continues to be the mainstay of the business. They have, expanded somewhat internationally. They expanded to Canada, which is still a very nascent market for them. But they have a lot of other key growth drivers. They don't just sell pet products on their platform. They have their pet telehealth service where you can connect with a vet on demand. They have a compounding pharmacy. They have partnered with companies like Lemonade and Trupanion to offer pet health insurance plans. They sell a lot of different third-party brands on their platform. But they also sell their own lines of, for example, of pet supplements. But the thing that's been really interesting for me to watch with this business is we've obviously seen a dynamic where a number of years ago, during the height of the pandemic, pet ownership increased, pet spending skyrocketed. Those are obviously were and are tailwinds that have really benefited businesses like Chewy. And since that time, there has been some deceleration in growth, which I think was inevitable, partly because the pace of new pet ownership has slowed, although that is still expected to be a durable trend over the long run. And also because consumers are a bit more cautious when it comes to their spending strategies these days. But pets are broadly seen as part of the family, and there's certain expenses that are not discretionary, things like healthcare for your pet, consumables, food staples, items like that. And that is where Chewy continues to derive the lion's share of its growth and sales from. When it doesn't always break down, the company doesn't always break down these numbers, but when it has, well over 80% of net sales have been derived from non-discretionary sources of pet spending, like consumables, like healthcare. And the other thing that's been a real key growth driver for the business is that so many of their sales are comprised of recurring sales from their auto ship program. Their auto ship program sales totaled about 81% of their total top line as of Q4. And their growth in auto ship sales, which was something like 21% year over year in Q4, was significantly higher than their growth rate in overall net sales, which was 15%. To close out 2024. The issue where I think some investors have been uncertain about this business is that they have seen some stagnation in their active customer growth rates. They had a huge uptick in active customers during the pandemic, and then that has really slowed. They returned to growth, although it was moderate at about 2% year over year in active customers in this most recent quarter that they reported. But the thing that has been even more, I think, impressive to me is while active customer growth has slowed because they have, I think, experienced a real run up the last few years that probably, if not for the pandemic, would have been growth they realized over a much longer period, is they've continued to do a really exceptional job of expanding gross margins, expanding their free cash flow, growing profitability, growing revenue, and doing a really good job of monetizing the customers that they have. One of their newer business lines is their sponsored ad programs where pet brands pay to advertise to shoppers on Chewy's platform. And while that is never expected to be more than a single-digit percentage of the overall business, that was the business that, again, just launched last year. That was like the single largest driver of gross margin improvement for Chewy in their recent financial reporting period. And then the other major tailwind for them now is these new pet veterinary clinic locations that they started launching last year, which sort of really fits in well with the overall trajectory of the different business lines that Chewy offers. And as management has pointed out, and as has been borne out by the early launches of these locations, has been a really nice dynamic where you have customers going into these vet clinics, whether to have a urgent care surgery or routine appointment for their pet. And very often they're then going to place an order on Chewy. And so there's this really nice cohesive dynamic between the flagship e-commerce platform and these vet locations. And the company expects to expand by, I think, another 10 or so locations this year. And they already had 8 or so open by the end of 2024. So this is a huge addressable market. There's room for multiple players. Chewy is definitely one of the more prominent players in this space. And I think as they continue to expand while generating really impressive financial performance, that is, this is a much stronger company from a financial perspective than it was a few years ago. They delivered about $453 million of free cash flow in fiscal 2024. They turned their profits from about $40 million in the prior fiscal year to about $393 million in this most recent one. This is a really interesting business to me, and one that, while they are somewhat dependent on shifts in consumer spending and sentiment, because so much of their growth is derived from essential sources of pet spending that flow from pet ownership, which are, again, durable trends over the long run, I do think this is a business that has a lot of room left to run, even if there has been a slowdown in active customer growth. The way they are monetizing their base and continue to expand both their e-commerce brand as well as this new brick and mortar, vet clinic presence, I think bodes well for the long run.
As long as it can bring down my vet bills, because man, when I have to bring my dogs in, ugh.
There you
United
go.
States veterinary bills are
maybe Chewy will open next in Georgia, right?
Oh, I mean,
in Tbilisi.
Veterinarian bills are here pretty cheap. I don't know if I need.
I would imagine.
When I get back to the States. So as I mentioned, big reveal. The company I had mentioned earlier, Lore Holdings, they released their earnings pre-market, and I got to say it was even better than I think, at least I expected. I don't know how many people actually follow this one on Wall Street, so maybe it might not be one, and maybe I'm the only person who cares. But you know what? I'm on camera, so people have to indulge me. So full year numbers, actually quite impressive. Sales were up about 27%. Net income was up about, actually went from a loss last year to diluted our earnings per share for the full year of 24 cents. Not much for a $60 stock, but again, IPO, lots of like moving parts in terms of, interest payments and things like that. But the thing that actually impressed me the most, and more than any of this, was actually its 2025 outlook. I mentioned that outlook in the third quarter of they gave their initial 2025 guidance, which was kind of tepid. They were somewhere between like 35 and 40 cents per share at the prior quarter, but this most recent quarter they revised that up to 57 to 62 cents per share. So much better in terms of that. They're expecting net income margins to expand from 5.5% to 12%. All of its sales outlets, either commercial business jets and OEM parts, high single-digit growth, aftermarket parts, high single-digit growth, high double-digit growth in its defense businesses, still making acquisitions. This is a business I've been curious about, and I just went from, ever so slightly curious to much more curious after seeing this outlook, because this is a business that looks to be doing quite well. And with all of the talk of expanding fleets in commercial airlines on top of the aging fleets, like there's some really old planes flying out there today. Aftermarket parts is going to be a key component of that, as well as heightened defense spending in Europe, North America, everywhere. Lore Holdings is moving up the ranking of, hey, you should be spending more time, at least for crazy person Tyler. I don't know how many other people listening to this will be interested in it, but if not, I think people should at least go look at it.
Oh my goodness. Okay, sorry.
Oh,
I was looking.
Sergey asked, what's
comments.
the ticker on this on this company? Lore. It's actually the same. Lore Holdings is the company. The ticker is LOAR.
Yeah, I didn't know this one before. I'm curious to look into it now.
It went public last year.
So yeah, this isn't one I have followed, and I don't normally get into newer IPO stocks, but I'm kind of intrigued. I always love learning about new businesses. For the Bees was saying, appreciate the mindset, listening and discerning because of my panic action in March 2020. Before beginning my full education, waited thoughtfully, now April action. Nice. It looks like there was a question that came in from Jeff asking you about, I think that's TransDigm, better investment than Lore, big price variable.
I that's going to have to be like one of those like comparisons, because I think Lore might have a little bit more growth. It's a much smaller company, so it can make acquisitions that will actually move the needle. I think what TransDigm is what now these days. I think TransDigm is like a $60-70 billion company. TDG. Sorry, I always get the ticker wrong. TransDigm Group, 77 billion versus, Lore Holdings is 6.1. So I think there's some opportunities that Lore can go after that TransDigm can't, and that might be the bullish case for. But TransDigm has been one of a fantastic business for a long time. I mean, when you're so profitable that you get dragged in front of Congress like once every 4 years because of the profit margins on products that you sell to the defense industry, and nothing happens despite every 4 years getting shamed in front of Congress, that typically means it's a pretty good business.
Jeff was saying, any room in the pet space for Bark? It has performed terribly. Yeah, that is an example of a pet-oriented stock that has really struggled, to say the least. So they're another one of these pet businesses. They provide products, services, and content for dogs, primarily through like subscription boxes, personalized meal plans, health and wellness products. So a very different type of a model than a company like Chewy. So they've been known for their Bark Box, which is a monthly themed box of toys and treats. I think another one of their subscription services also has like chew toys. They've got one that has different personalized meal plans and supplements. They do sell some of those essential items like, dog beds, bowls, collars, harnesses. But a lot of their model has been around these wellness and, toy and treat oriented subscription boxes, which has not proven to be a particularly durable model for the business, and is certainly an area where you could fathom that cash-strapped consumers might not want to spend money on recurring deliveries of these sort of I don't want to say frivolous items, but not essential items for your pet, right? You're going to buy your pet food and you're going to pay for their healthcare and all these other essential things, but you might not want to pay for a fun subscription box every month to your door of extra goodies. That might not be in the budget for everyone. They have been struggling on a financial basis, and that has very much bled into how the stock is performing. I actually wanted to see how shares are down. Okay, so shares are down about 26% year to date, up 14% over the last year, but the stock is now trading for just $1.40.
It's only down 88% since it went.
It's only. I know. I was trying to lend a little bit of positivity there. Like, it's down double digits, but there's been like a slight increase over the last year.
It's now a $240 million market cap company. That is becoming borderline penny stock.
That's what I was going to say. That's not looking so good, and they're losing money hand over fist as well.
I would say it seems like there's a little bit of a theme here with these subscription delivery monthly sort of concepts, because I'm trying to think of one that has been wildly successful. We had food, we had was it HelloFresh, Blue Apron, all of that group. None of them have performed terribly well. I can't say Stitch Fix hasn't exactly been knocking it out of the park recently. This monthly subscription box model, I think, is incredibly hard. Like your churn rates are incredibly high. Your customer acquisition costs tend to be very high because you're offering these huge deals to get people in the door, but there's nothing there to retain them over the long term. So I really kind of struggle with this business concept, not just Bark in general. Yes, I think doing it for pets is kind of silly. But then again, I have African street dogs that sleep 20 hours a day. They're like mopey lions. But that's beside the point. But this subscription box model of we'll deliver something to you once a month. The economics have been for those businesses over the past 5-6 years have really struggled. I'm wondering if either Rachel or maybe even some people in the comments, is there a shout out to one that's really working? Because I'd love to know which ones are actually working.
Yeah, and I think you're right that the economics of it are very difficult to sustain, and it's so different than a business like Chewy and how they operate and just what their fundamental model is based on. And I almost think for a business like Bark, maybe it would be more efficient as part of a bigger operation like a Chewy, but as a standalone company, I just don't see the opportunity for them to have a lot of upside or to necessarily get that business back on track, unfortunately.
I want to hit this one from Jeff from 17 minutes ago. Again, not trying to delve too much into politics, but Jeff asks, what are your thoughts on the effect of Liberation Day on the markets, hoping it will. Well, sorry, quotation marks, Liberation Day on the markets, hoping will relieve some uncertainty. The Liberation Day is a reference to, I believe, to kind of like tariff announcements coming from the current presidential administration as like, you know, what the liberation is for. It could be, is up for debate. But I want to go on to the concept, the uncertainty part of it. And one of the things that I feel like the first 3-4 months, the time that we have spent under these tariff regimes, I don't know if it relieve uncertainty. And there's here, I'll just give the mechanical reason why is because so much of what has gone on in the tariff regimes have been a one-sided negotiation with the executive branch of the government being able to implement them without, you know, laws passed through Congress and things like that. It's discretionary actions taken by the executive without, you know, kind of, we'd say the normal lawmaking process, because typically Congress are the ones who set tariffs. So with that in mind, and it, you know, kind of having this on again, off again relationship with tariffs already, I don't know if it'll bring any more certainty, because I highly doubt that any of these will be necessarily set in stone. One of the what was it? I'm sorry, a Yahoo Finance article that I just happened to read on this in the moment was like, there's discussions of already talking about carving out exemptions before this Liberation Day on a country by country basis. Basically, like if they can negotiate some sort of deal with countries on an individual basis, they'll be exempt from these. The number of for these tariffs seems to be changing day to day. The most recent account over the weekend was 20% tariffs across all imports. Whether or not that happens, I don't know. But in terms of the certainty, uncertainty kind of spectrum of it, I'm less certain on whether, you know, this is actually going to make it better or worse in terms of uncertainty, because again, all of these decisions are being made unilaterally at the executive decision and can be as easily reversed. And so I don't really know if that brings any more certainty, because as we've seen so far, it can change in a minute's notice. It can change with a phone call between two country leaders. And, you know, we can be delayed for 30 days or 90 days, or they can be moved up or down based on the results of that phone call. So, no, I wouldn't say it makes it any more certain. Sorry to, you know, perhaps I'm that's a little too political for this call, but that's kind of my take on it.
Yeah, I think based on the rapidly evolving dynamics of these tariffs that we have seen so far in terms of just official pronouncements, and then a lot of talk that we've seen come out ahead of what might be more concrete numbers that are announced in the next few days, I would not assume that any iteration that we see is going to necessarily be what the final tally looks like, because as you mentioned, Tyler, we're already, you know, hearing about a lot of potential exemptions and changes. We've seen that kind of dynamic take effect over the last couple months. And so, you know, while we've discussed a lot of the potential risks for different companies and sectors and industries, I wouldn't assume that anything that we hear on Wednesday would necessarily be the final iteration of what that's going to look like even a month from now.
Mm-hmm. We've got about 3 minutes left, and there's a question perfectly in your wheelhouse, but you're going to be on a 3-minute timer here. So Susan B asked if you follow Novo Nordisk, and I know I don't, and I know you do. So 3 minutes.
I do. I'm on a timer. Okay, go. Yes, I do follow Novo Nordisk, among many other healthcare businesses. This is a company that's obviously come to, I think, a lot of investors' attention in the last few years because they are the maker of Ozempic and Wegovy. So they have become one of multiple powerhouses within the GLP-1 space, with the other notable company being Eli Lilly, even though there are many other contenders like Roche, AstraZeneca, Pfizer, Viking Therapeutics, to name a few. Prior to the success of its GLP-1 drugs, this was a much slower growing business, primarily known for its insulin products. They have rapidly evolved since that time. In addition to Ozempic and Wegovy, Novo Nordisk is also working on the next generation of GLP-1 products. It is working on a once daily oral GLP-1 and amylin receptor agonist called amycretin for the treatment of obesity and type 2 diabetes. Eli Lilly is notably ahead of them and is probably going to be first to market with the first GLP-1 pill, but it's broadly expected that Novo Nordisk could be quite competitive in that next iteration and evolution of the space. But the most important upcoming candidate to watch for Novo Nordisk that they will probably be adding to their portfolio and hoping to seek regulatory approval for, I believe in Q1 of next year, is CagriSema. It's the sort of next generation GLP-1 drug. It combines semaglutide, which is the key active ingredient in Ozempic and Wegovy, with an amylin analog called cagrilinotide. It's administered as a weekly injection. There has been some negative responses in the market to some of the results that came out from the late stage phase 3 trials of CagriSema. Even though both of those trials met their primary endpoints, the weight loss that was achieved by participants was still a bit lower than what management had been projecting. But recently at a conference, management underscored that they still have a lot of confidence in this new addition and upcoming addition to their portfolio. They are still planning to seek regulatory approval for it, I believe, in Q1 2026. So broadly speaking, while they do have other areas of focus in their pipeline and in their portfolio, this is probably going to be the next major growth catalyst for the company if they garner approval. So those are some things to follow with the business since I only had 3 minutes. How did I do, Tyler?
You got actually in 2. So nice job. We could even do like valuation if you wanted to, because you got so much extra time. But you know what? They're going to cut it short anyways, because I know that Jim Gillies, Emily Flippen, and Nick Sciple will be coming in and starting off the Motley Fool morning show. Perhaps there's some thoughts on Novo Nordisk. Perhaps there's thoughts on tariffs, because obviously tariffs was a big story over the weekend, and I'm sure that there's going to be just some discussion with that. But with that, that's the end of our hour. Emily, thanks for thank you, Rach. Holy crap, I've run out of words.
You can thank me too.
You can thank Emily. It's okay.
I did do so
Rachel,
much
thanks
work.
for joining us, and enjoy the morning show, guys. Have fun.
Thank you, guys.
Thanks, Tyler. Thanks, Rachel. Good morning, fools, and welcome to the Monday, March 31st, 2025 edition of the morning show on Motley Fool 24. I'm Nick Sciple here with my friends and colleagues, Emily Flippen and Jim Gillies. How are we doing this morning? Last day of the quarter. We made it.
Doing well, and spring is now in full force here in Maryland, so I have the windows open. Things are looking up. Well, at least I thought that until this past weekend of news. Can't have a weekend without a little bit of tariff talk, right?
We had a not where I am, but we had about an hour and a half, 2 hours north. I've got friends up there. They had a pretty severe ice storm, so half of northern Ontario has no power right now, and trees. They have the way she put it on Facebook. She says we've got about 24 less trees than we had yesterday. I'm like, what do you mean you have less of them? I said, well, we still have them. They're just slightly leaning down, or So it's been an eventful weekend up here, and one where you can largely ignore tariffs because the trees are falling.
That's right. You're much more urgent, clear and present danger, right? Well, let's talk about tariffs. Certainly in the news this morning, likely gonna drive some of the volatility we'll see in the market, throughout this week. Regular viewers of the morning show might recall we closed out last Monday's shows asking if maybe tariff and trade uncertainty had peaked. Sitting here today, that was wrong. NASDAQ and S&P, last I looked this morning, S&P down close to 1%, NASDAQ over 1.3%, 1.4%, something like that. This is in response to President Donald Trump on Sunday announced that the reciprocal tariffs, which are set to be revealed on April 2nd, are now going to include all nations, or maybe they will include all nations, rather than this narrower group of countries we were talking about with large trade imbalances with the U.S. It was supposed to be a narrower group that was going to be, we were talking about last week. These new tariffs, the reciprocal tariffs coming on Wednesday, are going to be in addition to the tariffs on auto, steel, aluminum, and increased tariffs on Chinese imports that have already been announced over the past few weeks. We demonstrated last week kind of the folly of predicting where these things are going, but investors can control how they respond and prepare for this volatility. How are you responding and preparing for this uncertainty we see in the market today?
Emily?
I'm doing my best to try to separate what matters from the noise here. And I think with the tariff conversation, there is a lot of noise, especially when it comes down to individual policies, individual countries. It's great to a reminder to us to kind of fast forward 5 years, let's say, and think about how much of what we're hearing regarding tariffs really will extend and matter for these many times great businesses 5 years from now. That being said, there is, I think, some fair concern around the impact this can have on GDP growth. We already see a decline in first quarter GDP. Now, of course, it's always hard to separate what this decline is attributable to. And sorry, these are projections, CNBC projections for decline in GDP. But I would imagine a fair number of it can be scoffed up to the fact that these businesses and organizations are living in an uncertain environment, don't know how to handle tariffs, and are making business decisions as a result. And to the extent that we fast forward to, I believe Wednesday is the second, right?
Yeah,
to the extent
right.
that we fast forward to Wednesday and we see tariffs coming online in a stronger, more wholehearted effect than I think we even anticipated next week, that may indicate forward-looking projections for GDP growth that, again, look worse than what was previously expected because businesses don't know how to make decisions in this environment. Now, I try to imagine 5 years from now, what could be the fallout from that? And there is the question of, okay, do these policies ultimately drive us into something like a recession or an economic downturn that may take a long time to climb out of? We can speculate on that, and I think that's probably where my head goes in terms of how I'm thinking about handling in this environment. But I will say it's impossible to say right now. Just like it was impossible for us to say last week, these are the countries that are going to get hit by tariffs. This is how it's going to be impacted. A year from now, 5 years from now, we won't know where the state of the economy is, and that's why it's important not to make short-term or make long-term investing decisions based off of these short-term dynamics.
So I've got a whole host of thoughts. Some of them might even be right. The first thing as my daughter starts blowing my phone up, so I'll deal with you later. The first thing I think of is I stole this from Bill Mann, and I'm pretty sure he stole it from Richard Zana, who's a money manager. A lot of the time, if you're not fighting the urge to puke when you hit the buy button, you're probably paying too much. We haven't really needed that quote for much of the last decade. Even COVID aside, the COVID drop was 35% in a month and a half, and then it was off to the races. But I wonder if we're coming back to that era where, if I don't feel like I'm going to yak, am I paying too much money? To build on what Emily said, the first quarter Q1 forecast, as per a survey of 14 highly prominent economists, as opposed to dentists who recommend Colgate, 14 economists, I'm just going to go with that, forget the superlatives, is expecting that Q1 GDP and last day of Q1 GDP will be 0.3%. Now, Q4 was 2.3%. And they threw in two words that I wish more people were putting together, but at least CNBC is doing it. Those words are indeed, Emily, tariff-related uncertainty, and the word stagflation. Now, I am old enough to sort of kind of remember stagflation, largely from 72 to 83. I remember the tail end of that, fools. And stagflation is no friend to stock market investors. The stock market went essentially nowhere during the last large round of stagflation, which was largely brought on by the oil crisis of the 70s. So that condition doesn't seem like it's going to repeat right now. But we're going to have other wonderful shocks from the tariffs and what have you. And as Nick and Emily have both said, who knows how it's going to look? But then you start, so a stagflationary environment, not good for stocks. Tariffs, massive uncertainty. And uncertainty not only does things like businesses can't make decisions, as Emily said, from day-to-day productivity, but like you've got, I'll throw one stat out, and it's been making the rounds of Twitter, and there's always a little political stuff, so you should kind of ignore that as best you can. But like one impact of the tariff uncertainty from your friends to the north, so myself, and we're going to include Nick here. He's an honorary Canadian. You work with Team Canada. You're honorary Canadian.
Oh, sure.
We'll give you credit. That we got to work on that accent a little bit, though. It's pronounced hoser, eh? But no, like the stat running around is that advanced bookings from like April through the end of summer from Canadians traveling to the US is down 70%. We understand we're a smaller country relative to you. We get that. That's going to hurt. Okay. That is. And I don't think Americans are going to make up that spending. And it's not just Canada, it's other nations who are choosing to vacation or travel elsewhere. Okay. That is an impact of the tariffs. Someone in the Slido chat, and I know they've said it before on a couple other things, but I'll sort of answer their question. They're asking about MedPace, which of course is a company I like and follow and recommended several times and own, asking about the tariff impact on that. And I would say there's not really a tariff impact on them. However, who are their biggest clients and customers? Well, they tend to be small biotechs. They tend to operate down towards the small single molecule, single drug end of the space. They're not doing a lot of work for Pfizer, okay? Those smaller companies feel the pinch of uncertainty. However, whatever the trigger is, whether it is tariffs, whether it's stagflation, whether it's a Canadian team winning the Stanley Cup, whatever is causing uncertainty for them, it's the smaller and like kind of the 1 and 2 trick ponies. They start feeling uncertainty and they start saying, hey, we're having trouble raising money. Hey, maybe we're not going to spend that much money this quarter. Because of the uncertainty that may have been triggered by tariffs over here, they feel it and they lower their economic output or their plans, and that impacts MedPace. So this is going to touch pretty much everyone. All of that sounds really dire, and I spent way too much time talking about the dire. What am I going to do in this environment? Not much differently. Saving every paycheck, contributing it to, in the case of my Fool, RRSP, 401k, that's indexed. Our personal money, a portion of that's going to index as well. There are our regular savings outside beyond our work stuff going to, every paycheck. We pay ourselves first. We don't stop. We look for good prices. I'm perhaps more looking for more opportunities to be kind of fighting off, fighting off nausea as I hit the buy button. So that's kind of where I am. And also just kind of watching and saying, there have been many times of great uncertainty in the past. We seem to have gotten through them. My bet is we'll get through the current uncertainty as well. I don't think anyone will take the other side of my bet, but please, if you would,
Yeah, exactly. The stock market's long-term returns, bake in all kinds of uncertainty, recessions, all manner of things, and the economy continues to, over the long term, people want to produce more and improve their quality of life and work hard and those sorts of things. So, I mean, for me, Jim, you mentioned kind of nausea. I've used this analogy before in kind of uncertain market, environments. I don't know if y'all have ever been on like a big boat out in the middle of the ocean, but it can be kind of choppy. You're moving around a lot, and especially when you're in kind of more turbulent environments, which I would say this is certainly one of them. When kind of the winds are blowing quicker than ever, it can help if you're looking right over the edge of the boat. It's pretty easy to get seasick. You're kind of focusing on the kind of chop near to you. But if you're focused on the horizon, if you look out as far as you can see to what isn't moving, you can kind of, I guess, fight through the seasickness and kind of avoid that sort of thing. I think that same type of thing applies in the market as well. If you can focus on the long term, what is going to still be true 3 years from now, as Emily was talking about, 5 years from now, I think, especially in turbulent environments like we're in right now, more important than ever to focus on the long term. And to the extent there's high quality companies that have pricing power, even in a difficult economic environment, maybe there's some opportunities to add those to your portfolio, knowing that there's there could be more uncertainty coming down the line, and you might be underwater on that stock position, a week from now. But if you come back here in a few years, you might be happy that you made those investments. So focus on what's still going to be true a few years from now, not what is going to change here in a week or two, because I guarantee you something is going to change here in a week or two that you can't expect. But if you focus on the long term, you can make high decisions that you have a lot of confidence in.
Well, and also we're gonna, whatever happens tomorrow or Wednesday, whatever it is, Liberation Day, somewhere the French are going, dude, that was our word. But they could be gone by Friday, right? Like I really like that we focus so far in the show on the word uncertainty, because I really think that caps pretty much the whole thing, and just where I wanted to make I gotta fix that light, where I wanted to make the just tell people, like, look, stagflation, not great for market returns. Recent years where we just had back-to-back years of close to 25% in each of the last 2 years in the S&P, like, those were very good years. I enjoyed them. They're not normal. Normal is 10. And so, in order to go in that direction, to get back to maintain the long run average, we're probably going to have some years where the market is disappointing. And I think that 2025 looks like it's shaping up to be one of those years where it's just, save, continue to invest. You've got autopilot investing. If you're not retired, if you're retired, it's a different set of challenges, obviously. But if you're not retired, might be a good year to, how we all went outside during the COVID years because we were all stuck in our homes, and all we could really do was go walk in the park. And I'm probably using the term wrong, but go touch some grass. Go touch some grass, people. We don't have to. I'm assuredly using it wrong, of course, as both of you are laughing at me. But
no, not at all. Actually, I'm laughing because you used it correctly.
Oh, that's okay. Then both of us are shocked.
Well, and there's a David Gardner quote kind of right on point to this, right? He says, in bull markets, he gets busy tracking his portfolio, and bear markets get busy living his life, right? So I think this is a time to not kind of stare at your portfolio and maybe enjoy the good weather out there. Let's talk about some things that might be true a few years from now. Some of those things that are going to be important in the market coming down the line. One of those things is AI. Everybody's been talking about it. One of those things that's been driving the strong market performance over the weekend. So an interesting AI headline was in our breakfast news newsletter this morning. Apple trying to get involved in the AI doctor game. Bloomberg reported over the weekend that Apple's Project Mulberry is hoping to have an AI doctor app on the market by 2026. The idea is to have the existing the existing Apple Health app, which is already collecting data for me on sleep and exercise and all various other things, would collect that data and pair it with an AI coach that would then offer users tailored recommendations on improving their health. Also working to train that AI agent using data from doctors it has on staff, and potentially will be hiring outside doctors. Also looking at moving into food tracking, competing with MyFitnessPal and other folks. This story stood out to me because if you folks who follow Dexcom, which is another company we follow in Motley Fool land, announced a partnership with Oura Ring, another health tracking company, back in November, where they're going to be doing something very similar. So my question for you guys is, how excited are you to have AI help improve your health outcomes?
I maybe based off y'all's expression here, I'm going to take a stab about how you feel about it and say maybe I'm the contrarian in the room. I think this is great. I'm actually, if anything, I'm surprised that Apple hasn't done this sooner. And I understand, I think the legality around a lot of the implementations of AI right now is still very much up in the air. So maybe you could argue there's part of the delay is just a question mark about, okay, at what point are we crossing a line, right? Where does the line exist? People don't necessarily know right now. But this is not intended to obviously replace a primary care physician, but rather use the health data that they're already collecting and find a way to inform somebody sooner rather than later is something is wrong. And there's already been so much evidence that Apple Watches and smartwatches in general have been great at kind of giving initial indication and flags, especially for doctors who incorporate that data into underlying medical conditions. So I think it's a great move on their part. I'll be interested to see, Nick, and correct me if I'm wrong, if this has already been announced. I didn't see it, but if it gets mixed into some sort of premium subscription, we already had news out from this, I believe it was on Friday, that Garmin, who's also a maker of smartwatches amongst numerous other things, is launching their own paid subscription services. Now, this doesn't connect back to health, obviously, at least not yet, but that move in that direction, I think, is happening. That we still live in the subscription economy. So I'll be interested to see if this is really a value driver, I guess, for Apple smartwatch users.
I'm more concerned about. I'm not terribly concerned about AI coming into the medical realm. In fact, I kind of welcome it, whether it's from I think as well. It first and foremost, if it can automate a lot of the mundane tasks in the doctor's office, I think that's a good thing. Like, so I know Emily is kind of looking for a little pushback, maybe. I don't have it on this point. I think it's actually pretty good. My concern when you start talking about this is it's more of a privacy thing, because there is so much data, and this isn't data showing how often I take the dog out every day to walk, or how often I go for a bike ride. This could be potentially a lot more. It could be a lot more personal, and it can be potentially. It can be potentially problematic, because what if the data being used aggregated by AI finds its way into whatever insurance company is your provider? You could get barred for before you even know you need to be barred, kind of thing. I admit I don't fully understand how a lot of the U.S. healthcare system works. From what I understand from my American friends, neither do you. It's okay, but no, I would be a little more concerned about it kind of having some unintended consequences, because I think what we've learned from history is everything has unintended consequences. But the overall, kudos to the name too. Mulberry is great. A little homage to Dr. Seuss there, I think, as well. But no, I think it's good. I'd be worried about privacy concerns. I would be worried about the possibility that those privacy concerns could result in bureaucratic nightmares for people on the receiving end. But overall, I think it's a net positive. But as is always the case, the devil's probably in the details.
Yeah, I think this is one of the areas of the market to maybe pay attention to. We're really moving into this kind of health tracking, regime. I guess these devices are more popular than they've been in a long time. You look at these Oura Ring devices that have really come out of nowhere the past few years, and I think they've sold over 2.5 million of these rings. Apple's trying to go after them now, and I think you see Dexcom just last year was able to get their continuous glucose monitors offered over the counter. You can now just go get that from your local pharmacy. So I think we're going to come back here 5 years from now, and these kind of health tracking devices are going to be even more penetrated than they are today. And if we can make them even more useful than they already are, and attach some of that data back into the back to doctors and things like that, I think it can do really great things for health outcomes. I think Oura is one of the private companies I think to watch. If I was a company that was were to come public anytime soon, would be on the short list for me of one of those IPOs to watch. Mm-hmm. We have a question here from Cyber Mikey for Emily on where does Lululemon go from here. You mentioned before we hopped on that you had looked at the earnings at the end of last week. What can you tell us about Lululemon today? Yeah,
it's an interesting dynamic happening for Lululemon right now. I really like this company, long story short. The interim is looking rougher, I think, than I initially expected. That being said, I'm a little surprised by the market's reaction here. So basically, let me take a step back. Let's go back to Lulu's quarter, which I believe they reported after market close on Thursday. The quarter itself was strong. We saw earnings per share rise double digit. Now, a lot of that share buybacks. Growth was continued its slowdown. That was, again, to be expected. Where the market really started to get nervous was the guidance that management set up for the remainder of 2025. Now, a lot of the numbers I'm seeing used are without removing that extra impact of the 53rd week. If we kind of normalize
Last
it,
year.
which
Last year.
yes.
Yeah.
Thank you.
Sorry, it's just not this year.
No, I appreciate this. So, a lot of the numbers there can be a little tweaked based off that whether or not the comparable period had an extra week or not. But basically, they're continuing to guide for a significant slowdown in their top line. I believe it's 7 to 8%. And Jim, correct me if I'm wrong, because
it was exactly in the 7 to 8% range. Yes.
7 to 8% range for top line growth, which is significantly below where management has been putting up, of course, over the last couple of years. Unfair comparison or since the pandemic, but you understand part of their big initiative here. They have a overarching strategy, the power of 2 times 3. The name is ridiculous. But it includes getting
the company's named Lululemon. Okay. Like, come on.
Naming things isn't exactly their forte. But they are guiding, or their intentions there were for double-digit top-line growth. This is below those previous projections. Of course, they're still ahead of their initial guidance for the strategy because the previous year's growth has been so strong. But a lot of what the market is latching onto here, and the second dynamic that I think is really what's getting the narrative as opposed to underlying business, is around consumer spending and almost this disconnect between the Lululemon leadership team and where consumers actually are in terms of the demand cycle, with leadership kind of coming out. And I went through the call. I didn't exactly read into it the same way the market is reporting it, but some tone deafness potentially coming out from management here being like, why aren't people buying our stuff? And consumers being like, well, I don't know, maybe it's because it's $200. Now, of course, Lululemon has a premium brand. They don't discount. That is part of their strategy. When times get tougher and people tighten their belt strings, we do tend to see a decline in sales, of course, for consumers across the board. But unlike other consumers that attempt to drive demand by cutting prices, Lululemon does not take that strategy, right? They're not trying to do the Under Armour thing. At least it's a good thing, in my opinion, not to potentially devalue their brand during better times. But this is the fallout of the consequences of that, which means that some consumers will be priced out of making upgrades to their Lululemon leggings. Big picture, I don't see any big concerns here for Lululemon. I actually think a lot of their new product launches that are coming over the course of the year may do better than management is expecting. And I can understand guidance should be a little bit conservative in an uncertain environment. Gosh, it's like unprecedented times, and everyone kept saying that during the pandemic, the uncertain environment we're living in regarding tariffs and consumer spending. I understand conservatism is valued there in regards to guidance. So I think if people are willing to stick with Lululemon here, 5 years from now, again, going back big picture, 5 years from now, I'm not sure this matters much. But Jim, tell me what you think. You seem familiar.
Yeah, we covered this on Friday. I've said
sorry
before,
for repeating then.
No, it's fine. I've always really had a soft spot for Lululemon. Maybe it's because it was a Canadian company originally. But then, maybe I should be angry at them because they gave up their Canadian listing and went exclusively on the US. So go to hell, Lululemon. Anyway, no, in all seriousness, I very much like the story. I think you covered the main points there. The one thing that I think probably spooked the market as well that I don't think we've really talked about is that basically the growth in North America is basically flat, and it's outside of North America that's driving it. And then you start getting worried, like, is extra North America growth similar profitability, and they've got other challenges outside of North America. So you really want North America to get kickstarted again, but as we've beaten to death already, uncertain times causes people to pull back their spending, and then consumer spending comes along or takes a shot, and all of a sudden you get a 15% downgrade on Friday. Yeah, I'm of a mind that probably 5 years from now it doesn't matter that much. But again, the word stagflation being thrown around is bothersome, and I think people should understand why. If it's correct, again, like, you're setting your, historically stock markets don't do well. It's 2 to 3% annual returns on stock markets, frankly, which is what it did from 72 to 89 or 83. It just becomes a whole other series of challenges, and and the problem with stagflation is it's not very transitory. stealing that word from, was it Jay Powell that used the transitory inflation line back in the day? It tends to dig itself in, and then there tends to be one way to blow it up, and that one way is probably not the preferential direction of most governments who are participating in the tariff spat at the moment, because the way you combat that is you generally jack your interest rates up significantly. And it's a good thing most countries in the world aren't heavily indebted and maybe want to keep interest rates low to be able to afford their payouts, right? So it is. I think it's a great company. I think it was a fine quarter. It wasn't a great quarter. It was a fine quarter. But I think it's a fine quarter out of a great company. I just think that if we're not talking about 1 or 2 quarters of reined in spending, this price might not be done dropping. We'll put it that way.
Yeah. I guess my question for you guys, and it really was where you have to come out with on Lululemon, is we're in this challenged retail environment for sure. And Lululemon's not the only one who has put that out there, right? Abercrombie & Fitch has talked about it, American Eagle. I mean, lots of different, Urban Outfitters, I think, as well. So it's certainly something that's affecting everybody in retail, but there has been concern for a while about, listen, everybody is going after this kind of athleisure segment, and in an environment like this, where with challenges in the end consumer, it can be difficult to separate kind of competitive threats from kind of macroeconomic stuff to dismiss. I guess, how do you think about Lululemon's competitive position today and kind of ability to kind of maintain share? Because you could point to that slow growth in North America and say, listen, you've got, they're the big woolly mammoth, and everybody, all the big competitors have got their spear in it and are slowing it down. I mean, you could point to at Urban Outfitters, Free People of Movement has been a massive grower. I mean, Aerie's offline brand has been a big grower for American Eagle. You point to Aloe and some of these others. How do you, I guess, weigh the competitive kind of aspects of what's going on here as compared to the macro and just weaker consumer? It's an unanswerable question, but just that's kind of what you have to. That's kind of what you have to weigh here to make a decision.
I'll repeat the point that I made on Friday again, because I'm nothing if not playing the hits on Monday. But one of my formative opinions on Lululemon, which is kind of a weird thing to say, but it really was during the see-through yoga pants era, which I believe was 2012-ish, somewhere in there, 2012, 2011, maybe 2013. But it was, look, you own a company long enough, you're going to go through scandals, troubles, problems. Fundamentally good companies find a way and keep going on. So, but that was not a great time for Lululemon. As well, their founder, former CEO, said some really idiotic things, and he was suitably drummed out. Not a great time for Lululemon. And at the time, it was in my personal Lulu days before she showed up. So I was kind of between marriages, and and I was I dated various women, and this one woman I was dating at the time, we were actually talking about the Lululemon thing, and she was a fitness instructor, and as her part-time gig, and we were talking about Lululemon, and I was commenting on how we were at a restaurant that's kind of right by the campus of the university in town here, and you saw the brand everywhere, and the way she put it to me was, she says, Jim, what you need to understand, Lululemon makes clothing that makes women feel good about themselves. And I'm like, that might be the most profound piece of not stock analysis I've ever heard, because that is mindshare moat. That is competitive advantage. What that said to me, and I think I initiated a position on it in Motley Fool Options at the time, which is a service I was working on at the time. I think I initiated that position, the following week, because I'm like, that's actually really profound. And it was a bullish position, fools. It's like, oh, this stock going to go up. And I'm not going to say I was right. I'm going to say she was right. because I would not have gotten there if she hadn't like basically sat me down and put it that succinctly to me, because it was still very much a female focused brand at the time. I know they branched out into more male stuff now as well, but at the time it was very female focused. And I'm like, yeah, that is really insightful and I think really important. And most importantly, that type of insight is not being captured because I'm the guy that looks at the numbers, right? I'm not seeing that in the numbers. I thought that was really profound. So I don't know that in the 12 or 13 years since then that Lululemon has ruined that perception with their target market. In fact, I think they've cemented that perception with their target market, which is what continues to give me confidence and maybe even a little bit of courage in this environment with Lululemon going, yeah, stock got whacked on Friday. Stock probably going to get slapped around again today. We know from finance journals and finance literature that companies that basically companies that have an oversized market reaction to earnings, up or down, tend to trend in that same direction for the ensuing quarter until you get the next really, like, you might get 10% beat down on earnings day, but by the time you come to the next earnings day, you're probably closer to 20% down because it's just dribbled out. Same thing, it might pop 10% on earnings day. By the time you get to the next earnings day, it might be up 20% because it continues to trend upwards. So, I'm not rushing out to buy Lululemon today. I can't anyway. We have full trading rules, so it doesn't really matter. But with that earnings report, and because of everything I blathered on already, and because of the insightful things that Emily and Nick have provided, I'm probably going to be a standalone shareholder of Lululemon sooner rather than later, just because I think it's a fundamentally great company, and I think we might be getting a better price.
Yeah, I think since we recommended Lululemon, I remember at the time it was the cheapest Lululemon had been in like a decade on a relative basis. Now I'm looking at the decline here and I'm wondering if that still is the case. So let me see if I can pull up here what do you want to use? A price to earnings ratio? Is that a little too basic? It gets the point done. It gets the point
clicks
done.
Price to eyeball clicks. I don't know. Oh wait, no, we got rid of that 20 years ago. Okay.
I'll try to share screens here. Let's see if I can pull this off. Because I want you to just visually see. Oh, that's the wrong one. I'm sorry, guys. You always say
I have no ability to do this anyway, Emily. So I think only kudos to you.
Okay. Let me see here. I can get this out.
Well, while you're doing that.
Well. Oh wait, no. I think I got it. Okay. Can you see it?
No. I think the
maybe
show
Natasha
moderator
needs to share.
Yeah, I think Natasha needs to put it up. But while we're waiting for that, Nick, we have it in Stock Advisor Canada as well, I believe.
Lululemon, yes, we do. Yep.
Yeah, and I have no idea what the price was there, but I think that again, fundamentally good companies when they go on sale. And this may or may not be a sale. We won't know until Emily's graph shows. No, just kidding. But no, I think I'm stalling fools. How am I doing here?
It's all right. If we can't get it, no big deal.
Okay.
But basically what I wanted to show was the price earnings ratio, and you can use virtually any
valuation
metric, basically, because we really haven't seen a decline in margins for this company or anything that would imply, maybe earnings are incorrect or, free cash flow, whatever it may be. The cheapest it has been, I'm looking, it's a price earnings trailing right now of around 19 times. I don't even know if that takes into account today's, continued decline here because the market is opening up kind of soft. But that decline is the cheapest it's been in 5 years at least. And I'm expanding into the 10-year graph here. And yes, it looks like it is also the cheapest it has been over the course of the past decade. Now, granted, growth is slower. So it's understandable why, the valuation today will be lower. But if you're baking into, as we just talked about, Jim, the idea that 5 years from now, Lululemon won't be in the same position it is today. It'll still be a popular brand. International expansion is still very strong for them. If you're baking into that expectation, you could argue, and I would argue, that buying Lululemon today is the cheapest it has been since I've been investing. Anyway, but I will just quickly note in terms of the growth profile, because I know that 7 to 8% growth, we're all going to freak out about it, even though their price earnings ratio on a trailing basis is now below 20 times. But this stock is also, the business is selling nearly 30% sales in China. I keep waiting for the Chinese sales to slow down because it's slowed down everywhere else. China's still incredibly strong. Their international footprint is still pretty new. And I understand athleisure in the United States and North America is bigger than it is in a lot of other countries, but their retail footprint is incredibly effective. There's a lot of great things going for this company. And when I look at a great business who is being impacted mainly by outside dynamics, that worries me a lot less than when I see fundamental failures. The one hesitation I'll have is if their new product launches that they've been kind of working on here over the course of the past year, if some of these new launches once again go poorly, that may indicate to me we have an R&D problem, right? We're missing the mark. But as a Lululemon shopper myself, I can say I don't feel that way. And the public response I've seen to a lot of their new items has been pretty positive. So I don't think we're getting a repeat of what happened last year.
And I will just confirm what Emily was saying in terms of I pulled up the 10-year valuation, relative valuation chart in Y charts, which I'm not going to try to share, but I can tell you that the current 19, or it's Friday's close, 19.48 times earnings is very much the lowest it's been in the past decade. And anyone else have fond memories of the 96 times earnings we were paying in during the pandemic of 2020? Good times. Shareholders have made nothing since then, unfortunately, but it's gotten a hell of a lot cheaper.
All right, let's go maybe to some questions. Let's see. I mean, there's one I can try to take a crack at. Earlier on the show, mentioned Dexcom in the context of what was going on with Apple's new health initiative. BLSH says, Nick, any news on Dexcom? Competition from Abbott having an effect. So Dexcom is down about 50% over the past 12 months. That vast majority of that downtrend or price decline came back in July when they reported earnings. Earnings came in a little bit weaker than expected. Part of that, or a big part of that, was they lost some share in the durable medical equipment channel. So that's traditionally the channel through which continuous glucose monitors, which is what Dexcom sells and is market leader in that market. Traditionally, how those are sold. So when you would, if you're a type 1 diabetic, you would go to your endocrinologist, and your endocrinologist will set you up with your glucose monitor. You'd order it through the durable medical equipment channel. You would do it that way. Over the past year or so, I mentioned earlier that Dexcom Stelo product, Abbott also had an over-the-counter product that was approved where you could go buy this directly from your pharmacy, and increasingly the pharmacy channel is becoming the primary way that these products are distributed. So the way Dexcom has explained this is that, hey, we're really scaling up our sales force in the year 2024 to try to get ready for that transition to the selling through the pharmacy channel, and as they're increasing penetration in type 2 diabetics, also selling through primary care providers as opposed to these endocrinologists. And as part of that transition, that's what led to some of the market share declines in the durable medical equipment segment. Basically, they weren't spending as much time focusing on it during this transition, and they lost some share. Now management has come back and said, hey, we realize this is a problem. We're going to address this year in the year 2025, and expects they should be able to get back the market share there. So why the stock sell off so much? I mean, historically, this has been a 20% plus grower, a beater and raiser, and then you had an environment where they miss what the market was expected, and there's potentially some concerns about market share. That really explained the sell off. Also, you layer on top of that what we keep talking about, what they were talking about right before we came on here, this Ozempic GLP-1 craze and concerns about how does that affect Dexcom's addressable market? It's not going to affect demand among type 1 diabetics. These are folks that are develop diabetes as children, and it's a congenital issue. But for type 2 diabetics, this is something that you develop over time as a result of diet and kind of lifestyle. And to the extent these drugs limit the number of folks who end up as type 2 diabetics, maybe that slows growth. So I think those two areas of concern are really what drove the stock down. For me personally, I think now is an interesting time to maybe dip your toe into the stock. I've actually done that myself not too long ago. As we're entering 2025, we're still seeing increased pharmacy coverage among type 2 diabetics for these continuous glucose monitor products. They announced back in January, 2 of the 3 biggest pharmacy benefit managers in the U.S. have added coverage for CGMs among type 2 diabetics, expecting that to maybe grab the third of those this year in 2025. The concerns around Ozempic, I think, are a little bit overblown. At least the data that we've seen so far, doctors are often prescribing Ozempic in conjunction with these GLP drugs, so they can kind of monitor its effectiveness and be better at titrating the drug to make sure the dosage is correct based on that kind of individual patient. So I think a lot of these concerns, I think they're going to get back on track in the durable medical equipment channel as they kind of refocus there. I think long term, some of these concerns around GLP drugs are going to impact diabetes treatment, but I don't think are going to eliminate demand for these continuous glucose monitors. So and then there's also been some headlines. They got an FDA warning letter not too long ago related to their kind of manufacturing of these continuous glucose monitors. That said, hasn't resulted in any recalls, hasn't resulted in any disruptions in manufacturing. So created some concerns around the headline, but not really material to the business. All that to say, I think there's a lot of kind of headlines that there were a negative that have really driven the stock down here. But I think long-term Dexcom's importance as a business and kind of opportunity to be standard of care in diabetes, and long-term also to expand into more kind of health applications, as we were talking earlier with Oura Ring. I don't think the growth story has been broken, although there's certainly lots of things you could point to and say, hey, aren't you worried about this? Aren't you worried about that? I don't think it's really disrupted the importance of CGM long term. And I think that the guy mentioned BLSH mentioned Abbott as well. Abbott's always going to be an important competitor. Dexcom and Abbott are really they're kind of constantly chasing each other back and forth. So I wouldn't overreact to any kind of short term kind of headlines around market share. There's been times when Dexcom has been ahead, and there's been times where Abbott's been ahead. Long term, I think the two of them are going to be the dominant players in continuous glucose monitors. Okay, I've talked for too long. What are some questions that you guys want to talk about?
Emily?
I see a question here early in the show, which is a fun one, mostly because it's not related to some of the stuff we normally spend the mornings talking about here. And this is a question from David in Oregon. And maybe you'll like this one, Jim, because it's a cannabis stock.
What are you saying?
So it's a related cannabis stock. David asks, what are your thoughts on IIPR? Their dividend has been great. I'm just wondering if it's a catching a falling knife sort of situation. So for anybody who's unfamiliar, IIPR is Innovative Industrial Properties. They are a cannabis-focused REIT. So effectively, when cannabis started to become legalized on a state-by-state basis here in the United States, a lot of cannabis companies were like, great, let's sell cannabis, as one does. And then they realized, oh no, we have a lot of laws and restrictions on a state-by-state basis that we have to adhere to. And a lot of those states, including big states like Florida, with their medical cannabis laws, et cetera, they require something called vertical integration, which means if you're going to be selling a cannabis product in that state, they require you to have your greenhouse and everything grown in that state as well. And obviously you can't transport a federally illegal substance over state lines. That's also a federal crime. So a lot of cannabis companies who wanted to meet the new markets for cannabis related products, both medical and recreational, needed a lot of upfront capital. And because of the status of cannabis legally in the United States, that prevented them from getting access to banking. So Innovative Industrial Properties came in and basically was like, let us act as that middleman. We'll front you capital, right? Effectively own the underlying land that you grow on, that you sell on, whatever it is, and you pay us a lease under these really lucrative triple net leases. And because Innovative Industrial Properties is a REIT, that has required them to pay out 90% of their pre-tax income as dividends to shareholders. It's a very lean team. Last time I talked to them, which admittedly was a long time ago, I think they had 7 employees, just to give you an idea about the size of this company. It's and there's a lot of great things that come out as a result of that. This is a very shareholder focused company, a management team who knows what they're doing. That being said, the status of cannabis has not changed as rapidly as I think a lot of people expected it to change over the course of the past few years. And a lot of their largest clients were private cannabis companies. That's one of the key risks associated with innovative industrial properties. They have clients, cannabis companies, and for the ones that are public companies, you can go in and you can see, okay, what does this company look like? Do I think they're going to be able to make their lease payments? And just a couple of examples, I pulled up their most recent 10K here, so I had the most recent numbers, which was released in February. Some of their public companies, Green Thumb Industries, Curaleaf Holdings, these are companies that are really well capitalized. Cresco Labs, True Leaf Cannabis, right? These are some of their clients that are all, they're not just cash flow positive, but they're actually profitable. The risk of them, and they have great locations, the risk of them defaulting on their leases, relatively small. That being said, some of their largest companies are private cannabis companies. So when I had first looked at this company a number of years ago, their largest one was a company called PharmaCann. And now I'm looking at their most recent 10K. It looks like they also have, although I see the cannabis company, I believe it's a public company of its own accord right now. That's their largest property holder. This is all to say, some stuff has happened over the last few years. These cannabis companies, many of them, which, when they're giving out these leases, looked in a different financial position than they do today, have started to default on their leases. And PharmaCann is perhaps the biggest one. And that's part of the reason why I've seen a decline in innovative industrial property stock over the course of the past year or so, is because of the defaults. And we're seeing another decline today because one of their other public companies, I believe it's Forefront Ventures, they're also announcing that they're defaulting on some of their leases as well. Obviously, defaulted leases equal no more rent payments equals worse for shareholders. It's understandable why the shares have declined. I will say the amount of money that innovative industrial properties has made on these companies, both PharmaCann and Forefront and others over the course of the past years, pretty lucrative contracts, even considering the defaults. But you have to wonder if management started to underwrite some of these deals.
Underwrite's a good word.
Okay, good.
I like that. Yeah,
I did underwriting before I came to the Fool, and I don't know if that exactly translates to one-to-one what this lean, mean 7-person team over at Innovative Industrial Properties is doing. Anyway, this is all to say that these are pretty lucrative contracts. It's unfortunate, though, that we're seeing some of their largest customers start to default. And just looking over their most recent 10K here and seeing that out of their 67 properties that they had in February, 21 of them are now with the cannabis company, which, again, public company. So I pulled it up, who is unfortunately not one of the businesses that is generating positive operating income, positive cash flow. That is particularly concerning, because if we see more defaults, then to actually answer this question, it very much could be a situation where buying today could be catching a falling knife, depending on how many defaults continue to come out from a lot of their key customers. That being said, shares are relatively cheap for a REIT, understandably, because there's so much uncertainty with their core client base. This is an incredibly profitable, well-capitalized business. And there's still, unfortunately, with the lack of banking regulations, there's still a fair bit of demand there for cannabis companies that do persist.
And that's probably not going to get better. Just quick personal story before I ask a couple questions. I have one rental property. It's the house. But we looked at it was a fourplex actually near where we have the other one. And the price looked really great. And why? And then, and remember, I live in Canada. Cannabis has been legal since October 17th, 2018. Fully legal. Okay. So what's that? We're almost 7 years into this here, 6.5 years into this. And the world didn't end when we, with all due respect, having it legal, having it not legal, makes really very little difference in your day-to-day life, frankly. But we looked at this fourplex, and I talked to my real estate agent buddy, and he said, Jim, that house was a former grow op. You will never get financing for that house. And I'm like, well, I ain't paying cash, because that defeats the purpose of using someone else's money to run a rental empire. It was very much like, even in a country where it is 100% legal, and we like to think we've largely ironed out the problems with it, you still can't get financing. So I believe there's a real, when I just heard about this company as you're talking about, Emily, and as I firmly buy into that. Oh yeah, they are providing a real service, because that capital, in a country where you have 100% legality, and and I'd like to think a decent potential buyer, the fact that you can't get financing is kind of nuts to me. But what as a REIT, what is their distribution? What is their yield? Even because it sounds like, correct me if I'm wrong, it sounds like they've been slapped around a little bit. Yes. Otherwise, they
right
wouldn't be
now
asking
it's.
the
Do you
question.
want to take? Do you want to just guess?
My inclination is you're going to tell me it's lower than I would probably want, so I'm going to say 9%.
What do you want?
I want 9%.
Okay, how about 15?
Okay, yeah, that's see, I can give you a couple of grocery store REITs that are make 8-9% right now, and and no one's coming for grocery store. No one's coming for grocery stores the way they might be coming for cannabis providers. So, I think 15%. Now, is it safe? Well, in your opinion, is it safe?
No, of course not.
Yeah.
Okay.
Their most recent press release, they just announced about 11% of their gross rent defaulted.
That's PharmaCann.
Yeah. Okay.
PharmaCann and Forefront Ventures, which I'm looking. PharmaCann itself is 17% of their total contracted rent. Forefront Ventures only 3%, but a fair number of properties.
Are any of these companies publicly traded that you can go look at them? I think you've said one was. Yeah.
A fair number of them are. So that's what I say. A good news is that their top three after that: Ascend, Green Thumb, and Curaleaf. And I can speak on behalf of Curaleaf and Green Thumb.
Okay.
Strong, well capitalized, positive operating income, positive cash flow companies. At least last time I looked at them. Let me double check Ascend.
Yeah, 'cause I would want to know that they have the ability to pay my rent.
Realizing.
No, if they're not public, not public.
So for me, the dividend looks optically attractive. However, you've still got defaults coming through. It could be cut. You've also got the risk of, to the extent you get U.S. cannabis banking passed legislatively, or you get some type of regulatory change, maybe their ability to demand those great terms goes away. So you're kind of making the bet that we remain in our same political environment, and that they can kind of replace those tenants. And I think that's not something I would want to necessarily bet on personally, given that you can get cannabis companies that are cash flow positive trading at cash. Trading as nets, Warren Buffett value stocks. So yeah, it wouldn't be my preferred way to invest in cannabis, but if the current regulatory environment remains as it is indefinitely, it'll probably work out just fine. You want to be the debt segment of the business, not the equity.
And I will just quickly note, it's really interesting talking about the regulatory environment for cannabis companies, because in a lot of cases, I'm looking at Forefront, which is a publicly traded company, which is one of the companies that defaulted. If we had just descheduled cannabis from a Schedule 1 to a Schedule 3 substance, which still keeps it federally illegal, but changes the tax implications for state legal cannabis companies, I'm willing to bet money they would not have defaulted on their leases.
Yep.
All of their negative operating, they are paying out 2 or 3 times as much in income tax as they would have generated in operating income. The tax laws against these companies is absolutely insane because they aren't able to deduct any expenses. So even if we don't see, to your point, Nick, if I think the biggest catalyst we could see come for this company and cannabis companies in general is a descheduling, which this administration has different priorities. Each administration did. Even Harris didn't take up the descheduling the way that Biden did during her run for president. So unless we see descheduling, there's a chance that the defaults could pick up. But I think if we see descheduling, then the financial status of a lot of these companies look a lot better.
Yeah, just a double underline. Yeah, so if you're a Schedule 1 drug, which makes sense why the tax code would be written this way, you're not allowed to deduct ordinary business expenses for your drug cartel. However, if you have a Schedule 3 drug, which means it's been recognized by the, to have some medical purpose and that sort of thing, then you are allowed to deduct ordinary business expenses. And, those are expensive, right? I mean, when the typical business is, doing a 10% margin would be great, right? If you can't deduct any of that 90% of your kind of business costs from taxes, then obviously your tax burden is way higher, and that rescheduling would lift that tax burden immediately.
And for context, the effective tax rate on cannabis companies right now can get as high as 70 to 90%, whereas it should be, if they were profitable, 20%, 21%.
It's almost like they're trying to drive them out of business. Sorry, that's a little cynical, but
Well, it's actually
as
bipartisan.
someone who owned, well, I get
The
it, but as
support for it,
someone
yeah.
who was invested in online gambling stocks in the early 2000s, I like to say I was early. I was not wrong. But I didn't make any money on them. I made a little bit on CryptoLogic, but that was the problem, is that it was bipartisan support against them because, as you guys both very know in your soul, online gambling is one of the great moral evils of our time, which is why both sides of the political aisle were aligned against it until they could make money on it, and then somehow it became fine. Anyway, I'm not saying that politicians' morality is relative. I'm absolutely stating it as a fact. I had one question here I wanted to get to, Nick, if that's I'm sorry,
Yeah,
Emily.
we've
No, this
got
is the
time.
best way to start off the week.
We've got time for one more, Jim. Yeah.
What do I care? No, Jimmy G. That's not me. But people call me that sometimes. Notably the other occupant of this house. So maybe Lulu's watching for all I know, and she's using a pseudonym. Will Garrett Motion be affected by tariffs? If so, how negatively? Yes, it will. They make parts for cars, which is a directly targeted area of the present Trump administration. So yeah, they'll be impacted, and it won't be positive. But moreover, again, you bring in that uncertainty thing, even, because, sometimes the particulars don't matter. It's the perception that matters. And right now, the perception, it's going to be pretty negative for a lot of the auto space. Is going to be pretty negative for people who are, like, we talked about slowdown consumer spending. Through a weird quirk of fate last year, we replaced both cars. We bought 2 cars last year. Thank goodness we did. So we're not in the market for a confusing car experience this year. But other people, they might be driving, like, they're driving a 10-year-old Honda, and they're like, oh, we're going to replace the car this year. And that's like, Hondas, they keep their value pretty well, and, I can maybe repair it and we'll be fine. So yeah, it's not gonna be great. Now, the good news is Garrett is, without a sharp drop in sales, and there could be a sharp drop in sales, fools, but without a sharp drop in sales, Garrett will probably remain cash flow positive. They're well set up. They're well capitalized. They've got pretty decent backers who have a large stake. And they've been very aggressively buying back their own stock, and I think that'll probably continue as long as they are reasonably cash flow positive. So in other words, that may take a quarter or two for it to trail off. Maybe then we lose it, but for now, yeah, they're going to be impacted. Yes, it'll be a negative impact. I don't think the company is that poorly off, though. So once this passes, because it will pass, we don't know what'll come after, but this part will pass. It'll be, if they continue on their current path, I think they'll be setting themselves up for a decent response once we're through the tariff strangeness.
All right, folks, that's all the time we have today. Thank you to Emily and Jim for joining me for this edition of the morning show. Hopefully we were roughly good. We'll try to do even better next time. Now we're going to pass the ball to Rachel and Toby for a deep dive on GE Healthcare. Folks, take it away.
Cheers, fools.
All right.
Thank you.
Thanks, morning show team. We are headed into our deep dive, my friends. This is our normally scheduled Monday deep dive. I'm Toby Bordelon, joined today by Rachel Warren. How are you this morning, Rachel?
Good, Toby. It's been a minute. Good to be back on with you.
It is. We're going to have a fun show. We're going to have a fun show today. So let's get our questions. Let's get your questions at Slido. We are at slido.com, full 24 right now. And if you have questions on GE Healthcare or related around GE Healthcare, let's say, get those into the chat and we'll do our best to answer them as we move along here. Let's give our viewers a look at what we are going to be talking about today, Rachel. Let's see here. I'm going to share. I'll share my screen here, and then we can move on with this. So that'll come up in a second, and you'll see the agenda we've got going on for you guys. We're going to go through the business model quickly. Rachel will take us through that. I'll take a look at the financials. We'll go into some of the potential. We'll talk about the risk. We'll talk about the competitions. A little bit on valuation, I think. Yeah, we'll go ahead and get started. Let's move on this. And Rachel, maybe what we'll do here is you share, and then you can just kind of keep it up as we're moving along.
Sure.
So I think that'll work.
Yeah, I think that makes sense. All right, let me go ahead and get this pulled up here. I'll just take a minute. Yeah, this was an interesting one, particularly because this, as someone who covers the healthcare space pretty closely. Okay, let's see. I'm pulling this up. That should be popping up on the screen. There we go. As someone who follows the healthcare space pretty closely, this is a player that I have not really dug deep into previously before this deep dive. And so that was a fun kind of exercise for me as a healthcare investor and, someone who reports a lot on this space, and particularly looking at this company, given its history and the way that the company has evolved through the years. And so I'm going to be talking about what is GE Healthcare? What do they do? How did they come to be? What is their model? What are their different sources of revenue? What is the runway of growth for this business? But the way GE Healthcare describes themselves is a trusted partner and leading global healthcare solutions provider, working on innovating medical technology, pharmaceutical diagnostics, and integrated cloud-first AI-enabled solutions, services, and data analytics. This is a massive multi-billion-dollar business with more than 53,000 employees around the world. And one of the things I'm going to also talk about as well is the ways in which they are leveraging AI to revolutionize what the future of healthcare could look like, which is really intriguing and also exciting for me as someone who really analyzes these types of businesses regularly, to see real world examples of what that looks like in action. So this is a global medical technology company. They specialize in a wide range of areas of healthcare, including pharmaceutical diagnostics and digital solutions. And their business is all about providing these integrated solutions, services, and data analytics to clients to improve patient care and healthcare efficiency. Their goal is to improve everything from diagnosis to therapy to monitoring of diseases, with products and services that include medical imaging, ultrasound, patient care solutions, and pharmaceutical diagnostics. Now, they divide their reporting segments into these different areas. So medical imaging, this business includes molecular imaging, magnetic resonance, women's health screening, x-ray systems. They have their ultrasound business, which is focused on a range of ultrasound technology and solutions. Then they have their patient care solutions business, which includes things like remote patient monitoring, anesthesia and respiratory care, diagnostic cardiology, and infant care. And then there's their pharmaceutical diagnostics segment, which is all about manufacturing contrast agents and radiopharmaceuticals. For example, radiopharmaceuticals, one example would be the type of contrast you would take before you have a CT scan, that radiopharmaceutical liquid that they give you to enable better imaging. So they are investing heavily in digital solutions and AI to enhance their business. They're working alongside healthcare providers to understand really the unique needs and challenges that are facing the industry today. And they offer a range of flexible financing options for those clients, including unitary payment as well as pay-for-use models, to help healthcare providers manage their costs and investments. And one of the things that I found fascinating about this business as well is the way in which they are expanding their cloud-based solutions, like their Genesis portfolio, which I'm going to dive into a bit deeper here, in a minute, which is all designed to improve the coordination of patient care, reduce operational costs, enable easier access to medical imaging, and streamline the services that they provide to healthcare providers. For example, they're developing AI solutions for ultrasound, including real-time guidance for capturing diagnostic quality images that will improve scan confidence and workflow productivity. One of their software offerings that they've launched is called Caption AI. And essentially, it's an AI-driven software for rapid cardiac assessments at the point of care. And this has been a revolutionary and newer addition to their portfolio. But they've also been introducing AI algorithms that are embedded on their various X-ray imaging devices that help expedite diagnoses and also enhance patient care. Some of their AI-enhanced X-ray devices can flag critical cases on the device and send them to radiologists for immediate triage, potentially saving patients considerable time that would otherwise delay to treatment, if not for the incorporation of AI into these revolutionary devices. Something that they recently did is they are awaiting the review of the 510K that they submitted to the FDA for their new AI-powered fetal heart rate interpretation feature that uses deep learning to waveform data to analyze fetal heart rates. They've also announced a new AI-centered application called Care Intellect for Oncology, which can quickly summarize patients' histories, monitor disease progression, and identify relevant clinical trial data, saving healthcare providers really valuable time and effort that they can better spend with patients. GE Healthcare is also working with NVIDIA. They're working together to develop autonomous diagnostic imaging solutions, initially focusing on X-ray and ultrasound technology, but broadly speaking, leveraging NVIDIA's AI platform and simulation tools to create these AI-enabled systems. And the long-term goal is to create autonomous X-ray and ultrasound systems that can automate tasks like patient placement, image scanning, and quality checks. Again, things that can maximize the efficiency of seeing patients and ensure that healthcare providers get the time that they need to focus on patient health requirements. GE Healthcare also plans to leverage the NVIDIA Isaac for their healthcare platform, which is essentially built on NVIDIA's 3 computers that are utilized to build physical AI, including the NVIDIA Omniverse for robotic simulation workflows. They're also planning to use the NVIDIA Cosmos platform for synthetic data generation, reinforcement learning, and physics-based sensor simulation, which can help to train, test, and tune these autonomous ultrasound and X-ray devices that they're developing in a virtual environment before they actually deploy them in the physical world. And there's a range of very positive outcomes with this. Not only does it very practically reduce the physical strains that sonographers experience as they perform these very repetitive motions, but autonomous imaging could lead to faster, more accurate, more accessible diagnostics, particularly in remote or minimally staffed locations. We know that the healthcare industry has gone through a lot of changes in the last few years. There are still many healthcare providers and hospitals that are quite understaffed. You can see that there are a lot of valuable use cases for this type of technology. And by automating tasks, these systems could ease the workload on healthcare professionals, but also importantly, improve patient care by making diagnostics quicker and more accurate. Now, GE Healthcare's Genesis portfolio that I mentioned, this is a portfolio of cloud-based enterprise imaging solutions. These are designed to help healthcare providers streamline their workflows, improve data accessibility, reduce operational costs, and it aims to really address the challenges of managing increasing volumes of medical imaging data while also addressing very practical financial and IT constraints. So they offer these cloud-based storage services to help organizations redirect their time and resources from managing imaging data to focusing on higher value IT products. They provide this entirely managed software as a service archive solution that unifies and really intelligently manages patient data, images, and enterprise content. And this is another part of their software business. Something that is in the midst of its launch right now is the new NVIDIA ABUS Premium. This is a GE Healthcare AI-powered 3D ultrasound system, and it is specifically designed for supplemental screening in women with dense tissue to monitor and improve breast cancer detection and streamline exam readings. So this is an automated ultrasound system that uses 3D ultrasound technology and artificial intelligence. It captures the 3D volume of the tissue that can allow for a much more comprehensive and holistic view of the tissue architecture. And this has been found to detect more cancers than mammography alone. While AI features and the real non-invasive nature of the exam can also help improve efficiency and reduce unnecessary biopsies. This could be a valuable, game-changing product, particularly for women who are at higher risk of this type of cancer and whose cancers could be missed on mammograms because of the structure of their tissue. This is notably the first FDA-approved supplemental ultrasound screening technology that is specifically designed for detecting cancer in dense breast tissue. It's launching in key countries throughout 2025. Kind of fun to look at some of these.
Question, Rachel. When did that get approved?
I think this was just approved in the last few months. I can't remember the exact the exact date off the top of my head, but it's currently in the midst of its early commercial launch.
Okay, so very, very early on this. Cool.
Very early on. Well, and it's cool. And these are just some of the more recent, products, both software and hardware, that GE Healthcare has been focusing on. And it really goes to show the very diverse business model that it has. And this was something that was very impressive to me as I dug deeper into the business. A little bit of trivia. Their roots trace back to 1892, the merger of Edison General Electric Company and Thomas Houston Electric Company, which later formed General Electric. This was a company that had numerous iterations through the years. There was the Victor Electric Company, which later became a part of GE Healthcare. In 1896, GE began producing X-ray tubes, which was sort of the very early, foray into the healthcare business. Then in 1920, Victor Electric and GE's X-ray business merged to form the General Electric X-ray Corporation, which at the time was headquartered in Chicago. And then in the nearly century that followed, there was this broad and gradual expansion of the company's healthcare business. For example, even in the early 2000s, they acquired a CT maker company. They acquired a company called Medica Logic, which was a major creator at the time of electronic medical record systems. And then, of course, in 2021, they began the process to spin off their healthcare business. But again, those origins of the business can go all the way back to Victor Electric Company, which was originally founded in 1893. They initially focused on dental supplies and then later entered the X-ray machine business. And of course, GE, the original parent company, was formed by Thomas Edison and Elihu Thomson in 1892. But GE Healthcare became an independent company on January 4th, 2023, after spinning off from General Electric, began trading on the NASDAQ exchange under its current ticker symbol at GEHC, which marked a really pivotal moment in GE's transformation into three independent companies. It was a process that took a number of years to achieve. And it's worth noting, GE Healthcare has strategically acquired companies to expand its portfolio through the years. This is a company that has grown extensively through acquisitive efforts. And for example, in 2021, they acquired BK Medical, a leader in advanced surgical visualization. In 2023, they acquired a company called Caption Health, which is an AI medical technology manufacturer. They acquired a company specializing in imaging analytics and AI-driven solutions about a year ago in 2024. And then last summer, they acquired the clinical AI software business from Intelligent Ultrasound in July for about $51 million. Today, actually, and as I was finishing preparing the slides for this show, GE Healthcare announced that they had completed their acquisition of the remaining 50% stake in Nihon Metaphysics. It's part of GE Healthcare, NMP for short. It's much easier than saying the full name. Already a leading radiopharmaceutical company in Japan, and is positioned to enhance patient access to next generation radiopharmaceuticals that can enable detection and diagnosis of diseases. MMP's product portfolio includes a wide range of existing GE Healthcare radiopharmaceuticals. This is a company that's headquartered in Tokyo, has been around since the 70s. GE Healthcare had acquired a 50% stake in NMP a number of years ago through a different acquisition. And so the news today was basically that they are acquiring the remaining 50% stake in that business, giving them full ownership. So these are some of the major updates with the business recently, some of their most exciting and newer product lines and examples of what that looks like in the real world, what those real world use cases look like. How does their model work? So as they say, they're a trusted partner and healthcare solutions provider. And as we've gone over in the last 15 or so minutes, this is a business with a wide range of medical technology products, pharmaceutical diagnostic products, cloud-based AI-enabled solutions, and other services. And they generate revenue from all these sources, from the sales of medical devices, consumable products, service capabilities, digital solutions. And as they've noted, and hopefully I've demonstrated as well, their pursuit of precision care opportunities really expands their addressable markets as they are integrating these incredibly precise diagnostic tools and AI and machine learning-based clinical decision support into the very fundamentals of so many of their business operations. They're organized into 4 business segments: imaging, advanced visualization solutions, patient care solutions, and pharmaceutical diagnostics. So their imaging business, hold on. Their imaging business includes scanning devices, clinical applications, service capabilities. They've got their molecular imaging, computed tomography, magnetic resonance products, women's health, and X-ray. And then, of course, there is that newer imaging product I mentioned that is currently under its launch process that would also fall under this category. In addition to their imaging business, there are a suite of AI-enabled featured software and applications that help clinicians to improve productivity in using these systems, like X-ray systems, like magnetic resonance systems that produce very detailed images of almost every internal structure in the human body. And then in addition to these core products and accompanying digital solutions and offerings, they provide enterprise solutions to these healthcare providers that they sell these products to, like education, training, and data integration services. Now, their advanced visualization solutions business includes a range of areas. So there's their comprehensive care ultrasound, which is systems that produce images for screening, diagnosis, monitoring, and treatment of the whole body across a range of different disease areas. They have their health ultrasound systems that support different use cases in assisted reproductive medicine and obstetrics. They've got their cardiovascular and interventional solutions that help clinicians diagnose, treat, and monitor numerous cardiovascular conditions. They also have various surgical innovations that fall into this particular reporting segment. And this includes everything from advanced mobile surgical arms that are needed for surgical imaging and other surgical visualization solutions, a very diverse segment of the business. They also have their third reportable segment, which is patient care solutions. And this includes monitoring that helps clinicians, to provide flexible care based on their patients' needs. This includes electrocardiogram solutions. This also includes roughly 1,000 consumables that are used in hospital environments with their monitors and therapy devices for measuring things like blood pressure, temperature, respiratory rate, and other key patient metrics. This includes their maternal infant care products that are used in labor and delivery departments of hospitals. So neonatal incubators, for example, infant warmers, photography equipment, maternal and fetal monitors. And this segment also includes anesthesia products as well. And the technology used by anesthesiologists and nurse anesthetists to ventilate and deliver these drugs to patients. And then finally, their fourth and final segment is their pharmaceutical diagnostics business. As I noted, they are a leading supplier of contrast and radiopharmaceutical imaging agents to radiology and nuclear medicine clients around the world. And these are complementary as well to many of the imaging and ultrasound devices that they offer, including, CT, X-ray, and MR devices. So these radiopharmaceuticals or molecular imaging agents, they're injected into the patient prior to the imaging scan. So say before they get a PT scan or a PET scan. They also have contrast media, which are pharmaceuticals that are administered to a patient prior to certain diagnostic scans in order to increase the visibility of certain tissues. Now, to give you an idea of the impact of these businesses, and Toby, of course, will dive into the financials here in a minute, the ways in which their different segments impact the business. If you look at 2024, total revenue just shy of $20 billion for the 12-month period. About $8.8 billion of that total came from their imaging segment, about $5.1 billion from their AVS segment, about $3.1 billion from their PCS segment, and then about $2.5 billion from their PDS segment. So their imaging segment revenues and their AVS segment are the two leading drivers of growth for the business. And then they also have a really wide distribution in terms of clients. US and Canada clients are really the biggest needle movers for the business. That's where about $9 billion of their revenue was concentrated last year, the second largest region being the EMEA Europe, Middle East, and Africa. China region revenues have been decreasing and struggling in recent years, but that is still a notable part of the business. And then they divide the rest of the countries that do not fit into these regions into their rest of the world revenues. One other thing I'll note, obviously their revenues primarily consist of sales of products and services to customers, as I've outlined here. And this includes everything from equipment to imaging agents to software offerings. Generally speaking, they recognize a contract with a customer once there's that legally enforceable agreement between the company and their customer, and that's identified. And revenues are measured based on the consideration that is specified in that unique contract with that customer. Revenue is also recognized in the period in which the customer obtains control of the underlying products or services. That's something I always like to note with these types of companies, which can lend a little bit of understanding into how the business works. And again, this is just a quick look at those numbers I mentioned earlier about the ways in which the company's revenue is derived from its different core segments. And finally, at the end of this section here, I always like to throw up a stock chart. Obviously, GE Healthcare Technologies at its current iteration has not been publicly traded for very long. But it is worth noting, this is also a dividend, paying business, I believe, but slightly trailed the market recently, although it has been a market beater at certain times. Not a bad performer since it became its own publicly traded entity, but definitely wanted to put that up there to put a little perspective and context for the stock.
Yeah, it's certainly not a bad performer at all.
No.
That return. It's just that the market has been really, really good. And keep that in mind, my friends. Complete aside here. Look at that, 48% return for the S&P 500 total return over the last 2 years.
I know.
We, despite the last couple of weeks, this is a really good market. Just keep that in context, right?
Yeah.
We have.
Do you want me to take this down and so you can share after we hit the questions?
It's all right. You can leave it up because
I'll leave it up. Okay.
We can go through the financials pretty easily there. Okay. We have a couple questions though that we can hit. Sanjay JC asks, he says, thanks for tackling GE Healthcare. Are you able to discuss the extent to which its business overlaps with that of Pro Medicus, which is an Australian business? I can give you a quick, a quick overview here. Do you follow Pro Medicus at all, Rachel? Is that one you're familiar with?
I am not very familiar with that.
So the core difference, Sanjay, here is Pro Medicus is software driven. Right. They have an imaging platform, but it's imaging software, right? They're focused on healthcare imaging software. Is what and it's more of a subscription SaaS-based model, right? For the cloud-based imaging software. GE Healthcare has that hardware aspect. So you can think of GE Healthcare, I think, as hardware first with the software platform that kind of supports their hardware. I think that's the key difference between the two on a very, very broad level to think about there. Now, they obviously do overlap, right? Pro Medicus provides imaging software. GE has an imaging software component there. So there is competition in that space. But GE is also going to have that hardware focused business as well. Another comment too kind of highlights this, right? From Sasha B, who notes that they've used multiple imaging products, GE imaging products over the years. Great engineers, not great software, right? The CT
Interesting.
Buggy, the PACS imaging software is the worst, right? Now that's one opinion, obviously, but I think that impression highlights the fact that it's hardware focused from GE Healthcare, right? They engineer great products, and then they want to have the software to support staff, and maybe they're not as good at that, yeah, because the focus is from that from that hardware side. And Sasha also notes Swedish Spectra, a good medical imaging software company, taking the North American market share for them. That's one we should look at. Thank you for that suggestion, Sasha. We'll take a look at that one. That's not what I know much about. I will say that Pro Medicus has about a 7% market share, I think, in the U.S. or North American market. So it's pretty small. So this one, if you're looking at the software companies, maybe Sectra is one to take a look at too, to kind of see how they're fitting there. So thank you guys for those questions. Leviton, we're going to hit the management section in just a little bit, so we'll kind of defer your question about how management's doing until we get there, though. But let's look at some financials right now. So we'll look at the balance sheet here, Rachel. It looks fine to me, right? The assets look fine. Cash is decent here. Decent amount of cash on hand. Good growth year over year, I guess I'd say. Reasonable inventories, nothing particular that concerns me or to note here. From them, again, hardware focused, you're going to have inventories, right? Also, those the consumables. There's a lot of inventory with this business here. The goodwill, you're going to note, right? The goodwill is huge, right? 13 billion in goodwill. They're acquisitive, and that's not just GE Healthcare, right? The acquisition strategy is a legacy of overall conglomerate GE, of which this is a spinoff. And I think they've maintained that strategy and that approach. When I was looking at this, Rachel, we know that's bigger now, right? Because of that, they had announced that deal in December of Metaphysics, and they closed that today, I guess, right? So that's closed. So probably, I think we're going to expect to see more. I don't know how much of that will be goodwill in the balance sheet, but the Q1 financials will probably see an increase of that from that acquisition there. They've had two major acquisitions since they separated from GE. The Caption Health in February, MIM Software in April of last year. They did so, and when you count Metaphysics, I'd put that into that major category. So three since they've separated. So do not expect that the GE system of acquiring a bunch of stuff is going to end. I think that's going to continue. I think it's clear from that. Let's take a look at the liabilities for the next slide there. 7.4 billion in debt. If you look at that, the long-term borrowings there. Now it is coming down, so that's good, right? I like to see that decrease. But that's something I think we want to keep an eye on. You'll also note the share count is going up, which I don't love. I think there's some of that coming from stock-based comp there, but that's another one to watch. And lots of benefit liabilities, Rachel, which is something you don't see a lot, but you see that non-current compensation and benefit. They've got some retirement liabilities for this company. Again, that's part of the legacy business, right, from GE. You don't see that as much anymore with newer companies. They've all gone to the 401k plans, right? The defined benefit plans. But GE Healthcare does have some legacy pension liabilities, some legacy retirement obligations to keep an eye on there. Let's take a look at the income statement. We'll move right along here. So income statement here. Revenue steady. It's not a big increase from a year ago when you look at that, right? So if you'd ask me, what would you prefer to see from these financials in terms of improvement? I'd like to see revenue growth a little bit more. I think.
Yeah,
I think that's the primary thing we're looking for. They are doing a good job on the cost front, though. Despite that slow revenue growth, you're seeing the margins improve. They're increasing even as revenue growth may be slower here. So I think that's the takeaway right now. If you look at this income statement, it's a story of improving margins, which maybe it's kind of what you want to see post spinoff, some improvement in the efficiency of the business there. But we do want it eventually to be a higher growth story, I think. So that's going to be something to keep an eye on as the company continues for the next couple quarters, next year here. On the cash flow side, you see that is steady too. It dropped a little bit. I'm not too concerned about that, right? It's still within the same range. We'd like to see more growth here again, as with revenue. Stock-based comp is not awful. It's not too bad. I think it's probably fine given the overall levels of the business. And you do see, if you take a look at this, you'll that net periodic post-retirement plan benefit income and expense there, right? So you're seeing an impact from the retirement plan, from their contributions as well, the post-retirement plan contributions. So you are seeing an impact there. Show up in the cash flow as well. All right, and I also showed you that the next slide we've got here is this is from their recent earnings report, the Q4 report. And this just gives you a visual impact of the growth and margins, because I wanted to show that here. That's really has been the focus in the past year, is cost control, getting those margins up. And you're seeing, now these are adjusted margins, but still you get the idea. You can see visually the improvement both in Q4 and the full year that we've seen from them in that margin expansion. They're getting better, right? So this is good. This is good news here. So overall, summary here, they look okay. They're not great, Rachel. Like there's nothing here that screams these are awesome financials for me. You do have the pension liability. You've got the debt there. They're not great, but they are good. Like there's nothing terribly concerning, I think. Those benefit obligations to bear watching. That could be an issue later, so continue to watch that. And keep an eye on that acquisition strategy, and you'll see that show up in goodwill as it grows. You'll see it show up. Hopefully, you won't see it show up in write-downs. But you kind of want to keep an eye on how they continue to do that over the years, and make sure that's not too much of a hit to the financials, right? You don't want to see write-downs. You don't want to see debt balloon too much from acquisitions, right? You want to see. And you don't want to see an acquisition hit the margins in higher cost that persists too long for that. So you make sure they can continue to do that and do it well, I think is one of the things to watch with this one.
Yeah, I agree with you. There's this is obviously a very capital intensive business, right? We've been talking about that there's software offerings from some of the questions that came in earlier, but those, as you noted, are sort of they're a valuable complement, perhaps for some organizations, and particularly the ways in which they're trying to build on their AI prowess. But they are fundamentally a business that is focused a lot around hardware, and this is a very capital intensive space. Margins are improving, but could be better. And part of that is, I think, related to the fundamentals of this type and scale of an organization. But it's an important note for sure. Leviathan was saying, Rachel, GE Healthcare, very diversified, sophisticated, and complex businesses, for sure. How is management able to monitor and control such a complex organization? Well, good thing I'm going to dive into the potential and then the management of the business, because there was actually, I had to be very selective because there were so many different management figures that were worth highlighting, but each of the divisions of GE Healthcare, those different segments that I mentioned, has their own respective CEO. That is the scale of the organization we're talking about here. But I will answer that question in a minute. But looking at potential for the business, right? So GE Healthcare has provided some of their own projections for this. They had previously estimated that their total addressable market will expand from what it was in 2021, which they estimated was about $84 billion, to an addressable market of about $102 billion as of this year. And they continue to see the integration of patient data, the use of AI to deliver insights for clinicians, and as I highlighted earlier in the hour, the wide range of ways in which they are working with AI companies like NVIDIA and others to deliver these insights for clinicians to optimize their software and hardware offerings. That is a huge part of their ability to disrupt and further expand within this addressable market. They are anticipating growth by integrating patient data from various sources and leveraging AI to provide clinicians with actionable insights, from imaging to lab work to pathology to genomics. And their precision care strategy that I've highlighted is really designed to safely and securely integrate patient data, layer it with AI, and then use this information to help clinicians diagnose diseases, determine the most appropriate treatments, and do so in a more effective and efficient way than they would be able to without the use of these tools. Now, that estimated total addressable market expansion also reflects a really growing demand for advanced healthcare technologies and services that is, broadly speaking, growing within the healthcare provider space. Now, more recently, in their 2024 Investor Day report, they updated their estimates for their total addressable market through to the end of the decade. They now think that they are going to have a foothold within an addressable market worth about $110 billion as of the year 2028. And so that's a bit of an uptick from the roughly $105 billion valuation they were targeting for this year for their addressable market. And it's interesting to see as well. This was another slide that they shared in that report of how, even going back to 2023, their business segments by the numbers, delivered 45% of recurring sales, and the ways in which these sales or revenue are divided among their different segments that I highlighted earlier: their imaging business, their advanced visualization solutions business, their patient care solutions, their pharmaceutical diagnostics business. And all of these areas are key for them to continue disrupting and growing within this total addressable space. We've had some questions regarding some of the competition, and I know Toby will also get into that. There are certainly multiple players that overlap with the products and services that GE Healthcare provides. But they are certainly operating at a scale that is incredibly competitive within their core total addressable market. Now, this is the CEO and president of GE Healthcare. He was appointed in that role in connection with the spinoff. He's also served as a member of the board since the spinoff. Previously, he was president and CEO of a global medical device manufacturing company called Integra Life Sciences. He also previously worked at Baxter Healthcare. And prior to that, he spent 15 years at GE's healthcare business before it became the spun off publicly traded entity it is today, in a variety of leadership roles, both in the US and abroad, within different segments of the company's healthcare business, including their healthcare services and molecular imaging. So he has an extensive background in really all areas of this business and the diversified healthcare structure that it is today. Now, this is the company's vice president and chief financial officer. He assumed that role in June of 2023. Prior to that point, he also worked at Baxter International in various roles over the years. He actually began his career in strategic planning at Walt Disney. So really, right? Interesting. Yeah, there you go. I wanted to highlight real quick here under the other management section. I have listed on this slide and the next one, basically the 4 CEOs of the respective divisions in which GE Healthcare is divided: pharmaceutical diagnostics, imaging, and then, as you can see here, advanced visualization solutions, patient care solutions. Kevin O'Neill, who heads up their pharmaceutical diagnostics division. Again, this is a leading global provider of contrast media and molecular imaging agents. Prior to assuming this role, he was actually the chief financial officer of GE Healthcare Life Sciences, which was a multi-billion-dollar molecular medicine business, and previously worked in other areas of GE, as well as companies like the CFO Life Sciences of supply chain. Roland Rott is the president and CEO of GE Healthcare Imaging, which is their business that is focused on technologies and services across MR, CT, PT, nuclear medicine use cases. He joined GE Healthcare back in 2011. And has held multiple leadership roles since that time. He was leading the ultrasound segment for a number of years, and also was very instrumental in the acquisition of BK Medical, which is that acquisition I mentioned earlier in the hour. It was their largest since 2017. He was also very integral in the acquisition of AI healthcare leader Caption Health. And then Philip Ratcliffe and Thomas Westrick, they are the respective CEOs of GE Healthcare's Advanced Visualization Solutions segment and Patient Care Solutions segment. Philip, who heads up their Advanced Visualization Solutions segment, he joined GE Healthcare back in 2022 and has a really wide-ranging experience within this space. Prior to joining GE Healthcare, he was CEO of Centerline Biomedical, which was a Cleveland Clinic spinoff company, and also worked in various private startups. He also worked in sales and management roles at companies like Ernst & Young, Pfizer, and Boston Scientific. So really wide-ranging healthcare experience. And then finally, Thomas Westrick, who's president and CEO of the Patient Care Solutions division of GE Healthcare. He leads this unit that provides clinicians and frontline caregivers with a variety of virtual and digital solutions, as well as medical devices. He previously led the Global Quality Medical Regulatory Affairs and Global Research Organization, provided a different direction on regulatory affairs, policy, clinical, and medical matters. First joined GE Healthcare back in 2003 as Global Controller and Chief Accounting Officer, and also has a background for well over a decade in public accounting with the likes of Deloitte. So pretty impressive management structure. And given the scale of this business, the fact that they have these respective leaders controlling these different divisions is essential. This would be far too much for any one, chief executive officer to preside over. I was particularly impressed by the structure of management and also the wealth of experience within healthcare and adjacent to, the different industries that GE Healthcare targets that these different company leaders have.
Yeah, for sure. All right. Let's talk about some of the risks here, guys. We can get into this a little bit. There is a lot of competition, right? If you look at the last couple of questions, those of you in Slido, that Vihan has dropped in, he mentions a lot of companies that compete. We'll talk about a couple of them here on the next slide. But just know that this is a pretty competitive space. And then we got that company that neither you or I were aware of, Rachel, that Sasha had thrown out a little earlier in the show, right? So there's a lot of competition in the imaging space, for sure. Other things like the Chinese expansion, I think, is one that you're going to want to follow. That obviously works with that stuff I've got under the legal and regulatory aspect, that the tariffs and trade wars, right? If you're trying to expand into an international company at a time when we've got a lot of tariffs happening back and forth, it ain't great, right? You're going to have to manage that somehow. So they're excited about that, but maybe that's going to go a little bit slower than we thought it would go 6 months ago, based on how things, just the reality of the world right now. You got to think about things like technological disruption, potential issue for them. That kind of ties in with the competition aspect as well there, and customer concentration, right? Like a lot of their government health systems and large hospitals, the healthcare space, Rachel, has just gotten more concentrated in terms of these bigger entities owning a lot more hospitals, a lot more hospital change. And as that continues, and then you've got, we'll get into that in a second, but as that continues, that just shifts pricing power more toward the buyers and the manufacturers and the sellers of some of this stuff, right? The bigger my customer is in the space, the more they can squeeze me, because they're going to be a volume purchaser potentially, right? And the more critical it comes to get that one contract, because we have, like, our imaging contract going to be for 20 hospitals, right, in the region, not just the one, right? So it becomes a little something you want to manage. We talked about the debt, R&D costs are a thing, the retirement obligations you're going to want to watch, right? And so then the insurance companies, right, like that's another customer that's they're highly concentrated. Medicare, of course, being a big one. There can be a pushback on the pricing, not so much the pricing of the machine, right? A piece of imaging equipment, because it costs what it costs, but you've got to look at your Medicare reimbursements for a scan, for a test, your insurance reimbursements for a scan, because that's going to feed into what that hospital thinks they can get for that and the price they're going to be willing to pay, right? So the insurance market, the reimbursement market, the pricing there does have an impact on the pricing for the machines, right? Because you have to, like, is this machine lasts us 10 years? What are we going to get out of it, right? What can we afford to pay, given what our reimbursement is going to realistically be from these tests and these scans, right? And of course, the standard stuff that you would expect from a company like this: healthcare regulations, FDA approval, right? That whole approval process, protection of patent. Again, the tariff thing that we got to think about there. And of course, let's not forget the acquisition strategy, how they integrate that. Obviously a risk for a company like this. Then we can look at some of the competitors here. And these are not all of them. These are some of them, right? But I think some of the bigger ones, Siemens Healthineers, right? And this is the subsidiary of the bigger Siemens, the bigger German conglomerate there. The bigger company owns about 75% of the healthcare entity. They're big in imaging diagnostics, right? A big rival in the imaging space for them. Philips here, which is another Netherlands player, is a very strong competitor, especially in imaging, especially in cardiology. This might be, and you're going to see this on the comps I did for the valuation comps. This is probably, in terms of the comps we have, the best one. I think that kind of lines up with them in terms of size and what they do. So we'll get to more on that in a little bit here. Fujifilm, Canon Medical Systems, both camera makers, Rachel, right? Canon and Fuji are camera makers here. But that kind of makes sense, right? When you think about it, they both have a medical imaging division that kind of flows from their bigger overall business in imaging, in visual, in capture, and all of that, right? Medtronic, a big device maker. You say some of our fools may be familiar with that one. It's been a wreck in the fool in the past with the services. They're not a direct competitor, I would say, but they do compete in on the imaging space at least. They compete in the diagnostic space there. Abbott Labs, another big player, not so much a direct competitor. To some degree, they are, but they're more of a bigger device maker, diagnostics company than Shimadzu, a Japan company, is a smaller business and an imaging competitor. Mindray out of China competes in imaging diagnostics. United Imaging is also out of China, competing in the imaging space. Bayer competes in the pharmaceutical space, pharmaceutical diagnostics. Bracco, an Italian company, Rachel, also it's private, right? But they do have so that's probably why we don't know much about them. But it's a private company, but they do compete in the imaging space as well. And then these last two I put on here, Gerbert and Curium, they make contrast agents that would be used. And so you're a competitor potentially on the consumable aspect here. So you can see, right, like what is GE trying to do? They're trying to be the full
package, every corner of the market versus the segments.
They have the hardware, they have the software, they have the consumables, right, for their machine, for the imaging test. They're trying to be an all-encompassing solution, and in each of those pieces, hardware, software, consumables, they have competitors that aren't necessarily trying to do everything, that are trying to operate in their little niche. So when you think about an overall risk there, can you be everything to your customers, or are your customers going to prefer specialization and expertise in each of these spaces and prefer to get their services from different providers? I think that remains to be seen, right? GE's trying to be the full chain. Not everyone is trying to take it from that approach, right? And so that's why you have a lot of different competitors, because you do have these ones who are trying to do their one part of the chain and do it well, right? Versus trying to be everything. So we'll see how the market goes. It's a bet on a particular aspect of the market and how customers would prefer to get their services, right? Let's look at the valuation here. This is our a standard chart we typically put together. And now this is not to mean to be all inclusive, right? This is just to give you a sense of some valuation comps with companies. And again, Philips traded on the New York Stock Exchange, even though it is that Netherlands competitor there. Probably the closest comp here in terms of similar size, similar focus, right? You see revenue about in the same place, market cap a little bit smaller. GE is growing faster, right? Not much, but in Philips, their most recent comp was to come down a little bit. Not quite there on cash flow, but they do have their margins are slightly better. But I think it's a reasonable comp. And you see, I don't think GE is too far off of that, right? If you compare the price of sales and price to earnings, based on where the two are, I think it's probably reasonable looking. The other ones, Medtronic, Abbott, J&J, they have a lot more going on, so they're probably not as close comp. But you can just kind of sense it's GE Health in their space. It's not unreasonable, right? I think they're where they need to be. And so I don't look at this and say, oh, this is like wildly overvalued, or it's a screaming deal either. It looks about what you would expect it to be on that valuation standpoint. Let's go ahead and look at our final slide. Let's go ahead and give you guys our bottom line, and we'll hit some more questions with the time we have left here. It's fine for me, Rachel. I didn't say buy or not. I don't know.
I saw the fine. I was like, what is this?
Yeah, I know. You like it better than I do. And I guess that's my way of saying
no, it's all right.
It's probably not a buy for me in my portfolio. But but it looks like a good company. It looks like a fine company to buy if you want exposure to this space. The financials are good. They're not great, but they're good. They do compare quite favorably with some of their peers. It's just hard for me to get too excited about what they're doing right now. Maybe I need more time with this to sit with it a little more. So if you were asking me, were you buying, Toby? I'd say, yeah, I'm probably passing on this, but not because I think the business is bad. Is it a market outperformer over the next 5 years? I think I'd lean more so than not. I'd say more than 50% chance. It's just not striking me. It's not grabbing me for whatever reason.
Yeah, I mean, look, there's other healthcare businesses I find more intriguing, but I do think that this is just on its fundamentals. I think it is a solid business. I think that there are for sure other healthcare enterprises that are delivering faster growth, though, both from a business perspective as well as from a share price, and dividend growth perspective. So, that may not be a buy for every investor. I think this is a really well-diversified healthcare business, which I find really intriguing because they are so integrated into so many of these different segments within their overall core addressable market. And I am intrigued with the company's, pace of innovation, particularly their expansion into AI-driven technologies that I highlighted earlier in the hour. I found really interesting. And I think that's really kind of a nascent area of growth for them. I don't know that. I think I have other healthcare stocks on my personal watch list that I'm more interested in buying right now, but this is one that I would consider buying in the future. I do think it's a solid business. It's certainly, after preparing and digging into it for this deep dive, it's one that I want to get to know better and take a closer look at.
And I think it's fascinating for me. One thing I find fascinating by this business, I was looking at it, is despite the spinoff, which is what we're about 2 years removed from that now, from GE, you've still got that very legacy GE attitude from this company, right? It's acquisition, and look at what they're trying to do, right? Now they've separated out their focus, right? Their focus on healthcare. Say this is not a conglomerate; it's a healthcare focus, but it is, right? Because what are they trying to do? They're trying to own the entire chain in the imaging space, right? They can't get out of that GE mind, for better or for worse, of saying,
right,
you want to be everything to everybody. Now, only in healthcare, but everything. Like, we're going to do the hardware, we're going to do the software, we're going to do the consumables, we're going to get your whole package. That's a very GE mindset, right? And has been for forever from this company. Which, and again, not good or bad, right? It's an approach not everyone in this space takes. And maybe in a couple of years, we look back and say that was the right approach because they've got a bunch more customers that kind of dominate the market. I don't know how that's going to play out. But it's just very interesting to me that we still have that here, right? Like, it's GE Healthcare, but it's also GE for sure. Yeah. Right.
Oh, approach to the legacy of the former parent company is definitely there.
Yeah. Yeah. We got about 5 minutes, Rachel, and we have some questions from Rose and from Vihan I think are interesting.
Although one of the ones from Vihan, he named different companies, some of which are not necessarily, healthcare centric. So there's CureMD Healthcare, right? And this is a business that essentially provides cloud-based practice management, electronic health record software. They do revenue cycle management services to medical practices. So again, more on the software record management side of the business. So there's some adjacents for sure to what GE Healthcare does. Magnagas, as far as I could tell, is in a completely different zone. They work on the metal cutting fuel derived from liquid waste, and they sell equipment for the sterilization of bio-contaminated liquid waste. So a little bit of a different business, if that's the correct one that I'm referring to, or correct me, Vihan, if I found the wrong one. AGFA is Agfa Gewert, and I'm probably saying it wrong. I believe this is a company that's headquartered in Belgium, and they basically develop, manufacture, and distribute products and systems for industries, including healthcare. So, for example, radiology and IT solutions. They develop systems for capturing, managing, and processing diagnostic images, clinical and administrative information for hospitals and healthcare facilities. And they also have different contrast media solutions. But then they also provide solutions for the printing industry. They produce, membranes for green hydrogen production. So not exactly a direct competitor. So several kind of different businesses here. These are not ones that I know particularly well, but it's interesting to think. I mean, I would say there's probably the most overlap between, CureMD Healthcare with GE Healthcare's, software-centric business offerings, and then, Afka Gavert with their healthcare, imaging and clinical administrative solutions. But it's at a much different scale, and that's really just one small chunk of GE Healthcare's business. And some of these other businesses also have completely wide-ranging, business operations that are not at all involved in healthcare. So it's kind of interesting to compare some of these.
Yeah. Paul had asked, what are you more interested in GE Healthcare? Do you have a couple of companies you want to throw out off the top of your head that?
Yeah, I mean, look, I cover a lot of companies in the healthcare space. I continue to be really intrigued by Eli Lilly, well outside of what they're doing with GLP-1s. I think that's just an incredible business. If you're looking at these massive, well-known, established, been around forever healthcare companies, that's a great example of one. Obviously, there are many other healthcare businesses that are not tried and true within the space. Vertex Pharmaceuticals is one I talk about a lot. I think another major operator in the space that I find really interesting, in pharma is Pfizer, but these are different. They're not direct competitors necessarily to GE Healthcare. So those are perhaps some companies off the top of my head. But as I said, this is a pretty complicated structure. It's one I'm working to understand a bit better to determine whether it would be a good fit for my own portfolio. But yeah, those are a few, massive players off the top of my head. If we're looking at trying to have more of a one-to-one comparison in terms of just the size and scale of the organization.
Yeah. And Rose's question is the companies that were on that valuation chart, right? So pecking.
Oh yeah, Johnson & Johnson. I'm a shareholder. I love that business.
Now again, so they're not all direct competitors, right? Or I should say they are to some degree, but
there's some overlap.
Yeah, Abbott, Medtronic, Johnson & Johnson are different, much larger, and they do more than GE Healthcare and Philips, which I think are really more focused on that imaging space when going on there. But actually, I would put GE Healthcare ahead of Philips, I think.
I think so.
Yeah, I think for sure.
Yeah, and I mean, Johnson & Johnson as an example, this is another one that I'm a shareholder of this business. They spun off their very slow growing consumer health business a few years ago. So they've really been focusing on their pharmaceutical business, which is what I think a lot of people know them for, but also their med tech or medical device business. Yeah. And this includes everything from, orthopedic musculoskeletal solutions to they acquired Abiomed a few years back, which is known for the world's smallest heart pump. They've been focusing a lot on cardiovascular medical device solutions. That's been a fast growing business for them. So again, there's some adjacents, but there's a lot of areas of divergence between these businesses as well.
Yeah. And I think of those other three, Medtronic, Abbott, and Johnson & Johnson, I probably like Johnson & Johnson better.
Yes.
Yeah. I think that's the case. So thanks for that question, Rose. We are basically up at time, guys. We've got, we're going to have Tim and Asit jumping in here in a second for you guys. But thank you for the questions. This was quite good. As we, we've transitioned to an hour format ratio with these deep dives, and we're still trying to feel this out a little bit. But I think it's working with the questions that we're getting to kind of fill this out, and it gives us more time to hone in on what people want to know about specifically from the company. So that's been good. Thank you for joining me. Good show.
Yeah.
And with that, we're going to turn it over to Tim and Asit for Mindset, with Asit sporting a new haircut, I think. Is that recent?
Yes, I get a haircut like twice a year.
Nice.
Okay, but yeah, thanks for noticing. Someone noticed. My wife's like oblivious. But Toby noticed. I'll remember that.
All right. Well, you guys have a good show.
All right. Thanks, Toby. Thanks, Rachel. Fools, welcome today. You say you only get a haircut twice a year, but I genuinely really only get one twice a year. This is why I wear a hat all the time, but I chose not to wear one today. So
we're so similar, Tim. I like to let mine grow long, and then you see me in my phases where I'm throwing my cap on all the time. So.
Yeah, I spare the members the Marge Simpson until I get my until I get my hair cut. I'll get it again here shortly. But welcome, fools, to the Mindset Hour. I'm Tim Beyers. With me, Asit Sharma. Get your sleep numbers in. Get your questions in. We have an interesting one today. This is going to be a more interactive show that Asit is going to lead us through. Sleep number for me, Asit, I was thinking about it. Choppy towards the end, but I think a solid 6 hours, 20 minutes. So let's say 6.3 roughly. Not bad. A little bit more restful. How about yourself?
Tim, I think I clocked in at 8+. Again,
Nice.
seem to be a person of extremes here. Some weeks taking a lot of care to start the week off right and get into bed on time. Other weeks just pushing it till the very end and waking up tired on Monday, but refreshed today. So get your sleep numbers in, folks.
Yeah. All right. So what we're going to talk about is something that matters to all of us and something we are all either going through now or are going to go through, which is the journey from novice to seasoned investor. What's that? What is that like? And I'm going to kick it to you here, Asit, because there's a lot to go through. And again, we're going to need your participation here because this is a show that we believe should become a series.
Absolutely, Tim. We want to make a mini series out of this. And the origin in today's topic, we can call it "Where Are You in Your Investing Journey?" started from, our conversations with each other every Monday, with you all asking questions, helping guide us, providing thought-provoking comments and insights. And I'm usually trying to gauge, Tim, for those who comment frequently, just where are they? Is this a newer investor? Is this someone who's tried, a lot of different methods? Maybe someone who's extremely experienced. So for the people who participate a lot, I sort of get a sense of that, and we both do. But a question that's on our minds is, for all of you listening, what is your level of comfort with investing? How long have you been doing it? What are your observations to date? What do you want to learn going forward? And so what we're really trying to do is to call on both the people who sit at the front of the class and answer a lot and raise their hands. We love you. But also some of you who are watching and maybe not participating as much.
Yeah, the lurkers.
Yeah, the lurkers. And I've been both in my academic career. So
of course,
no great shame in being a backbencher in some ways, but it will be very helpful in this hour if everyone participates and lets us know. We're going to ask some questions to guide you all on how to think through this, but we'd love that because we're going to take what we get in today's hour as the basis of our series going forward. Now, next week, Tim and I will not be here. We're going to be at our annual company event called Foolapalooza, where we have a couple of days as just one big team from all over the country and the globe, really, to come together and dream up the next year and see our friends. But we'll be thinking about you guys, and we'll be planning out for when we come back to continue this series. So we're going to start by talking about ourselves a bit, our favorite subjects. Just kidding. Just kidding. We talk about ourselves on this show to help, I think, give examples and give illustrations from our own personal experiences. But we're going to begin by talking a little bit about the outset of the journey. I'm going to answer a question, but I'm going to first pose it to Tim. And if you want to answer this question yourself, that's great. Basically, what we're looking for, I'll invite, along with sleep numbers, something very general. You can use novice, you can use intermediate, or the word seasoned. Maybe tell us as we go along where you think you are personally in your journey. And then we'll also solicit some feedback on some more specific stuff as we go. But Tim, I want to take you back from when you first started investing. It could be maybe informally when you were out there in the world, not even associated with the Motley Fool. Maybe it could be when you started writing for the Fool. Maybe it could be when you started working on services like rule breakers, or even when you came on board here and started leading services. I'll let you pick your point, but at some point, I'm sure you felt like there was a lot to know and figure out. What did it feel like to be a novice? What do you remember about it? What can you tell us about that time?
So I'll take you back to late 1990s and early 2000s. In the late 1990s, when I first started investing, I'd read the Motley Fool investment guide. I'd always been stock curious because I grew up, friends when I was young. One of my friends had his dad was an individual investor, and so I was around it. I was not around it through my own family. I was around it through friends, and I knew that he was an investor, and it was important to him, and so I knew something about it. Um, but in the 90s, when I was in my, well, let's see. Yeah, I mean, I turned 30 in 97. So I'm not young anymore. We could say that.
Of course, you're
Uh,
young, Tim. You look young from my perspective.
well, I appreciate that. You do too. But so but i- during that period, I I worked at Sun Microsystems and I signed up for the employee stock purchase plan, and I had that. And during that period, when everything was going absolutely mad, absolutely insane, I was buying stock as part of my paycheck, and that stock was going to the moon. Like it was absolutely soaring. And so it was generating a lot of value, and I was getting irrationally excited. Like, I'm going to be independently wealthy, here if this keeps up. And of course, it didn't keep up. I ended up selling those shares. Sun Microsystems is not a public company anymore, and was acquired several years ago. But I ended up selling it for like a 30% gain, badly lagged the market, but at least I sold it for a profit.
So
Um,
you had a big multi-bagger that went all the way down to a 30%
yes,
gain.
yes.
Tim, do you mind if I have a sip? Do you mind if I ask you a question about that
Hmm.
now? And your story is so interesting. If you had the tools that you have today in your toolkit and were able to separate sort of the emotional tug of working for a company and having stock in that company, seeing it from the inside, do you think things would have been different? Would you have been able to objectively evaluate with the things you look at today and say, an employee here looks promising, but man, these shares are way ahead of themselves. Maybe I should cash in a little bit. I'm really curious about that.
Oh yeah. I like that's one of the things. Now, what I would have done though, if I was going through the same lens today, I would have been like, so this is a 20 bagger now. This is outrageous and it can't keep up. So I need to sell some of this, but where else am I going to put it? And that
Right.
would have been my decisioning. But I wouldn't have sold all of it. So I still would
Yeah.
have ridden a fair amount of it down, but I would have sold a fair amount of it and put it somewhere else.
Right.
I probably would have put a fair amount in cash. Um, and then I would have found some other stocks, may have, found some dividend payers, but it was so outrageous. It was so indefensible that, yeah, I definitely would have sold some. That's one of the things that has changed. When I see extreme
Mhm.
valuations, like we've done this a couple times now. I don't
I
think I'm
saw you do
giving.
it recently with a company you recommended. It multi-bag, but it got way ahead of itself, and I saw you trim that in a real money portfolio. Like,
Yeah, and we got rid of it.
yeah,
We just
totally. Yeah.
we went up and sold it. I don't think it's given away too much to say that, a couple of times I've sold some Nvidia, not because I don't believe in Nvidia, but I've sold it twice inside services. And the reason why is because it was so hot and it was going so crazy. It's just like it's becoming too big. Two things. It's becoming too big a portion of the portfolio, and I didn't think it was, fully sustainable, at the price. So I wanted to keep holding it because I thought it was excellent. but there were other opportunities, and I could fund those opportunities, taking some from NVIDIA. So I did it.
Yeah.
And I think a couple of those moves worked out quite well. So yeah,
Awesome. So,
I would have
thanks.
I would have definitely looked at it a little differently. But at that time, no, I just had
Yeah.
googly eyes.
Because you were the novice
Yep.
at that time. Wonderful. So keep going. So we get to the point where you're having your first exposure to not just really investing, but the potential to see a small amount that's been put in by way of being an employee at this company, to see that become substantial for you. So what a quick introduction to how markets can reward as well as they can punish.
Yeah, and I mean, later on, I ended up buying into narratives. Like as a novice, the narratives really sold me. And this is going to sound like I'm putting some blame on David and Tom Gardner, which I'm not intending to do. They were making a point that I misunderstood. Asit. They said there are some obviously great businesses. They wrote that in the Motley Fool investment guide. There are obviously great businesses. And I think they used the example, I may be getting this wrong, of like the first bank of Coca-Cola, meaning that, there are some stocks where you buy and you just sit on it and collect the dividend, and you feel safe and you're going to get a relatively steady return and, collect your dividends. And I bought into that idea that there are obviously great businesses. Where I got it wrong is that, well, obviously great businesses bought at the wrong price or at the wrong time, or businesses that are, it seems obvious that they will become great, but they aren't yet, is, can lead you into some trouble. So one that I bought was Amazon. I thought it was already an obviously great business. What I didn't realize is that it was obviously great at that time because everything that was .com was great. They were building a great business, but they weren't a great business yet. And they were going to go through some challenges that I didn't quite understand how to evaluate. So when the stock went down 70+%, I just threw up my hands and gave up and sold it way too early, which people know. People who've tuned into this know that I sold it at a ridiculously low price, like a split adjusted price, I think of 35 cents a share, which is just, extremely painful. Gave me another lesson. At that time, that was, so I got the taste, I got the sugar high, and then I got the very painful hangover of like, you're not evaluating this correctly. You need some tools.
So Tim, these are two examples of really vertigo-like experiences in the market with two different companies.
100%, yeah.
What were your feelings at that point? So now you have so much experience, not just with the intellectual side of investing, and you exhibit a lot of intellectual curiosity. In fact, that's one of your parameters to take some risk. If you're intellectually engaged with something, then you are sometimes more apt to take risk. And I forget your phrase for it. Is it intellectual risk?
Yeah, I manage to intellectual risk, not so
Okay.
much portfolio risk. Right.
Right. But you've also become, I think, much more of a holistic investor, someone who can manage his emotions. What were your feelings like these couple of times when you didn't know as much about how businesses operate over a longer term, how success can manifest itself? It ain't all straight up. And how there's just a correlation over time between a company that's innovating or growing and the future stock price. Let's not even worry about what it's priced at today. We are, I think, all of us much more tuned into valuation. 2021 was one big wave of reminder. But what did it feel like at that time in either of those instances or shortly after when you decided to really learn this game and become an investor?
I was deeply engaged with it. I just started reading everything and as some people need to learn everything first, and I'm kind of like that, but I'm also a learn by doing person. I do that a lot, and so I end up, buying a little, doing my own modeling, trying to unwind things and figuring out and getting it wrong a lot. I have a hard time just if you give me a strict formula to follow, I'll follow it. I'm not that guy. I tend not to do that. I am the give me the guidelines of what I'm looking for, and then I know what I see, and then I will try to fit into what I see. Like this, you can't just hand me something and I'm like, great, those are perfect instructions. I will follow those. My brain doesn't quite work that way, by the way. That may be part of the reason why I get so much anxiety, because there aren't, very strict rules that I could just like, oh, great, I could just follow that. Like, I don't find that a lot. And so my anxiety responds. But yeah, I just dug in and started doing and reading and then picking up things that were super interesting. And the more that I picked up, the more that it would be a thread that I could pull on. So like David and Tom released Rule Breakers, Rule Makers. And I was like, okay, this rule breaker structure makes a lot of sense to me. Then I read, I had already read One Up on Wall Street by that point. And I started reading a bunch of other books, and I started reading about valuation techniques. I read a book called You Too Can Be a Stock Market Genius by Joel Greenblatt. And I was like, that taught me about leaps. And I was like, oh, that makes a lot of sense to me. And so I just started picking up pieces that made sense to me and started building something. But what I really wanted was some way to describe the kind of thing that would work for me. I was very fortunate that I learned from Lynch early on. And this is something that I didn't read Buffett early on. I read Lynch early on, but Lynch and Buffett have the same principle of your circle of competence, like investing in what you know, which is why you mentioned this, like once I got very comfortable with that, like, okay, well, this is an area I know. Tech is an area I know. So how can I build something that works for me in this area that I know? And that became just a quest for me over the next several years.
It's not by coincidence that the book Good to Great, the two interesting books, if those of you
Jim Collins,
Built to Last and Good to Great, he
Great
talks
books.
about
Yep.
something called the hedgehog concept, which is for businesses, not necessarily investors, but there's an analogy here. The hedgehog principle is really the confluence of three circles. So it's the intersection of what you're truly passionate about, what you can be the very best in the world at, and what drives your economic engine. So put those three together, those circles where they overlap is your hedgehog principle, your ability to be the best at something and to excel. So I find that very interesting that you alighted on these concepts from the investing world as well. And Joel Greenblatt is such an amazing investor and teacher as well. For those of you who
very smart,
want to learn about some really interesting investing concepts, a professor at Columbia and someone who I've also admired over the years. Well, Tim, I'm going to talk briefly about my own journey and feelings of being a novice.
I would love for you to answer these questions here. So like, what was it for you that started?
Yes, for sure. And as I'm doing this, I'm seeing, we're getting some comments in. Some folks are weighing in.
Keep them coming, please.
Keep them coming. So for me, I think many of you have heard bits and parts of this story. And I'm pretty sure Tim and I both did this series for Motley Fool Money. Oh, this was maybe 6 months ago or 9 months ago, Tim. But just an interview with Mary Long for me on my story in investing, where I talk through everything about me. And my story starts, sort of as a kid whose mom used to drop him off at the public library a lot, and a very small town. So I sort of knew everyone in the town. And I used to watch a couple of people. One was a very nice old school attorney, come in, and another guy. And they used to pull the Wall Street Journal on the wooden racks. I don't know if you guys have
I
ever seen
remember
this.
those.
Used to slip the newspapers through these big,
Yes.
long wooden dowels,
Right.
and that's how you'd read the paper.
That's how you
and
read
then,
the paper. Yeah.
Yep. And Mr. Britt, the attorney, his finger would be going down.
Yeah.
And one day I asked him, because I was in school with his daughter, and he said, I'm looking at stock prices in the Wall Street Journal. So that was the first time I heard this idea of stocks and stock prices.
Love it.
I eventually scraped together some money and bought some shares of a mutual fund in the brokerage across the street, which, again, in a small town, everyone humors the kids, right? So I don't, you had to go through some hoops. I think this might have been UTCMA, but Uniform Trust, some version of what the Uniform Miners Act is today. My parents signed off on some paperwork.
Got it. Yeah, sure.
Anyway, so I bought some peanut shells in a mutual fund and watched that over the years growing. And so I had some hints on what long-term investing was and what investing itself was, the discipline of it from that. Always interested in finance and math. And then I'll fast forward my story to sort of like ignoring the lessons of seeing this little mutual fund that I didn't touch and a couple of pieces of silver now that I think about it, which I didn't include in that podcast episode, but I bought some like silver rounds, Tim. I think I had, I don't know, I scrolled up $14 or something at some point. And I bought 2 silver rounds. His silver used to be after the Hunt brothers nearly killed the silver market. They tried to corner the silver market. It didn't work out. The price of silver crashed from like $50 an ounce down to $6 or $7. And anyway, so this is how we used to do things. In the old days, kids, we would go buy the physical assets. We would go talk to people to do transactions. And anyway, so I saw the price of those silver rounds appreciating. Every so often I would check the price of silver. So in my subconscious, I knew investing was a long-term game. But to make a long story short, because I was really good at science and math and with money, my dad very foolishly gave me a sum of money to invest in a margined brokerage account. I had actually been advising him for years as I studied up on stocks. Hey, put your pension, some of your pension plan money in this stock and this stock. He had a self-directed pension plan. He's a retired physician. And we used to love to think about companies like Charles Schwab, which has been publicly traded for a long time. Even early Apple, early Microsoft, never really held on to any of those shares. But those were exciting companies back in the day. They were coming public. But Tim, I really just started trading on that account because I'd read a little bit about speculation and day trading. And the technology at that time, so now we're fast forwarding to like the early 90s, just really allowed you on a very primitive basis to speculate. And I used margin in that account, and I took out most of the value of that account. It was one of the worst months of my life. My dad entrusting me with money and me not understanding risk and thinking I knew what I didn't, and thinking I knew how to invest when I was actually doing a different activity. So to cut all this even shorter, I came to this idea that there's got to be a better way. And by the way, another marker along the way was sometime in the early or mid 90s, my dad started subscribing to the Motley Fool when they had the print newsletter still. So I used to thumb through those, and it was fascinating. I mean, so well written, so exciting, and it made investing seem approachable and doable.
Absolutely.
So that's where I call myself a novice, was not really after all these experiences through my, early childhood, through my teens and just getting out of college. But after that, where I was like, I got to figure this thing out. And I was sort of like you, Tim. I started reading, I started talking to people. After graduate school, I took some accounting classes, some finance classes. I got my CPA certification. But my feelings at the time were of being overwhelmed. Because when I started over and started understanding that there was a different way to do things, I felt like there's so much to learn here. How am I ever going to learn this? You got to learn sectors. You have to learn about markets in general. You have to understand how businesses operate. You have to gauge management. You got to read a balance sheet. There's so much there. And then, of course,
sure,
CNBC wasn't invented yesterday. That was around, Tim, when we were,
When we were
teenagers in
kids,
our
yeah.
20s. I mean, maybe
Yeah.
even, I mean, some of those guys, I think, isn't Joe Kernan still around?
Yeah, he's
He
still
was a
around.
young man then, Squawk Box. I remember all
Yeah.
that and thinking
Yeah.
that this is the source. This is
Right.
my source material with CNBC because I didn't know any better.
Yeah.
And not knocking
Sure.
on that. I think
Sure.
it's a good service for financial news, but many people take that as their indication of how to conduct their investment affairs during the day. And it's to their advantage to get people to comment who are pulling people in and out of companies. Almost everyone they ask about, is this the right time, to trade this stock? I'll wait. I would say trade out. Even our friend Aswath Dhamaradan, who is an amazing professor at NYU, the dean of valuation, he comes on CNBC and he talks about whether it's a good time to trade a business or not. Now, everything else he does and speaks about and writes is about evaluating a company in the frame of narrative, Tim. And his approach to valuation is neat. It merges up a lot of modeling with the story. But even when he comes on there, I'll notice he'll take, I won't call it the bait, but he'll take their questions like, would you buy this for 6 months now? No, I think you would wait. So to say that the impulse for us to be short term is very powerful in the marketplace.
Of course, yeah.
And I'll wrap this up by saying that it took me many years to get out of that feeling of being overwhelmed. Bit by bit, how I did it, Tim, was just the knowledge. And then, of course, in my career, I switched gears a bit from being a person who thought that you could probably raise a family with 3 by trying to publish poetry, because my degrees were in English, to someone who was like, yeah, I'm going to sort of start over, and this CPA business seems good. You can practice, make a decent living, and maybe still have some time. They never told me about tax season, how overwhelming that is in the profession of accounting, where you're working ungodly hours up until April 1st. And then audit season, which picks up right after that. It seemed like a very 9-to-5 type of business, but in actuality, it's not. And there is always a pressure to bill clients and to keep doing billable work. So as much as I really loved the profession, it wasn't for me. But that helped me get grounded too, as I learned about things I needed for my career. It flowed over into investing. The fun thing is that there wasn't a magical moment for me where I felt like I had made it to intermediate investor from novice investor. Just at some point I realized, by letting some of my anxiety go away, Tim, and just learning, at some point I naturally felt like, okay, I've got some information on how I'm doing as an investor. I'm still not great at this, but I'm a lot better than when I was trading.
Yeah, sure.
And I think I understand the basics now. It ain't rocket science. Some of it is complex, but on the whole, there are ways to do just what Peter Lynch says, which is to try to understand how great companies operate, to try to understand the products and the services, to invest widely, to invest in what you know in your circle of competence, and to be patient. Putting all that together, I think at that point I was probably on my way from being intermediate, getting to seasoned. And with that, we're almost at 11:30. So maybe we can pause here, take some sleep numbers, and I'll prepare us with the next little bit of our show, which is to talk through some questions.
Great. Let's see what we got for sleep numbers here. We've got a few. Jazzman, 8 hours, 25 minutes. Love that. Well done, Jazzman. Rose, 7.25 hours. Very good. That's great. Random Lake, winning the assignment yet again. The fewer hairs I have, the more haircuts I need to keep the survivors looking tidy. Very good. Sleep number, 7 hours. Like that a lot. Let's see. Cena telling us about 7 hours sleep for me. And a good morning walk. Feeling good and zooming out. 5, 10, 20 plus year view on life and investing. Great. Love it, Cena. This has got to be, I love this one, Rebel. Wiggly grandchildren waking during the night hours. Fun but shorter. 5.5 hours. Smiles all around.
Nice.
If I had permission to show you, I will ask her maybe at another time. For those who know, and then I'll kick it over to you if you want to read any sleep numbers. But Alicia Alfieri, she's on maternity leave right now. She had her first child. She had a little baby girl named Naomi. and she's been like, when she knows that I'm having a stress, this is just, it shows you the heart of Alicia, what kind and lovely person that she is. If she knows I'm having a more difficult day, Asit, she'll send me pictures of Naomi, because like I don't know, like I mean, I guess it's not for everybody, but for me, I'm like, yeah, of course. Will that, if you're going to show me a picture of an adorable baby, will I feel better? Yes. Yes, I will.
You
That
can't
will,
fight it, Tim,
yeah,
right?
that will lift my mood.
It's going to lift your mood.
That will lift my mood. So yeah, if I had permission to show a photo of her baby, I will. Maybe I'll get that and we could show it another time. But
Sounds
yeah,
good.
she had a little baby girl. Yeah, but if you want to maybe get a few other numbers.
Sure. So Zach's a fool says working with 7 restful hours today, gents. And let's see. I think we've got most of the sleep numbers. Wait, Karen, who's back with us through, I believe what she said was a Canada subscription, says 7 hours. Fermenting investor. I like that.
Yeah, it's
We
very
can see
good.
that with all your gardening efforts.
Yes.
Rereading my dad's book, Who Moved My Cheese,
Mhm.
today, honoring dad's memory and legacy. The book title popped up in my meditation. And I am just out of curiosity, Karen, is that your actual dad, or your dad loved that book? I read Who Moved My Cheese years ago, and so many parts of it stuck in my mind. I think you all have heard me say from time to time that the part in the book where he discusses how some people who can't keep a clean desk shouldn't be asked by their employer to make that their biggest metric, that they have an organized desk. They should try to do a little bit better, but focus on what they're good at. That was a light bulb moment for me. But
Yeah.
I'd be curious if that's your actual dad. And then we've got lots of great comments coming in from people who are telling us where they are in their journey.
Right, yes.
So why don't we do this, Tim? Let's go through our 4 questions. They won't take long, and then we'll start reading through some of these comments and interacting with
Yeah,
the
great.
comments. And we're going to capture all of this for our series. So as Tim said before, keep it coming. So I'm just going to ask us 4 questions. Maybe I'll ask Tim to reflect. Either you don't have to answer the question, Tim, but just you can reflect on the question if you want, or if you want to give it from your perspective, that'll be great. But what we're doing here is just creating a little bit of a framework that you can use. It could be the basis of a feedback loop. And in fact, loops are part of these questions, or it can just be something to sort of jog your ideas of what you want to do with your learning later this year. The first one, Tim, what strengths have you developed so far? I'm asking for any reflections on that, or you can, probably love, all of us would love to hear what you think the strengths you've developed so far are. And I'll put these in the chat, everyone, as we go along.
Okay, great. So I'll just say quickly on mine. My strengths are imagining, it really is product led, like imagining what a tech product can do, and how it might drive future earnings, future cash flows. I am very much a product led tech product type of investor. I focus in on how a market can develop and change over time based on what I've seen over the course of my career. So I don't lead with valuation. I don't lead with compensation. I lead with, is this a migraine level problem, and who's solving it, in a way that it makes me much more of a venture style of investor, which is why I've been in rule breakers for so long. That's just that is my strength. I come from a place of analyzing and looking at markets and product. That's my number one strength.
I'm going to take part of what you said and answer the question as well, because I think one of the strengths I've developed ties into, used a word, Tim, imagination. And while I consider myself a very creative person and actively try to increase my creativity, I realized some years ago that I wasn't allowing my creativity to be expressed in my investing. I approached investing, from a perspective of anxiety, and I'm still not sure why. It could be that when I finally got serious about investing, we were still relatively young and didn't have like much disposable income to invest. Then I started through my employer putting money away in a 401k. We had 3 youngins and um, enough to be happy, and we were really happy in all those years, despite a lot of curveballs I think I threw with the family in my different like ventures and disappointments. But basically, some level of anxiety was always there. Like, gosh, how am I ever going to have enough? The kids have to go to school. We have to retire, etc. At some point, I let that go. But I realized that as an investor, I was still very uptight. I mean, I had to be right, perhaps, on this thing. I had to be careful with my capital. And you do. I'm not saying that you don't have to be careful with your capital, but you don't have to be right all the time. I learned that. And at some point, Tim, I realized that I was having adverse reactions from seeing a stock go up a lot. So if I didn't know the company and I saw a company that maybe in today's world we would say had near meme status. You and I were talking about meme stocks yesterday on Full 24. I would just not investigate that. And I would form some kind of weird, like pseudo intellectual argument before even examining the proposition of why this wasn't going to work. It was a bad stock. And that lingered with me for many years. Finally got over that. And the strength that I've developed now is the strength of being able to imagine that something could work out. Oh, okay, Sharma, what if you're wrong? I mean, what if these guys aren't so weird and the idea not so implausible? What would have to happen for this to go right? Being able to do that and start from an objective place, again, going back to my Marcus Aurelius, what is this thing that's in front of me? And then let both my professional skepticism and my imagination have an equal say. Let them have both the same space at the table has been a strength that I've developed. And I think that's helped me avoid some companies because then I can imagine, but let the skepticism say, this isn't for me. And then accept sometimes that, yeah, this could be something very interesting just because there's so much signal here and it's already appreciated doesn't necessarily mean that it's not a great company. And it doesn't mean that you can't be patient. It may give you a chance to buy it if a better price is what you want. Patience can sometimes help with that. All right, so let's move on to our next question, which is, and again, you all can feel free to answer these in the queue. Anything you put in today is going to help us develop this series. So you can tell us the strengths you've developed. And the second question is, where do you feel stuck? And I might lean on asking Tim to actually answer this one rather than comment on this one, because I think it would be very illuminating for all of us to hear where Tim might feel stuck. It doesn't have to be right now. You can also just say in the past, here's where I felt stuck, an example of that.
No, I can tell you right now. I am still stuck with how to build the best valuation model. I have shortcut models that work for me because I know my brain well enough, Asit, that I will go down. I'm a very detail-oriented person, and I will dig into and get lost in details that sometimes may be irrelevant. So I think if I tried to build, I don't know how to do this yet. If I tried to build the most detailed and most functionally awesome discounted cash flow model, I think what I would do is corrupt my own process because I'd get lost in details that do not matter. I don't know how to do it in a way that would allow me to see the picture that I need to see, which is what are the units of value? How many units of value do we need to reach the goal that drives a big return? That's why I have these shortcut models, which is entirely focused on that.
Yeah.
I'm trying to isolate the units of value that matter most instead of getting lost trying to build out a 10-year fancy spreadsheet that has every little piece properly modeled out with properly modeled tax rates. That to me, I think I could learn it. I can do it. I have thought about learning it. and I have wondered, should I learn that? Because I don't know if that really works for me. And do I need it? Do I need it in order to do the work that I do, or is my attention better spent on learning more about value creation inside the markets that I follow? And I have chosen to spend more time learning about value creation in the markets than I follow, instead of trying to get great at discounted. Because, let me tell you, I am terrible at discounted cash flow models. I'm not good at it. I have my models that work for me. And so that's how I got around how being stuck on valuation. No joke, man.
Yeah.
If you are stuck on valuation, please know that you are not alone. I am a senior analyst at the Motley Fool, and I am right there with you.
Tim, I'm going to comment on yours and then give where I've been stuck recently. And I hope you remember hearing me say this. I've said this many times in our internal research meetings, but I'm bad at DCFs as well. It's not because I can't do the math. I can build a spreadsheet. I understand the concepts. And I'm probably one of the fewer people who actually, well, I say that and then I'll probably be lying, but conceptually can really walk you through net present value. I had to do that in my old job. I had to do that when I was an accountant. So why am I not good at this? It's because on the assumption level, it becomes extremely difficult. The more inputs you have into a modeling system, the easier it is for your assumptions to be off. And the thing about discounted cash flow models is that they do ask you to think through lots and lots of inputs. So even to get basic information, where a unit economics exercise might be really good in just a top-down common sense, like Tim does. Here's what the free cash flow yield is today. Here's where I think it can be in the future. Now, how many restaurants does this company need to open to do that? What kind of margin do they need to have at the restaurant level to do that? What could be the obstacles? That is, in some ways, can be a harder exercise, but it's more logical. It may take even more work to be able to do what Tim does, but you don't have this system where one assumption that you get wrong can sort of throw off all of the modeling. And this is because at the end of 10 years, we have to assign a terminal value to the rest of the cash flows. And that assumption is really hard to do in this day and age when technology changes so much. And I don't know if it was someone on our investing team, or maybe I was reading Damorodin recently, Tim, but someone reminded me that that's something that lots of investors get wrong. Sometimes you don't really understand how great those future cash flows can be, or you overestimate the worth of them. So that's very difficult. And I've been thinking myself, I want to do some more expectations modeling, going back to Mauboussin and just trying to build a model that understands or tries to understand what the market thinks of a stock today, because the market is also just expressing its idea of future cash flows. Understanding why something is priced today can help you as you're building your own model, however simple or however complex, on what you think those future cash flows are. So just talking shop here together, which is so much fun about mindset, because I think our members appreciate it well, but I can appreciate exactly where you're coming from. For me, where I've gotten stuck is in taking a swing. And this is not anything new, because members who have been around for a while remember I was discussing this about half a year ago, actually a year ago, where I took a pass on recommending some companies that later appreciated, a bit out of just abundance of caution, and a bit out of, well, I'm not sure if this proposition is really going to work out, where I had the ability to just have a smaller allocation in a real money portfolio and just say, okay, this has a little bit more risk, but I didn't do that. And I went to the doctor for this, Tim. Unlike you, I never had a chance to train with David Gardner, and he's retired from investing now, but he's still with the Fool and still very active in our foundation. So I booked some time with DG, and I said, Coach, here's my issue. I'm having a temporary problem taking a swing. It's not a case of the yips, right? Because I'm performing everywhere, but I have held the ball back I'd held the bat back on a couple of swings that I should have taken. Now, whether those were strikes or they were legitimate like balls at the end of the day, I probably won't know for a few years. But his message to me was like, you got to take the swings. I know it's difficult, but that's how
Yeah.
you build success. You're going to have to take the swing. And so that helped me get unstuck some. And actually, even a few of the stocks that I've been researching on the stock advisor side, I've argued a bit more forcefully for, because I realized that the way greatness is built in investing is being able to have a lot of good companies, some of which, even though you've done your homework, just aren't going to work out. Some of which you have a middling expectation of, but will surprise you. And a few of which you had an inkling they could do well. They're going to do really, really well over time. So that's where I've been stuck personally. Okay. So I'm going to.
Can we combine these last two questions? Because
Sure.
we're running short on time and we want to, this is the important part.
I'm going to put these in here and ask Tim to comment together. So what do you want to learn from here? And how would you rate your inner learning, assessment, improvement loop today? So think of an internal feedback loop. How would you rate that today? Tim, thoughts on this? And I'll put this right now.
Well, I want to, it doesn't, we're not asking you to, reveal all of your dark secrets here. What we want to know, so as you respond to these questions, just help us understand how we can help you. That's the only, that's all that matters here. What we're trying to gauge is, where are you at? What do you need? How can we be helpful in getting you from, let's say, novice to intermediate? Because there were a lot of people who said, I'm intermediate, or I still feel like a novice. That's fine. Let's see what we can do to get you to intermediate. We don't need to get you to seasoned right away. But what is it that you need? Because that really is important. And it could be any number of things. You could have multiple things you put in there, but maybe just for the sake of argument, what's the most important one thing? If you want to put in multiple things, that's fine. We'd love to hear it. But I want to make sure we capture these, because that's the basis of what we're going to do from here. Because I'm sure there are some roadblocks. I'm sure there are some things you'd really love to learn. Great. Let's find out what that is.
Wonderful. And Tim, we've got a lot of feedback here. I'm going to just take one, which is to read Karen's response, and then ask you to alight on any of the
yeah. And for
comments
our
that you'd like
moderator,
to.
please do not kill the questions right now, because we need to save these, because they're the basis of our. So Natasha or Eric, please don't kill the questions right away. We need to. We need these questions, so we need everybody's answers.
Just leave them in, please.
Yeah.
And for the B says, Asit, it's my dad's actual book. I adored my dad, but didn't always appreciate his book recs. Decades later, finding courage from what he modeled, belief, strength. So yeah, so nice to hear, Karen. That's wonderful, and makes me want to definitely go back and read the book again. And if you haven't had exposure to this, just a great book. And anyone of like our generation, Tim, has heard of this, Who Moved My Cheese? And I know it's got younger fans as well.
Yeah, for sure. I'm just capturing some questions here. So if you, I'm doing some screenshots. So if you want to keep going, keep going.
Right. Will do. So Random Lake says from 4 minutes ago, stuck at finding time and focus to dig out financials to do evaluation with a DCF. Think I could do it. Have skated by without it. Suspect it's a blind spot. And I would say here, Random Lake, first of all, thanks for that comment and sharing something that you feel stuck with. I would say valuation in general is something that many of us have a blind spot for at some points in time, and an experience of buying a company when we shouldn't have because it was really overvalued is one that teaches us we need to pay attention to this. I would say, for myself, I do a reverse DCF. I have a couple of ways, sort of similar to the way Tim thinks, which is big picture. Let me understand, okay, if this is the price, what do I need to understand about that? So some expectations modeling. I I do, you can just Google up expectations investing. It's a concept championed by Michael Mauboussin, who's a professor at Columbia University. A reverse discounted cash flow exercise can be sort of a step in that direction if you're looking to have maybe to do this in stages, because it will actually teach you something really fundamental, which is, hey, based on today's price, what kind of growth rate do either earnings or cash flow need to achieve over the next 5 or 10 years to justify what people are paying today? And it's a really fun thing to do. And there are many free spreadsheets out on the web. I know that our foolish contributing colleagues, Brian Stoffel and Brian Feroldi, have one that they have put out from time to time on the web, the free version of that. So that could be something that you use to just go and take that next step.
Yeah, for sure. As I'm going through these, I'm seeing a lot of folks who are talking about their strengths and their weaknesses. And one of the big themes I'm seeing is finding out, like either like getting out of analysis mode and into acting mode, or getting good at seeing what I don't see. There's and this is understandable. Like, how do I know whether the way I categorize this, Asit, is like, how do I know whether or not I'm making a mistake, and how do I avoid the mistake next time? Totally understandable. Like, you want to be able to process, learn lessons, and get better. That's how we improve. We evaluate and we improve. So I'm seeing that. And I apologize. I'm like taking so many screenshots here.
I
But
actually, yeah, I just have like sort of scraped copy control C. So I have everything up until tax accountant's question. So we can
Okay.
keep going and keep them coming, folks. Obviously, we're not going to get to all these answers today, but we are recording everything. We're going to look at them. So whatever you want to share, feel free. And I'll read some more now as Tim is doing that. Nathan R says, stuck in finding lots of interesting companies and filtering down to the best investable ideas. Also what I want to learn. I don't know. That seems like a pretty unstucky type of exercise. It may feel like you're getting stuck, but you have a great funnel here. So looking at lots of interesting companies and then filtering down to the best investable ideas. So what that presupposes, Nathan, is that you've got some kind of criterion. It might not be like the most detailed process, but you've got something in your mind already that is trying to separate out the good ones from the best. And I really like models and ways of thinking like that. A mental framework that says, okay, something's got to differentiate this from another business. Tim often talks about those crazy businesses that are solving migraine level problems. So I think you have something that you're articulating, and maybe that might be the key to getting a little more unstuck, which is to spend some time even further defining what best investable means to you. The more you can define that, the easier it will be to separate out the almost rands from the ones where you want to put your money behind.
Yeah. Completely agree with that. Other things that I've seen here. So the pessimist said, I identify the best companies, similar to Nathan R. Tax accountant saying one of my weaknesses is not knowing what I do not know. We've all got that one.
Yeah.
And so dealing with ignorance is another one that we can address. Rebel saying would love to see comparative methods of valuation for the same corporation. That's a little less mindset-y, but we could talk about that. We could talk about what does value look like for you, and what, how to think about it. That's something we could probably talk about. Darren saying, always enjoy you visually going through financial statements, as it is what I find difficult. Okay, that's interesting. Appreciate that one. And our pal Luella saying, identifying which companies to be patient with and which to ditch, preferably before I buy. Sure. I mean, and there's a principle of knowing what it is that, like, I think that's there is a mindset skill around identifying, whenever you're investing, you're making a prediction. So like being clear about what it is you are predicting. So then you can go back and as you evaluate progress, say like, well, like I think one of the distinguishing factors between novice investor and senior or let's say seasoned investor, Asit, is that we judge the success of an investment differently. So,
Mm.
for example, a novice investor will say, well, this thing tripled in like 3 years. This was obviously successful. Was it? Because that may be a good outcome, but a failure of an investment thesis. That is possible.
Yeah.
It is also possible that you could be right about an investment idea and things still go against you because of other factors. You could be right about what the inputs are, the influences are, and there could be an exogenous event or there could be a new competitor that pops up and still kills your thesis. It can still, but you were right. You were right, but the conditions changed.
Mhm.
So the way that you judge success, I think, changes as you become a more seasoned investor, and that is a mindset thing. That's a
Yes.
big
Yeah.
change in mindset.
It's a willingness to evaluate the information as it comes and not let the impulse to over congratulate yourself or over criticize yourself from understanding what exactly happened. Here, you were directionally right, but the conditions changed. Here, you're directionally right. And you also got lucky because you didn't foresee this part of the business that took off, but you still learned something. And
Yep.
that's, I think, one thing. If there's no way to shortcut um, going from in this game, I believe there's no way to shortcut from going to passable to really good. But that doesn't mean it's a years and years and years long exercise. Maybe for some people it's a year or 2 years. But one way that you can get close to a shortcut is just to be an observer, just to observe, okay, what just happened? Let me analyze that and take yourself out of the mix for a bit. It's not really about you validating your personal self. It's about you validating what works in your process to find companies that'll succeed and hanging on to them and letting some of them do their thing and perform for you.
Yeah,
So
you got to know yourself. Like this is
you do. Oh,
this. So this series is about if we could give it an informal title, it would be like this is the series that we are going to go through to help you know yourself, so that you can make steps that allow you to get better. Because when you're a novice, like what I think it was Tax Accountant says, I don't know what I don't know. I don't know what kind of investor I am. I don't know where my weak spots are. And you're starting to figure all this out. Moving from novice to intermediate is really getting to know you, because the most important input into any investing endeavor is what you put into it. You are the X factor. So your ability to analyze, your ability to be patient, your ability to put capital to work on a consistent basis, you're the X factor. So
so true.
you should be studying yourself more than anything else. That's what this whole idea is largely about. I think I've captured most everything
Yeah.
except for these last two.
Same, Tim. I think I got the last two and have all the ones from the start. So don't worry if we didn't get to your comment or question. It is going to be read and it's going to help us as we make this series. Really appreciate everyone going along for this ride for the last hour. It's been a lot of fun for me. I love hearing Tim's stories and also love hearing your stories and your bits of guidance and what you're up against, because that's what we're going to try to solve together when we get back from Foolapalooza.
Yeah.
And a couple more just came in. We're grabbing these as well. All right.
Yeah, no, it's great. I mean, and Fulio saying Just want to say hello, Mind Centers. Hello, Fulio. No, sleep number 7.5. Fantastic. Really good. And Shrinking Horizon. I'm going to capture that last one, and then we got to go because we've got more shows behind us here. So remember, we love you, fools. We'll see you after Foolapalooza for our I don't know what we're gonna call it, Asit, but we'll
get a snazzy name.
Yeah,
we'll keep everyone in suspense.
Helping people learn who, get to know you, meet the new you. That sounds terrible. That sounds awful. But
it sounds like a good slogan for a hair salon. But anyway,
yeah, there you go.
We should that out.
Yep, here comes the upgrade.
Sports cop ad.
So, yep. Seth, Tyler, take it away. See you, fools.
See you guys.
Yeah. Hey, Tyler, how's
Thanks,
it going?
I'm doing well. How are you? I see we made a slight tweak to the name or the theme for the show being AI chips, hyperscalers, and housing. It's kind of like one of these things is not like the other.
It's the everything show. Mostly it's
Yeah.
answer questions as they come in. Did you do any backcountry skiing out there this weekend?
No. It was the last weekend to take my little 4-year-old kid, and
It's not big on backcountry skiing.
Not yet. I mean, I'll do the proud dad moment for a minute, and he's 4 and he can pretty much ski anything beginner intermediate by himself by the end of the year. So I felt pretty good about that. But other than that, no, staying on piste, getting torched on the face because, if you're out on a glacier at 10,000 feet in the sunshine, guess what? You're going to get a lot of sun and you're probably going to come back burnt.
Yeah. Wow. That sounds like exciting stuff. Been much more boring here in Northern Virginia, where we are, except for the poor folks who are all being laid off right now. But we're here to talk about stocks and so AI chips, whichever. Throw the questions in if you've got them. Tyler is over there. How long have you been around the Fool now?
This is 2025. I think this is going into year 13 or 14. I can't remember.
13. And I just had my 20th Fooliversary in August. So it's been a while for me. Anyhow, I'm looking through the question queue here to see Shrinking Horizon ask something about a waiver to accept extra risk in order to buy MLPs, master limited partnerships, in a brokerage. I've never gotten that one. I've only ever gotten the extra risk stuff for, options trading and things like that.
Yeah, I don't think I've ever had that with MLPs. I'm guessing it really does depend on your brokerage. I have Fidelity. I never got that. I've had to get special.
Yeah.
It's the same for you for options and for international trading, but I've never had it for master limited partnerships.
There's weird tax stuff if they're in retirement accounts sometimes, but that's not really about risk. That's about about a pain in the tuchus when the tax time rolls around.
Right. I don't know if there's extra risk. I think it's an odd. I think it's an interesting way to put it because a business is a business is a business. These just happen to be formed in a slightly different way. That it changes the tax structure where as a partner in a master limited partnership, the company doesn't pay taxes because it passes the tax obligations for the partnership to you, and you pay your proportionate share of the tax at the end of every year. This is why a lot of master limited partnerships are not appropriate in retirement accounts, because you can't have a tax advantage asset on top of a tax advantage brokerage. That kind of starts to get into double benefits that the federal government doesn't necessarily want you to have. So I would be interesting to know which brokerage Shrinking Horizon has that requires the extra waiver. I'm going to take a wild guess and say it's Vanguard, because I have heard of Vanguard being a little bit extra cautious with its brokerage clients as to what they can and cannot. But Shrinking Horizon, if you want to let us know which brokerage you use, because I use Fidelity. I've never received such a thing. Seth, what brokerage do you use? Because you haven't. I assume you haven't gotten that for MLPs either.
Schwab, E-Trade. Those are the main two for me, Schwab and E-Trade, and I've never seen that one for MLPs.
Yeah.
But again, most of my individual stock investing is in retirement accounts. I can't remember the last time I owned an MLP, but I know I've never gotten anything about extra risk.
No, I own them. I own 2 of them right now. And I've never received anything on extra risk. I just get the extra tax, the extra paperwork come tax time, because you get a K1 partnership form instead of a regular 1099 dividend thing, which I tried doing it once. I did my own taxes once a few years ago with MLPs. I'm never doing that again. I hired.
Were you doing prep software? Or
no, I did it. Well, I was living in sub-Saharan Africa at the time, and I didn't have access to anything, so I did it all by hand. And it was between all the extra Microsoft Excel charts or Excel files I had to do and all that, it wasn't fun. Lesson learned. I know we're not supposed to give personalized financial advice here, but one little tip that I would say: don't try to do your own taxes. It's not fun.
Yeah, I pay maybe $150 for one of the software packages, and it takes me like maybe 2 hours some random day once everything is in to get it through, and to me that's money well spent. But yeah. So it's actually a Fidelity IRA.
Yeah, so IRA, and that's where I think it's going to get complicated. I don't know. The extra risk I feel like might just be the default message they send to you for investing in MLPs and IRAs, because what happens is when you own a master limited partnership in an IRA, you can be subject to what's called UBTI, unrelated business income tax, or UBIT, excuse me. And so this is it's kind of a thing where it's basically saying, like, look, if the purposes of the account or the MLP aren't appropriate for business income, it can be a taxable event in your IRA. There's also some extra headaches and paperwork that you have to do with it being in your IRA. The best example that for unrelated business income tax I've ever heard is basically, like, say you're a university, which is a nonprofit, but you have a pizza shop in like the student union building. You have to pay taxes on like the earnings you get from that pizza shop, even though it's like part of the like the big nonprofit organization that is a for-profit entity within it. So that's considered unrelated business income tax. The MLPs within an IRA is the same thing. So if you want to own MLPs, it's just a little bit easier. If you have an IRA with Fidelity, you can also own a brokerage and then just, make your investments that you want in MLPs in brokerages.
Yeah. I think that was the route I went. And then eventually I was like, yeah, you know what? I can find easier things to do. I'm a lazy person at sometimes. Yeah. In fact, some of this stuff, I think I got mail the other day might have been my father-in-law. I think I got some stuff that was mass MLP tax related stuff came in the mail for him because he wasn't around. And so we were the forwarding address, and I looked at it and I said, yep, I'm glad I don't have to deal with that stuff anymore. So that would probably be it. All right. What else have we got here? Any questions going back a while ago that are good for us? Stuff about neat desks, staying calm. Staying calm is probably a good thing to talk about.
Looks like there's a lot of mindset comments left over from the previous one. But for people who are perhaps joining us from YouTube and are looking to ask comments or questions, you'll probably notice that the comments are turned off on YouTube. So please go to slido.com, enter the code FOOL24, and you can ask there. It helps, just like Seth and I, we can kind of keep everything in the same spot and get questions there. So if you're not a Fool member and are watching through YouTube, go ahead to go to slido.com. You can get your questions in. And as we wait for some questions to come in and perhaps dig up some of the older ones to help people answer their questions, we can do that.
One of the topics for today probably would be, if I were asking questions, it would be, wait, what's going on? Why are we on freak out time again? And of course, it's because we're hearing more about more tariffs coming on, every company, although specifically perhaps 15 or dirty dozen or something. It's all rumors coming out of the Trump White House. You don't know what's actually going to happen and whether that story changes from one day to the next. But overall, we've gotten a decent number of questions the past few weeks about people are seeking safe haven stocks. So in general, when stock markets crash, there's almost no such thing as a safe haven stock. But people have been looking at the same time for, okay, are there companies that are sort of less at risk for these tariffs? And it might seem, this is something I shook my head because so many conference calls I read recently where the CEOs and the management were saying, oh, we're totally fine. We moved 3/4 of our suppliers out of China into Vietnam and Indonesia. And I was just sitting there going, what makes you think they're not next on the list? Like, why would you assume that Vietnam and Indonesia wouldn't just be next on the list or anywhere else? And so I imagine we're going to find out something about that in the next couple of days. But certainly right now, I would say any import into the US and any company that you own, which more than likely is bringing in either raw materials or finished goods or parts from other places, is going to have some fairly significant cost increases, because of course the reality is that foreign countries and foreign suppliers don't pay the tariffs. We all know that now. That's a myth. They might try to eat a portion of the cost, but if you're running like a raw materials or a parts shop in, say Vietnam or Indonesia, you're probably not generating super high margins. You don't have a lot to give on price. And so that price is going to be paid by the importers and the OEMs that might be over here building from parts, and they're not going to soak up that cost either. They might soak up a little, but for the most part, the studies show they pass it on. They pass it on to us when we buy stuff. And then there's interesting things that go on, like when the washing machine thing happened last Trump administration, washing machines got very expensive. Dryers weren't included in this tariff scheme. The dryers all went up too. Well, why is that? Because everybody kind of thinks of them as the same thing. So the dryer sellers just marked them up the same amount as washing machines. And so they got free margin. So to the extent that a company is like in the US and to the extent it is in any way advantaged, if it doesn't have costs coming from overseas or materials, you can expect them to also raise their prices. Maybe not as high, but they're also going to raise their prices just to capture that margin and be, slightly undercutting any foreign competition. So probably this means higher prices on everything, which, people dealt with for several years and didn't quit spending. One of the interesting things to me about the belly aching about inflation that went on for so long was that people were like, oh, restaurant food is too expensive. Yet every quarter people were going to restaurants more and more. And I use restaurants as a prime example because it's the easiest thing to not do, right? You can cook at home, but people just continue to spend that. So we're going to find out probably very soon what the average consumer appetite is for more inflation.
Yeah, and we got a question about this in the 8 o'clock hour too, on the idea of like, well, now that we know tariffs are coming, it's more certain, right? And it'll make it a little bit easier to invest because we know that these structures are in place. But I would kind of caution to that mindset too, because a lot of the ways that we are implementing tariffs here in the United States is very, very different than how we have historically handled tariffs. Typically, tariffs are something where there's some horse trading in Congress. It's actually enacted within some laws and then signed by the executive, whereas this most recent administration has been using some legal, I don't want to say technicalities because that sounds very diminutive, but kind of stretching the boundaries of some laws on things like national security and things like that, which gives the executive power, kind of unilateral power to enforce these, under the guise of national security or something like that. And so because you don't have that like congressional horse trading and kind of the traditional lawmaking thing, I don't know if it makes it any more certain, because it kind of allows the executive branch to kind of change their mind. And one of the things, I was reading some CNBC articles about earlier today about, these tariff regimes, and it seems like it's still very much in flux. They say they're going to be implemented, but the actual, like, what they're going to enforce seems to be changing by the day. And also mentions of like country by country exemptions, which kind of sounds like, hey, if somebody makes a phone call and does something nice, like maybe they'll be exempted. So in terms of the certainty with tariffs being implemented this time, I don't know if I can really go with that, because there is this kind of weird thing where it's like, we're not in any more certain times when the tariffs get implemented, because they could just be reversed just as easily as they're being implemented.
Yeah, the only certainty right now is a weird uncertainty. We're in the midst of tariff by whim because of the way Congress has let this go, giving all the authority to the executive branch to say, like, yes, you're absolutely right. The fact that we don't make enough washing machines in the U.S. is a national security problem, and we should be able. I mean, clearly it's not, right? Nobody in the U.S. really cares where their washing machine is made, but that's the conceit that has allowed this to happen. And the other thing is that I ironically, or maybe not ironically, this probably isn't going to accomplish what one of the stated goals, whether it's a real goal or not, is different, but probably wouldn't accomplish what one of the stated goals is, which is to bring like factory jobs back to the US. One is like, people don't really love factory jobs that much anyway. What people liked about factory jobs was like getting high wages and protections and things like that they got really if they were factory jobs and unions a lot of times. But factory jobs aren't always like the most desired jobs. And the thing about making factories in the US is it costs a lot of money. It takes a lot of time. And if you are somebody thinking of expanding your manufacturing footprint in the US, you're really going to think twice, because again, the certainty of uncertainty. Another administration comes in, somebody makes a phone call, says the right thing to the right person, and suddenly that tariff is dropped. Well, you were looking at potentially, say you thought you had a 25% price advantage because you didn't have a 25% tariff on your goods being from the US. Suddenly that's gone. The investment in your factory is wiped out, or you're competing on a more level playing field than you expected. And so these are not slam dunk policies to bring manufacturing back to the US, again, because everything is just so weird and so whimsical in the bad sense of the word.
Yeah, I mean, I think we could probably do a really, really long diatribe, but unfortunately we really start to dabble in politics, which is perhaps not our strong suit here. I'm going to try to do my best to answer Let It Ride's question, who just came in, because we had a deal today that was announced. Mortgage company Rocket Companies agreed to acquire another mortgage company, Mr. Cooper. They're a Texas-based mortgage originator. Rocket Companies has a bunch of different components. Rocket Mortgage is their largest, but bringing in Mr. Cooper obviously boosts that mortgage origination business. It was a $9.4 billion all stock deal. As as the deal was announced, Rocket shares are down 9% as part of the deal, because whenever big merger is announced, it always seems like the acquiring company stock tends to drop just a little bit, or a lot, depending on how much the market thinks that it was a good or bad idea. The question kind of specifically is, will this lower the value of Redfin due to Rocket going lower? I mean, technically, yes. So in addition to the purchase of Mr. Cooper, Rocket Companies also agreed I think it was a couple of weeks ago, to acquire Redfin. And it was, again, also an all stock deal contingent upon, with a fixed ratio depending on Rocket's share price. At the time of the deal, I think that Rocket Company's stock was considerably higher. I'm trying to pull up a slightly more recent chart that kind of explain, to see its stock price. it's maybe a little bit higher than like right after the announcement for Redhaven, but it is considerably lower. And that's the thing that people who are investors in these like acquired companies is, if, you know, for some reason the market really doesn't like what it sees with these deals, and the stock price goes down considerably lower, the value of the deal could end up being lower. It's like, you know, the headline says $9.4 billion, but say like rocket company's stock drops another 15-20% from here, all of a sudden the value of that deal goes way down. So, you know, just do keep that in mind. Talk about added complexity. You're adding both a competing mortgage originator with Mr. Cooper and trying to integrate Redfin, like all within a couple of weeks of each other. Look, M&A is hard as it is. Trying to do this all at the same time really feels like trying to walk, chew gum, juggle while on a unicycle.
I feel like we're in the 80s a little bit here, like the 80s when companies were just doing so much M&A. I guess we're not seeing as much as we did then, but yeah, we see a decent amount of it. Back then, it was really the time. I had an uncle who was an M&A guy at a company that ended up buying like dozens of other companies and becoming like a really big company. And you know, one of the reasons you see M&A sometimes is that you've got folks in charge of it who are, you know, incented for that. And to judge by the number of Ferraris in my uncle's garage when I was growing up, he may have been incentivized fairly well to go out and find other companies to be absorbed by this one entity. Yeah.
Yeah, it always seems like the people who win the most in M&A are the M&A bankers and the lawyers and whatnot. But
Yeah,
it is at least from I'm trying to think like on a strategic thing, like why Rocket may be doing this. I mean, obviously the sale of existing houses, or, you know, basically housing sales are way down relative to what they were 5 years ago. You know, and companies like Rocket, Mr. Cooper, they're all basically like tangentially associated with, you know, housing sales, because why else are you originating a mortgage? And, you know, refinance is not a lot of people are looking to refinance right now, because anybody that did refinance did it in 2021 when rates were much lower. So yeah. If I was trying to read through the tea leaves, I think Rocket Mortgage's management, or Rocket Company's management, is basically saying, look, this market's in the dumps. Everyone's kind of having a miserable time right now. And so why not be extra aggressive in consolidating an extremely fragmented industry like mortgage origination? You know, there's private and publicly traded mortgage originators across the country, and there's hundreds of them. And there isn't, I would say Rocket is probably one of the most dominant, but even by that standards, it's pretty small relative to how many mortgages are actually originated by them. So it's a bold move, but the thing is with bold moves in a down market, it can blow up in your face. Like, it could go either way. You know, if you're very optimistic about the idea, yeah, sure, they're trying to like consolidate in one of the worst times of the market, probably get some good deals on stuff, and maybe emerge better on the other side. But sometimes getting through the other side with all this extra weight can be additionally challenging.
Yeah, at least they didn't finance it with debt, right?
Well, for now.
For now, yeah. All right, what else have we got here? Anything back in the queue further back? Here's an interesting one. Considering from Paulie D, 23 hours ago. We're going back to Sunday. Considering selling STZ, seeing what seems to be less enthusiasm toward drinking among younger generations. I find that one interesting, because I have I'm not a younger generation, but I'm one of those people who just doesn't drink any beer, any wine, any booze at all anymore. So STZ is Constellation brand. So if you're drinking any Corona, what else do they have in there? They've got Mondavi on the wine side. I guess they have lots and lots of stuff, right? I'm reading there. reading through their description to kind of get the main ones because I forget. It's funny because I see stuff in here I've never heard of. Kim Crawford, Rufino. I guess I don't drink enough wine. Mondavi, I know because the dude came from my hometown. What's that?
Okay. Yeah,
Well,
I've heard of Kim Crawford. I did work in restaurants for a while, so
there you go. So yeah, sales across the entire beverage industry have not been great lately, and it seems like small brands kind of gather a lot of traction and come up quickly. You got like Poppy, or think of a Celsius or something. Think of and those are both non-alcoholic, of course, although there's so much caffeine in a Celsius, you might get even bigger buzz. But it's a business that is like, I feel like the speed of entry and the growth of competition in beverages in general is faster now than it was like when you and I were growing up. Maybe we just weren't looking at it, but you didn't suddenly have like a brand new beverage become popular every 5 years or something. It just didn't really happen. And so, social media has changed things. People still like drinking, but there is an awful lot of non-alcoholic drinking. And at the same time, you go out to bars and places and they will have more non-alcoholic alternatives there. So what that means for Constellation long term, I mean, the stock basically has dropped from the $250 level, to where are we, sort of 183. But it trades at like a free cash flow yield of 4%, and the top line is kind of still headed upwards. What's the compound annual growth rate is like in the 5-6% range, so it's slightly ahead of inflation worldwide. But with a free cash flow yield of like 3.7%, that's not like a home run value, right? Because it's a fairly predictable kind of business, right? If you look at the cash flows over the past few years and you look at the revenue line, you can be a lot more certain about what that's going to look like in 5 years than you would with a lot of other companies. And so, if you're looking at 30 years before you get the free cash flow back that justifies the investment, maybe that's not the one for you. If it were trading at something closer to like an 8-9% free cash flow yield, maybe you'd be more interested.
Yeah. Actually, I was going to bring up a chart to kind of show like how much it's not just Constellation Brands when we're talking about basically how much we're seeing struggles in like the booze market, I guess, if you will, because by all accounts, Constellation Brands is actually holding up considerably better than some of the more they're the Europeans, but they're also much more like spirit based. With Constellation Brands, with its wine and beer, has been a little bit more resilient. It seems like in the wine, beer, spirits business, spirits are the ones that are really taking it on the chin in terms of like what is popular. If you look at in this chart here, the yellow, the blue, and the green are Diageo, Pernod Ricard, and Remy Cointreau, respectively. Pretty much all spirits in their portfolios relative to in the purple is Constellation, and the pink is Anheuser-Busch. And it kind of gives you, it's when it comes to like alcoholic beverages and stuff like that, they do very much run in cycles. Like people, like there's like a wine kick for a couple of years, then it's a beer kick, and then it's a craft beer kick, and then everyone says, oh, the craft beer is too expensive, and they just go back to the cheap lagers, and then they go to cocktails. So it certainly, when you look at, yes, drinking is down in general, especially with younger generations in the United States. I can't, doesn't seem that way here in Georgia. Drinking is a national tradition here. Look, it's a cyclical industry. I would not be shocked to see like the spirit companies do better again, as tastes change or fads change. I don't know, some blog that puts a guy in a nice handlebar mustache and a fancy, butcher apron and makes some fancy cocktails for a little while, and all of a sudden everybody wants to, start drinking cocktails again. It's kind of like the I don't want to be. It sounds dismissive, but like there's the TV show The Bear, which was about like Italian beef sandwiches in Chicago. And it just seemed to happen to correlate with like, hey, Portillo's is really popular right now. I'm not saying that like all of Portillo's success is, contingent upon The Bear, but it certainly helped it.
But then it went to a super fancy restaurant that
but
loses a lot of money. It needs a really harsh guy to come in and tell them no chargers. We're not making any money. But I agree. It is a little cyclical, and it depends. We have kind of healthful products. Some of it, there's a lot of like scam health products out there, and there's a lot of weird misinformation, but not drinking is definitely better for your health. Like, booze is the world's favorite carcinogen. People will get up in arms about, like, they hear that, such and such has a tiny risk of cancer, and they will be holding a beer or a glass of wine or a cocktail in their hand while they discuss this terrible development, forgetting that the thing they're holding in their hand is actually like, everybody agrees that it's a class 1 carcinogen. So it's very popular. It goes in cycles. To the extent that people get away from it, I don't know. And then around here, I would actually start to wonder, just from where I live, Northern Virginia, how many people are switching from booze to weed? Like the folks who are into the booze because they want to be drunk. They're not doing it necessarily socially, but they want to be drunk. When I'm out and about, it's incredible to me how much pot smoke I come across, like on the Beltway, literally, like driving on the highway at 70 miles an hour. You can smell it in the cars behind you. And so sometimes I wonder in some markets if there isn't some switch over to marijuana legalized or not, for folks who are kind of looking for that from their chemicals. But that would probably take a lot more digging into the data to find out.
So I see a question here from about 3 hours ago that got a lot of upvotes. So it seems like there's a lot of demand for this particular one. So Zach's a Fool asked 3 hours ago, companies like Berkshire Hathaway and Brookfield offer a level of diversification on their own. Are there other one company diversifiers you could recommend? We could go in a whole lot of different directions there, because it's not just one company diversifiers. One of the beauties of investing today is there are passive index products, which is not too dissimilar from owning one of these all-in-one stocks that has the built-in diversification, where whether it be the S&P 500 and you can pretty much carve up and cut how you want to invest on a theme, on a diversification basis, on an asset class through these passive products. And so I want to start with that, because if you're looking for diversification and resiliency in companies, and I mean, Berkshire Hathaway has been a default for me in this regard. But if you're you're like, oh well, there's Berkshire Hathaway, but what else? There aren't a lot of other option in this regard. A lot of the like diverse conglomerates have kind of gone to the wayside. It seems like the 2010s has been very much a time of deconsolidation, specialization. You're a company that does one thing, you do it well, and and that's kind of how it goes. I mean, we saw the breakup of General Electric, United Technologies broke up. I'm trying to think of there's another one that's like, Honeywell is considering breaking up as well. So, those diversification offerings are not really as much on the table anymore. And I maybe it's a cop out to say, like, looking for ETFs instead, because it's obviously not a company, but you're getting the same effect. And certainly with low fees and what is available today with ETFs, I think you might be better off looking in that direction rather than trying to find somebody other than Berkshire Hathaway or a Brookfield, for the simple fact that there are conglomerates out there, but I don't even know if they're really that good. And you can kind of skirt the not as good capital allocator management problem with ETFs and things like that.
Yeah, I would agree with that. And make sure you take a look at the components in the various ETFs, how much they hold. Sometimes you get into an ETF, And if you try to go more specialized, and I'm thinking here in terms of like, I think the last time I looked at Kathy Wood's space ETF, there wasn't a whole lot of space in there. There was stuff like John Deere, which has some GPS like enabled.
Oh, I thought that was
gear.
for agriculture on the moon and agriculture on Mars.
Yeah. And so you want to look what's in there, because and a lot of the ETFs, what's in there seems to make sense. And some of these, what's in there doesn't make sense, but they're just fulfilling the ticker. And you may be surprised by like how much of what's in there. So I think I'm trying to remember how much NVIDIA was as a component of the S&P 500, a month or so ago. I think if you just had an S&P 500 index fund, you might have had like something like 6 or 8% of your holdings in NVIDIA at that point in time. I was trying to grab it right now, but it's so make sure you grab
I think
it.
I got it right. This, I might be wrong here, but this is what I have. It's NVIDIA is, I'm using, what is it? Slickcharts.com. This could be wrong. So, but we'll see what it goes here. It says that NVIDIA is 5.68% of the S&P 500 ETF component for the Spider S&P 500. NVIDIA is 5.95 and Apple is 6.92.
Yeah, and that tracks with what I was seeing, and it tracks with sort of how how those indices were moving when NVIDIA was doing really well. So if you're the type of investor who doesn't want more than like 6% of your portfolio in NVIDIA, if most of your money was in an S&P 500 index fund, you already had that. You already had that weighting, and you had 500 other things, but you already had that. So I think it's good advice to look at the ETFs. There's so many out there, but grab the sheets off your brokerage, look at the expense ratios, and see what's actually in there.
Yeah. What else do we have here? I mean, there's obviously lots of questions. Unfortunately, a lot of them are a little bit outside of our, at least certainly my expertise. I can kind of hit this one, and I'll let Seth kind of fish around while he's looking for another one as well. I'll try to dance around this one a little bit. Kevin Walsh asked 3 days ago, what do you think of Con Ed, or Consolidated Edison, which I believe the ticker is ED? And let me just double check. Yep, ED is the ticker for Consolidated Edison. Is
and not what ED means anymore in popular culture, is it?
Yeah, unfortunately. So the question is, obviously, is it a buy, sell, hold? So Consolidated Edison is a diversified regulated utility. I believe that most of its offering, its regulated entities are mostly around New York City, as well as parts of the metropolitan area, Mid-Atlantic as well. Please don't quote me precisely on it. I don't have the entire geographic breakdown of Consolidated Edison. But as far as regulated utilities go, I mean, regulated utilities are pretty simple, easy to understand businesses, and regulated is pretty nice because state regulators basically tell them, like, you can have a 9% return on equity based on, somehow, and you can have a debt to capital ratio of this, and that's kind of how they go. And they're allowed to do that, and you're allowed to spend money on upgrades or new installations or whatever, capital spending that needs to be done to ensure reliable, cost-effective service to customers. They kind of get the regulator okay to do that. I believe Consolidated Edison, because it's diversified utility, it probably also does it does like gas delivery as well, so gas distribution. Again, regulated businesses I think have been fine lately. They're typically dividend payers, growing dividend, use a lot of debt, but it's regulated, so it's not like they can get in too much trouble with debt, because the state regulators don't necessarily let them push their debt leverage too much. One thing that's going to be, I think, is very interesting to follow with like electric utilities especially, is this idea of electricity demand growth for the first time in decades, and how that's going to impact a lot of these companies. I want to say for at least the past 25 years, much of the capital spending that these companies have done has been about portfolio turnover. It's maybe like, it's things like storm resiliency for its transmission and distribution lines. It's maybe taking old expired energy generation plants, like old coal plants, old nuclear plants, or something like that, and either decommissioning them because they're too old and can't be, economically they don't have a lot of life left, and replacing it with a new asset, or recommissioning, or trying to make them usable again. That has been the bulk of capital spending for a lot of these companies, and growth has not been something that they have been accustomed to. And it's going to be very interesting to me to see how much it actually affects regulated utilities, because there is going to be pretty considerable demand growth, not just on power generation, but more specifically the distribution and transmission lines. Most of, like, when you talk about like data centers and AI development, a lot of them are signing power agreements with like independent power producers. The man, I'm blanking on the name right now, but it used to be Constellation Energy, but I think they're changing. Well, it is Constellation Energy, because I was getting confused with Constellation Brands we just talked about. That's a merchant power producer. They have a lot of nuclear plants. They like signed a deal with Microsoft, Brookfield, and some of its like power assets have been signing deals as well for with data centers for renewable power, things like that. There's this idea that all these these companies are going to supply their own power. But it's not like, Consolidated or Constellation Energy is going to go build a nuclear plant right next to a data center. It's like a theoretical purchase where it's like, yeah, we'll buy it from you at this set rate, but it's not like that specific electron from Constellation's power plant is going into the data center. It still has to be transmitted.
Rejected too, right? Like sometimes proposals get rejected because the regulators look and they say, yeah, but then the households won't have enough energy. So no, we don't want to do that.
Yeah. And there's the, not just the households not having enough energy, but also, hey, you're going to put so much demand on our infrastructure, the actual transmission and movement of those electrons, that it's going to, strain our system. And so when we're looking at a lot of these, AI demand growth, there is going to be an immense amount of spending necessary to enhance our grids to handle it. And we haven't had that in a long time. And I am genuinely curious when, these big regulated utilities are going to have to go to their regulators and say, hey, we need to like triple or double our expenditures to not just, do the turnover of our legacy assets, but now we actually have to invest in growth. If like that's going to change like how much debt they can take on, how much they can pass on to customers, because why should residential customers foot exorbitant bills for all this demand for commercial partners? So like, how does that change that dynamic? I think it's going to be a very interesting and challenging time for regulated electric utilities that we may not necessarily have been thinking about for a long time. And I don't want to say that like, oh yeah, they're all going to cut their dividends, but there is going to be like hard cash considerations for a lot of these companies that, may have to rethink the way they've been paying dividends for a while.
Yeah. And we can't discount the fact that for several months, at least, utilities somehow became meme stocks. Well, somehow it's because the people pushing AI started to push utilities. So you saw utility stock prices like go through the roof, which again makes very little sense if you have even an inkling of how they operate, which is, capped returns, investing plans that need to be approved, immense pushback publicly once rates go higher. And then that's even before you get to the second order issues like what's it going to cost them to send all this money to data centers? And will they be able to afford that? And who will pay for it? And I follow this fairly closely, at least in like kind of ad hoc local level. I get all sorts of news alerts about, so-and-so wants to build a data center here. And invariably it's like Ohio or something. And they're like, oh, this is great. We don't have the problems they have in Northern Virginia, which is like the data center capital of the world, except that they're still on PJM. They're on the same grid as Northern Virginia. So like you go to Ohio, you don't escape the problem of tight electricity supply in Northern Virginia. You're just, a few hundred miles further away, kind of part of the same pool of electrons. And so this stuff is really going to get difficult, especially because moving that power is the toughest part. And it takes an enormous amount of time to get high capacity power lines, figured out, let alone like approved, bidded, built, and so forth. So yeah, I haven't looked at some of these utility stocks for a couple of weeks now, so I haven't seen how far they've pulled back. But definitely, if you are fairly new to this, don't get meme stocked into utility stocks, because they do not have the same return potential as like a chip company or something that has just started selling a bunch of materials. There was another question further back in the queue that I thought would be fun to take a look at, and it was about Crocs. And I'm wearing a pair of Crocs right now because why not? You guys can't see my feet or my hairy toes, so why not wear the Crocs? And I try to remember, where is the question here? Did I find it? Oh, how did I lose it? I scrolled past it. All right. Well, we have a question about Crocs. And I haven't
I'll
checked
find it
in
for
on
you,
them.
and you can
Sure.
you can start.
I haven't checked in
I got
on
it right
them
here.
all right, read that out. Read it back
Yep.
to me. Where did
So Moncho from Shy, I'm guessing Moncho from Chicago, says, I like the Apple initiative. By the way, have any of you looked at Crocs before? It's 6.6 times earnings. It's looking interesting. It looks like they were asking
There we
during
go.
the morning show because they're asking
Yeah.
Jim Gillies. But you know what? Jim's not
He
here.
was probably-
So
Yeah. He was probably wearing Crocs too. So I haven't checked in with them for a while. I follow footwear a little bit, and Crocs is one of those weird companies that it got huge for a while, and they started doing things that seemed ludicrous to me at the time, like they were buying their own foam companies and so forth. And I happened to sit across desks from somebody who worked at GE, a fool who worked at GE, basically handling foam. And so he's like, foam is a commodity, dude. Like, you wouldn't build your own foam plants. The dumbest thing you could do. You buy it from wherever you get the cheapest source, that meets your requirements. But they were doing stuff like that. This was years and years and years ago. Probably when the stock was, $9 a share or something like that. But Crocs, the demand has fallen off here just the last couple of years from the growth they were showing, but it's still there, still growing. They did like 4.1 billion last year in revenues, and they have really good margins for a company that's selling for the most part a molded rubber EVA shoe. It's like 60% gross margins, almost 58%. And a free cash flow margin in the 23% range. And this is not a market where it's tough to duplicate the product. You can go on AliExpress and buy knockoff Crocs, for next to nothing, or you could in the past. And I used to, and they were just as good, but it's just easier to pay full price for Crocs if you're in the US. And so they generate a lot of free cash flow. They are trading for, like 7 times earnings right now. I haven't looked at their most recent conference calls to see, what is causing, any recent reaction in the market. The price doesn't actually look like it's crashed, crazy amount lately. So I would say, yeah, keep digging into Crocs because it looks pretty interesting. I have here that their average return on invested capital is 40% over their weighted average cost of capital. That's so high that I assume I must have an error. There's got to be an error in my data or something. If that's true, that's pretty incredible.
I see it on the data provider I have there over the past 12 months. I got 30.7 return on invested capital.
Okay, so there's got to be some kind of but that's still not bad. And a free cash flow yield of 8% is actually pretty decent for a company that's growing the top line. What's the compound annual growth rate on the top line has fallen back the past couple of years to like 7.4%. Before that, it was like in the 20, 25% range. So that, just kind of the change in the growth rate may be the reason, because they got pretty stellar margins still making money. So it just must be people adjusting to like, all right, maybe they're a 10% grower instead of a 25% grower.
We have these are like a lot of there's a few questions in here that are not necessarily individual stock, but there's a lot of like, hey, are we headed for a bear market? Macro is always like a great for talking heads, but actionable is rarely effective at best. But it seems like there's enough questions in here to kind of like talk about the idea of like, some are saying like partying like 1999, like we're in some sort of bubble. Are we headed for stagflation? Obviously there's a lot of people who seem to be a little tepid on the market outlook with some of the things we've been talking about, slowing. We get jobs market report on Friday to see how that is doing. Obviously inflation has been a little warmer than expected, so the Fed has kept interest rates relatively high. I think there's people are obviously looking for what to do in these sort of things, as if and typically that means taking some action. And I find that for a lot of people, taking some action it's like that, doing something must mean you're improving it, but sometimes taking action just makes things worse. Mm-hmm. And when it comes, at least, and this is my personal thing, because again, we can't give personalized advice, and and Seth, I'm sure you'll be able to share your thoughts on how you handle these sort of situations. But like, at least for me, I kind of used the analogy earlier. It's like playing team sports, ball sports, basketball, football, soccer, anything like that. The defensive position is more or less the same thing, right? It's like be up on your toes, good shoulder width stance, and be ready to react to anything. And that's kind of, at least for me, when we're trying to like better understand like, where things are going. Are we headed for a recession? Are we in stagflation? Are we in a bear market? Yada, yada, yada. It doesn't really matter what it is. We as investors kind of just need to be ready for anything, and kind of have some sort of portfolio defensive position that will allow us to react and make good moves, rather than trying to like overly aggressively pursue AI, or have no cash on the sidelines to take advantage of bear markets or things like that. And so for me, when all this bubbling up of bad times coming, that's really the value of having that larger cash position, having a relatively diversified ownership of stocks. Motley Fool has always kind of said, like, what is it, like 25 stocks tends to be like the generalized good idea, or for
at least have a couple
portfolio diversification. Yeah. And so, but that doesn't mean like 12, 15 like NVIDIA vendors. It's going across to some different sectors and things like that, and trying to find a little bit of balance there. And that's what those things are for. They're not for when the market's doing great. It's for when things go bad, and things eventually go bad. And that's why you want to take a defensive position. You may lose out a little bit on the big gains because you have some cash on the sidelines. You may be diversified into things that aren't absolutely ripping like AI, but when times go bad, it falls back. When things go bad for a particular sector, you're diversified enough, you have enough cash to deploy that you can take advantage of those situations.
Yeah. And unfortunately, like right now, if you've got money in stocks, you've lost some value in many stocks at this point. So the time to have been planning was, several months ago. And actually over the past 6 months, I had been selling a decent number of stocks, and it wasn't because I was sitting on the porch in my rocking chair looking at the horizon saying, yep, recessions are coming. It was because I looked at a lot of the companies I own, and the valuations were kind of nuts. I'm thinking of stuff like Wingstop. and many others. Like I just looked at him, I said, I just don't see that valuation holding up. And I've been through this before after the COVID pop and everything. So I started selling a decent amount of stocks, and I rolled that money into like CDs and things, because I didn't have a lot of ideas that I thought were super compelling at the time, where I maybe already didn't have positions. And so I ended up doing better maybe than some folks, because I had been offloading stuff that has since been crushed. But was I still holding a lot of money in stocks that also got crushed? Yes. So I didn't predict a recession. I didn't predict a stock market crash. I looked at some valuations that looked stretched, and those have come back. And you can buy some of these stocks back later. So unfortunately, one lesson to learn is that if you are looking at companies you own that where the stock prices have come down, like if you were looking at it 3 months ago saying like maybe this was too good to be true, like this thing was trading at 60 times earnings but was only growing at like a 18% pace, you've learned a valuable lesson that you can use kind of next time around when you see that, and don't be afraid to. It's a much easier for you folks out there to sell when you think a valuation has been reached than it is for us. Because like if we own a stock but we also recommend a stock, like it's much more difficult for us to say like, well, I think the valuation is a little tough, we should start selling here, because often that doesn't happen. Often stocks continue to press past that point. And in growth stocks, your biggest danger is is getting out too soon when it looks expensive. Ask me, Chipotle, how I know that. I've probably left $1 million sitting on the table just on Chipotle, by being very clever and having gotten rid of it when it was too expensive. So you can definitely overdo it.
I did the same thing with Cintas. That Cintas is my, I'm so clever. Watch it, double and triple in value.
Yeah. But, sometimes you have to, and you have to become kind of an investor to do this. You have to say, is a company that's going to grow 15% a year worth 50 times earnings? Well, maybe not. And that's okay. But unfortunately, you need to be making these decisions along the way. If you wait until now and you react to stock prices dropping, like the research shows that people who start freaking out and selling when the prices are going down are almost always making a mistake. They're selling at lows, and then they buy back later when we're already sort of past the point of value. So those are reflections that 20 years of screwing up have given me. And the other thing you can do is you can take some of this out of your hands by, if you're younger, by just having buying on a schedule, buying your index funds on a schedule through your 401ks. And in rough times, since I say this all the time, since transaction costs are almost zero at brokerages these days, go out and buy a few $100 worth of stocks once every 2 weeks of the companies you like better. The transaction costs are not going to sink you. They'll be zero. And you can get yourself into the habit. And you don't have to roll in all at once. You don't have to say, I better pick the bottom. You don't have to pick the bottom.
Yep. So we got 2 minutes left, and I think we'll do like really quick hits. I can open if you want, Seth.
Sure.
But the question for 3 hours ago was from Dimitri Mueller. We'll take some Jim Gillies leftovers from the morning show. Again, in these uncertain times, which companies do you think are interesting? So we'll just go more generic. If there's a company in particular that looks really interesting to you today, and then the follow-on was any particular international ETFs, because I'll do the international ETF and I'll let you pick a company. So a international ETF that I find relatively compelling right now is the iShares MSCI Mexico ETF. The ticker is EWW. It's arguably the worst ticker ever. Like, why would you want your ticker to be EW? But aside from the bad ticker, I think one thing I've been very bullish on the Mexican economy, and by default, kind of the Mexico market. I think there's a lot of very interesting and compelling companies there, especially in construction and real estate. They have an incredibly globally competitive labor force for manufacturing that puts them on par with companies like Vietnam in terms of labor costs, and at the same time having the same like cheap energy advantages, especially with natural gas that we see here in the United States. And that's a 1-2 punch that is not common across the world. And, country with 100 free trade agreements, you can do a lot. So that's a international ETF I can give.
Yeah. Interesting stocks. Both of these came from viewers recently today. Crocs, haven't looked at Crocs for a while. Looks kind of interesting, actually. Would be willing to, start taking a look, reading the call, seeing what happens, and maybe starting in with buy $100 worth now, a couple $100 worth later. And then another one that a member brought up last week or the week before that I hadn't looked at for a while, and a company I hated when it first came out, Yeti, the coolers and the drinkware and stuff. Take a look at their numbers. Don't look too bad. Looks pretty solid. And one that had just completely fallen off my radar after a couple of years till somebody here on Fool 24 said, "Hey, what do you think of Yeti?" And I said, "Let me look." And said, that's interesting.
Well, I think that does it for us. We gave a little bit of recommendation at the end there for stocks, and now we can pass it off to Andy and Jayson. What's the theme for today, for the next hour?
Ask us anything.
Oh, anything.
Anything.
How much of your hair is on fire? I'll start with that. See you guys.
See you, Seth.
Guys.
See you, Tyler.
Hey, Andy.
Jason, how are you, my sir?
I'm good, buddy. I'm excited. It's been a minute since you and I were on together, so I'm very glad we're going to be answering questions for Motley Fool members and people who I like to call future fools watching us on the YouTube live stream. Andy.
Great. Welcome to the Motley Fool. We love to have viewers from all over the world, whether you're joining us from YouTube, Jayson, or from the confines of Fool.com as one of our members. It's great to have you here on another, I'll just say, interesting day in the market, Jayson. I posted a note quoting Rudyard Kipling's If poem, which is one of my favorite, about written to as advice to his son about being able to show grit and understanding in the times of turbulent days. And certainly I think in the markets, many of us are feeling that. And so hopefully we can help a little bit here at the Motley Fool as we're trying to help people navigate these markets as we have through both lots of good markets, in fact, more good markets than bad markets, but the bad markets emotionally really can tug at us, Jayson.
Yeah, no, that's exactly right. And the one thing that I continue to come back on, and, I've been lucky enough that I've been an individual investor, stock picking investor for 16, 17 years at this point. So I've been through some really turbulent periods. And the one thing that I have learned that helps me in these periods, because it's one thing to point at that chart on the screen and say, March 2009 was a great time to buy stocks.
Yeah.
March 2020 was a great time to buy stocks. October 2022 was a great time to buy stocks. It's easy to look back in hindsight and find a bottom and say, hey, this was a great time. It's always hard as hell when you're living through it to get through it. And it does help me a little bit to be able to know that when we go through these periods of uncertainty, when stocks are down and there's a million reasons why the market can continue to fall, is knowing that over the long term, the market does recover. And here's the cool thing, Andy, it's not just that March 2009 bottom, it's that October 2007 peak still worked out fine for long-term investors. February 2020 was still a pretty good time to buy stocks over the past 5 years, right? So having that long-term mind and not getting caught up with the idea that you got to get the bottom and trying to be too precise, but directionally leveraging stocks is our wealth value created over the long term by owning the great businesses, right?
Yeah, Jayson, even the indices, which we quote and talk a lot about, and I've talked about how the markets talk about the markets and the indices, but we all own individual stocks, and they tend to be more volatile than the stocks than the indices. But like you said, if you look over history, when you start to stretch out from a year to 5 years to 10 years, the stocks generally diversify basket like the S&P 500, the Russell 3000. They tend to make money. Those indices tend to go up higher. That chart up and to the right, Jayson, as you talked about, over that time period. It's just that when we're in those markets that are falling, the S&P is probably going to finish down, say, 6% this quarter, right? And the NASDAQ and many of our stocks are down more than 10%, 10, 15, maybe some cases 20% or more. And so we were, we feel that so much more than looking at the data and saying, gosh, if I just would have, it's what I call it's just would have, or had I market. And you have to be very cautious. I mean, Seth said, great, it is a good time to think always about the markets and your emotional state and where the markets are in your stocks and when it comes to growth and valuations. But, maybe not acting or being very cautious and being very prescriptive about your actions when the stocks, on Friday, they're down 2%, today down 1% to 2%, and many of our portfolios down more, really understanding how those emotional, that baggage can impact us if we're not careful.
Yeah, that's right. We want to do more than just talk about our thoughts and share our thoughts, which we'll be happy to do, but we want to answer your questions too. So go to slido.com. The event code is Fool24, whether you're watching on the Motley Fools behind the paywall members or you're watching on YouTube live stream. Again, slido.com, event code is Fool24. Get those questions in. Remember too, we're happy to give our answers to your questions, but we're not telling you what to do. We're not providing anybody with individual or personalized financial advice for a million reasons. So, all right, we got questions coming in. Andy, is there a question you've seen you want to grab or one that you think you want to hear me from?
No, let's talk about J.R. Rocker's question, which is from about an hour or so ago, because I think it speaks to the way that many of us are feeling. With the current bear market environment, with the current bear investment environment with nothing that would change this narrative anytime soon, why would anyone invest in growth stocks now, Jayson? Why would you invest in a business like called the trade desk, although this year is not going to be a huge growth market for the trade desk, or just or Nvidia or any of the tech stocks or any growth stock that you might have, even if it's not a tech stock? Why invest in those right now?
So I think I love this question because I think it gets to the heart of what so many people are facing in this sort of uncertainty, especially when there's a lot of hindsight too, because we saw that peak in 2021 and so many growth stocks, the peak in like October 2021, which was the peak for the NASDAQ 100. And then January 2022 was the peak for the markets broadly. And then we were down 22 or 23%. And a lot of stocks were down 70 or 80% during that period, Andy. So there's reason in these periods of uncertainty to expect another leg, right? The next shoe to drop here with the market. But I think it gets back to some lessons that I've learned, and I think really most of us have learned over the long term from investors, and not just in growth stocks, but businesses that have the ability to grow their earnings and compound those results and to be compounders in per share value, is that in the midst of uncertain environments like now, there are opportunities. Okay. We don't know if there are opportunities for the next quarter or for the next year even, right? But we do know is that in this periods, there's always opportunities to buy quality, right? To buy great companies that are disrupting industries. The trade desk, for example, they've had some operational missteps, but we know that the ad industry is being disrupted and continues to be disrupted by programmatic advertising, streaming and over the top, more digital advertising. Programmatic is even getting into like grocery and other retail format as well. So we know this is a thing that is happening. And when better to participate in that when you can buy quality for a better price in the midst of near-term uncertainty. So I think that's the answer for me. And it's built on the foundation of the bottom line is that with stocks as an asset class, Andy, we can't buy them based on certainty. We never have certainty. It's a range of how much certainty or uncertainty we have. And I heard Ben Carlson, who I'm a huge fan of, he writes a blog called A Wealth of Common Sense, and he publishes something just about every day. And it's like my daily affirmations in a way, because it's just a reminder of all of these realities. And that's sure, you can say that with everything going on that's coming out of the Trump administration with tariffs and all that stuff, that the probability may be higher if these things persist. With the economy could get worse and we could see a protracted bad period for stocks. I mean, it's a higher degree now, but what do we also know, Andy? We know that AI and other technologies, the continued growth of the cloud continue to create pockets of value and we don't know that the global growth of the middle class is increasing global economic power, spending capacity around the world. And these are durable tailwinds. These are things that are going to grow wealth around the world. And stocks are the place that we can deploy our capital to participate in the businesses that are going to be benefiting from and driving that growth, right? So that's the way I think about it, is that yes, there's uncertainty right now, but the further out we look, Andy, our ability to predict a positive outcome for stocks tends to get greater and greater, right? Stocks, the longer you own great stocks, the lower your risk of loss of capital becomes.
Yeah, a few quick reflections. David Gardner used to say that one of his pet peeves was when people would talk about buy low and sell high. One of my pet peeves that when I hear constantly, the market hates uncertainty. And oh my God, did we hear it for the past couple of weeks so many times? The market hates uncertainty. Jayson, as you said, stock, that's why we're paid a premium above risk-free rate, is because we do have that uncertainty investing in business. Nothing is certain. Businesses go bankrupt all the time. How many businesses, small, medium-sized business, sadly, go bankrupt every day?
Yeah.
So businesses go bankrupt. Hopefully many of our large cap companies don't go bankrupt, although Jayson, you and I have experienced one in SVB in the past few years, unfortunately. But the market, it's always uncertain about what the growth rates are going to be, what the earnings, what the margins, what the innovation into R&D. It's always uncertain. So that's just naturally what comes with investing in equities. First point. Second point, to those who aren't familiar with one of Warren Buffett's favorite quote about hamburgers, he was saying, if I'm a long-term eater of hamburgers, when hamburger prices go on sale, I love that because I can buy more hamburgers. So I'm paraphrasing one of his favorite quotes. So investors should be thinking about that. It's the same long-term investors to focus on the business, because so much activity, Jayson, in the market every day is based on algorithmic trading, is based on sentiment, is based on noise. You and I do a noise versus signal segment. Or you do it more often than I do, and so much of that
when
is
you're there, Andy.
So much of it is just every day. Well, that's kind of you to say, but so much of that is tied around the daily trading, and most targets for Wall Street or stock targets are based on 1 year price targets. So all that being said, is that the daily activity around the markets tends to be driven so much by what we are seeing right now in front of us, and the ability to take off the glasses that are just the microscopes and put on the telescope is so valuable to think about as an investor and think about market history. Now, back to the stocks, Jayson, as you said, when you see multiples go from, let's just say a company that might be, well, you mentioned the trade desk, but even one that's doing very well, like Shopify, and the multiple comes down, or the CrowdStrike and the multiple comes down. If you're looking at the next 3 to 5 years and thinking about that, or Asina put in a question there about Arista Networks, and you're saying, will this company be larger, more meaningful? Will they be able to innovate, grow their markets, grow the market, have products that take market share over time, whether that market is growing very rapidly like those tied to technology, or more that might be kind of middling single digits like consumer spending,
right?
More or less. And will the companies be able to be more relevant? That's what we're trying to find out. And then so if a stock is falling, 10, 15, 20%, and that 3 to 5 year perspective holds, that's what we're trying to find. And that's why you would invest in growth companies, to get back to the answer to the question, because the stock market in any given time period with all the macro and the noise around it is selling stocks off, sometimes indiscriminately. And that's what we're trying to figure out.
Yeah, that's exactly right. And just to build on that a little bit too, I think the corollary to this question, or maybe to invert it a little bit, if you're not investing in times of uncertainty and you're only investing when the sentiment is positive, you're consistently paying a higher premium, which is okay. That's fine. And it can work out great.
Yeah.
But you're missing the rare opportunities when we do get that the market gives us to take advantage of a little bit of a lower cost basis. We should take advantage of those when we get to, as David Gardner says, one of my favorite quotes of his is that dips only buy dips, right? Because you spend a lot of time watching the market climb 50% before it sells off 10%.
Yeah.
It's still up a lot from where you waited, right?
Yeah.
But don't not buy those opportunities when they're given to you too. And part of it too is having a framework based around your financial goals. If you're worried in these periods because you own stocks and you need money this year or next year and that money's in stocks, you have an asset allocation problem, right? So it's thinking about owning the right things based on your financial goals is a really important way to make sure that you're not turning volatility into risk versus letting it be opportunity as a chance to buy more for the long term.
Yeah, 100%, Jayson. That's where you get allocation, cash positions, diversification, all those kinds of things. But I think your point is around investing is I think investors don't realize that most of the trading days, most of the time, the market is much closer to its all-time highs than its all-time lows.
Oh, yeah. Yeah.
Almost, I mean, definitely. And so I think we might be trying to always think about the dips, but usually the market, and again, the market over time goes up and to the right. There are those significant drawdowns that, might last, a few months to a year and a half on average. Bear markets kind of last around that time period. So they do fall, but most of the time the markets are closer to their highs than their lows, and the markets continue to go higher. So we have to remember that. And that gets to Seth's point earlier that he was saying the last hour about just building out positions, exercising that muscle memory of, hey, I'm going to just put a little bit of capital to work every month and just invest in the markets, and then having a diversified portfolio, having the allocation set that matches each of us, our own sentiment, our own ability to handle risk, and then thinking about at various times, like we might be going through now, as I was last week, building out positions or adding new positions that look attractive based on the market pessimism.
It reminds me, I've got to make my solo 401k contribution here. I need to take that check to Fidelity. Let's Andy, let's hop in the DeLorean and answer Cena's question. Stretch out things a little bit long term. Andy, the question from Cena, hop in the DeLorean and pop out 5, 10, 20 years ish. How is Arista Networks, ticker ANET? How's Arista doing? What were its biggest successes and challenges? The first thing that I want to do, I want to ask Cena, is this something about me having the Doc Brown hair? Is that the reason we're getting the Back to the Future question, Andy?
I love it. Yeah, those of you who don't know, the Back to the Future movie from 1984, I believe, is the year. The first one? Maybe 85, the first one. Yeah. They used a DeLorean, a very infamous car turned it into a time machine. The timing was
glorious too, right?
It was glorious. Yeah, DeLorean ended up, I think, filing bankruptcy, getting arrested and prosecuted, and a whole bunch of other stuff. Lots of different scandals.
All right, so we're 88 miles an hour, and we hop out in 5 years, Andy. What do you see, Arista Networks?
You have to get the DeLorean up to more than 88 miles an hour for it to go back in time is the key.
That's right.
Here's the thing that I love thinking about, which makes us, I think, slightly different. Now, most analysts are looking out at a year or two at best, trying to figure out not just price targets, but trying to figure out profit margins and cash flows and strategies and all those kinds of things. And you start going out, Cena, as you know, 5, 10 years, 20 years, you start to get into really trying to exercise that creativity muscle. What companies have the intellectual property? What do they have the leadership team? And this is where I like Arista a lot. Their proven leadership team, the way they built the company, the ownership structure they have, and Andy Bechtolsheim and the rest of the team, Jay Ual, who's been CEO for a long time, owns lots of stock, been through it all, their competitive position. I think Arista continues to win. I think the valuation got stretched in the short term, coming at the end of last year, as we talked about a few different times. And now we're starting to see this reset. The thing I love about Arista, Jayson, is it is a tech company that operates as a very profitable toll booth company, more like MasterCard and Visa from the financial side than almost any other tech company that I know.
Oh, cash margins are in the mid 30%, which is, it's hard to fathom how good that is for a company that, like, at its core, they're making networking equipment. The way they monetize it's a different story, but it's a remarkable business. It really is.
And they have a software with the EOS system that is just integrated. They are tied. So much of their growth obviously has been tied to AI data center build out. They have a campus business. They have some other smaller sides, which are doing okay, I think. But really the explosion was on the AI side. I'm guessing that will moderate. this year, Jayson, we're going to see that growth start to kind of like stagnate. And that's why we've seen the stock come down and the multiple now go back down to the, more reasonable when you're looking at the earnings potential. Reasonable. They do have some investor client concentration tied into Microsoft and to Meta, who continue to leverage Arista's products. Do they diversify away from those? I think so, but those folks are the big spenders right now when it comes to that Arista technology, especially in the data centers.
Yeah, my expectation, I'm looking out 5. And the thing I love about doing this, Andy, is I don't know that it necessarily informs, because we're going to be wrong, right? We start predicting 5 years from now.
That's right.
Where the business is going to be in the stock, how is it going to do, and like all of these things. We're going to be wrong, but it's it's not in the plan, it's in the planning, it's in the thinking through it, considering the implications. Right. It's really, really healthy. So thinking about Arista, my expectation is 5 years from now, it's still going to be extremely concentrated because it's built to be as a starting point, right? It's built to be relatively concentrated in terms of its customers. It's probably going to be less concentrated. Now, the answer that I don't know to that is how much of that is some of its other customers or customers that don't do as much business with it now are doing more versus where are we in the spending cycle for AI infrastructure and accelerated computing infrastructure more broadly, right?
Yeah. That's
the question. Is it because Microsoft and Meta mainly are spending less, or is it just more is spread across a more diversified customer base? I don't know the answer to that. But I do think that 5 years from now, it's harder for me to predict that the stock will have beat the market because of the questions around that transition from the growth spending on the AI infrastructure to the upgrade cycle.
Right.
I don't know. Does that slow down in like 18 months or 2 years, or is it 3 or 4 more years before we really get to the point where capacity is so stacked that we start to see the slowdown? I don't know the answer to that. Now, if I'm looking out 10 years, I don't want to go 20. But thinking 10 years, because 20 years from now, the core founders that are still so critical in running the business and innovators that are right in the middle of everything, they're not old.
Young chickens.
They're not. Yeah, exactly. They're not our age, Andy. They're not young like me and you. They're a little older than us here. But that's the thing. You start stretching out 20 years and the face of the company's leadership could look very, very different. Disruption happens.
Yeah.
This company exists because they disrupted the status quo in networking.
Yeah.
Eventually it could be at risk of the same thing. But looking out 10 years from now, my expectation is that it will still be the dominant player in its space because they do continue to innovate. They're right in the place to be as we see the infrastructure for accelerated computing on a global basis will continue to proliferate, and it's going to be monetized. The next decade, we're going to see a lot of more monetization across businesses using AI in their businesses, whether it's just at home office or it's all the way down to operational things. We're going to start monetizing AI, and that's going to mean a lot more of their stuff in between the data centers and the users on the other end.
Jayson, you got to think the way that from the get the perspective and the be roughly good. I'm thinking, okay, Arista over the last 5 years has grown their earnings cash flow somewhere in the 30% range, give or take when you look at them and the metrics you're looking at, but 30% per year. That's outstanding, right? Revenues in the 20% range. Let's cut that in half. You have earnings growth maybe in the 15% range. Are you willing to pay a 30 times multiple for that? At the end of December, we are paying almost 60 times earnings for that. Yeah. Now we're paying somewhere in the low 30 times for that, depending on how you think about that. So do you want to see that in the 20% range? At what point do you start to say, hey, listen, the long-term growth rate for this kind of business in the mid-teens, and I'm paying for this. They have a stout balance sheet. They have defensible margins. You can make the argument maybe their margins might come under a little bit of pressure, but let's just say there's some defense there. From this kind of business that I said before has the financial look of more like a outstanding financial duopoly than it does a tech company. And I think that starts to get really interesting to me, given the pedigree that Arista has. And that's one reason why I've been more excited with around Arista adding it to our rankings or portfolios than where it was at the end of last year when it just had the stock had done so well, but the expectations got really high for that kind of business.
Yeah, no, I think that's fair. I'm going to throw two more little things in there to think about for everybody to put on your thinking cap if you're thinking about a business like this. As it gets to a little bit more maturity, as you're talking about, the growth rates start to slow down, and has this immense fortress of a balance sheet with so much cash, and looking for ways to deploy it. We haven't seen Arista start really aggressively buying back its stock. It's still a net generator of shares. Its shares outstanding continue to increase. Over the past decade, it's up about 19%, which is not a ton, but it's up, right?
Yep.
And it's not a dividend payer at this point. So as we get towards the back half of a decade from now, those are things that we have a management team that's smart, that has created value, focusing on the business, that I think at some point will start pulling other levers to continue to be disciplined creators of value, reducing the share count, maybe at some point paying a dividend, and those things could create value as well, above and beyond just the earnings growth rate that the business can generate.
That's right. Yeah. And I think once they get to that spot, they're going to start buying back
gobs,
more and more shares, because I think finally one of the big concern, just how do they deploy that cash? What acquisitions do they made? They've been very cautious in acquisitions, but they have made a few to get into different parts, like into the campus business and a few other lines. So how do they deploy that cash? But I think now Arista starts to look a little bit more attractive. Let's move on, Jayson. We'll start to take a few other ones.
Sounds good. All right, I'm gonna reach. What's next here, Andy? I think you got another one.
How much of this pullback is really tech-based versus broad market correction, in your opinion? Susan B says, I think it's both. I think, Susan, you're definitely seeing market correction just because, again, we went through 2 years of outstanding returns, lots of spending, a lot of excitement. We started later in last year. We started seeing more and more individuals get into the market, I think, based on some of the data I saw. And so I think you just see a lot of enthusiasm. You start to see a little bit of the meme stocks come back. And so now we're just seeing that start to go out the other way. And now I think we're dealing with some of this. So that's the pullback perspective. And on the tech side, I think you just started to get into some of the valuation concerns, and that started impacting some other things. And then you start seeing some of the real technical trading things, double cross this, and you start hearing from, under the 200-day moving average and all that. And that drives a lot of the momentum, a lot of the daily action, especially from some of the algorithms. So some of that is tied in there as well more recently. But I think more of it's just a reaction to, we're not going to grow to the moon. We're under some times right now that are unique, that we've never seen before, coming from some of the policy that we were hearing from Washington, and trying to wrap our heads around that and what that impact is. But again, mostly it's coming off those couple years and jumbling those together, Jayson.
Yeah, I think it's worth remembering that when we see a broad market correction, and this is, in the past 25 years, certainly, and I think you could go back further than that, innovative companies, whether it was tech or the tech of its generation, right? High growth businesses have always been more volatile than the broad indices. So whenever you do see a broad market correction, you're going to see whatever the highest growth pocket is the one that's going to also have sold off the most too. So yeah, like you said, Andy, you can't really decouple those two things. I want to reach back and take Ed's question about a couple. Hang on a second here. So Ed's asking thoughts on EMC and ASML. I can talk about ASML to a certain extent. I don't follow EMC.
I do not either, but ASML.
Yeah, lot to talk about here. So talk about a company right in the midst of, right in the middle of the vortex of uncertainty here.
Yeah.
You have a Dutch company that manufactures equipments that supplies the global semiconductor industry. So the company has largely kind of, and the Dutch government largely kind of followed the U.S. government's lead with trade with China over the past, really for forever, right? They've pretty much, it's been, but as we've seen over the past few years with artificial intelligence, particularly has followed America's lead with restricting China's market to semiconductor equipment that can make the most advanced chips. And ASML's equipment, David Gardner snap test, you snap your finger and ASML disappears. Every single leading edge tech device that's been made over the past decade really doesn't exist anymore, because you go into their EUV, their DUV machines, their deep UV machines, which is like the workhorse of the industry now. For years, that was the leading edge. They surpassed Intel. Intel lost its way, and Intel actually has been a customer of ASML for a long time. But now the transition to their EUV machines, and now their high NA version of that. If it's a high-end chip, whether it's in your smartphone or in a Hopper or Blackwell GPU for artificial intelligence, or it's one of AMD's semiconductors or GPUs for data center environments, guess what? If it's Apple's highest end stuff, it's probably been made in Taiwan Semiconductor's plant using ASML machines to do the lithography, right? So critical company. Now, again, as much as the high-end stuff matters, we actually saw last year was kind of weak for their EUV machines, but it was still a record year because the entire, like the whole value chain for semiconductors still relies on those deep UV machines, those DUV machines. This was expected to be a big year for their high NA machines, which are their most expensive, really critical machines that drive per unit really high revenues, a lot of recurring revenue. So I think that it could be a tough year, again, depending on all of the factors in the trade war, because you start thinking about retaliatory implications. Again, this is a Dutch business. The U.S. is kind of in the middle of all of this. It's the kind of business that could get hit because, well, who does China want to go after to really upend the global economy, the global trade of chips? This is a good company to target for that sort of thing, and to get the U.S.'s allies pushing harder on the U.S. So that's like the geopolitical background, right, of what's happening. But there's still nobody that's close to ASML when it comes to its technology. So again, putting the microscope aside and getting out the binoculars, this is still one of the 2 or 3 most important companies in the world when it comes to semiconductors, which means it's probably one of the 10 or 15 most important companies in the world, period. I think it's gotten really compelling. I was hoping to buy this week. I guess it's going to be a little later in the week.
Yeah, Jayson, and let's not forget, so semiconductors are inherently cyclical. There's been so much talk about just NVIDIA and all the success they've had in their super GPU chips on the AI side. But there are loads and loads of other chip technology that ASML serves. And as you said, the semiconductor parts of the semiconductor market have not been that great. Autos has been very difficult. So ASML serves them all. And by the way, they also, more and more stories starting to come out that there might be some competitive challenges coming from China. So there might be an alternative out there to help Chinese customers that would normally rely on ASML or would use ASML if they could. So wrap those all together, all the positives, Jayson, that you said, and the market environment, and we just were looking at it saying, you know what, this just seems, again, looking out the next 3 to 4 years. Yes, there are cycles. Yes, right now is not great. Their growth has really slowed down, as you said, Jayson, right? So it's kind of slowed down. It's like single-digit kind of growth.
It was a record year, but it was just a little bit better than the year before, right?
Exactly. So it was great, but it was slower. So you start to see that growth kind of slow down. And yes, the stock could be in this kind of trading range for a year or so if you put kind of that hat on. But looking at 3 to 5 years, even with some of the stories that there are other competitors, or at least one competitor kind of out there that might be able to, I mean, there are other competitors out there, but this one specifically kind of focused mostly on China, that might emerge, but might emerge, as we talked about in our reveal show recently with ASML, might emerge and is at market, at scale, being able to serve customers is far different thing. And let's not forget, ASML also has a services business, Jayson, that is still servicing machines, machines that they've sold years ago.
Right.
And by the way, these are very complex, large, expensive machines, millions and millions of dollars. So,
no, that's the key. And the supplier relationship and the complex supply chain just to build these machines is, it's an order of magnitude more complex than anything anybody else in the industry has done. That actually acts a little bit as kind of a lock-in effect to some of its customers that they're going to deal with ASML. So the moat that it's built is very durable, and we don't normally see these sorts of moats in technology. And eventually they're going to get disrupted, but for right now, they remain so critical to one of the most important industries in the world. So, and we did get a correction. It's Andy. It's MCOR, ticker
MCOR,
EME.
EME, not EMC.
Makes
Far
more
different.
sense.
Much different.
Yeah, exactly.
Much more different there, Ed. Yeah, MCOR, which does construction services, industrial services, much different than tied to the EMC. And so I think MCOR is still, the stock is now, I think it's back down to where it was a year ago or so.
It continues to
struggle,
to fell off.
I think it's I still have confidence that MCOR, when I look over the next really 3 years, I think 3 to 5 years with that pullback, I think it got a little bit elevated. That's when I had added my first position. But I think they're going to be in a pretty good spot because the construction market is not going to slow down, I think, over the next few years.
Yeah, stock's down about a third. It's a little more than 30% from the high. I think it was November, December last year is when it kind of peaked. And what's changed? A lot of it is AI, right? Yeah. Because we saw after the DeepSeek story came out of China with that Gen AI LLM tool, basically being one of the top 2 or 3 best performing of the LLMs, and one of the few that can actually do some reasoning on its own and not just regurgitate something that it learned through its training, but actually come up with its own conclusions, and at a much lower cost and the total compute cost that was needed to build it. That sent MCOR stock down as well, because call it 20% of its business is tied to data center technology, that sort of thing. And that has been a tailwind. That has been a tailwind for the business, but it's easy to lose track of like the bigger picture for this business and everything that we learned coming out of the pandemic about the global supply chain, and that it takes years and years to really move the needle with things like onshoring and TSMC. So we're mentioning ASML's machines. Taiwan Semi is building factories in the US to produce semiconductors, right? And we are seeing more of that kind of thing happening. Don't forget about just the demographic trends that are happening with a lot of businesses and a lot of people relocating to the Sun Belt, where there's more economic opportunity, lower cost of living. Yeah, there's a lot of infrastructure that needs to be built for those sort of things. So you look at the other 80+% of its business, and a lot of the time it's a bigger percentage. There's still a lot of things going very, very good for MCOR. The acquisition that they made of Miller Electric, I think, is going to be a boost. Helps them get, because I think they're based in Connecticut, not too far from where I am, but stepping more into the Southeast where the trends are really favorable. Miller Electric's going to get them into those markets a lot more than they are now. It's like they're using the playbook that they've used for 35 years to build this business up, and they continue to deliver on it. Eventually the cycle is going to be ugly, and the stock's going to get even cheaper because just spending is going to get pulled back. But you know what they're going to do? They're probably going to still generate free cash flow every quarter through that period because they leverage their costs up and down pretty well. Mm-hmm. And then the spending cycle is going to return. I think we're talking, this is a multi-year cycle of spending that, I think 10, 15 years from now, we're still going to be talking about the energy transition, right? Moving to more electrification, less things powered by or fuel, running on things like natural gas. And as that continues to play out, that's more opportunity for for it to continue to grow. Bolt-on acquisitions like the Miller Electric deal that they've done. I mean, there's more than 100 names of companies that are part of MCOR that are regional specialists in one of the industries or where they focus, and they've been so good at bringing those companies in and integrating them, and generating better return for the company as a whole and the shareholders. So I think it's attractive right now. As much as the stock is down, it was a little bit of a kind of a manic high. I think it represents good value now, but again, thinking beyond precision, Andy, we're not going to get it perfect every time. I think 5 years from now, you're going to be pretty happy with this business at this price.
Yeah, I think so, Jayson. I mean, if you think about their earnings almost doubled. They're probably up 80% or so over the last couple of years, right?
Yep.
So they just exploded with so much of this build out. That's going to normalize. I was buying it as on the way down, and then it kept going down a little bit further. That's natural if you're thinking about owning businesses for the long term. That's going to happen. But I still think for the reasons you said, Jayson, that playbook, it's a relatively low margin business. It's got lots of scale. They've demonstrated they can inch out different profit margins, pull different levers, make those acquisitions, and I just think that market, as those stocks fall, down in valuation and start to could this stock get, it's probably, I don't know, it's less than a market multiple, but could it get even cheaper? Of course it could. Mm-hmm. But would that just be, again, when I think about their ability to drum up business, they have a very robust pipeline. That pipeline, while it might not grow as fast as it did last year, which was outstanding year for MCOR, it's still I think it still will grow over the next few years, and they're going to benefit from that, and that's going to be okay for shareholders. And I think the stock is going to see some higher days. But like you said, if the cycle softens and starts to slow down, they're going to be impacted without a doubt.
Yeah, no doubt about it. So Newbie's got a question that I want to chew on here, if that's okay with you, Andy.
Chew away.
Okay, so Newbie asks, I'm so sorry, everybody. Has Chewy reached all the market share potential that it could? How do you see it going forward? So ticker is CHWY. So Chewy's core business is selling stuff to people that have pets and having it delivered to their homes. And a lot of it is auto ship, auto renew, things like pet food, treats, chew toys and stuff that pets destroy. And you're going to need another one in 6 weeks anyway. They've built a wonderful, wonderful business that it's you could almost say it's recurring revenue, even though you can turn it off. But they've built that model really, really, really well. Mm-hmm. And I think the pandemic certainly pulled forward a lot of their customer growth. I think we've learned that that's the reality. Just if you look at how much their customer acquisition has slowed over the past couple of years, it's pretty clear that happened. Yeah. I mean, the upshot of that is they got those customers money sooner. So it's funded a lot of the things that they wanted to be able to do. But I don't know that we're necessarily at the point where it's maxed out its market share potential. We just saw last quarter, I think 2% customer growth, which is small. I mean, it's minuscule if we're being honest, but they're continue to grow the spend with their customers at a much, much higher rate, which is, I think, compelling, even as their biggest non-e-commerce competitors, like their pure play competitors, continue to shrink, like literally closing stores, concentrating their business just to try to get to the point where they can reach a stable state, right? So Chewy being able to be like a ground floor clean slate, we're going to start on the internet, we're going to build this business, and now they're being able to they're getting to the point where I think they can invert more, where they can start getting to the physical presence things that are stickier, which I know sticky things when you're talking about your pets isn't always a good thing, but it's good when it's stickier services that you can deepen your relationship with. So I think it was last year was their big push to start the vet clinic business. Yeah. They had one at the beginning of the year and they opened 10 more. So they have 11 now. Yeah. So they're not rushing out to do this, and they're focusing on big markets, like a couple cities in Texas, Atlanta, a few other markets like that, where they're looking to kind of expand that. But here's the thing. This is one of the things that I love about this business, and I get to compare it to some of the REITs out there. They have a relationship with, call it half the vet clinics in the country, like 17,000 vet clinics that they have a relationship with for their compound pharmacy and some of the meds and vet care stuff that they do. where they have this relationship that's already in place
Yeah.
that they can start to leverage. They provide some software and things that clinics can use too. So what does that mean? If you look at some of these self-storage REITs, like Life Storage and others, they have a platform that they provide to small mom and pop self-storage operators. They charge for it. But basically it's like their list of partners becomes a shopping list where as they look to grow and expand this business, they're already connected to a lot of vets out there. They know where there's opportunity, and that could be a way that they leverage to expand into more markets by finding vets that they're already partnering with that may be a good opportunity to bring in-house, to make part of their long-term plan. And to me, this is like the broader, like hybrid Costco Amazonification for Chewy. Is their strategy is to build these deep, sticky relationships with their customers, that their customers just automatically assume this is the person, this is the business that I need to go to for my pets, and never even think about going somewhere else or look at somewhere else. And where the services that they provide, the services that they charge for, because they have a number of like membership kind of benefits, and they have a healthcare thing and some other programs where those become really good, high margin, sticky, truly recurring revenue services that they get from those customers that deepen the relationship. So I think there's a certain level of maturity in terms of the market that they've already does business with them. I think low single digit growth for the long term is good, but growing their share of the total spend will continue to be the goal. And I think Chewy, if they continue to leverage that, can drive bottom line returns that are very competitive to be able to, get market level or even market beating returns over the long term.
Jayson, now one of your final points was going to be my first point, which is, newbie, it really depends on what you are talking about when you say market share. And I think for Chewy, it's not so much the customer growth, at least here in the US, as they expand, globally, it'll be a little slightly different, but in the US or in Canada, North America, it's going to be much more around the share of wallet. Yeah, and that share of wallet is expanding and growing. So 80% of their sales are tied to auto ship. So they're already kind of indoctrinated into there, ingrained in there, trying to convince their customers, like myself, to spend more. I basically get 2 things shipped to me from Chewy about once a month or so. So making that a more recurring, higher wallet share. Veterinarian services, the veterinarian market is a $25 billion service market. It's massive. Chewy can play into that. This is a $12 billion company. It's driving the profit picture, which I think is what has gotten the stock really doubling over the last year. Jayson, is really, can they do this all at scale? And I think Chewy is charting. And by the way, that double is even considering the pullback that in the last, few months or so, Jayson. So the stock had done really well, reflective of the market, their ability to, I think, add in. It's that waterfall effect, Jayson. You add a little bit from customers. You add a little bit from market share, share of wallet. You add a little bit on profit growth, depending on whether you're buying back stock or not. One of those companies, not so much Chewy, but you start to see that little increment where you start to see each time you go down the income statement, you see the growth rates increase faster and faster. It's just fantastic to see if you can get that up with scale, and they've started to demonstrate that. And I think we'll see more of that from Chewy. The stock not nearly as reasonable, because when there was so much pessimism over the last 18 months on, can they do this? Can they really get this right? I think they have, and the vet business, as you mentioned, is just one example.
Yeah, that's right. That's exactly right. So Andy, I know you got another question we want to hit next, but before you do, I want to respond to a comment here from Newbie and a question, because I want to completely take you off the hook here. And so Newbie says, thank you for the Serve Robotics interview. It is such a wonderful technology. That's one of the things that's been added to Fool 24 that I love too, Andy, is the interviews with some wonderful entrepreneurs, executives, and smart people across the investing community that is creating a lot of value for people watching the programming here. But the question, I'm just going to take this completely out of your way. Are you looking at making a Rule Breakers recommendation soon? Newbie, I see what you're doing right there. That's really clever. Trying to get some insider information here. nobody. I'm not. The reason I want to answer this is I'm not on the rule breakers team. I have no connection to it whatsoever. Andy, you're the chief investment officer. You hear things and you know things. Andy can't tell you that. So we'll see what happens. We'll see.
Here's the thing about with Serve is it is. I mean, we had a great follow-up conversation behind the scenes with me and Tom and Samit and a few others. It is still a very speculative investment. It's a small company. They barely have any revenues. They have 1-2 major partnerships. That technology, as we talked about with and I really enjoyed that interview and really loved talking to him. But they are still figuring things out. So this is really much more on the speculation side, like small positioning for those who are going to venture into an investment. So that's the one thing I'll say with Serve. They're still really just figuring out. I think they are figuring out the technology still, but really the business model to be able to do that and make it very profitable as they are figuring out how do they fund that growth, how do they have the pricing mechanisms in place where they are more of a price maker, less of a price taker, all those things with Serve Robotics. So still very early on to find that. And certainly competition is not just going to stand and give them that market.
Not at all. So Andy, next question here. Dildog asks us, can you talk about how stock-based acquisitions and cash-based acquisitions work? I see Rocket Companies is acquiring another company, which happens to be Redfin. And it looks like it's driving Redfin's stock down. Well, it's making another acquisition.
Yes, this
That's
is
right,
what's
another acquisition.
And Jayson, you and I talked about this, and I know we love talking about this. So there are essentially 2 big ways one company can acquire another company. Company A can acquire company B just with cash. This is the Warren Buffett playbook. Berkshire Hathaway, hey, I'm going to go buy that company. It sells for, $10 billion in the marketplace. I'm going to offer $13 billion for cash. Those shareholders, whoever owns that company, whether it's private or public, those owners will get cash from me that I use from off my balance sheet or I go and borrow it.
Yeah.
The other way is to issue stock. And again, maybe there's other ways, Jayson, but let's just talk the 2 big buckets. Issue stock. So those people that who are selling to me are getting stock in my company as opposed to cash that they can put into their bank account.
Yeah, no, that's basically it. And what do we know? We know what cash is worth, right? Stock is worth the market's willing to pay for
I
it,
guess so.
right?
Mostly we know what cash is worth, yes.
So, yeah, fair. But we price everything else on dollars, so therefore we know what $1 is, right? So when you say I'm going to buy a company for $11 a share and I'm paying cash, then you know that asset is now worth $11 a share directionally. There's other things that can affect it, right? How long is it going to take to close? Is there speculation the deal's not going to happen? Maybe the market's going to discount it. Is there speculation a competitor is going to jump in with a higher bid? Maybe it'll trade for higher. But directionally, we know it's worth roughly $11 a share. Now, if I'm saying I'm going to buy this company for $11 a share, but I'm paying for my stock, now what the market's going to do is going to figure out a calculation and say, okay, what does your stock price equate to $11 a share for this? And then whatever your stock price does up or down, it's going to move the other price that's being the price of the asset that's going to be acquired up and down based on exactly that same thing, right? So that's why we're seeing Rocket Mortgage's deal to buy Redfin stock at $11.25 a share based on the closing price of Rocket stock the day before the transaction was announced, lead to a Redfin stock that's trading today for $9 and change after the big double-digit sell-off that we've seen so far today, after Rocket announced that it's buying Mr. Cooper, which is a big mortgage,
much bigger, much
It's
larger
tiny.
than they're going to pay for Mr. Cooper, much larger than they're going to pay for Redfin. But
It
both
was like
with
$9 billion
stock.
deal. I think $9.4 billion.
Yeah, and Redfin was like almost 2 billion, 1.8 or something like that.
Yeah. I mean, it's substantially bigger.
But they're doing it with stock with both. Now, Jayson, here's my feeling with stock. First of all, here's my feeling with stock. If someone is giving stock away, why would I want to buy that stock? If management is giving that stock away, why would I want to buy that stock? You have to answer that question first. And by the way, I've owned companies that have done stock-based acquisitions before, so I'm not saying but in general, if someone's giving away the stock to somebody else, why would I want that? Why would I want to buy their stock if they're giving it away?
Yeah, I think that's exactly right. And it's a little bit of a rhetorical question, but there's also an answer to that question too. And if number one, if you read the book, The Outsiders, I can't remember the full name of it, the investing book, The Outsiders. Yeah, I got a copy sitting up here behind me, but this is basically the book is it's a breakdown of a number of exceptional CEOs that operated in different industries, but delivered massive market beating returns for their investors, largely based on how they were able to allocate capital. And one of the things they were all really smart about, Andy, is they would use their stock at times to do acquisitions. They would do it when their stock was expensive, right? They would leverage their stock when it was trading for a good multiple that was above what they considered was the intrinsic value or whatever multiple they were using or measurement they were using. And they would also buy back stock when it was the cheapest, right? So they were smart about when it was valuable capital, you deploy it. When it's cheap capital, you buy it back.
That's right. And so Rocket Stock, this is what I think, right. So they just announced the Redfin acquisition is barely even, the ink's not even dry. Like they still haven't even closed that deal. And now they are going out and doing Mr. Cooper. Now, hey, it's going to add a ton of clients to the books. It's going to add awesome ability for refis and all this kind of stuff. But the stock is continuing to trend down. Rocket is, stock is basically flat to down over the last couple of years, right? It has not been, a super market. They're doing this on top of one that they haven't even closed yet. They're using stock to do it. So they're giving that stock away. And for some reason, Mr. Cooper's like, great, I'll take that stock. So Mr. Cooper is saying, rather than own my own stock, I'll take the combined entity of these two. So they're buyers of this stock, right? So they're taking it. And for some reason, they're saying, I don't want to stand alone in this market, even though I'm a $9 billion organization. So all things being equal, I think those companies that are smart, this is the TransDigm TDG playbook and many others, but the TransDigm playbook, you borrow smartly at good rates, you make smart tuck-in acquisitions, you add to your playbook, you get pricing power, you rinse and repeat. TransDigm, Constellation Software, many companies, Berkshire Hathaway, do this very, very well, and they tend to use cash almost exclusively.
Yeah, though Berkshire did use some shares to buy
painfully
BNSF. Was it BNSF Railway? No, it was BNSF, right?
Yeah, he's used stock very, very rarely, and he criticizes himself for doing it many years ago. I think with Dexter Shoes, was it that he used stock? He used stock that did not work out, and he said that
well, and the
BNS
and the Dexter one was because it was a business that he now says in hindsight was a mistake to buy.
Yeah, that's right.
And with BNSF, the reason it happened is because to get the numbers to work because of some insiders, the decision was made to do the B shares and use some of the B shares to close the deal. So that's worked out okay. That's worked out pretty well for Berkshire.
Buffett's perspective is like, hey, listen, I'll pay you cash, and if you want to go buy Berkshire Hathaway, go buy Berkshire Hathaway stock. Right?
Yeah,
don't let me dilute exist, because when you give those shares out, if you're issuing shares for that, you're diluting the existing shareholders. So you're telling the existing shareholders that you're worth your piece of the pie is worth a little bit less.
So it can get really obscure, though, as we wrap up. Here's an entertaining little story for you, an anecdote about sometimes paying with assets other than cash and stock, because sometimes you can use somebody else's stock. AOL Time Warner acquired the Atlanta Braves when it acquired TBS. It merged that whole Turner empire, and the Braves came along with that. But at some point, AOL Time Warner went through all the issues that they went through. There was a little company out in Colorado called Liberty Media that was interested in getting out from underneath its AOL Time Warner investment, but was interested in the Braves. So they took some AOL Time Warner shares and traded them to AOL Time Warner for the Atlanta Braves. The reason they did that is that there were some substantial tax benefits to trading these two assets, because they didn't have to sell the stock, realize a gain, take the tax hit, and then use the cash to buy the Braves, which then AOL Time Warner would have to be realizing a taxable event from selling that asset. So they just traded the assets that they basically said were roughly equivalent value. So
there's like cash, stock, and then there's all the stuff John Malone does. And that is just like a whole other bucket. That's a whole other bucket. And that's a whole other, we don't have time to talk about what John Malone has done over his 70 years investing in different asset classes.
And it's the bucket that we largely call tax arbitrage, I think is the way to describe it. So
that's right. Hey, Jayson, very quickly, Nathan R., why, when buying in a down market, how do you pace yourself? 30 seconds for Nathan R. Pacing yourself in a down market.
I as a starting point, I kind of set some basic rules. If the market's down, if it's less than 10% down, I really don't change a whole lot. We get too close to around 10%, I'm going to take a third to half the cash that I have, and I'm going to go find the things on my watch list that look the most compelling, because we don't see those 10% sell-offs often enough that we should miss them, but they do happen often enough. We should have rules around it. If we start getting more than that, I'm not going to try to time it. We get to 15, 20%, I'm going to spend my cash, but I'm 10, 15 years before I get to my financial goals. I don't have to think about trying to get it perfect. I just want to create a little bit of extra value, and I'm looking at the long term.
Yep, I think same thing. I use 10% when the market in general, if some of my businesses I've been eyeing are down more than 15 to 20%, so a little bit more than the market. That's when I start thinking about deploying some of that capital, as we've seen over the last few weeks.
Yeah, they're so rare, Andy. If we wait for the perfect moment, we're just going to hurt ourselves by sitting on cash with money that should have been in stocks anyway.
That's exactly right.
All right, we're done. We are out of time, Andy. This has been an awesome hour. Thanks to the folks behind the glass. We got new people in front of the glass where we got Brian Orelli and Karl Thiel. Time to turn it over to you guys.
Thanks, Jayson. Have a good show, guys.
See y'all.
See you, fools.
All right. Thank you. Hey, Brian.
Hey,
how are you doing today?
I mean, I could have better days. It's raining in San Diego, which doesn't happen all that often, and the biotech market is crashing today, which is, I mean, I would like to say it doesn't happen all that often, but it really has been not so great in the last few, year and a half or so, 2 years. So, maybe today's not such a bad day for that.
Yeah, I mean, what the XBI, broad ETF down like 5% today. I mean, that's huge. And I gotta say, it's not at its lows that it's had over the last several years, but it's not that far off. I mean, it's definitely trending back down towards that. And those, I mean, you're not just talking about like 1 year lows. You're talking about, lows since 2016. I mean, you're getting on for a decade now in terms of some of the lows that the industry is moving towards. I mean, last I looked, it was at like 79 or 80. I mean, it briefly hit a low of, I think, 66 back last year sometime, or maybe it was late 2023. But yeah. It's rough. And I mean, it's not a mystery, I guess, at least part of the reason for that, which I don't know if you want to talk about a little bit.
Yeah, I mean, I think maybe some of it is due to the fact that the marks am I stuck?
You were for a second, then I can hear you okay, I think.
Okay. Yeah. So Mark's the head of CBER, which is the Center for Biologicals and Research at the FDA. He retired or quit, I guess, on Friday, and sort of was pushed out, I guess, by the Kennedy Jr., RFK Jr. And so it seems like, maybe that's pushing the certainly the vaccine makers, people who so CBER, there's two different divisions that look at drugs, right? There's CDER, the Center for Drug Evaluation Research, and CBER, the Center for Biologics Evaluation Research. And so CBER is involved with vaccines and cell therapies, maybe gene therapies, I think maybe 2. And then even though CBER has biologics in it, the name, the biologic drugs, so antibody drugs and protein based drugs, those are actually reviewed by CDER, the Center for Drug Evaluation and Research. So small molecules and biologic drugs get reviewed by CDER, and so the head of CBER with a B resigned, and obviously made it very public that the reason why he was resigning was because he felt like RFK Jr., who is the head of Human and Health Services, so that's the Human and Health Services, and then FDA is below them, and then so there's a head of FDA, and then there's a person below that is in CBER, head of CBER and head of CDER. And so, the CBER person resigned. I'm not convinced that this is a major issue, issue as everybody else thinks, as the investors think it is by the declines from today.
Well, just stepping back, I'll say this, and I want to avoid being any more political than necessary, but this is obviously a political situation, so some of that's unavoidable. So it's been widely reported that Marx, was forced out. So, but yes, obviously to him it's a political issue. He cited RFK Jr.'s quote lies and misinformation in his letter of resignation. But yeah, I think the reason it's having a chilling effect is not so much whether this guy's irreplaceable. He's obviously not. I don't think that's particularly a big deal. But it's just the idea of there's another new appointee heading the FDA, which is Marty Makary. And I think industry was kind of relieved about that. He was seen as not necessarily being basically a fine hand at the rudder at FDA. He wasn't going to be wildly unfriendly to industry or anything like that. And so the idea is if Marty Makary is running the FDA, that's probably fine. And then I think the involvement of RFK Jr. suggests that maybe there's going to be more of a sort of ideological bent to potentially what's going on at FDA. Now whether you read that through, and so, do you read that through to vaccines? Well, that's, maybe not an unreasonable read. And if you look at companies like Moderna and BioNTech, they're getting absolutely crushed today. And I should say that Peter Marks was, intimately involved in getting COVID vaccines approved, and pushing through the original emergency approvals, but then probably more controversially giving full approvals to the vaccine, which some people think was a bad decision. So those companies are getting hammered, but even companies that are large companies, Pfizer, Sanofi, Merck, were all down today as I looked. Those are other big vaccine players just in the broader vaccine market. And so, is there a read through to vaccines in general? I guess you don't know, but there's certainly concern about that. And then there's the added concern, does this read through to potentially other things where there could start being political decisions about what gets approved? And hopefully that's jumping a little ahead of the gun, but certainly you can't stop people from being worried.
Yeah. We got a lot of questions coming in, so maybe we could start with those, and then we have
okay.
A few more news items that we could probably get to if we run out of questions, but
sure.
Let's get to those. So AAA asks about thoughts on XBI, buy, trim, or I guess question mark was the third thing. So XBI is the ETF that tracks the biotech industry. It used to be that it was not cap weighted, and so the individual stocks every quarter would go back to being equal weight, and I didn't really think that was the best idea, because if you're every quarter you're adjusting, that means you're selling the high the growth.
I think
the
it's still
stocks that-
equal weighted.
It's not equal weighted anymore. Yeah, it stopped a year ago, so now it's not equal weighted anymore.
Is that
So
right? I'm
about a-
reading on. Okay.
Yeah,
Ah.
it's not equal weighted anymore. It's now cap weighted. So it's back to the more like IBB. So there's another ETF that is cap weighted that looks at small biotechs. I think it's I forgot the name. But yeah, so the XBI is now cap weighted. So now it's tracking more from large pharmaceutical companies. But even if it wasn't cap weighted, I don't know that you'd really want to buy it, because then every quarter, if you're adjusting to being equal, then you're selling the winners and buying the losers in the group. So I don't think that makes very much sense either. So my view is that you should buy individual biotech companies as a basket rather than buying an ETF, because also you're also buying a whole bunch of losers in buying an ETF, right? You can easily like remove the losers based on the fact that they've had they have a negative phase 2 clinical trials, and then they go ahead and move into phase 3 because the company doesn't have anything else to do and they don't want to shut down. And so those are obviously losers. And so, I don't see a big advantage to investing in companies that are negative, that are not winners. So, if you invest in the ETF, you're buying the winners, but also the losers.
Yeah, I mean, I guess I slightly different take on it, just in that I think like you're investing broadly, and what you capture that way is you capture some of the really big surprises, right? So the companies, there's the companies that go up 20% because they had a successful clinical trial that everybody kind of thought was successful. This will catch you the ones that go up 150% because they had a successful trial and nobody thought they would. It gets you the big losers as well. I just stepping back from it. I mean, I just like, it's very hard to look at that chart. It's very hard to look at what's going on in the industry right now and say a bunch of positive stuff about it. Honestly, it's the headwinds are bad. The financing situation is bad. It doesn't look like interest rates are coming down quickly enough to start to turn that around. I think the amount of uncertainty means that some of the acquisitions that could kind of drive that tend to drive a lot in the sector are probably going to come. I mean, they'll still come, but they'll come maybe more slowly, as companies might just be a little bit more cautious about what they do with their capital. All that is not awesome. With that said, I guess I agree with Brian. I mean, I think if you go and look at individual companies, you can look at companies that are sort of stepping around all those minefields. The overall environment it's just a lot of headwinds. I mean, eventually, I don't think the industry is going to die. I mean, I think it will eventually get around some of these things, but there's a lot of headwinds. And so I think it's probably better to at this point stick with companies that are, they have a lot of cash. They have a recently approved product or one that's about to get approved. They have, this and that. And so you're avoiding some of these issues. Yeah. Let's see. Do you want to just talk about Moderna, since that was also from AAA?
Yeah, I mean, I think that's they're obviously down substantially. What was let me grab
last I looked, it was like $28, down like 8% today or something.
Yeah, it's 9.25 as of the last time I updated my thing. So I mean, obviously most of that is due to the Mark's resignation, and I'm not sure that. I mean, again, I think that's probably an overreaction, especially since I would say a majority of their valuation is due to the fact that they're going to potentially get a treatment for cancer, which is, I mean, technically a vaccine in that it's allowing the immune system to attack the tumor, but it's not a vaccine in that it's a prophylaxis vaccine, and that it's literally, you have cancer, so we're going to give you a treatment, and then it's a vaccine that trains the immune system to attack the tumor. So I'm not sure that I don't see any reason why the views on vaccines are going to affect the oncology.
Yeah, I mean, you could almost brand it differently and just choose not to call it a vaccine, right?
Right.
Yeah, I agree. I mean, I guess the only, if you think that things are going to get like really, really profoundly political, and that Moderna and BioNTech are going to be deliberately frozen out somehow out of some sort of vengeance or something, then I guess you could be really worried about them. But yeah, just based on the science and what's really not it's not a vaccine in the sort of traditional sense that we think of it. I think that's where their value lies. So I agree. And also, I mean, again, unless they start pulling stuff off the market, which seems, again, that would be a big further step down the road. I think that largely speaking, doctors are not going to change their prescribing habits, and people, at this point, whether you choose to get a COVID vaccine, which is obviously still an important business to Moderna and to BioNTech for that matter, and Pfizer, that's kind of a personal decision that you might make each year based on your own vaccine history and whether you want to, and how severe the disease is and everything like that. I think most people think what they think. I think most doctors aren't really going to change their recommendations. So yeah, it looks a little overblown to me.
Yeah. I mean, my doctor's always, every doctor's I've ever seen says, have you gotten your at least your flu vaccine every year? Like, they don't so obviously Moderna's working on a COVID-19 plus a vaccine for flu, a combination vaccine. So I think that could be a potential, upside. And I don't see that, again. I don't see why even if there's issues with vaccines in general, I'm not sure why that would affect the doctor's prescriptions for those drugs, those vaccines.
Yeah. Okay. Let me see. I guess there's a couple of questions. You want to deal with Humacyte? There was an article.
I saw that on this weekend. Yeah. So, obviously, so the stock has fallen twice, right, in the last week or so. So it fell last week because they raised more capital. So they raised, $50 million, and their market cap was only $250 million. So they diluted shareholders by, 1/5 or 50, and that obviously resulted in a lower stock price. So the stock was at like $250, and then they sold shares at $2 or something. So then obviously the share price dropped to $2 per share, because obviously if institutional investors were buying at $2 a share, there's no reason that retail investors should be buying at $2 a share. So that, I don't know. I'm mixed on that one, right? So obviously the fact that they have more capital is good, right? So they have more cash to launch their artificial blood vessels. So that's good. But also they started the sales in, February, right? So they've had a month or a month and a half or something of sales. And I feel like if they felt like their first quarter was really good, which, I guess is ending today, right, then they maybe wouldn't have have raised more capital. They might have waited, assuming the fact that if it was good, then the stock price would go up, and then they would be able to raise capital at a higher valuation, right? So I think that's a negative to me in the long run, but or at least on the initial launch. We'll have to wait and see what the first quarter data looks like and what they think, they're gonna release maybe in a month. So we'll have the first quarter data, and then maybe they give you some, commentary on how it's going in the start of the second quarter. And then most recently this weekend, there was it was a New York Times, I think, article that said that there was a big controversy on the approval, and that there were some people that were, I don't know, associates of the FDA that thought that they should have an advisory committee meeting, and they didn't, and they went ahead and approved it anyway, even though there were some issues, and that maybe higher ups overtook the lower level analysts that were evaluating the clinical trials, and that maybe the statistics weren't that great, and then it's fallen some more today. So I don't know. I've been mostly a bull, like 2.5 weeks ago. I was mostly a bull. I don't know. Between those two, I'm not feeling nearly as confident. Those two events, I'm not feeling nearly as confident as I was 2 weeks ago. And I'm certainly not adding to. It's not a huge,
I would want to
huge
see
position.
more from them.
Yeah, it's not a huge position for me, and now it's even a smaller position. And I don't know. The selling more shares, I was considering maybe thinking about adding more, and then when that New York Times article came out this weekend, I was like, okay, well, I'm definitely not going to add more, because I think I would rather see some progress and buy at a higher level than buy right now with unknowns, all the unknowns of the potential launch.
Yeah, I agree with you. I would be waiting to see something more definitive in terms of progress before I got more excited about them. And they did have that long delay in approval after their date, and we never knew why. And the idea was like, well, it seemed like it's just some manufacturing issue, but it looks like more like there was a lot more review of the clinicals there. So we shall see. Certainly the initial approval in trauma, I wouldn't think that's going to be a fast ramp. So I wouldn't really expect them to come out with great numbers for their first quarter of sales, but you want to see something at least.
Yeah.
Okay. Let's see. We got a couple of things. I need input says, hey, Karl and Brian, what are the long-term prospects of Exact Sciences in your opinion for the long term from current levels? Multi-bagger potential. So Exact Sciences is in the great colorectal cancer wars, I guess. They're selling Cologuard, which is a stool-based test for colorectal cancer screening. I think the big change to their industry is that Guardant Health has come along and they have a blood-based screening product. So it's both of these are, in some ways compromises to kind of the gold standard of just getting a colonoscopy. Particularly in that neither of these tests are particularly good at picking up if there's, benign polyps or precancerous polyps. The tests are kind of likely to miss those. And ideally, you might want a little bit of advance warning. But, I think, your doctor might have, various doctors have different opinions on this, but certainly if you're on the younger end, it can make sense to maybe do one of these easier screenings earlier on and wait until you get a little bit older before you start getting the colonoscopy. Whatever, certainly they've been successful products. Cologuard is a little better than the Guardant Health one in terms of accuracy, but they both leave a little bit to be desired. I guess, Exact Sciences, I think, has managed to be, even though they're still reporting losses, I think they've managed to be cash flow positive for the last couple of years. So that's good. And I think they're going to finally tick over into profitability, or at least adjusted profitability this year is the expectation. It's at this point, it's going to be a marketing battle. I think that at least Guardant Health, even though that test isn't quite as accurate, they do have the advantage of, like, your doctor can be like, you need to get this screening and we can do it right now. They just take blood from you right in the office, rather than
and oftentimes you're already giving blood for other tests, right? I mean, especially at the age that you and I are at, right? So pretty much every time I go to the doctor, they're recommending I get a blood test, just to check my levels of everything else, right? So it's literally just an extra vial, which, it's not that big of a deal to you and I. We're already there and getting the blood test. Even I had to, they wanted me to fasting, so I had to go back, but it's still, I had to go, get the rest of the test. So it's not that big of a deal to go back and get another vial of blood is no big deal. So I think that's, the huge advantage versus playing with your stool, which is, I don't know. My doctor prescribed the Cologuard, and the box is literally still sitting in my bathroom. And
really?
He prescribed it at the beginning of January. February. So beginning of February. So it's been sitting there for basically almost 2 months, and I still haven't dealt with it. So
I encourage everybody to do something in terms of screening, and
eventually get to it. But it's like, I don't know. I obviously, if he'd ordered the blood test, I would have already done it, because I went and got my blood. He ordered at the same time he ordered the blood test, and I went and did the other blood tests. So obviously, if he'd ordered the blood test version, I would have gotten that already. So I think that one n equals 1, obviously that's a negative. But again, as you point out, the Cologuard is a little bit more sensitive, so maybe that's going to push the doctors to continue to try to get people to deal with it.
And I'll just also add, like, colorectal cancer, for whatever reason, I don't think people fully understand why, it's tending to strike people younger, so it is really important to get screened. But that also, again, for reasons I said, that might help both of these companies, just in that, like, if you're 40 and you're getting screened, there might be more of a, like, well, you just do one of these tests for now, rather than, getting pushed into doing the full colonoscopy. I would say, I guess, with Exact Sciences, I don't think they're in a terrible position or anything. I think that they're okay, but I would look, and just because the launch of Shield, the Guardant Health test, is so recent, that I would just watch a little more and see how that's trending. So I'd just be kind of watchful on that one.
All right. Hold Long and Prosper asks, specifically to me, I've said that I wish Transmedics, ticker is TMDX, would stick with making hardware. I think, and then Hold Long and Prosper says, I think their plan to own the whole delivery. I like their plan to own the whole delivery chain. Their mission is dedicated to saving lives. So, I don't know. I think this is a, personal opinion on investing more than whether they can do it or not, right? So my theory is that I would prefer to invest in picks and shovels, where a company is selling a hardware and then getting a payment for each individual procedure, in this case, transport of a organ, rather than trying to be a logistics company and own airplanes and trying to make sure that the airplanes are being used in their maximum capacity, because there's issues with there's holdover amounts for the amount that it costs to have the airplane. And so it's just a different business model. So I'm 100% rooting for Transmedics. I love the I love the idea that they're able to increase the number of potential transport of organs, right? So, more people that can get organs is better. That end stop, right? So I'm not I'm not rooting against them. I just don't like the business model of, I would rather them be a picks and shovels model and then let somebody else take on the burden of transporting the organs. And I think that would be a better business model. But they seem to be, whatever. That's the road they're going down. So if you want to be an investor, you have to accept the fact that they're going to be a logistics company in addition to developing these transport things that devices that can transport organs.
Let me see. We've got going down here a little bit. We had a question from Ed. Opinions on Viking Therapeutics and Moderna. I mean, we touched on Moderna somewhat. I actually think it's, as long as you're willing to deal with a lot of volatility and some risk, I think it's actually gotten kind of attractive. Viking Therapeutics, it's been incredibly volatile. It's had a really rough ride. It's got stuff coming up this year that's going to make a difference one way or another. I mean, I wouldn't take the recent volatility as meaning all that much. I mean, it's down with, I think, mostly in sympathy with everything else down today. I mean, I guess, again, if you're sort of perhaps running ahead of yourself with political concerns about like how FDA is going to view things and whether FDA might start just taking a negative eye towards obesity treatments or anything like that. I mean, I just, at this point, I don't think there's enough evidence of that to get super worried about that. But people are going to worry anyway. So, I mean, with Viking, it's really like, are they going to get this phase 3 trial underway in the second quarter, as they say they're going to? I mean, second quarter starts tomorrow. So anytime between tomorrow and 3 months from now, they should have this trial up and running. They've already got a manufacturing partner. They're going to have phase 2 data, phase 2B data on their oral out late this year. So those are all the critical things you have to look for. In the meantime, they should have cash enough to be doing what they need to do, and they just kind of need to get on with the cooking, and the volatility is going to be what it is.
Yeah, I mean, obviously, I don't know, you didn't really mention it, but the fact that they haven't been acquired, I think, is the majority of the reason why the price is down. If we look at the 1-year chart or something, I think that the fact that everybody thought that they were going to be acquired and they haven't been acquired, and so that's the main reason why the price is down over the last year.
Yep, that's absolutely true. All right, let's see. We have a really huge question from Vihan from a while back. I don't know how much we want to dig into parts of this. He lists a whole slew of tickers, GEHC, so GE Healthcare, Philips, Zimmer, SOLV, SNN, Penumbra, STVN, Glaukos, Bausch & Lomb, Inspire, and Inari, as all parts of the medical equipment industry, and thoughts on those. I don't know if we'll get to everything, but I can dispense with one really quickly. Inari was acquired several months ago, so that's part of Stryker now. Penumbra is PEN, the ticker PEN, is a direct competitor to Inari, and to me that one looks very expensive. It ran up. I think when Inari, that acquisition was announced, I think that the Penumbra stock ran up a little bit with the idea that, well, maybe they'll get acquired too, and then it's kind of drifted back down. But the stock is I think quite expensive. I think INSP is kind of interesting in that they're in the Inspire Medical Systems. They're in the sleep apnea space, and And so, unlike doing CPAP machines, this is a sort of surgically implanted device that helps for sleep apnea. Interestingly, so if you step back, you might be, GLP, tirzepatide, for instance, GLP-1 drug has been actually approved for sleep apnea. Presumably, semaglutide has similar benefits. So you would say, well, this is bad for these businesses. You can now take a medicine, you can lose weight, you can improve your sleep apnea. So this is bad. I mean, ResMed has actually reported the opposite. They say they've helped their business. So
in that people come in for obesity and then they get both a prescription for a obesity drug and a potential treatment for their sleep apnea.
Yeah, which is exactly what I was going to say. It's like, so is that a short-lived temporary benefit, or is that really something that's going to help them in the long term? I'd be a little concerned about how that plays out over the long term, I guess. And then with Inspire Medical, that's not going to be your first line in most cases, unless you can see structurally that there's a reason that you need to go to this solution. So you kind of have Inspire sort of one step back down from ResMed, I think, in terms of how you get your intervention for sleep apnea. You got any other thoughts on that one?
No, I mean, I think the ultimate, it's a negative, ultimately, if people are losing weight, that's going to be a negative for Inspire, whether that's, I guess the question is how much you think that people are going to lose weight, and are they going to keep it off, right? Not only are they going to lose the weight, but are they going to be able to keep it off once they lose the weight? And if they don't, then they're going to end up back, in the obesity, and then they're going to end up back having sleep apnea, and therefore potentially needing Inspire's treatment.
Yeah, I guess the counter argument there, that I don't know the company well enough to know this, but I mean, not every case of sleep apnea is like strictly tied to weight. And there might, and it's possible that that Inspire captures a larger percentage of those people who have just very structural reasons for sleep apnea than your typical CPAP machine. So that would maybe be something there. I guess Bausch and Lomb, the only thing I'll say there, it's a stable company. It doesn't look unreasonably valued. It's fine. The only thing I would say there is, if you're looking at it, Bausch and Lomb, I believe, is like almost 90% owned by Bausch Health, which is the ticker BHR. And I think there's been talk about BHR divesting its holdings in BLCO, and since it's such a large stake, that could have a significant sort of nearish term impact on the stock. So I'd just be cognizant of that when you were looking at them as an investment. Let's see, and then GE Healthcare versus Philips. Let me just say one thing also overall about all medical device companies, not all medical device companies, but many medical device companies. There is a lot of, Mexico is a very big region for doing assemblies and manufacturing of medical equipment. So there is a significant tariff factor that's perhaps more than you would see with pharmaceuticals. So you got to keep that in mind with any of these companies.
Yeah, and I also wonder how much of their gross margins are compared to pharmaceuticals, right? So the tariff is not based on the selling price, but on the import price, right? Which is the price that it costs the company to manufacture it. So that's so there's if it's a higher gross margin, then it's less of an issue for the tariffs. But I would imagine that these machines are not necessarily the highest margin businesses compared to pharmaceuticals.
Yeah. Let's see. I mean, just another Glaukos is the company. They make, I don't know if this is their only I don't know the company super well, but I mean, I know at least one of their products. I think their main product is this stent for glaucoma that's basically allowing some sort of pressure drainage from the eye. And the stock, I think, has been kind of beaten up. I'm not entirely sure why. What's going on there? I think they have a new FDA. They're basically trying to get approval of an improved version of that right now. So I'm not sure. Yeah, what the big, because they had a huge drop off in February, so something happened then. I guess yeah, there was a really bad reaction to their earnings. Even though that was like it was a 28% year-over-year increase in revenues up to 100 million. So I'm assuming that did not meet expectations, but that the size of the crash in the share price based on that is something that was that really overdone? I don't have a firm judgment on that, but that looks interesting to me. Anything on any of these other ones?
No, just in general, like I'm not that interested in large medical device companies. I think if you're going to invest in medical device companies, I'd rather invest in ones that are specific to very, specific industries or, treatments, diseases, rather than investing in, large companies like GE Healthcare. Just that's my personal opinion. I think there's more growth available in those smaller companies than in the large companies that are selling mega products to hospitals like GE Healthcare.
Yeah, I mean GE Healthcare it's been a, I think it's a reasonably well-run company, and it's had good returns on investment and everything else. It's return on equity, decent profitability. That's all good. It's not a super fast grower, but Philips has had some problems on the other hand. But then the stock is also, considerably cheaper. Okay. We've hit most of those.
Yeah.
Should we move on?
Yeah. So Jimbo has a question about Twist Biosciences, ticker is TWST. Jimbo says that tech-wise is interesting, but when will it start making money? What are your expectations in the next 5 years? Is that your best play in the biotech and synthetic biospace? So just to be, if people aren't clear, don't know about Twist Biosciences, this company has a way to make DNA very cheaply. So, researchers need DNA, synthetic biology companies need DNA. So they use Twist when they have large experiments or large screens that they want to do to look at different, the ability of different proteins to do different things. So every time you change the DNA, then you change the protein, because protein makes mRNA, DNA makes mRNA, makes protein. So if you change the DNA, then you can look at a different protein. So you can make individual changes at the DNA level, and then look at the individual changes at the protein level, and you can make minor changes and then therefore look at minor changes at the protein level, and then figure out the best way to do that. So synthetic biology might be looking at it, creating a new enzyme that can I don't know, synthesize something. And so you might want to look at 100,000 different options, and so you need the cheapest way to make the DNA so that you can make the protein to test the individual potential changes that you might make in the protein level to increase your yield of the enzyme. And so they've created a way to make very small amounts of DNA, and you'll actually need small amounts of DNA to do these experiments. And so they can their cheap is really just less volume, but the less volume is all you need. And so they create they make the DNA on silicon chips, and then that allows them to create smaller amounts of DNA. So they're currently selling DNA both to synthetic biology companies as well as to researchers in academia and at biotechs, mostly at academia. And so that's their current value play, and they're not cash flow positive, or at least certainly not gap positive.
No, they've improved their cash burn, is what you is what you could say. I mean, it's getting lower now.
Yeah, and
yeah.
so they opened up a new manufacturing plant. They were basically manufacturing constrained until I think the beginning of 2024, and so they opened up a new manufacturing plant. And so what they've done is because they were manufacturing constrained, they've created a 2-tier system where you can get your DNA very quickly if you want it and pay extra, or you can get you can wait in line and get your DNA when they finish everybody in front of you, which is a couple month to a couple of months. So that has helped their margins, because if they're charging more, but it literally costs them the same amount to make the DNA, whether you're waiting in line or whether you get put in the front of the line, that's helped their margins substantially. So they're moving towards profitability. I think they're guiding towards profitability in 2026, if I'm not mistaken. So they also,
I think maybe cash flow positive.
Cash flow positive in 2020, or EBITDA positive, or whatever they've decided their metric that isn't gap is. But so that would be their main issue. Their main they're going to get to cash flow positive or whatever before they run out of cash. So I don't think that's a really big worry. And then they've also been screening libraries. So because you can make DNA quickly or cheaply, you can create a library of antibodies very easily. And so they've created libraries of antibodies and then been able to screen those for biotech companies. And they have like 100 or something partners where they've created antibodies and then basically just given them back to the biotechs and said, go ahead and develop them. And they've been able to create they have partnerships where they either get milestone payments and or royalties on those sales of those drugs. Now, obviously not all 100 are going to become drugs in the end that are approved, but even if you assume 10% of them are going to become positive, and then maybe each one of them is worth $1 billion in cash flow down the line, so that's $10 billion worth of potential cash flow down the line from that 100 potential initial drugs. So I think that, and then of course further down the line they're working on writing data as DNA, and then storing that DNA, and then you could read the DNA back if you wanted to by sequencing the DNA. And so this is for long-term storage of data where you don't think you're ever going to need it, but in case you do, there's an option for getting it back. And so the getting it back is sequencing the DNA. And so I think that's a long-term potential for the company. I'm not really counting it in the valuation, but I think the valuation looks pretty good right now. And I think that they're on the path towards at least cash flow positive and eventually profitability. So that's sort of my expectations over the next 5 years. I wouldn't even put they maybe have some sales of, they're in beta testing for their testing of writing DNA as data. I think they're going after what I think is the right model, which is rather than trying to do the data writing themselves, what they're going to do is try to create a box, a machine that will write the DNA write the DNA, start with data, write the DNA, and then the input is the DNA, and then they can sell this box to other companies that can then be the manufacturer of DNA as data storage as DNA. And so I think that's the right model rather than trying to do the data storage themselves.
Yeah. Let's see. Rose popped in with a question, which is just says, what about Medtronic? Is that too large and non-specific in what it addresses? And so, I mean, I don't want to. I guess I think she's reacting to what you said earlier about companies. Right. And I mean, I will say, I'm not trying to put words in your mouth, but I mean, I think that's kind of a personal thing for you, that you're not especially interested in those companies. I mean, some of them can be Medtronic, for instance, is, you know, a steadily profitable, you know, slowly growing company that pays a decent dividend. I mean, and is not unreasonably valued. So it's not like that's, you know, a relatively
on a risk reward basis, it may be a good investment. It's not necessarily a company that I'm interested in investing in. Also, I have a hard time figuring out how to value the company because they don't give very much detail on their individual products, right? They just sort of break them into 3 or 4 different groups, right? And then they don't tell you, they tell you each individual group how much that's going up and down, but in terms of individual sales, they don't give you very much information. So compared to a pharmaceutical company, they'll tell you every drug that's, you know, their top, you know, 90% of their drugs. They may throw the bottom 10% into an others category, but that's only 10% of the sales. So you're not really worried about whether that's going up or down, or is that driving the sales. Where with a medical device company like Medtronic, there may be a new, they'll cite in their press release and in their conference call, oh, we have this great new medical device that is, you know, we've just launched and we're really excited about it, but they won't tell you how much sales it is, and they won't, in the future, they won't tell you how much it's growing or not. They're just, it's within this thing, and they may make a comment on it, like, you know, the diabetes group was up 10% because of our insulin pump, but they don't like tell you how much that insulin pump, how much of the sales of that total group that insulin pump is, and then how much is that insulin pump actually going up. You know,
funny you should mention insulin pumps, just because that's a particular business in which Medtronic really messed up its market.
Yeah.
So, but you know, they're very diverse. I don't, you know, Medtronic, like a lot of these big device companies, are also not, like, even compared to, I mean, obviously the role of these large companies is often to act in a way as venture capitalists to the industry. So, you know, you find that in the pharmaceutical industry, where a large part of what they're doing is looking around the biotech industry or the, you know, smaller companies and seeing what's innovative and partnering with them, investing in those programs, licensing in what they want. And, you know, it's similar in the device industry. But with that said, I tend to find that the big device companies just tend to be a little less innovative. They tend to wait too long, I think, sometimes, or to miss certain things. So there's that. And like, when you look at a really long-term chart of Medtronic, I mean, it did have a nice run up. It went down, I think. The drop, if you look at like a really long chart of Medtronic, 10 years or more, they did have this nice ramp, and then it started to drop down, and I believe that was related to their problems in the diabetes glucose pump and glucose monitoring market. And they've not really, I mean, the stock is definitely up off of its recent lows, but I mean, it's kind of been sideways-ish for quite a while now.
Yeah.
Do
you want to talk about Vaxcyte? They had some news today, phase 2 clinical trial data.
It's a bad day to report your vaccine news.
Yeah. I mean, so obviously we talked earlier, if people weren't around, we talked about the fact that Merck's resigned from the CBER on Friday. But it's down like 50%. So I don't think it's 100% due to Marks. I think that some of it's just that this is for their pneumococcal conjugate vaccine phase 2 data. It looks similar to Prevnar 20, but somehow I guess that wasn't good enough to, for a phase 2 data. I'm sort of surprised that it was down, last time I looked, it was down about 50%. It seemed like maybe an overreaction. What did you think?
From what I saw, so you can correct me if my understanding of this is wrong, because I didn't go super deep on this or anything, but the results that they report today are on a product called VAX-24, which is a pneumococcal vaccine, but they also have one called VAX-31 in the works, and I think that's really the one that that's more important to them. And I think where all of these are is they sort of add in more serotypes of pneumococcal disease.
Right. Prevnar 20 has 20 different so these are like individual, the virus has mutated, and so there's multiple different versions of the virus. In Prevnar 20 there's 20 different, there's antigens to 20 different versions of the virus. Right. And so I don't know if VAX-24 has 24.
I think it does. It's 24, right. And then they have one with 31. And so the idea is like, well, that would theoretically be better, and I don't want to go too deep down the rabbit hole here, but that starts to be I'm not sure how they divided up the trial, right? I mean, if you've got 4 different serotypes in your clinical trial, how much did those 4 serotypes show up? How well did you build that into your design where you're going to expect those 4 serotypes to tick over your overall results in the study? I mean, basically this was a sort of a non-inferiority test and they passed it. So yeah, I mean, I get, my read on it was that it seemed like an overreaction, especially as this is their sort of, further ahead product, but not even really the main one that they're going after, which is VAX-31. It seemed like an overreaction. I reserve the right to be wrong if there's something I'm missing about it, but it seemed a little much for okay at least data.
Yeah, I mean, I don't know. Maybe people were expecting it to be much better or something. I mean, I guess the argument might be that Prevnar's from Pfizer, if I'm not mistaken, right? So Prevnar, if we've got Pfizer, if you're similar results and you're competing against Pfizer, maybe that's a negative, right? So that maybe that's the argument, is that it's not so much. If it was much better than Prevnar 20, then that would be a argument for it being good. But because it's similar, maybe that's an argument that they're not going to be able to compete against Pfizer. Just the fact that Pfizer is much bigger than Vaxcyte.
But when you're talking about a vaccine, right? I mean, these should have very high rates, right? So being as good should be. I mean, that should be.
Yeah. How much better can you actually be, right? I mean, that's
and so what you really want to do is, I think you need to power your study enough to show that you're capturing serotypes that the other ones aren't. And I don't know if you're going to do that in a phase 2 study. I think you got to do it maybe in the phase 3.
Right.
So yeah.
Yeah, I don't. It definitely feels like that 50% decline is an overreaction, but again, I don't know if either one of us have a huge idea of the valuation to make a firm decision, firm call on that.
Yeah. Let's see. We did have an older question here. Maybe this is the last one we'll just hit real quick before we're out. From Besties, asked about Lantheus, LNTH. Says, any one of you follow Lantheus? How is this business going? And what are your expectations for return in the next 2 to 4 years? This is a company that sells, it's a radiopharmaceutical company. So they do both imaging products and then increasingly moving into radiopharmaceuticals, making a lot of money off of a product called Pylarify that's been doing well. And they've been making some acquisitions and moving forward on this radiopharmaceutical pipeline. Stock's actually up 1.6% today, so that's saying something on a day like
on a very down day for biotech. That's
yeah, right. However, overall, it's I kind of like this company. It's not unreasonably valued, and I think there's a lot of potential in the radio pharmaceutical part of the business, even as it's got the sort of stability from its imaging product. And that imaging product is, while theoretically somebody could come along with something competitive, I mean it's definitely favored just because it's very specific. It's got all the right, it basically gets better images. You're going to capture better stuff when you're doing prostate imaging on it than you are with other agents. So certainly one I'd be interested in on any weakness.
Yeah, I mean, I don't know. I love the business model because in phase 1 you can see very easily whether your antibodies going to the tumor, because you can just image it and you can know really quickly. And then there's no reason to think that if the antibody isn't going to the tumor, that the antibody with a rather than an imaging isotope, a damaging cell isotope shouldn't also affect the cells in the tumor. So I like the business model in that it feels very much like, I don't know, like a virus treatment, right? Where, if an antiviral, if phase 1, if it treats if it lowers the virus level, the fact that, the phase 3 clinical trial is going to be successful feels very likely. This is the same sort of model, in my opinion.
Yeah. And probably not a whole lot of generic threat, right?
Right. Yeah. I mean, because it's really hard to make. Yeah, exactly.
You're dealing with radiation. All right. Rachel and Lou are here, and we shall bid you adieu until later in the week.
Yeah.
Bye, guys. Have a great show.
Thanks, Karl.
guys.
Thanks, Brian. There's some sort of great segue, speaking of radiation coming in. I don't know, but
leave it at that.
We didn't have a good segue plan, did we, Lou?
I never do. I'll say though nowadays, but Karl has the greatest voice for this in the world. I could listen to Karl talk all day. I'll leave it to that. Unfortunately, fools, you have to listen to me instead. But you get Rachel here. Rachel Warren, Lou Whiteman here to answer your questions about this, that, and whatever, and related to investing. As the scroll says, you've probably heard this once or twice by now. This is for educational purposes only and does not constitute personalized financial advice. We can't tell you what to do. You don't want to do what I do anyway because you're not me. So we are here to hopefully answer questions, maybe educate, and please get those questions in. Slido Fool 24 is the keyword. Would love to hear you. Otherwise, you got to listen to what we think is interesting, which is probably less interesting than what you think is interesting. So get your questions in. Rachel, how you doing?
I'm doing good. Just, keeping an eye on the market and some interesting stories coming out. It talked about on one of the earlier shows today about some of the things we're watching this week. There are a few companies that are reporting earnings, but I think the biggest things that investors are probably paying attention to are, one, some of the GDP data that comes out later this week, and then also midweek, more clarity on to be announced tariffs. But, there's other things going on in the news as well. Maybe we can talk about that to add a little levity and joy outside of some of the more dire aspects of tariff talk that we've been discussing a lot in recent shows.
Yeah. Yeah, I don't know though, and I mean, I won't. We should leave this in the queue because I'm hoping someone gives a better answer. But I guess that was this morning. Stefan was talking about what is your favorite Liberation Day family tradition. We should do an hour of that too. But yeah, just
Liberation Day family traditions.
Yeah. Do you celebrate it the old-fashioned way like your family did, or is it? Yeah. Anyway, we just won't go there. Eric, leave that in there though. I want some host to have a better answer than I do on that. It's problem with the holidays is, Rachel, I always get sort of the blues. Liberation Day. I think about the Liberation Days of my youth, and it's just hard. Yeah, and maybe although the market has turned, the market is now green. So
yeah,
who knows? You don't know anything. All right, we'll talk about it. I think you had a couple of news stories. I might have had one or two, but what are you seeing? What's interesting?
Kind of go back and forth. Yeah. Well, one story I saw that I thought was kind of interesting that was published actually at the latter part of last week, but I just was reading through it today, was about how ChatGPT's viral image generation AI is actually melting OpenAI's GPUs. So on Thursday, CEO Sam Altman announced the viral use of ChatGPT's new image generation AI, which was introduced earlier last week, and was saying that this is overloading the company's servers. And he was saying, well, it's super fun seeing people love images, and posted this on X, our GPUs are melting. And it was saying that images of anime style renderings of users' uploaded photos have been going viral on X and other social media apps since the feature was launched almost a week ago now. So it was launched last Tuesday. And what's interesting is that because the GPUs were melting as a result of high adoption of this new image generation AI tool, Altman said that we're going to have to actually temporarily limit the feature's usage as it works to make it more efficient. And one of the things the article pointed out was that the rate limits affect OpenAI's debut of native image generation within ChatGPT. And basically this tool that they launched is a way to produce everything from diagrams to logos to business cards, stock photos, infographics. There's a range of companies off the top of my head I can think of right now that might be shaking in their boots a little bit, thinking about that, the potential of that specific tool. But the feature can also use an image, an existing image, as a starting point for art. For example, the article gives the example of a custom painting of a pet or editing a professional headshot. So let's say you had headshots taken for work. You're not really satisfied with the final product. You're like, you know what, let me go ahead, plug this into ChatGPT's image tool and edit it as you like. That is an option. So the image generation feature began rolling out to ChatGPT Plus Pro and Team users, and as well as users of the free tier when they're using OpenAI's 4D model. And then presumably this week that we are currently in is when ChatGPT Enterprise and EDU users will receive access to this tool. But there's been all of these different, and I haven't had a chance to look through all of them yet, but all of these different anime style renderings of users' uploaded photos that they have been creating using this new image generation tool. Altman, at least for a while, changed his X profile photo to an image generated by the new feature. That might still be the one on his page. Anyway, kind of interesting. Altman's also said that users of the free tier on ChatGPT, the goal is for them to soon be able to generate up to 3 images a day. So clearly the demand is there, the interest is there, to the point that their GPUs, their entire platform is built on, were melting because so many users were rushing to use the tool. So that was kind of interesting. I don't know, that caught my attention.
I don't know if it's marketing or not. It's great marketing if it is. So Sam, good on you, even if it is.
It might be just great marketing.
I have mostly non-relevant thoughts. I mean, my first thought was how I think have a headshot that had to be taken in the 90s. How fun would it be if I could find that and say, just take the hair off of this and age it and
just go edit it.
Just to fact check it. That would be fun. I have a few friends on Facebook who have used this tool, and I can tell you either it's not ready for prime time or they're no good at it. I can't tell you which, but the really fun thing is mostly moms making action figures of their kids, and like like their kid's face in a little like cellophane package but yeah, it's neat. And it's the same question I have about Adobe short term. I mean, long term it might work, but it seems to me that this will definitely capture the idiot users. And I use that, or just the me's of the world, that the people who aren't going to pay for high-end software. I am much more skeptical based on what I've seen of most of these tools that they are going to quickly be deemed good enough for professional users, especially in a world where the professional tools are incorporating AI as well. So I think it might blow out any dream of some of these companies for ever capturing the retail, like a non-pro version, which was the business plan from like 5 years ago of Adobe's the obvious one, bring Photoshop to the masses, right?
Right.
Those days may be over. But in a weird way, if AI is also an opportunity to make what they do more sticky, with the core audience. And I honestly don't know how that plays out. You know, that it seems like it's a little bit of roulette there, right? Because you are hoping that this technology enhances you instead of kills you when the technology is going to be cheaper than you. But
Right.
I do think there's at least a path among the professionals. It might lower your total addressable market, but hopefully if you can use AI wisely, you can at least be a better value proposition because you're doing more for those professional users who buy it. But we'll see.
Yeah, it's kind of interesting because Adobe was, of course, the first company I thought of. And we've seen, especially over the last couple of years, how they have been really working to sort of get ahead of the curve. Because I'm pretty sure when these tools started really becoming more widely adopted, I think there was a real rush of users, consumers, and even analysts that were thinking, how does this work for these types of businesses in the long term? You know, they could potentially replace the use cases for a business like Adobe. Now, I tend to agree with you. I think especially for the professional use cases, which is really where, for a business like Adobe, a lot of their revenue, derives from. Just like we've seen that these tools can be useful, but say for homework help, but aren't necessarily always giving 100% accurate answers. You know, you're not necessarily getting back a Monet or a Renoir when you ask for a rendering, from this generator. But it is interesting. You think about Adobe; they've been working to incorporate AI and machine learning technology into their entire experience cloud, and then also, of course, into areas like Acrobat and Reader, as well as their creative cloud apps like Photoshop, Illustrator, and Express. And they have seen that has been very sticky to the end user, and there have been a lot of ways in which the marketing agencies that they partner with have found that to be really useful. So, I think sometimes we look at the developments in this space and it can be easy to think in the extremes of, this technology might replace these companies or replace the need for certain human elements and human workers. And I feel like the truth, and we'll see, is probably somewhere more in the middle. I don't think that suddenly, you're not going to be having the need for talented creatives in these different industries. I don't think that suddenly the need for really exceptional professional software that has been used and continues to refine and upgrade to the current environment at hand is suddenly going to evaporate, because we have seen that there are flaws and limitations with some of these AI tools. They can be really helpful. They can make work more efficient, certainly. But it is not, the end all be all. And there is a lot more refining, I think, that's still ahead. So I tend to think that in the long run, there's going to be some truth to some of the concerns and sort of cautious, warnings we hear about the widespread adoption of AI in different industries. But I do tend to think in the end, it just makes people more efficient and makes us work better and gives us more options to focus on important tasks. And I think that can be a really good thing.
Yeah. Yeah. And of course, all of this is a huge caveat of for now. That
could change.
Yeah. It is. It's easy to get caught up in just the, wow, this is really cool if you're me just trying to make stupid memes for Twitter or something versus a professional use case. That doesn't mean it can't get there, but I do think that most of the things that I'm doing with these tools that I think are really amazing, I don't think would pass the muster of a lot of professional users. So, we'll see. That can look very, very outdated quickly as these tools improve. You're basically making a bet whether or not you think these companies can improve along with the free alternatives, and we'll see. I think we talked about Chegg on the weekend, and sometimes AI can bite you, and sometimes AI becomes a tool that helps you, and it's going to vary by company to company, I think
that's right.
Yeah. All right. We do have some questions coming in. We can get to those in a second. Rose says, Lou, I skipped the weekend sessions. Did you discuss trucking and aerospace? Duh. Sorry, Rose.
What would a show with Lou be without this?
I know. I mean, I feel I've been typecast, Rachel, but it's so accurate. So, Rose, you're right. I'd love to hear about those two sectors. I can opine before the end of the hour, but if you have any specific questions, go ahead and get those in, because I'd love to actually address what you're thinking about. there was a question from a couple hours ago, and I don't know, hopefully Ed, you're still on, but I wanted to kind of take a stab at it. The direction 3X Bulls Semiconductor ETF has been hammered recently. Should investors start to consider nibbling? Now, Ed, this is a good time to say, scroll below. And of course, we're not giving you individual advice, but let's talk about these 3X ETFs here. And we're not just going to talk about this particular one you mentioned. We can kind of generalize with all of them. And they are a tool for a specific purpose. And that purpose is not to be held past close. Okay. What you are doing basically is you can make a trade that you could basically 3x your profit, right? Because whatever you are betting on, and this is, and to some extent, everything in Wall Street is just a form of gambling. This is definitely gambling, but you're just going to lever up on a bet using options, but it's packaged in a nice ETF to make it easy for you. And that basically daily, they are going to give you 3 exclamation points to what your bet's move was. All right. Using their ability to generate leverage. It is, if you bet right, it's 3x up. If you bet down, yeah, the math is still mathing. So these things by design are not made to be buy and hold. The people who make the ETFs have to constantly rejigger what's in it to account for the last day's trading. You can exponentially do better or do worse than any one day's return by holding these in long term. Even in a steady market, you can get compounded away. It's just the nature of options. So should investors start nibbling? If you want to day trade and you have conviction in a sector, in a move, or something like that, it is a way to pump up your returns using leverage and just pump up risk and pump up returns. I don't think anyone who wants to be a long-term investor, and by long-term in this case, I mean for the week. So very, very, anything other than just day trading, these things are just a wrap of risk. And I don't think the fact that it's been hammered is a reason that you should buy in and kind of wait it out. You are much better off if you believe in the semis and see the sector being hit, just to buy an ETF that is just stocks from that will recover as the stocks recover, not a play on options that are betting on dramatic moves on a daily basis. You can Google it. I'm probably doing a terrible job explaining the 3X leverage ETFs, but like many things on Wall Street, Ed, they are a product that was designed to be sold based on current market conditions, with everybody basically focused on daily moves and oversized moves going back to the GameStop phenomena. These things make a lot of sense from a marketing perspective. I would argue they make a lot less sense for those who are seeking long-term investment strategies, but your mileage may vary. I don't know. I don't have a lot of these, Rachel, full disclosure. So we shouldn't get into our own personal portfolios, but this is not an area that I've chosen to build my nest egg around.
Yeah. I similarly have not really delved into that space so much. I've studied it, but it has not been where I've personally wanted to put capital to work. But it is interesting to look at. There's a couple questions, but I'm going to hit one for now from Rose. This is relating to the deep dive that Toby and I did earlier today at I believe it was 10 a.m. Eastern on GE Healthcare. And so this is what that question goes back to. But Rose was saying, Rachel, looking at the valuation slide, is Abbott overvalued? Medtronic and Johnson & Johnson, are they at a good price to earnings and price to sales right now? Which of the three, Abbott, Medtronic, and Johnson & Johnson, has the greatest upside the next 5 years? So I want to share some thoughts. And I do think that valuation is definitely, important looking at these businesses, but I think there's also other things you have to consider that are going to not only feed into that valuation, but feed into their growth story over the coming years. I went into great detail about how GE Healthcare's business works earlier today. For anyone that's interested and wants to go back and watch that, feel free to do so. But in terms of from a valuation basis, right? So GE Healthcare, they have a market cap of about 36 billion. trading at a price to sales of around 2, a price to earnings of around 17. A business like Medtronic, and I'll talk briefly about some of the overlap and divergence in their businesses here in a minute. But a company like Medtronic, they traded a price to sales of around 3.4, price to earnings of around 15. Market cap is roughly triple that of GE Healthcare's. Abbott Labs has a market cap of around 230 billion. So again, significantly above GE Healthcare's, and they're trading at a price to sales of around 5.5, price to earnings of around 25. And then you've got Johnson & Johnson, which I am personally a shareholder of. And Johnson & Johnson trades at a price to sales of about 4.5, price to earnings of about 15.5, and has a market cap of just under 400 billion as of right now. Looking at these companies and where their respective business operations lie, and also understanding that these are traditionally value-oriented businesses. These are not high-growth stocks. I do tend to think that they are fairly valued for their respective segments of the market. GE Healthcare, compared to some of these other businesses, is also not a one-to-one comparison. And some of these businesses are growing revenue and earnings at similar rates, but from very different sources. And as important as valuation is, it's also really important to look at the underlying business to understand whether that's something that resonates with you as an investor, over the long run in your portfolio. So, as I mentioned earlier today, GE Healthcare, which was spun off from GE almost a couple years ago now, they are known for a wide range of hardware and software devices that they provide to healthcare providers. They are primarily known for their medical devices like their imaging systems, CT, MRI, X-ray systems, ultrasound, pharmaceutical diagnostics. So they sell contrast agents, radiopharmaceuticals. They offer solutions for remote patient monitoring, anesthesia, respiratory care, diagnostic cardiology, infant care. They've been investing heavily in AI, partnering with companies like NVIDIA to offer solutions that overall improve diagnostic accuracy and personalized patient care, heavily focusing on developing an entire ecosystem of products and services streamlined towards precision medicine and sort of fulfilling the full spectrum of needs that healthcare providers have. That is very different than a business like Abbott Labs. So Abbott Labs has several different segments. They do make medical devices, including different products for cardiovascular health, diabetes care, neuromodulation. But they also have their diagnostic segment, their nutritional products, like their infant formulas, which they're pretty well known for. They also manufacture and sell a broad line of generic drugs as well. Growth rates have been similar. Something we talked about with GE Healthcare's growth, earlier today is revenue growth in the single digits is pretty standard for that type of a business. And that is also broadly speaking the case with Abbott Labs, with Medtronic, with Johnson & Johnson. These are established, very mature businesses. And just given the backdrop of the industry they're operating in, those are pretty standard growth rates. So we talked a lot earlier today about GE Healthcare's growth. For comparison, Abbott Labs in 2024, their sales increased about 5% year over year. Now their free cash flow margin increased significantly to about 66% in the final quarter of the year. And they have a really robust track record of being a solid dividend payer. They've increased their dividends for, I think, 53 consecutive years at this point. So that's Abbott. Medtronic is also a medical technology company. They also have the medical device segment. So where you're really seeing an overlap here between these three businesses so far is when it comes to their medical devices. For Medtronic's part, their largest segment is their cardiovascular medical device segment. So devices like pacemakers, defibrillators, heart valves, stents, products for cardiac surgery, but they also have different diabetes care-centric products that they sell. For example, insulin pumps, continuous glucose monitoring systems. They have products for minimally invasive surgical procedures like surgical instruments and wound care that they sell. Then they also have their neuroscience division, which includes things like spinal fixation devices, neuromodulation devices. In 2024, that cardiovascular segment, which is a huge area of growth for the business, certainly an area in which GE Healthcare has exposure. That business generated over $12 billion in revenue for Medtronic alone. And their growth was about 3% in terms of the top line in their most recent fiscal financial reporting period. And then finally, you have Johnson & Johnson. So again, you've got some overlap here, primarily as it pertains to medical devices. But this is one of the most well-known pharmaceutical giants in the world. They sell prescription drugs across a wide range of therapeutic areas, everything from immunology to oncology, infectious diseases, and more. And since they spun off their slower growing consumer health segment a few years ago, they've been focusing heavily on their pharmaceuticals business and their medical device or med tech segment. And this is a wide range of devices and technologies that are used in hospitals, clinics, surgical settings. This includes implants, surgical instruments, diagnostic tools. They acquired Abiomed a few years back, which was known for the Impella pump, the world's smallest heart pump. They also acquired Shockwave Medical, and I believe that acquisition closed just last year, which is also going to be a key driver of growth for their medical device segment. So as you look at these businesses, they are growing at similar rates. They have some areas in which their businesses overlap, primarily as it pertains to medical devices. Johnson & Johnson is a pharmaceutical giant. Medtronic is primarily known for their medical devices, Abbott Labs for their diabetes care nutritional products, and some of their other medical devices as well. And then GE Healthcare has really exposure to so many different sectors of the broader precision healthcare space. So I think one of the important things to consider if you're looking at these businesses, because each of these three businesses is by several orders of magnitude larger in terms of market cap than GE Healthcare, although they are growing at similar rates and have in many ways similar valuation traits. Considering whether these are businesses that make sense and that you think about for your portfolio over the long run, I think that as a shareholder of Johnson & Johnson, I can attest to the fact that share price appreciation has not been robust by any means over the years. This is very much a classic blue chip value-oriented business, but it is a fantastic dividend payer. And that total return over the years, as well as just the steadiness of a business like Johnson & Johnson, has been one that has really resonated to me and for my portfolio. Now, I don't invest in Medtronic, but I've invested in other medical device businesses. This is also a stock where share price performance has been somewhat tepid in best in recent years, but this has been a faithful dividend payer. And similarly with Abbott Labs. So looking at these companies, I think it's important to understand that these are not necessarily going to be market-beating companies in your portfolio. Abbott Labs is probably by far the one that has experienced the most robust growth in terms of share price over the last few years, just for comparison purposes. Although GE Healthcare has done quite well in my estimation. So I think when you think about some of the different growth factors for these businesses over the next 5 years, there are some overlap between how they derive their revenue and profits, but there are very distinct areas in which these companies have their own unique focus within the broader healthcare field, and kind of understanding how those businesses work and whether that makes sense for one's portfolio, I think is key. I think it's likely that these are businesses that will grow at similar rates over the next 5 years, if I had to guess. These are companies that have had a pretty steady track record of doing that, steadily growing dividends. Share prices do increase over time, but these are not high growth businesses. These are much more the sort of steady compounders in one's portfolio that are, broadly speaking, very steady growth, profitable healthcare businesses. So those are just some of my thoughts. I hesitate to prognosticate on which particular stock might have the biggest upside over the next few years, because as I've said, I think that these have a lot of different growth factors that might lead to similar growth rates in the coming years. But I think, on the basis of it, I think these are all quality businesses. For some investors, a basket approach is a great way to go. I think for some, it's important to look at the individual business and see which one is most interesting, for your personal portfolio. That's the approach that I would take in this situation.
It's interesting. Back to the GE. You mentioned with GE Healthcare, and we are coming up on, I believe it's this week, the 1 year anniversary of the big split, and the three GE cousins kind of going off on their own. And the theory is that there was a lot of good assets in all of these businesses, but just the corporate baggage and the GE baggage that came along with it, and also just that fight for resources that comes as part of a conglomerate, that they were all better off if they go out on my own. It's too early to keep score yet, but Natasha, share my screen. Like I say, it was April 2nd, 2024 that these all began trading, the three businesses, and buying away, and maybe some of this is just kind of macro issues, but GE Verona, the energy, well, very, very big. GE Aerospace, which is mostly a play on commercial aircraft engines, doing pretty well. 44% in a year is not bad. And yeah, healthcare doesn't really speak to the quality of the business. I'd argue they aren't that inferior from business, but some of this is macro and where the industry is going. The upside to the split was that all of these companies could be valued and make capital allocation strategies based on the particulars of their industry. The downside of splitting up is that inside a conglomerate, it's sort of a safe harbor where even if your business is in a lull, you might have an energy business that's doubling in a year because of the natures of just theirs. I think it could still work out in the long term. And I think it was still probably a good move for them to split and kind of become more focused. But you have a very different perspective on how that is going. If you only own GE Healthcare right now, you probably kind of wish the breakup never happened, and you're still getting some exposure to that energy business. And you only own energy, you're just thinking, thank God we are free from all of that stuff that was bothering us before, right? So
yeah, it's interesting because I had not been as deeply familiar with GE Healthcare, and then had to really take a lot of time to study the business for this deep dive we did earlier today. And it is a fascinating company, and it is a very profitable enterprise. And they do have that very kind of steady, slow growth you see from these very massive capital intensive healthcare businesses. And that's sort of just how the fundamentals work. You're not getting low to even mid to even low double-digit growth is not something you're traditionally going to see with these businesses. If you have a segment that delivers double-digit growth, that is really, really solid. And that's just partly down to the nature of how these businesses work. But it is interesting.
Yeah, Rose. Yes, if you owned it, you did get all three, and plus some other things that have gotten rid of along the years. And yeah, I mean, I guess that is really the answer. If you kept all three, you sort of get the safe harbor exposure, but you also get these companies. There really is something to be said that healthcare is in a different investment cycle than energy, and its bonds trade on a different kind of cadence. So to kind of get that on its own, but yeah, just really interesting. Because I think everyone, myself included, said this split's a good idea. I'm not going back on that, but it probably does depend on if you only kept one of them, which one you kept as far as how you think of it today. Right.
Yeah. It's fascinating.
Jimbo's questions this is a quick one, and we actually have boots on the ground research asking, does Toast to sell outside the U.S.? I know, Jimbo, I have seen them in the British Isles. I have never seen them in Portugal. I don't know if they're in Italy or not. The answer is yes, they are outside the US because I think they're Canada, and I definitely know they're in the British Isles. I don't think they've gone far beyond that, though. I don't think they're really saturated in Europe right now.
No, they have a very kind of small, but I think they're trying to grow their presence outside of North America. But they did launch their platform in Ireland, as well as the United Kingdom, Canada, US, obviously, and Canada are their biggest markets right now. But the UK and Ireland is where they're expanded internationally. And I do think that they are targeting other markets. I don't think that they are in mainland Europe. As of yet, I have definitely not encountered them in my, for whatever anecdotal experience that is. But based on just my readings as someone who follows the company, I'm not aware that they are outside of those, specific regions just mentioned. But I would imagine that that's a plan over the long run, because they launched, they sort of positioned it as we're launching our European presence. And that was back in 2017 when they opened their first, Dublin office, and they launched their digital technology platform. So I would imagine that's a long-term vision for management.
So Rose, and yes, I do remember you asked this, so my apologies. Rose says, Lou, the question I asked last week, I don't think I addressed it over the weekend. If not, Rose, you're here now, so we'll talk about it again. How would you rank ODFL, Old Dominion Freight Line, XPO, which is XPO Trucking, and JBHT, JB Hunt? These are three of the biggest names in what we call LTL trucking, which is less than truckload. And basically what that means is, if you think about it, if your truck is just contracted by Walmart to haul things from one Walmart facility to another, then that's truckload. If you have like multiple customers with multiple goods going in the same general direction, but maybe to different endpoints or maybe just to a distribution center, that's less than truckload. So in other words, you're just putting multiple customers' goods into a truck. The upside here is it tends to be more lucrative because you can get better margins on smaller deals from individual customers, but it adds a ton of complexity to the network. So you have to be good at it. These three, by and large, are very, very good at it. Old Dominion is famously a long-term market beater in ways that you would not expect out of a trucker, based largely on their culture. As silly as, I sometimes roll my eyes when I hear that about companies, but Old Dominion has a fantastic culture and they just operate more efficiently than the rest of the world. As far as ranking them today, that's tough because in some ways I think Old Dominion benefited from the same thing I talk about Southwest Airlines having benefited from. Yes, they were good operators, but also they were the designated drivers at the party. They were the only people in their industry that knew what they were doing. And I think this is really played out for airlines. Deregulation happens. Southwest focuses on profitability and efficiency. The other airlines just want to see all their shiny little dots on the map, and Southwest ate them for lunch. Over time and through bankruptcies, and it took 30 years, the airlines got smarter. And Southwest didn't get dumber. Southwest didn't maybe evolve, but a lot of what has happened to Southwest in the last decade is that the competition is just smarter than it used to be. So it's the low-hanging fruit is gone. I think we're starting to see that with Old Dominion. We had Yellow Roadway, which was the biggest giant out there, but a terribly run company, the result of a number of mergers, bankruptcies, acquisitions, private equity, then come out, and just terrible union relations, terrible operations. They finally liquidated. And that kind of relieved a ton of capacity, but also that was the low-hanging fruit, the easy ones to compete against. XPO went out and hired basically a chief operating officer from Old Dominion, and has spent the last year or two adopting a lot of those tactics and trying to come in-house. JB Hunt has always been just a decent operator. I think all three of these are winners relative to trucking. If I was to buy one right now, my thought would be thinking, if you want slow and steady wins the race, I don't think you can go wrong with Old Dominion. I'm not convinced it is going to outpace the other two, but I think there's a lot less risk to it. And I do think that when trucking performs, Old Dominion will perform. They know what they're doing. So you're going to basically be a victim of the cycle, and these stocks have been down almost across the board with one exception, but you're going to be a victim of the cycle because if there isn't demand for trucking, there's nothing they can do, and they all suffer. But you are going to be a relative outperformer when trucking is good. XPO has been a huge winner in the last year or two. We talked about just it's kind of similar to GE. XPO was part of a kind of transportation conglomerate. They split three ways and they focused on trucking. They hired people from Old Dominion and elsewhere, and they really kind of got their service level up to snuff. They bought a lot of those liquidated assets from Yellow Roadway. I know for a fact because I saw some of the things they bought, they were buying $1 worth of earnings for less than $1. The nature of the bankruptcy court. So they literally were just stapling things on that were adding to earnings. And sometimes, Rachel, they were buying $1 worth of earnings for like 30 cents. So it was just,
wow.
it was a once in a lifetime thing. It was kind of after COVID. Old Dominion didn't participate in this. It was mostly just XPO and SAIA, another company that's pretty well run, that was just gobbling the stuff up. Not all of it was good. And as part of it, you had to take some of that lesser to get the good. But relative recently, XPO has been the clear winner. I still think they probably have some runway to outperform the others, but it's kind of playing catch up. But if you're getting in right now, you don't care about the past, you just care about the catch up. So I think if I was willing to take on a little bit more risk, that you don't get that reliable long-term history of Old Dominion, but maybe a little bit more upside from here, I might be tempted for XPO, but if that comes down to style, because I do think with Old Dominion, like I say, you are going, when trucking works, Old Dominion really, really works. And when trucking doesn't work, Old Dominion is well enough run that they don't get in trouble. And that's the real value. So that's kind of, I don't know if that's a real ranking. I don't know what order I just gave you, but those are some thoughts. JB Hunt is both a pretty good company, and I would say not nearly as good at either of those things. So I personally wouldn't consider them. I basically try to figure out risk reward and pick between the other two. So there's that.
Okay. There was another question from Rose. Apart from weight loss drugs, what is Novo Nordisk known for? I mean, prior to the success of their GLP-1 franchise, that has really, I think, brought the company to the forefront of a lot of investors' attention over the last couple of years, they had a much slower growing insulin-based business. So I'll talk through some of the products that they make and what they're known for. By far and away, their biggest growth drivers now and likely for years to come are the diabetes and obesity care and GLP-1 products that they're making. Prior to that, they had a lot of different and still sell insulin products. Novolog is one of them, Levemir. This was a much more mature and slower growing business, and one that was delivering pretty moderate, if not tepid growth prior to the boom we've seen with Ozempic and Wegovy, and now these other products that Novo Nordisk is working on. So one of the other drugs in its portfolio is so it contains that main active ingredient semaglutide, but the drug is called Ribelsis, and it's approved by the FDA specifically for adults with type 2 diabetes. It was first approved in September 2019 as the first oral GLP-1 treatment for type 2 diabetes, and it contains the same active ingredient that's found in Ozempic, for type 2 diabetes and heart disease risk reduction, and then Wegovy, which is used for weight loss. So Ribelsis is taken once daily, usually 30 minutes before the first food or drink of the day. One of the things that's interesting is, and results actually just came out about this weekend, but this diabetes pill, Ribelsis, is being studied in a late stage trial for lowering risk of cardiovascular related death and other adverse complications. So one of the key sort of growth factors for a business like this is not just, the initial approvals of some of these blockbuster drugs, but garnering additional indications that extend the, revenue cycle and patent life of these drugs. So what was interesting was this diabetes pill, Ribelsis, showed extensive cardiovascular benefits in a late stage trial. It actually lowered the risk of cardiovascular related death, heart attack, and stroke by 14% compared to the placebo after 4 years on average. And this was in patients who had diabetes and established heart disease with or without chronic kidney disease. And this could potentially pave the way for this pill, which again is currently approved for patients with type 2 diabetes, has the same main active ingredient as Wegovy and Ozempic. But these results could pave the way for Ribelsis to potentially become a new treatment option for individuals who have diabetes and also have established heart disease. Novo Nordisk has already applied in the US as well as in the EU to expand the approvals for Ribelsis to include lowering the risk of serious cardiovascular complications. And again, this is the once daily oral formulation of their blockbuster diabetes injection, Ozempic. Both treatments contain the active ingredient semaglutide. So it's interesting as we're looking at the pace at which many other drug makers, including Eli Lilly, which is sort of broadly seen as going to be first to market with their oral GLP-1 specifically for diabetes, weight loss, and other conditions, including sleep apnea. There are a lot of ways in which these drugs are being studied to have benefit to patients that are far outside the use cases they're currently known for. That phase 3 trial of Ribelsis examined almost 10,000 patients 50 years and older who received either Ribelsis or the placebo on top of their standard treatment regimen for an average of just under 4 years. And by the end of the trial, only 12% of people taking Ribelsis and had experienced some kind of cardiovascular adverse event like heart attack, stroke. And essentially this represented a 14% overall lower risk among those who took Ribelsis. So it will be interesting to see if this additional indication is approved. Something I mentioned earlier is I think there was a question about Novo Nordisk as well, is sort of one of the next, great watched for additions to its portfolio is its next generation obesity drug candidate, CagriSema. And this is a combination of a pretty emerging type of weight loss treatment known as an amylin analog and semaglutide, which is, again, that main active ingredient we keep talking about that's in Wegovy, Ozempic, and Ribelsis, all of which are made by Novo Nordisk. CagriSema did meet both of its primary endpoints in late-stage trials, where the market responded a bit negatively. Was, for example, there was a late-stage trial that was published in December that showed the drug helped patients with one or more comorbidities who were obese but not type 2 diabetics lower their weight by 22.7%, which again met the endpoint but was below the 25% that management had previously forecast. And then more recently, there were additional results that were from a concurrent late stage trial that again met the primary endpoint but came in a bit below some of the numbers we had been hearing from the company. And so that is where you've seen significant value wiped out from Novo Nordisk's share price over the last few months. But management has said they still are very, very confident about the commercial capabilities of CagriSema. They said, we know 22.7% is not 25%. Some people were disappointed. They're actually conducting a new phase 3 trial, which will further explore the potential of CagriSema, but it looks like they are still planning to seek regulatory approval for that early next year. So those are some of the biggest things to watch with this business. Right now, while there are certainly other candidates in their pipeline of note, this is the area where the company is focusing a lot of its efforts, its research and development and capital right now. Is within this very fast growing and highly evolving and dynamic GLP-1 market. And that is really where a lot of the tailwinds of growth for the company are expected to be derived, at least in the next 5 or more years. And alongside Eli Lilly, they are probably the most advanced player in this space. Even though you have other companies working on their own GLP-1s, you've got major pharma companies like Roche, Pfizer. You've also have, newer players like Viking Therapeutics that's working on their oral GLP-1. I think there will be room for multiple players, but these first to market ones that have been, dominating essentially share in the space, I think are going to have a bit of an edge over the competition.
Good deal. All right. Well, Matt asked about Rocket Lab, which actually reminded me there was a different rocket I wanted to talk about. So I'm just going to talk about them all at once. So
go for it.
The problem with being old is you forget things. But let's, Matt, I'm going to ignore your question for a second and talk about Rocket Mortgages for a second, and sort of, but mostly talk about Redfin. Rachel, as you may remember, it was just March 10th that Rocket Mortgages bought or announced a deal for Redfin, an all-stock deal that valued Redfin at the time at $12.50 per share, $12.50. And the important thing there is all stock. Now, there's lessons here and takeaways, and I don't even know how I come out on it, but I do think there's good just learnings in what has happened since. So I'm going to share my screen and we can look at what has happened next. So as I said, it was March 10th and right when the deal was announced. And here we go, Natasha, if you get it up, and you can see it has been a ride for Redfin since. Good news, it is still up 56% from the deal announcement. But as you can see, at the time the deal was announced, it was up almost 75%. That was the premium. And we're down about 20% from what happened from the highs post deal. So what's going on here? This morning, Rocket announced yet another deal. They are going to buy Mr. Cooper, a big mortgage servicer, the ones that actually collect the bills every month, for $9.4 billion. It's also an all-stock deal, and it is driving down Rocket stock even further. So combined, this is a powerful company. They're going to, serves a couple $1 trillion in mortgage. But for fools that were looking at $12.50 and saying, "Oh well, I don't really want to own Rocket Mortgage long term, but I want to get my 1250 and held out. Things are moving in the wrong direction. So the math here, and the thing to remember is that the 1250 number was only good on paper at the moment it was written. What Rocket has agreed to do is exchange one Redfin stock, so every share of Redfin you own, for 0.7926 shares of Rocket. So the value you are getting is Rocket's price, which when looking at 1192 times 0.7926, which is about $9.45 right now. Now, there will be time before this deal closes, and only thing that really matters as far as your consideration is what Rocket trades at on the day that the deal closes. It could be well north of 1250. It could be well south. If they keep doing a $1 billion deal every 2 weeks, I'd wager it's going to be well south of that, but hopefully they're not going to do that. So what are the lessons? I mean, for me, the big takeaway is that the first thing to do when you see an all stock acquisition is, do you want to own the buyer? Because if you want to own the buyer, just hold tight. And, Rocket, to their credit, I guess, is what's the Warren Buffett thing about be greedy when others are fearful and be fearful when others are greedy. Rocket is taking advantage of a really crummy housing market and housing mortgage market to make a big bet on consolidating the market. They're using their stock to sort of minimize the downside. The downside is being felt by shareholders in the near term, but they're not going to have like tens of billions of dollars of debt on the balance sheet that might cripple them later. So they are making a bet on capturing more of the long-term housing market when it recovers. I think it'll recover at some point. We're not going to live with, we need roofs. So it might work out, but it is a long-term bet. If it's not something that interests you, it's probably why it's a good idea to, for the most part, just go ahead and sell and take what you can get, because there is fluctuation in this. It really is a lesson too, though. Make sure you read the terms, because they've settled down some, but I've gotten so many questions. Like, why is Redfin trading at 9 something when the deal price was 12.50? That only works if it's a cash deal, unfortunately. And if it's a stock deal, you are just tied. Just memorize that number. Memorize, in this case, it was 0.7926. Multiply that by the current Rocket stock, and that is Redfin's price, absent any fluctuation. And just make sure that the real takeaway, for better or worse, whatever, is make sure you know what you're getting and make sure you understand the terms of these deals. And who knows, hopefully we'll get back to the 1250 and people who want out can get out. But I can't predict that any more than I can predict the near-term future of any other stock, unfortunately. And Rocket is one that tends to move around a lot. As for the actual question, though, that other Rocket, Matt asked, Lou, would you add to Rocket Lab RKLB right now? Matt, this is a hard one. You said, would I? And I am forever, for wrongly or rightly, anchored on the fact that I could have gotten it for, I believe, half the price as recently as December 1st. And so it still doesn't look like good value to me, because I don't think the business has materially improved by 84, 90%, whatever it is, since December 1st. That said, I do think this is a long-term winner. I do own this stock, and I do believe that, subject to volatility, and if you want to take the long-term perspective and realize that it may go down, and may go down quite a bit before it eventually goes up, because there is volatility, or hey, maybe it won't. I do think that if you want to make it a small part of a diversified portfolio and just be ready for the quote unquote rocket ride, I do think that it's just as viable now as it was before. But for me personally, I already own it at a lower price, and I can't help but think that I don't like getting caught up in the enthusiasm of volatile stocks, and so it's not really on my radar right now at these valuations. One more real quick, Matt said, I don't know, I might have mentioned any one of a number of defense policy think tanks that I enjoy. I probably said either Thiel Group, which is a great group, TEAL, or it's owned by TD Ameritrade now, but I think they just called the Washington Research Group. That used to be independent, that it was bought by Cowen, and now it's owned by TD Ameritrade. But if you can get, they are some really, really smart people. WRG, a great group. Thiel probably gives away more of their stuff for free, though. So if you're curious, go over to Thiel Group. You can probably get on a ton of email lists if that's what you want. All right. So I handled Rocket, and more.
Very cool. There was a question on a company that I am not super familiar with, but I like to sometimes look up these types of businesses and like learn in real time because that's often it's interesting to learn about companies I haven't heard about before. And one of those, there was a question from Joe about any thoughts on ticker NNOX, and that is NanoX Imaging Ltd. This is a company headquartered out of Israel. They do trade on the NASDAQ. Pretty small market cap, less than 300 million, and shares have been hit pretty hard over the last year. And I wanted to go ahead and pull up a couple things because it looks like they also reported earnings earlier, which is interesting. It looks like they missed on earnings and revenue fell short of estimates. And as I was looking into the business to see, what are some of the reasons for the decline? Well, one, I think it's important to understand what NanoX does. So they make money through a few different sources. They sell medical imaging devices. They provide teleradiology services, and then they also develop and sell AI solutions for medical imaging. So they develop and sell commercial grade tomographic imaging devices with digital X-ray sources. Then they offer teleradiology services, which basically enables radiologists to remotely interpret images from the company's devices. And then they also develop and sell AI-based software solutions to help healthcare providers with their medical diagnoses and image analysis. And so they have these different revenue streams, primarily revenues generated from selling and deploying their 2D systems, as well in different regions, including the MENA region and in the US. And then there's their teleradiology business, and then there's their AI solutions business. Now, it looks like there's been a few reasons that the stock has been hit significantly in recent times. First of all, there's also the broader impact of AI-centric businesses being afflicted with somewhat negative sentiment in certain trading days. What's interesting as well is that it looks like NVIDIA was a investor in this business, as well as some other AI-centric businesses, and they exited their positions from these companies, including NanoX Imaging, and that seems to have also negatively impacted the business. There's also the fact that they're seeing a significant shortfall in their core imaging business. Their AI solutions, which this maybe is why NVIDIA would have withdrawn their stake, are bringing in incredibly small amounts of money. They brought in just about $400,000 in one of their most recent fiscal quarters in revenue from their AI solutions. They sold just about $48,000 of imaging equipment, and they are still operating at significant losses. This is a pretty small business anyway, but they have certainly been dealing with headwinds of late. Some of which I mentioned, which seem to have broadly impacted the stock price. Now, it looks like it was just today that they released their results for Q4 and the full year 2024. And looking at it, as I mentioned, they did not meet analysts' expectations on either the top or bottom lines. They generated just $3 million in revenue in Q4 2024. Which was up slightly year over year. They also achieved FDA clearance for their Nanox Arc machine, as well as the CE mark for that back in February. So they are working towards U.S. commercialization of these devices, which could be a nice added tailwind for the business. They also signed 2 new customers to their Nanox AI business, one being a healthcare AI company called Azra AI that is focused on early cancer detection. And they've also been engaging new distributors for their Nanox Arc device in Romania and Greece, which will be where the company focuses their initial entry points into the EU. They are still operating at a net loss. They're also dealing with losses related to settlement agreements for class action lawsuits that were filed against the company. And unlike some of the bigger players we see in this space, they don't have that much capital on their balance sheet to navigate this type of litigation to begin with. They are seeing some growth in their teleradiology business. Their AI solutions business is essentially hemorrhaging losses at this point, although they are starting to see more adoption. They had property and equipment of about 45 million, intangible assets of about 70 million, cash and investments of about 84 million on their balance sheet at the end of their fiscal year. This is what I'm obviously just now looking at. Some of these things that I'm reading about this business would be some red flags to me as a healthcare investor, to say the least. I think that there is some potential with some of these devices they just had approved, but the value proposition for the business to me, as I'm looking at this, does not compel my interest the way perhaps some other businesses that are incorporating AI into their medical device segments is. So it looks like this is a company that would have a ways to go before I would consider putting cash into it. But those are some of the things that have been going on with the business as just a quick rundown.
So we started like an hour ago talking about XXX leverage, and the products are just created to be sold. I don't want to be too hard on this business, but I have a feeling that this is one of them you hear about from a buddy or in the gym or on a message board. I mean, when you're trading at almost 30 times sales and your annualized sales are only $10 million, and that is trading at 30 times sales when your stock is down 94% in the last 5 years.
Yeah.
I would say that this is more a speculation than investing to get involved without knowing it well enough to really say, and I probably shouldn't, but just I would say be very, very, very careful with something like this. There are better ways to make money. It might not go quite as quick, but then again, the money might not disappear quite as quick either. So just be know what you're buying on these things. And it does not appear you're at this second buying a lot. So you better hope for the future. If they better have great things to say about their future.
Yeah, and from what I could see, the NVIDIA had invested in Zebra Medical, I think the company's called, and so sort of indirectly ended up with a pretty small position in NanoX. But I think NanoX's troubles, broadly speaking, go down to major fundamental issues with the business from what I'm seeing from just a first glance.
It appears, and I don't want to be all negative, but it appears, and I'll get off here, but it appears, if nothing else, NanoX, and I like giving compliments, they were very, very good at letting people know that NVIDIA was an investor. So they did.
Yes.
They did nail that about it. Whether or not that's relative to my previous points, that's for Toby to decide. Let's blame it all on Toby.
Let's put it on Toby. Yeah.
Yeah.
There we go. That sounds like a plan.
Fools, it's been fun. I believe Toby is coming on now. If not, Toby, can I interest you in a $10 million farm tech company, a 10 million revenue farm company that trades at about 30 times sales, and the stock is off 95% on its highs. Most of its press releases from a couple of years ago.
It's 10 billion in sales.
No, 10 million.
10 million in sales.
Yeah, with an M.
So it trades at 30 times sales after it's off 95% of its high?
Yeah.
Who was buying it 95% ago?
Probably the people reading about NVIDIA's investment in the company that, as Rachel just pointed out, was a backdoor.
It was just like 40 grand. It was not much. It was indirectly. Yeah.
What was the multiple? So, wow. That was like a triple digit multiple?
I would assume, I don't have it up anymore, but I just and I should say, I mean, I'm playing radio here. It was only 28 times sales. I rounded up, so.
Oh, well then, that looks much more favorable right now.
I guess I like it better now than I did 95% ago, but that's not to say I like it now.
Some stocks are more made to be sold than businesses to be bought.
Fair enough.
It's getting near penny stock territory. It's scary.
I like making money fast, Lou, but I don't like that money going away fast. As you
There you go. And speaking of going away fast, you guys have a great show.
All right,
always good to see you.
We'll see
there you go. Bye, Lou.
All right, we're heading into our next hour here. We're talking about earnings. We have no earnings right now. Did we? I don't think we have any. So today is the last day of the quarter for many companies.
I
right?
think PVH was when I talked about that they own Calvin Klein and Tommy Hilfiger, and
Oh, they reported.
I think they're reporting today. So maybe if we
Hey,
have time, I'll take.
maybe
a look
we'll
at
check
that.
them out.
Yeah.
If they're, I love doing that. If they're reporting right now, we'll check them out for sure.
Yeah.
It is the last fiscal day or the last day of the first calendar quarter, March 31st, which translates into the last day of the first fiscal quarter for many companies. Not all companies, but many companies will end their first fiscal quarter of 2025 today. And so we're going to expect a bunch of earnings reports in like the next 2 weeks here is really when it's going to kick into gear. So with that in mind, what we're doing here, Fools, is we're kind of trying to give you a preview of what we're looking at, the things that are coming up. If you have particular companies that you're thinking about, that you have particular concerns about, you want to throw those in the chat, ask us about those for sure. But our focus is here is let's think about what are we looking for? What are we watching for with a couple of companies with this Q1 reports that we're going to start getting in a couple of weeks here? Because you want to do that, right? You want to have a thesis going into this. You want to kind of gather your thoughts and say, what am I most concerned about? What am I most interested in this report? And a couple of companies, Rachel, that I've been thinking about that our viewers may want to think about as well. Delta Airlines, Airbnb, and Marriott are companies that I'm particularly interested in coming up for this quarter. Those are all travel companies, you will note, our viewers here. And I will say, in terms of what I'm interested from these companies, I'm actually less interested in the Q1 numbers. That's going to be interesting, of course. But I really want to hear their commentary around what they're expecting for this summer. And we're going to get some of that, right? You're going to get that from bookings too, right? You see a lot in this quarter, this holiday, or not a non-holiday quarter, rather, January, February, March. We're done with Christmas, right? All that holiday travel. We're heading into the summer, but this is the time when a lot of people start booking that summer travel, right? And a lot of companies will tell us, here's what the next couple months, especially that heavy summer travel season, is looking like for us in terms of advanced bookings. That's going to be important, Rachel. We have concerns over the economy, right? Concerns over travel, concerns over consumer spending. And it will be very, very instructive, I think, for us to be able to get a sense of what is the summer shaping up to look like from some of these travel companies. Delta for the airlines, I think they're fairly representative of that. Airbnb and then Marriott for your hotel business in terms of travel, right? And you can put those together, right? If they're both doing well, if we've got our lodging and our airlines doing well, maybe we don't expect too much of a drop off. If our lodging is okay, airlines are seeing a drop, what does that tell us? It tells us maybe consumers are staying closer to home, right? Rethinking some of the travel. Maybe we're driving more. Maybe the national parks are going to be full. Something like that, right? Versus taking these longer trips to Europe for this summer. We'll see. We don't know what it's going to look like yet, but that will give us a sense of what that part of the economy is going to do or is shaping up to look like heading into the rest of the year. And I think that's going to be important, right? I think that a lot of people are going to be looking at this. A lot of analysts are going to be looking at this and saying, are people spending money? Are we still traveling? Because this is the definition of discretionary spending, right?
Right.
Very, very few people have to get on a plane from the leisure standpoint. Very, very few people have to travel and stay in an Airbnb or a hotel. That is discretionary. This is something you can easily pull back on, especially maybe this is less true for the airlines because of the way they do their ticketing and whatnot. But for hotels and Airbnb, you can generally cancel. So even if you book something in the fall for the summer, if they start talking about cancellations, well, we're seeing some, pull back in what we're seeing higher cancellations than we did a year ago for summer travel, or we're just seeing people delay their booking for a little bit longer. We're not seeing as much advanced booking as we did before. All of this is going to be useful information for us to get a sense of what the consumer is doing heading into the rest of the year. Let me take a break now. Any thoughts from you either on that or are there other companies that you're looking at as we head into earnings season here?
Yeah, well, a few thoughts. One, the travel piece, and I'm with you as this is a space that I follow pretty closely, and we do have some of these major companies reporting in the next month. And I do think, we've talked a lot on some of the different shows recently about these different consumer sentiment surveys that have been coming out. We've got projections that I read earlier today from CNBC about what they expect, for example, as well from the GDP report that's coming out later this week. We've had, the University of Michigan Consumer Sentiment Survey that I read through the final iteration of that. I think it was over the weekend. And broadly speaking, we are seeing declining consumer sentiment, but people are still spending money on travel. Now, of course, sometimes by the time that growth has slowed, it's a backward looking metric. And so it can take some time for that to normalize and be, recognized, particularly by these companies. But it is interesting as well. There was a survey on there was a travel company called Skift, and they were referring to, there was this survey of consumer confidence that was released that I had talked about that showed the fourth straight month of declines, but respondents still said they plan to increase spending on travel and vacations. There was a comment from the senior economist at the conference board saying consumer expectations are especially gloomy. There's pessimism about future business conditions deepening and confidence about future employment prospects falling to a 12-year low. Fewer consumers plan to spend more on movies and live entertainment or sports, but more plan to spend on outdoor activities and travel, and vacation plans also increased. So this was very interesting to me. And this also relates to kind of the landscape of these companies and which they're going to be reporting. And I agree, comments on, expectations for the summer ahead will be key. So that's obviously a huge growth driver for these businesses. But it is fascinating to watch how we are seeing real data from consumers who are having very gloomy expectations for, business conditions and what the state of the economy is going to be looking like in the coming months. And they're still saying, but we're booking vacations and we're going to go travel. And this is where we're funneling our cash towards. So that is a really interesting, dynamic that we're in. And, for a company like Delta in particular, of course, they make most of their money through passenger revenue, ticket sales, ancillary services. But ticket sales is huge. And the largest source of income for Delta is their passenger revenue segment. So baggage fees, seat upgrades, selling air tickets for main cabin and premium. And if you go to their more recent results, 2024 was a really great year for the business. They delivered record revenue in the December quarter, as well as operating profits. Something like $8 billion of operating cash flow, more than $3 billion in free cash flow last fiscal year. This is a company that came into 2025 from a real position of strength, which can also be said, I think, broadly speaking, for Airbnb and Marriott, even though their business models are obviously quite different. And so it's interesting to see this dynamic right now that may not necessarily seem logical, and it's certainly no longer a function of pent up demand from the pandemic. Savings that had been held back during the pandemic era have probably long been spent in terms of money that was set aside for travel. But you're still seeing this dynamic where for better or worse, consumers are saying we don't have a lot of confidence in the coming months, but we're still going to go take that trip and we're still going to go on a vacation. Now, what that looks like in terms of international versus domestic travel dynamics remains to be seen. And that's obviously something that will be important to pay close attention to with these businesses. But I find this dynamic that we're seeing, at least from the early data we have, really fascinating, maybe a little bit confusing, but also in a way you can think about how in a time where maybe consumer confidence is lower, people want to prioritize experiences that are going to, make them feel better, maybe have a break from, the day-to-day grind. And that definitely seems to be the case in terms of what we're seeing from consumer responses right now.
Nice.
There's some companies I'm watching as well. Things really kick off, especially towards the end of April. There's companies I talk about a lot, like Johnson & Johnson is reporting mid-April. There's a wide range of other healthcare businesses reporting in April as well. You've got Gilead Sciences later in the month. You've got Merck. I believe, yes, Pfizer is also going to be reporting at the very end of the month. Amgen. Another travel company reports, I guess, on it's May 1st, but we'll be getting results from Booking Holdings. So that'll be interesting.
Yeah.
And then Novo Nordisk as well on that same day. But some of these big pharma companies like Pfizer, Johnson & Johnson are reporting in the tail end of April. Starbucks is another one. That's one that I'm following with more interest in this earnings season. Eli Lilly is also reporting at the very end of April, so that's another one I'll be watching. Starbucks is one, of course, we've talked about a lot on recent shows. Sort of tracking the pace of their international expansion as they're really working to, reduce their reliance on these core markets where China is their largest international market, but is where they've been seeing really significant slowdowns in growth, partly due to just really well-placed competition in the country that is outpacing, Starbucks' ability to grow there. So that's definitely a company I'll be watching. Another one that's reporting that I'm following that maybe isn't as widely followed as it was a few years ago is Pinterest. That's a business that has done, I think, a pretty good job of turning things around the last few years. People might recall this was a business that was obviously really popular during the pandemic. We all had a lot more time at home to sit and scroll on our phones and laptops, and Pinterest's platform and its design is, I think, very much is very much targeted towards those types of user behaviors. And then there was this period following this really impressive surge of growth that the company witnessed during the pandemic, where they dealt with real deceleration in terms of the acquisition of new users, which partly was a function of fairly, poor year-over-year comparisons. They also were just dealing with real, slowdown in growth because that pace was not sustainable over the long run. They dealt with, profitability issues. And there was also this issue of advertisers were decelerating ad spend in a environment that was more inflationary, where the cost of running ads was higher. And because Pinterest essentially makes all of its revenue from ads, that was a huge factor that impacted the business. But fast forward to now, in their most recent fiscal year, they reported about 1.9 billion in GAAP net income in 2024. Revenue of about 3.6 billion. They're now at 553 million global monthly active users. That was an 11% year-over-year increase. They also derived about just shy of 1 billion, 940 million to be exact, in free cash flow in 2024. And the final quarter of the year was their first $1 billion revenue quarter. And they have been doing a really, really good job of delivering really efficient advertising campaigns to merchants at a more effective, cost per click. And that's been something through different initiatives they've taken, like direct linking, that has been really effective for advertisers on their platform and has then translated into really steady growth for Pinterest. So it's really interesting to see. This was a company that I would report on regularly through the last few years, and even as sentiment seemed low, I continue to feel optimistic about the business, and I think we've definitely seen some signs that things are turning around. So I'll be very interested to see what their Q1 results look like, what kind of comments we get from management in terms of expectations for advertising spend. Are they seeing more of a cautious environment as the macro landscape shifts? That's certainly something that I'll be paying attention to.
Yeah. So we have a question from Matt on Lind earnings. This is not a company I follow too closely. I'm guessing you don't.
I don't know that one. No.
Follow them, Rachel. So it's it is, as he notes, it is an industrial company. They do industrial. They're playing in the industrial gases, engineering sectors, that sort of thing. They produce things like oxygen, hydrogen, rare gases, argon for industrial uses, as well as design and building equipment and plants for that production type of thing. And briefly, we can briefly touch on earnings, Matt, if you like here. This was their Q4 report. So Q4 2024 which they reported. They reported on February 6th. They reported earnings for the full quarter and for Q4. Slower sales growth, I think, was a story here, right? Up 2% for both the full year and for the quarter. 8.3 billion for the quarter, 33 for the full year. So not a lot of growth is one thing we're seeing there, Rachel. Operating profit up more. So we not a lot of growth, but they were able to increase efficiency. So operating profit increased 9% in Q4. So that's good. If you were able to boost your profit by 9% on 2% growth, I say congratulations. Like that's an accomplishment right there for them. Operating cash flow is still pretty good, not quite 10 billion in operating cash flow for them. And they send a lot back in dividends and repurchase, about 7 billion in dividends and repurchase to shareholders. So nice returns there. The market, it's from what I can tell, the reaction was decent to earnings. This is one of those companies, an industrial type company. Your focus is on efficiency, operating improvements, right? You do not expect a company like this to throw up double-digit growth in revenue every quarter. You expect them to do what they do it well, become more efficient, steady dividend and stock buybacks, that sort of thing. It's what we're seeing from the company. And so, optimistic reaction to that, decent reaction to that. They did note they have a record project backlog, right? So 10.4 billion in backlog. Which that will translate into future growth. We assume that. So pretty good. The CEO talked about the challenging global macroeconomic conditions. Everyone's talking about that right now. So there's a little bit of caution there. But overall, just quickly looking at this, Matt, I think it was a pretty good report, the type of thing you want to see from a company like this. So pretty good for them.
PVH, which is that company that I mentioned earlier,
Yeah.
they actually reported. Yeah, it took me a minute to find it because it didn't post right away. And then I was trying to look through some of these results, and they don't actually host their earnings call until tomorrow morning. So for anyone that's interested, that's worth noting. Now, this is a company that they have been beaten down heavily by the market over the last year, although the stock is trading up about 11 or 12% after hours following their earnings results, which were better than expected, broadly speaking. This is a roughly $3.6 billion market cap company. They're trading at a price to earnings of about 5 right now. Just to give you an idea of how much that valuation has been depressed. I think they do still pay a dividend. The yield is quite low, barely a quarter of a percent. But just to give a little background there, and for anyone that's not familiar with PVH, they own brands like Calvin Klein, Tommy Hilfiger, Van Heusen is another one. They usually have a sort of model where they distribute through wholesale partners, right? That classic retail model with companies like Kohl's, Amazon, JCPenney, Macy's. They have products that they sell through their own online platforms as well. They franchise and license their brands in various regions, particularly in the Asia Pacific region, which really allows for larger and broader market penetration. And they have brands that span different price points and styles. They cater to various consumer segments, including dresswear, more business casual brands, and they source apparel from a wide range of countries. Now, sort of just some of the upfront figures, their revenue at the end of the year in Q4, which was 2.4 billion, exceeded what analysts were guiding for. Now, that was still a 5% year-over-year decline, but it was better than what had been projected. So that's something that probably is moving some of the positive sentiment we're seeing. They also recorded record gross margins and double-digit non-GAAP EBITDA margin achieved in 2024. They also noted that their order books for fall 2025 in Europe are actually returning to growth after a period of pretty intense stagnation in terms of order values. They also announced that they completed $500 million in stock repurchases in 2024. They have another $500 million planned for 2025. Now, full year 2024 revenue was about 8.7 billion. That was a 6% year-over-year decline. Again, Q4 revenue declined, but less than expected, 5% year-over-year to about 2.4 billion. Their Q4 gross margin decreased to 58.2% compared to 60.3%. Inventory increased about 6% year over year. On a GAAP basis, their 2024 full year operating margin was 8.9% compared to guidance of 9.2%. And then in terms of earnings per share, they reported $10.56 on a full year GAAP basis. And that was compared to guidance of $10.55 to $10.70. So they sort of fell right in the lower end of that range. Now for 2025, they think that revenue will be flat or potentially increase slightly, but more likely to be flat year over year. The operating margin is also projected to be flat or to increase slightly on a non-GAAP basis. This is a business that's dealing with some, I would say, serious challenges right now. They have been working to streamline their family of brands, really align their focus on their two global iconic brands, which they're most known for, which is Calvin Klein and Tommy Hilfiger. They did say that they delivered strong profitability in their North America segment. They did see sequential improvements in their wholesale order books in Europe. And they also achieved their third consecutive year of growth in the Asia Pacific on a constant currency basis. So those were, some positive things to note. They're seeing single-digit decreases in direct-to-consumer revenue and wholesale revenue. Again, their gross margin was down slightly. By segment in Q4, Tommy Hilfiger revenue decreased about 5%. Calvin Klein revenue decreased about 2%. And then their heritage brands decreased 41%. Which was a notable amount. I think that this is a business that, like a lot of these very well-known retailers, is struggling with an environment in which they are finding it difficult to sort of assert themselves and find their place in that landscape, so to speak. I mean, this is still a business that is delivering pretty significant revenue. It's just down and declining steadily, particularly in their heritage brands. Line. They are, still reporting profits. For example, in their most recently ended fiscal year here in 2024, they had just shy of about 600 million in net income they reported. That was compared to about 664 million a year ago. So still profitable, but definitely a decrease there on the bottom line. I think a lot of it is probably tied to the macro environment. And I also think some of it is tied to some of the performance and trends that we have seen afflicting some of these legacy retail businesses for a long time. PVH is certainly not the only one. So some improvements, some metrics that were less bad than what had been projected or expected. And so we're seeing some positive share price action after hours. Personally, this isn't one that I would probably be putting cash into, but when we do have these, earnings stragglers that come up, I do like to try to cover them. And I'm glad to see that they are, delivering some notable growth in some of their segments, but they have a pretty challenging environment they're operating in. Again, profitability is still strong. That's not something you necessarily see from as many of these businesses, but I think the declines they're seeing on both the top and bottom line are probably not going to be improving, at least in the near future. So we'll have to see, how the next fiscal year shapes up for them.
Yeah, they're not guiding for substantial improvement, right?
No, pretty much flat at best.
Flat, maybe slightly up for the full year, but yeah, they're looking at flat for the most part. So you put these things in context of the company, right? You can't just look at the earnings report in isolation. The stock right now, Rachel, is up like 12% after hours from a very objectively not great report, right? Revenue went down, and they're saying, not going to be much better next year. Don't expect any much improvement, if at all. And yet the stock is up 12%. Why? Well, they hit like a it was like at a 52-week low not too long ago. The stock price, so recently hit a 52-week low. So there were very, very low expectations around this company. So I think what we've got here is a combination of extremely low expectations for the business, coupled with indications that this actually might be the bottom, right? Not as bad as expected, and they're forecasting for it at least not to get worse next year in terms of revenue. So that was better than what investors were looking for, right? And so there you go. Those core brands, right? For Q4, Tommy Hilfiger down 5%, Calvin Klein down 2% in revenue. So they really like that. That's got to be what they focus on, right? That has to be you would hope the focus of management going forward, getting those brands to recover, because you got to see growth from them. I think soon. I don't know what that means or what they need to do there, but they're just not getting the traction that I think they're looking for with them. Do you know what percentage of revenue those two are?
That's actually a really good question. I'm trying to see if I can find the answer to that, because I know that those are their two most notable brands.
Yeah.
So, and I haven't done the percentage from this last year they just reported, but in 2023, Calvin Klein brands were about 42% of their total revenue, right? Okay. So let me click now. I'm looking back through the 2024 results to see if I can actually do some quick math, which Calvin Klein revenue. I'm trying to get the actual numbers. I think it comprises about, let's see, because they divide it by total Tommy Hilfiger, total Calvin Klein. Okay. So total Calvin Klein sales were about 1 billion, and total Tommy Hilfiger were about 1.3 billion, and that was in Q4. And their total Q4 revenue, that's almost all of their Q4 revenue is attributable to those two brands. Yeah, their heritage brands are a pretty small slice of the pie, so divided pretty evenly, I would say, between those two.
Right.
And
international is more than North America for both of them, which you'd expect given the company.
And the thing that as well, there's obviously been slowdowns in consumer spending. They've seen a difficult macroeconomic environment that has particularly impacted a lot of these older legacy type brands, and certainly not just PVH. Their wholesale channel has been really struggling, and that's a significant part of their business. And there's also been this reality that their demand for their brands has been really weak in Western Europe, and particularly in key markets like the UK and Germany, which is where historically they've derived a lot of their growth from. And they've been actually really trying to reduce some of their sales in Europe to focus on higher quality sales, including, growth in different parts of the Asia Pacific. But they've also struggled with their international business, and particularly in the APAC region. And then there's obviously pressures from things like rising raw material costs. They've been working to manage their inventory levels, but that's been difficult for them. They've been dealing with, disruptions in some of their major sourcing locations for their apparel, and that has also really impacted margins. So there's a lot of factors that play there right now, for sure.
Mm-hmm. Mm-hmm. All right. Well, that's, there you go. I do not believe is this a recommended company?
I don't think so.
I don't think it is.
I don't think so. Hey, I could look it up, but I'm pretty sure it's not.
Yeah, I'm gonna look it up here. I'm gonna see. No, I don't think it's not a recommended company. And good, because the last year hasn't been great. Although 71% increase over the last 5 years. That's not bad. Not bad. It's just been pretty volatile. It's been kind of up and down. I think they just can't get consistent traction on these brands. I think is part of the issue here.
Yeah, I think that's I think that's right. Let's see here. Looking through some of the older questions. There was this question from about 5 hours ago. Jimbo has questions. This time feels like the aftermath of partying, like 1999, or like the 2021, 2022 bubble inflation rise. I mean, I was pretty young. I was pretty young in the late 90s, so I was here, but I wasn't partying yet. So maybe I won't comment on that, but the 2021-2022 period I remember quite well. That was when I was a newer investor. So there are certainly some similarities, I would say. I don't know if you have thoughts on that, Toby.
Yeah, I think so. Well, look, so I can give you one thought here. According to the Wall Street Journal article just out. So again, end of the quarter for the year, the S&P 500 and the NASDAQ both had their worst quarters for each of those indexes since 2022, right? So if you're looking for a comparison, Jimbo, it hasn't been as bad since 2022 in terms of stock indices declines. So there's a data point for you. So yeah, in some ways, I think it might be a little bit similar in some ways to that. Everyone forgets about the 2022 crash, right? But it was substantial. You look at any chart, right? You'll see. Look at the S&P 500 chart. You see a big dip there in 2022, which we now put out of our minds because it wasn't so bad as 2020, right? That it just doesn't carry the same memory impacts, I guess. Maybe this is going to be another one of those 3 years later. Wouldn't surprise me, I think. But then maybe 2026 is the same as 2023, right? A good time to be investing. Who I don't know. Who knows how that's going to shake out? But yeah, we're back in that territory of thinking about corrections, maybe even more to go here for sure. That's where we are at the end of this first quarter of the year. Who knows what the rest will bring, Rachel? But this quarter has been a correction quarter, absolutely.
Yeah, it's interesting because I feel like, and I think this is just sort of human nature. It's easy. We think about how difficult it is to be amidst that volatility in the moment, and then the market rebounds and you sort of forget about it all over again. And when the next patch of volatility or even a correction hits, it's sort of like you're dealing with it again for the first time, even though, as the life cycle of your investment grows and the longer you're in the market, the more likely you are going to experience these periods of volatility and periods where it can be very, emotionally intensive and mentally straining to be a long-term investor because you're just kind of looking at these day-to-day machinations and thinking, what does this mean for my portfolio? But it's interesting for me as someone who is more of a newer investor in recent years, over the last 5 years, having been through 2021 and 2022 when I was brand new as an investor and really was trying to find my way and figure it out. And I do feel more confident going into this period of time we're in because I have much better processes, I think, in place for my own ways in which I analyze businesses, in which I, analyze the stocks in my portfolio. And that gives me more confidence, I think, over the long run, really regardless of what happens in the next few months. But I do think it's an interesting question. There's certainly, I can see the overlap and feeling of similarities between the different periods.
Yeah.
There was a story I saw as well that kind of caught my attention. The CoreWeave IPO was sort of all the news waves were covering last week, right? And that was a much anticipated, biggest tech IPO since 2021, which obviously there haven't been many public debuts to the market in the last few years, particularly not in the tech space. Certainly not ones that have gotten the attention of CoreWeave. But what was interesting was that there was this headline that Wall Street banks got a meager payout from the CoreWeave IPO, that the payout to underwriters in CoreWeave's IPO amounted to just 2.8%, according to filings that were released today. Morgan Stanley, JP Morgan Chase, and Goldman Sachs were the three leading banks on the offering, and that accounted for about 2/3 of the $42 million in fees related to the IPO. It was the largest venture backed tech IPO for a U.S. company since 2021, but the debut has thus far been somewhat disappointing. Probably to put it, in a moderate way. We obviously this was also something that was interesting that was noted in this article, that of the 1.5 billion raised in the offering, 42 million went to underwriters. And the article highlights that that's historically on the low side. Since Facebook, now Meta's record-setting IPO in 2012, there have been 25 venture-backed offerings for tech-related U.S. companies that have raised at least $1 billion, with an average underwriting fee of 4%. Facebook, in raising $16 billion, paid out the lowest percentage at 1.1%. Morgan Stanley, which led the Facebook IPO, had the, as they put it, coveted lead left spot on CoreWeave, followed by JP Morgan and Goldman Sachs. And these three banks are obviously typically the leaders when it comes to tech IPOs. But CoreWeave's initial trading sessions have not necessarily provided a lot of confidence, in a rebound. They lowered their price to $40 from their previous expected range of $47 to $55 per IPO share. They did not notch any gains on Friday, and I think the stock actually fell single digits today in trading hours. And of course, there's also broader factors that aren't specifically related to CoreWeave or their IPO, right? There's the broader market volatility. There's I've noted this, and I think there's many other investors that are concerned about its reliance on Microsoft as its largest customer, accounting for about 62% of its top line, very much a debt-laden business. But it is the first among venture-backed companies to raise $1 billion or more since Freshworks in 2021. And among the few more recent IPOs, which all raised less than $1 billion, though, the underwriting fees were much higher. So, for example, for Instacart, Reddit, Astera Labs, these were some companies that went public, more recently. Payouts were all at least 5%. As lead in the CoreWeave deal, Morgan Stanley was given the highest percentage allocation of shares for clients at 27%. JP Morgan got 25%, Goldman Sachs 15%. So kind of interesting. A relatively small payout from this IPO, particularly considering past, track records in the space for adjacent companies. Still the largest venture-backed tech IPO we've seen in the last few years. But you have to wonder if, at least so far, the market response we've seen might make some of these other companies that are contemplating an IPO, pause, give them pause, make them think, or, continue to go ahead. We know of other businesses that are reportedly contemplating or have already filed for an IPO. So it'll be interesting to see what happens with that.
Yeah. I'm not aware. What are the upcoming ones that you're aware of, if any?
So Klarna's one.
Yeah.
Klarna is a big one. They filed their S1, I think, just a couple of weeks ago. That's one I find myself more interested in, particularly because of their business model and the way it works. The fact that they are a licensed bank in Europe is also something that's interesting. I mean, they're obviously known for their buy now, pay later services.
Yeah,
but that's not
right.
But that's not actually the major source of revenue. That's what's so interesting. They charge merchants a transaction fee for each purchase made through their platform. And that can vary depending on the payment option chosen in the country. And many of their payment options are obviously interest-free, but they're really the platform that is connecting merchants and consumers. And so a huge part of their revenue model is transaction fees for every purchase that's made. That's merchant fees. And then obviously they do, make some revenue from things like interest on financing, late payment fees. There is obviously a certain level of risk that is baked into this business. They are responsible for paying the merchant, even if the consumer defaults on their payment. But it is kind of fascinating to see the way they have built a pretty robust revenue producing business through the years. And their financials are actually published on their website as well. And I think that they have also been profitable, as I recall, or at least working towards profitability. And then, another company that more recently filed is StubHub, the ticket selling platform. And then a company that has been reportedly contemplating an IPO for a very long time, and there's been different reports that they are, consulting with different banks potentially ahead of filing their prospectus. Is Discord, which is a super popular platform.
Do you know what the average fee they take, Klarna, from transaction?
If I remember right, I think it depends on the transaction. I think it can be anywhere from 5 to 20%, but I can't remember the exact number. And I'd have to look it up. I can't remember off the top of my head.
Huh. Yeah, that might be an interesting one to look at when it comes to the market here. Hopefully more successfully than CoreWeave.
So their commission, I was trying to look this up. So their commission ranges from 3.3% to 6% of the transaction amount plus a fixed fee.
Okay.
Plus a fixed fee. So it can depend on what the transaction is. Yeah.
Okay. Cool.
Yeah, kind of interesting. And then Discord. So Discord hasn't filed anything yet that I've seen. StubHub and Klarna have. But of course, companies can reverse course and withhold, wait to delay an IPO if they find that the market is not.
Yeah, and we may see that, given what happened with CoreWeave here. So do we know when Discord is rumored?
There has been conversation of Discord going public for years now, but more recently I was seeing reports on Yahoo Finance as well as some other news sites that they are reportedly, there was actually a report on Bloomberg that said Discord is working with Goldman and JP Morgan
last week. Yeah, right.
Yeah, on a planned IPO. So there's a lot of buzz around it. Some of the actual gamers and players that use the platform reportedly are not thrilled with that news. Yeah, although I think that investors are certainly interested. I mean, just to give an idea of scale, there was a opportunity where Microsoft was looking at purchasing Discord back in 2021 for $10 billion. That deal did not pan out. Discord was last valued at around $15 billion when they had I think it was their last fundraising round that I'm aware of in 2021. But it's a super popular platform, especially in communities like video games, the crypto space. It's also been emerging as a more unlikely player within the AI revolution space, because there's image generation companies, for example, that are using its servers. So it's interesting. There's been a lot of, I think, public interest in its IPO plans. There were sources that talked with the New York Times that said, their discussions with investment bankers are exploratory, plans could change. So we'll see. They've mulled an IPO before and decided to take a step back and not proceed. So it'll be interesting to see. I'm curious if, while again, some of these industries are different, if the reception to the CoreWeave IPO might give some of these companies pause, particularly in the current market environment.
Yeah. There's a question here I think that's interesting from Senjar. Thoughts on Tesla domestic competitors Polaris and Lucid are things they mentioned. Now Polaris, I don't think it's Polestar, I think is the one, right? That you've been thinking about, because Polaris is actually a maker of recreational vehicles, power sports, right? We're talking snowmobiles, motorcycles, and boats, right? In ATVs. So I don't think that's what we're thinking. So I'm assuming Polestar. That's the one that we're looking at, right? Now, quite honestly, Sanjar, in terms of these newer startups for EVs, I just don't think any of them right now are legit competitors to Tesla, quite frankly. Lucid is still losing money, right? Lucid, and I think the latest info I have from them, they had negative gross margins. in their most recent quarter, which basically means before you're even running your business, like just the cost to the cost to produce a car, you're not even selling it for that price, not even factoring in your operating costs, right? That is a very, very bad place to be in, obviously, clearly. And this is not something you can necessarily make up on scale easily, right? I mean, to some degree you can. When you're talking about automotive makers, you can get more efficient if you're producing more vehicles. But if you had negative gross margin, that's hard. Like negative operating margin, okay, we can scale that up and get enough gross profit to overcome our expenses, fine, right? But they're not even in a position where they can make a car profitably, just from a gross standpoint. So that has to change. In terms of the other one out there, Polestar, similar situation. I think they're just not where they need to be yet. Honestly, the best competitors, I think, Rachel, to Tesla, the more legit competitors in the EV space, I'm talking, not just a general matter, but in the EV space, is not any of these new startups. It's like Tesla, it's GM, Ford, the legacy automakers, right? Who are also losing money with their EVs in large part, but they have profit operations. They're large operations. They can eventually get there, I think, with what they need to do. The startups it's just really, really risky. Even someone like Rivian, which sells a lot of cars, is not profitable. And it's a very precarious situation. Tesla, as much as I really don't like the valuation right now of the company, I think it's, from my own personal viewpoint, is it's overvalued. They're the only one that's done it in terms of being a new startup in the automotive space. Everyone else just is trying to do what they did, and they can't. Tesla has been successful, and that should tell you how hard this is. We've only had one, right? In the recent past, even when you had a shift to EVs, even when you could have, we can go in as a startup and be doing something different, be doing electric vehicles, not your bigger, not ICE vehicles. Even with that shift, in the midst of that shift, only Tesla has been able to do it, at least in the United States. So that should tell you something about the challenges of being a startup automaker. So yeah, I personally would not personally, I do not wish to invest in any other domestic EV manufacturer right now. And they don't look super viable at the moment. I guess I'll put it that way. So if you're going to invest in an electric car maker, Tesla is probably where you go. I have valuation concerns where they are. I think a lot of what you see with Tesla, there's a lot of expectations about things that aren't there yet. The AI, the robotics, that sort of stuff, autonomous driving, and a lot of things have to go right, I think, to make this valuation justified. But they are making money. They're producing cars. They're selling stuff. They have revenue. It's a real, from the car standpoint. If you look at the business, I don't think you necessarily have terms about survivability, even with all the political issues going on. They can produce cars and sell them at a profit. All right, that's more than any of the others have done. So
right.
That's they're the winner in those terms. If you're looking for a legit competitor to them, I think you've got to look overseas at BYD, the Chinese manufacturer, which is doing quite well. As big operation, nice scale. Not so prevalent in the U.S. yet. I don't think they're really officially here. They do have a U.S. website if you go look at it. I don't think they're officially selling here at the moment. But they are in the process of building factories elsewhere. There's, I think, one in Africa, one in Europe. I forget exactly which country. So they're growing their global footprint as well, just as Tesla has been doing. So that's the legit competitor in the EV space. BYD also does hybrids, so they're a little bit more than just EV. But yeah, I don't love any of the other domestic startups right now.
There was a question from Jojo about Twist Biosciences, which I can share some thoughts about. This isn't one that I currently own, so I can't necessarily say whether it's one that I would personally, buy or sell, as it wasn't one that I particularly had on my to-buy watch list. But I can offer some thoughts of maybe some things to think about if you're looking at this business. right now. So for anyone that doesn't follow this business or know what they do, Twist Bioscience is a synthetic biology company. They are known for their synthetic DNA platform, which uses a silicone-based approach that manufactures synthetic DNA and DNA products for various industries and use cases, including healthcare applications, industrial chemicals, agriculture, academic research. So they essentially use this very high-throughput silicone platform to miniaturize the chemistry that's necessary for DNA synthesis, and that enables them to produce DNA at scale. And they offer a range of synthetic DNA products, including genes that are synthesized for applications like research, drug discovery, biopharmaceutical development. They help provide tools for preparing samples for next generation sequencing, which enables more accurate and efficient sequencing. They help create antibody libraries for drug discovery and development. They're exploring the potential of DNA as a storage medium for digital data, and they've had collaborations with companies like Microsoft to that end. So heavily involved in, drug discovery, biopharmaceutical development, and diagnostics, as one might imagine, with their core product being the synthetic DNA. But then they're also exploring the use of synthetic DNA in industrial processes, applications in agriculture, as well as other research areas. So they make money in a few different ways. Again, it really goes back to their proprietary silicon-based DNA platform, offering these synthetic genes for research and development in different fields, as well as tools and reagents for prepared samples for next generation sequencing, which is a really crucial step for a lot of research and diagnostic applications. And then they develop and offer these antibody libraries, which can be used by drug developers, manufacturers, research organizations for drug discovery and development. That core strength is their DNA synthesis platform. But there's been some challenges. It is the synthetic DNA market is highly competitive. They are competing with very established companies in the space, and so they've faced a lot of pressure on their pricing model and really struggling to maintain margins. And because they really are reliant on a services-based business model where they synthesize DNA for customers, that can be really challenging to scale. And there's also the very real likelihood of it being susceptible to being displaced by hardware-based platforms. There's also, this is a rapidly evolving field, synthetic biology, and Twist and other players also risk having, their technologies become outdated or non-competitive. They have shown, revenue growth, but they've really struggled to achieve profitability. They've faced a lot of challenges in terms of managing their cash burn. In their most recent quarter, they identified an impairment indicator related to a specific asset group in their antibody discovery portfolio, and that led to a $45 million one-time impairment. So there are definitely, some issues at play for the business that are really kind of heavily impacting their growth and their ability to, move towards profitability, which, as I mentioned, is something that they're really struggling towards. Now, in the first quarter of their fiscal 2025, they did report a record revenue. That was about $89 million, and that was an increase of 24% year over year. It was also their 8th consecutive quarter of sequential growth. They did see some gross margin improvement as well. Their gross margin for the first quarter of their fiscal 2025 was about 48% compared to 41% for the same period 1 year ago. Their net loss narrowed slightly, but they still reported a net loss of about $32 million. They had about also $271 million in cash and investments on hand. They shipped products to about 2,376 customers in Q1 2025, which was a slight uptick year over year. And they also shipped about 205,000 genes during the first quarter, compared with 171,000 a year ago. For fiscal 2025, they are forecasting anywhere from 19 to 21% year over year revenue growth. For their synthetic bio business, they're looking at revenue in the 17 to 18% year over year range. For their NGS revenue segment, about 21 to 24% year over year growth. And their biopharma business, they're also targeting growth in the ballpark of 13%. So some of the biggest factors for this business over the long term are their ability to continue to innovate their platform and stay competitive in what is a rapidly evolving and dynamic and highly competitive space. They are, as I mentioned, hemorrhaging net losses and burning through cash. They are delivering very strong revenue growth, and that is pretty well uniform across their different core businesses. So those are some things I would be thinking about, if I was looking at this business for my portfolio.
Nice. All right, we have about a minute left here before Wilson to come on. And join me. We're going to say goodbye to Rachel. So I'll just let you. Is there anything in the queue you see that you want to hit in the last 2 minutes, or thoughts on earnings season as we move into that?
Well, I think, with earnings, there's obviously a few companies I mentioned that I'm looking at. A lot of healthcare businesses that are reporting in the next month. Like I mentioned, Johnson & Johnson, Pfizer, Moderna, Novo Nordisk, Eli Lilly, Intuitive Surgical is another one I forgot to mention. Merck is another major player. We've got also results in mid-April coming out from United Health Group. That's another major, healthcare business, as well as, Johnson & Johnson, which I own and follow pretty closely. Broadly speaking, this is a space that tends to be more resilient in a wide range of economic environments. These are certainly not companies that are, impervious to the shifts we see in the market, but they're businesses, and often share prices do tend to be a bit more resilient. And a lot of these organizations I just named, they are some of the biggest healthcare entities in the space. A lot of them are very consistently profitable. They're not necessarily super high growth businesses, but they have been, really steady compounders and steady growth businesses through the years. And so it's an exciting time for me as someone who follows and reports on the healthcare space very closely. And I think that's the area where I'll probably be focusing most significantly in this next period of earnings, with, some stragglers like some of these consumer staples companies we mentioned and the travel businesses. Those are ones I'm also watching pretty closely and with a lot of curiosity, because I think that might give us a little bit of additional insight into the state of the consumer, as that is, I think, something that's on the mind of a lot of investors right now.
Nice. All right. Thanks so much, Rachel. This was fun. Always fun chatting with you. So we'll say goodbye to you for now. And
yes.
Hello to Will.
Night, guys.
Take care. Hey, Will. How are you this evening?
Good. How are you? I think this is our first time together since you got back from vacation.
Yeah, I think that's right. I'm doing well. It's snowing and raining outside right now here in Reno as we move out of the winter into the spring. One last hurrah, I think, although the snow's not sticking anywhere, so I don't think it's going to do much for the extension of the ski season. But
yes,
I don't know. I don't know what it's doing up there in the mountains. We're talking about some coffee companies today, guys. We thought we would discuss Dutch Brothers. We discuss Starbucks. We discuss whatever you guys want to talk about. But those two are our focus right now. If you want to ask us questions about what's going on with those companies, and as we wait to see if we get questions on those, Will, let me ask you, as we're at the end of the quarter now, as we're probably going to start getting some Q1 reports in the next week or two here. Is there anything that you are particularly waiting for or watching for this first quarter of earnings reports?
Well, the big one is going to be the trade desk, because I was in that, so I took the 60-some% hit that came, between the time it peaked in January and the big crash. I think that may actually wait until May, but that's the one I'm going to be focused on, because I think that was the most active earnings report, for better or for worse, from the previous earnings season. Now, I don't think they're going to miss their revenue number again like they did before, but it'll be interesting to see how they recover and how the market reacts to it.
Nice. Yeah. That'll be a fun one to watch for sure. I don't know. I don't know how that's going to go.
Yeah.
I'm not even sure I'm going into this with any expectations.
Yeah, we've seen a lot of volatility over the last couple of months, so it's kind of hard. Actually, Dutch Brothers might be another interesting one too, to come to think of it, just because it's had that big spike over the last few months and started to come back down. So We'll see if that reaccelerates or if the drop continues with that one. But I'll go into that in more detail when we get to that stock.
Right. So there is a question here that Tim Jungles just asked about Guerrilla Technology. This is not a company I'm super familiar with. Do you have any familiarity with it, Will? It's a very so first let me say it's a very small cap company, so we're not going to spend too much time on it. But we did get a question, so if to the extent that we have any thoughts.
Yeah, that's not one I'm familiar with. Let's see.
Yeah, it's
it's big enough to talk about, but
yeah, it's a London-based company. I think
Yeah.
AI-based solutions and intelligence, security, Internet of Things, that type of stuff. Video. It looks like video analytics is one of their key focuses, and they provide services. They can focus on things like retail analytics, monitoring of industrial sites, security and surveillance, law enforcement, smart cities. Right, it's a big thing, right? Smart cities.
Yeah.
Everybody wants to be smarter, right? Sometimes I wish my stoplights were smarter in this city. But that's kind of a sense of what they do in terms of earnings. Tim, I do see it's a small cap company, so they seem to be pretty volatile. They were up like 18% today and down 10% after hours. So it's moving all over the place, man. Let me see if I can pull up the report here.
Yeah, they beat expectations. Yeah, so I can see why it grabbed Tim's attention.
Yeah, I mean, it's yeah. So yeah, I'm not seeing much on this yet.
Well, it was I'm reading from a news article. Up 15% for full year 2024 revenue, year over year. Gross margin was 50%, which was higher than expectations. They reported adjusted EBITDA as opposed to full earnings. A little leery of that, but the EBITDA was positive at 20.6 million, up from 11.7 million the previous year. But earnings per share, yeah, it was a loss of $6.06 for 2024. So yeah, it's pretty high losses. Looks like they're pretty far away from profitability at that rate.
I think so, right? So this is an early stage company. It seems like a little bit of a risky one here. Don't know too much about it. I just note the volatility today around earnings, which is something to be aware of. And it's very, very small. It's really small still for now. So I would tread carefully with it, but I think it's one that if you just want to play around a little bit, knock yourself out. But looks like high risk, very, very high risk, high reward, I think is the category I put it in at first.
If that reward comes, that's
if that reward comes.
Yeah.
Yes. But fascinating the little companies are sometimes fun to look at, right? Because they can give you a sense of maybe what's going on at the edges of an industry, and what people are trying to do and what looks interesting. Let's talk about which one you want to talk about first, Will. Dutch Brothers or Starbucks?
Let's go Starbucks since that's
right.
The most familiar one. I even made a slide, so let me pull that up. So Starbucks has been through a lot of turmoil lately. I mean, they're the established player in this industry, obviously. 41,000 locations, approximately in 87 countries. However, just over 60% of those locations are either in the United States or China. Yeah, the U.S. is people assume it's pretty saturated in many respects. It is, but it's still expanding in some parts of the U.S. and China's kind of their big expansion story right now, and has been for the last few years. But they've been struggling to get their sales numbers back on track. This is a very heavily competitive market, so Starbucks is the better known chain. However, there's Dunkin', which actually that was trading on the market until a few years ago. It was taken private, but it's still 14,000 locations worldwide. So pretty substantial. In China, there's Luckin Coffee, which is growing at a very rapid clip, and I think they have more locations in China than Starbucks. However, they grew their Luckin grew its locations by like just over 30%, but they had like very negative same-store sales growth. So that there's a lot of turmoil with that one. And Luckin was on the NASDAQ until 2020 when they admitted to, reporting 300 million in sales that they didn't actually have. So they were kicked off the NASDAQ. They still trade on the pink sheets, but it's interesting, but not one I would personally touch. And then you have the numerous private chains, and then you have independents like, just independents, the mom and pop coffee shops, and then you have other competitors that do coffee but don't have coffee as a main focus. You have McDonald's, which tried a coffee concept that one opened here where I live in the Dallas area briefly, but it closed after less than a year. So I'm thinking that one is not going to fly, but we'll see where that goes. And Restaurant Brands International also has coffee. Krispy Kreme, that like that. But I think the big ones right now are Starbucks and Dutch Brothers. To compete with all those people, they brought in Brian Niccol. If you don't know who Brian Niccol is, he was the previous CEO of Chipotle. He was the first non-founder, I think, to succeed at that job. And in that sense, it might fit with Starbucks because Howard Schultz, who founded this concept of Starbucks anyway, he's not the actual founder, but he's the one who made it what it is. They really haven't had a successful CEO since him. So, since Niccol was so successful at Chipotle, I guess they're assuming he can do so at Starbucks. So they did come up with 4 core initiatives to get sales back on track, which is, as you can see from the slide, they're still struggling a bit with revenue and with comparable store sales. He wants to reintroduce Starbucks to the world. He wants very, very high levels of customer service. He calls it winning the morning. So that's another initiative of his. He wants to reestablish the community coffee house, which I really think that was kind of Starbucks' competitive advantage because, even if you look at Dutch Brothers, which we'll talk about in a minute, that's just a coffee stand pretty much. That's a drive-through. They have like a small outside seating area, but it's not really a coffee house experience per se. So it's probably good that they're going to lean back into that. Then he wants to do the unrivaled best job in retail. I'm not exactly sure what that one means, but with these initiatives, it looks like he's trying to bring back Starbucks back to its core and maybe try to regain some of these customers it's lost. As you can see, this is a 5-year chart that the stock has fallen behind. It's been trading in a range for a few years now just because of the sluggish sales growth. The PE is still high at 31, I think, and the fact that the PE is going to go up to 33 on a forward basis tells me that analysts expect profits to continue sliding. But it's going to take Brian Niccol some time to really get this company on track. So we'll see where it goes from there.
Yeah, I think you had to take the call it a turnaround story because it's fine, right? But I think it's sort of in that stage. Certainly, I think Brian Niccol has that attitude that he was brought in to turn the business around to some degree, to jumpstart growth again, solve some of the problems that I think if left to fester could get to be really problematic in the years to come if you don't kind of address that and deal with it, right? I'm optimistic, Will. I think I'm optimistic about his ability to succeed here, but so is the market if you look at what the stock has done since he took over, right? So you're seeing some optimism there. I saw a commercial for Starbucks on TV, I think last night with one of the basketball games about here's your free refill, right? I think was the tagline there. So they're making that big push: come back, relax, hang out, enjoy your coffee, right? So it's just trying to take that bring it back to maybe what it was in the early days of that feel, at least.
Yeah.
And I I don't think it's necessarily entirely their fault that they've got away from that, because you got to remember what was going on 5 years ago. We had this whole pandemic thing, right? And people wonder, well, and at the beginning they couldn't come in and hang out and sit down because that was just not allowed in most places in the world. What you could come in and do is grab a cup of coffee and leave. And so they optimized their app for that, right? They kind of redid their stores to some degree for that experience. You're coming in, you're grabbing, you're leaving. Of course they did that, right? They were responding to the environment that they were in at the time. They were doing the best they could to continue to make money to grow. And I think they did a very good job of that. But that's now gone. And they have that legacy holdover from they kind of pushed maybe too hard in that direction. All about throughput, all about get you in and get you out. And it changed the feel. It changed the feel of the business. It changed the feel of the stores. And I think part of what Nichols is trying to do is, all right, well, now we're post-pandemic. Maybe we can try to recapture that old feeling and generate some more good vibes about Starbucks. You come in, you hang out, you get a free refill, and you buy a donut or something, right, while you're hanging out. Or you make it a habit, and so you come more, and there's more revenue to be gained from that potentially. So we'll see how it works out. Although intuitively, wouldn't you think that the more time people are spending in the stores, the less revenue per person hour you're generating? I don't know.
Yeah, no, the drip coffee is typically their lowest price.
Right, there's not a lot of margin there. Yeah.
So I think they kind of have to do that because a lot of other places you can get free refills on drip. So I think that one is kind of necessary, and and maybe this is okay for a while because they need to do something to get back on track. And Brian Nichols sort of built a reputation as an operational guru because he got Chipotle back on track after all those health related scares. Starbucks doesn't have that problem per se, but I think that it hasn't been the most pleasant customer experience the last few times I was going there. I don't really go there as much as I used to personally. Of course, part of that was I bought my own espresso machine because I was tired of spending money on that. But I don't know. I kind of got to where I preferred going to Independence when I did go out for coffee.
And that's the other source of competition from Starbucks, the big one, right? It's not just Dutch Brothers; it's those independent coffee shops. That we've got all over the place throughout Grand Food. And for some people prefer that and will seek those out. For some people, it's a location issue too, right? Where are you going to go get your coffee? Who's closer? Who can I walk to? Right. So that factors into the decision, I think, for some people. I tend to go to Starbucks because I can walk there. Even in a city that is not the most walkable city in America, I live close enough to one that I can walk, right? So that influences my decision to some degree. I have another coffee house I prefer, but it's a drive, right? And so that kind of, helps make the decision more often than not. But let's shift here. Let's talk about Dutch Brothers, which is an up-and-coming competitor. Not exactly the same. It's a different feel, different focus, different style, but they're growing quite rapidly. So what are your quick thoughts on Dutch Brothers, Will?
Well, Dutch Brothers is, unlike Starbucks, which is well established and pretty much everywhere in the U.S., Dutch Brothers is on the way from becoming a regional coffee company to a national one. So they started off in Grants Pass, Oregon in the early 90s. They didn't grow that quickly, but especially in the last 5 years, especially since maybe a couple of years before they launched their IPO in 2021, they started expanding rapidly from that West Coast operation. I believe they're in 18 states now, if I'm not mistaken. Sorry, I have a slide that's should come up. Bear with me on that. But they've gone as far as Florida. There it is. Yeah. So as of the end of Q4, they were at 982 locations. They did actually surpass 1,000 during the current quarter. So it'll be over 1,000 the next time they report. So still growing very rapidly. Q4 revenue up 35%. Most of that is just the fact that they're expanding so quickly. I think I think they add more than 150 locations over the last year or so. That in itself explains most of their growth. They still grew comparable shop sales by 7%, which is pretty good considering that Starbucks was negative. So they are winning some business, probably from Starbucks, probably from some of the independents or the other chains like Dunkin' and all the others that are out there. Wall Street's finally taken notice of this. You see, until late 2024, it was kind of trading in a range, and then suddenly it spiked. Back to established an all-time high. Then it's kind of pulled back, but it's still a fairly expensive stock after that run up. PE ratio 179, forward PE 103. They did just recently become profitable on a yearly basis, so that's part of why the valuation is so high. But I think here it may be a little bit overvalued, but as you can see, it has now outperformed the S&P 500 since its IPO day, especially if you got into it, and especially in 2023 when the price was so low. So, for this year, they have another 160 shops planned. They want to get to 2,029 locations by 2029. So, at the rate they're going, they may just get there. I don't see why they wouldn't get there at this point. And they see an addressable market of over 7,000 shops. So despite the fact that they're above 1,000 now, they still have a long way to go. As I touched on earlier, unlike Starbucks, Dutch Brothers is just a coffee stand, a drive-through coffee stand. So they really have to rely on their drinks. Whereas people might go to Starbucks for the to sit down and talk to their friends. Dutch Brothers, you're going purely for the drink, and they've stood out with their Dutch classics, which are basically espresso and half based drinks. And they have teas, lemonades, smoothies, lots of types of drinks, and some snacks. So that concept has really taken off with a certain segment of the population, especially with its rapid spread across the country. And I really don't see why that continues. It just depends on where you buy the stock as to how well you do. But I think this stock is going to rise longer term. I like these regional and national growth stories, especially when they grow this rapidly. And I do see a bright future for this particular company.
Yeah, I think so. And you look at the difference in your trailing and forward PE ratio there, it's dramatic.
Yeah.
And that reflects the expectations of relatively high growth in earnings for the next year is what you're looking at there. And you look at those numbers you have on their growth plans, Will. I was taking a look at that. So in Q4, they opened their 1,000th location, right, in Orlando. They're looking for 2,029 shops by 2029, which is cute. But look at, let's give them the benefit of the doubt and say end of 2029, 5 years from when this was put out, right, from the end of Q4. So it's not, they're looking for 160 plus this year. They have to increase that pace of openings a little bit to hit that over 2,000 number to double their size, but not a whole lot, right? Maybe you do close to 200 in 2026. Maybe you do a little more than 200 in 2027, 250 in 2028, a little more than that in you're there, right? So you do have to accelerate a little bit, but not dramatically. So it's certainly doable. It's an aggressive goal, but it is an achievable goal, I think, to get to where they want to be, which essentially, is double the store count in 5 years is what that is. So yeah, doable, certainly doable. And I think the valuation is probably in large part reflecting the expectation that will be achieved. So if you're investing in this at these prices, that's your metric you got to follow and make sure they are on pace to do that. Because if they slip up and they come out at the end of this year, Will, and say, we opened 140 stores, that's not going to be good, right? I think you're going to see a decrease in that. So just that's what you want to track. Track that growth. Make sure they're continue to on pace to double that store count in 5 years. And I think you also want to make sure they're doing that without seeing unit sales suffer, right? You want them to stay about what they are and even go up a little bit. I think those same store sales comps to increase. So what, 6.9% last year, that's kind of, you want to be holding there at a minimum. Maybe you want to get to 7.5% in the next couple of years would be nice to see.
Well, for a same store sales increase, I think that's pretty huge.
Yeah, it is. It is. But I think they need to keep something around there, I think, as they're growing for their double the store count.
The only problem is as they grow more, especially in certain areas, they're going to cannibalize each other a little bit. So they'll maintain.
I think you can probably get to 2,000 without cannibalizing too much, but you are right. At some point, you're going to start to eat into existing store sales. So it's not just randomly throwing up another 1,000 stores, right? You got to plan those carefully.
Yeah,
and you want to put them in the right place. But so far so good. So I think we like what we see with this one here. And what is let's have some fun. So 7 billion for Dutch Brothers market cap.
Yes.
Starbucks has a market cap of 111 billion.
Correct.
They're not going to be Starbucks. Let's not assume that.
Probably not, because Dutch Brothers is still only in one country. I don't know how they would do internationally, especially.
It's a different model. Dutch Brothers in large part relies on the automobile for one, right?
Yeah.
And so even domestically, I don't know. Could you do well in New York City? Yeah, but it's a little bit of a tweak to your store plan and your store footprint to do that, because you're really optimized for drive-through throughput here. Could they get to 35 billion? Yeah. That's I think that's possible. 5x will.
Yeah, I
10 years. I mean, maybe.
I can see that.
Could see that. Could we get to? Yeah, I think you could do it. Double in 2 years, double again, 3,000 to 4,000.
I'm actually not that optimistic about the stock in the near term, just because that it had a huge run up since late last year.
It is.
We may be having it still within the backlash of that. So
yeah, I don't know. I feel like my optimistic scenario for them, and this optimistic, right? 35 billion in 10 years, I think, is an optimistic scenario, but not unachievable.
Yeah,
it's just a lot of things are gonna have to go right to get there. Also, 10 billion in 10 years could be where we are, and that would be disappointing. But
it's possible. I mean, coffee is very competitive.
Yeah, it is. But it's a fun one. It's a fun one to follow as they come on the scenes. All right, so those are our thoughts on these two companies right here, guys. If you wanted us to dig in a little more, if you got any questions on those or the industry, feel free to get those questions in here in Slido, and we'll be happy to talk about that. Otherwise, we can start looking at some of these other questions here for you guys, and try to answer some of those here.
I kind of like this one from Cyber Mikey about 3 hours ago.
That's a good one.
Yeah, he says, I've heard differing views on Fool 24, whether to have dry powder allocation for market downturns or a cage match all-in approach. What's your strategy? I'm personally on the dry powder side. I was the all-in guy for much of my investing career, and it always came back to bite me. When there was a significant downturn, and the market's always cyclical, so there's going to be another downturn eventually. I don't know when, but it's going to happen, and I think it's good to have some cash on hand when that does happen, so you can capitalize on some of the opportunities that these downturns inevitably create. But we are foolish, as we say, so not all fools are going to feel the same way.
Yeah, I don't know. I tend to be more all in. I think I rarely have more than 10% of my investable assets in cash at any given time. So I guess like you say, well, that's a little bit of dry powder, right? You got a little bit of that. I do, but I rarely get less than that. And usually I think it's probably closer to 5 at any given time, 5% in cash. And it's not necessarily, Will, for me, cash for opportunities. It's just I have stuff in case I find something interesting to buy, right? Like
Yeah.
you always want to have your ability to buy if you see something, oh, this is a cool company, I want to invest in it, right? You want to have that possibility. So that's kind of why I tend to keep a little bit on hand. But yeah, that's my approach. I get less interested, I should say, or less eager to invest when I start worrying more and more about valuation, when I see some higher valuations in the marketplace. And so that's when my cash tends to naturally get a little bit higher because I'm just spending less of it or I'm investing less of it. But I don't know that I ever look at the market and say, this looks high, I should sell and get more cash. I don't think I do that. That's typically not my approach. I know some people do try to do that, but I once I'm invested, I'm in, and I rarely pull out, if that makes sense.
Yeah, I'm more that way. I will say I do sell if I see something at a bubble valuation because I've been doing this for a while. I had Cisco back in 2000 when it was like it briefly became the world's largest market cap, which it really had no business achieving. So I should have known that and sold. And here we are 25 years later, and still it's still about 25% below that 2000 high. So some of these highs can just get way ahead of themselves, and it can take years or literally decades to get back to the original high if it gets there at all. So I think there's some reasons to sell, but yeah, just because something's a little bit expensive, I'm not going to sell it.
Yeah. And now I have sold stuff in the past now, right? And very recently, like towards the end of last year, I did end up selling some Amazon and some Microsoft because those had become very large. But that was more of a portfolio allocation sell than I think this is overvalued sell, although valuation was driving some of that decision. But it was more that they had become a large part of my portfolio, and I wanted to trim that down a little bit because I was getting a little bit nervous about their relative sizes, not the company specifically. So that I do that sometimes. And that cash, I think, has now been mostly reinvested in some other things.
Yeah, but you're talking about dry powder, and you asked about earnings reports I'm looking for. I should have mentioned this. Berkshire Hathaway, with their $334 billion in cash, as of the end of Q4, I'm going to be anxious to see if they invested some of that.
Are you looking for them to buy something big? Like this year, that was one of my bold predictions, which I got a lot of pushback on from I forget who I was on with at the time. Maybe it was Jose.
Yeah,
I was expecting $100 billion plus acquisition from them, and he's like, I don't know about that.
Yeah, I saw that. I think $100 billion is a little bit aggressive. Maybe I could see.
But I mean,
it's $50 billion maybe.
Right? Yeah, but again, like, what are you going to do with $300 billion? I mean,
yeah.
2 acquisitions, maybe. You could do that.
That will buy all but a few stocks. Actually,
that will buy a lot. That could buy quite a bit. There are not a lot of companies in the marketplace that Berkshire couldn't buy.
Yeah,
that they wanted to buy, I should say. I mean, obviously they're not buying Apple, but there are not a lot of companies out there that they couldn't just go out and buy now with $300 billion. At least of the reasonable. This actually would work as a Berkshire acquisition type company, right?
Right.
And there's any number of private businesses out there too that they could go after.
Yeah.
So you wanted to hit Jimbo's question here?
Yeah, he had 2 questions actually.
Yeah. Go for it. His first question here: how do you decide how much you invest when you decide you want to buy a particular stock? You decide the amount relative to what? For me, Jimbo, 2 things, right? It's the amount relative to my overall portfolio, right? Because if I'm going to invest in something, I want it to have the potential to be meaningful at some point, right? But it's also relative to how much cash I have on hand, right? I mean, if ideally, I'd like to get if I decide this is the company I would like to own and I'm going to own it and I'm moving forward with this, I probably want it to be about 1 to 2% in fairly short order if I can get there. But whether I can do that with the first purchase depends on how much cash I happen to have on hand, right? Because again, I'm not often approaching this with I'm selling something else. I'm trying not to do that unless either I have one that's just a huge percent of my portfolio and I kind of want to trim anyway, or I have one that I think just a junk company and it's ready for the boot, right? Then I will sell. But it's sort of a function of how much cash I happen to have lying around at that moment. Well, how much has been built up over the last couple of months or whatever, right? If I've got if I've got a couple $1,000s, I'll buy a couple $1,000s of the stock to start, right? With the goal of I eventually want to get to that 1 or 2% before I say, okay, this is a good initial position for me. So I guess 2 things. How much cash do I have? And I'm trying to target a 1 or 2% position ultimately for a new company that I'm buying. What about you, Will?
Yeah, if I decide I want to buy a company, I'll typically put I'll take about a 1% position in it usually. If I decide I'm going to buy it, I with the intent that if I continue to like the stock, I'm probably going to buy it a little bit more at a future date. Yeah, I used to be the guy that went all in when I bought a stock. I'll just allocate my full position immediately. I now regret that. So that turned out to be a mistake in most cases in retrospect. So I will more tiptoe into it now. Just take that maybe 1% position and then just see what happens with it. I kind of did that with the trade desk over a few years. I was in around 68 or so, and then it went up to the 140 wherever it had the record high, then fell back into the 50s. I did add a little bit more when it fell into the 50s. So it just depends. I like to find a good deal, but I tend to go for stocks either in the top of their field or second or sometimes their niche. I guess I bought Celsius, which is third in the energy drink field a few months ago, but I think they're first in their category of energy drinks. So I was comfortable with that. But yeah, typically they have to be at or near the top in some form and trading at a reasonable valuation. But reasonable valuation is going to vary based on the stock and the industry too.
Nice. So let me look at this question. So from Tim Jungles here. Okay. So Tim Jungles has this question. AYI is the ticker symbol. Acuity. Acuity is the company. From the electrical industry, this is the type of lighting being sold in my area. Your thoughts on the company? They have earnings this week. Not one I know too much about yet, but let me give you some thoughts on this. Let's look at this. Ticker symbol AYI. 8 billion, Will. 8 billion market cap is the company. So, it's small, but not, would you call an $8 billion company a small cap? Maybe
mid cap. I would
mid cap.
I guess maybe we.
Relative to Facebook or Meta, sure, it's a small cap, but yeah. 8 billion is legit, right? So let's look at this here. So let's look at Acuity. We can look at the what is the ticker symbol again here? AYI, and I really do enjoy looking things up as people bring them to us. So if you guys are looking at this, right, there are several Acuities out there. What you're looking for, I think, is Acuity Brands. Acuity Brands lighting with this ticker symbol for there. Let's see. And this is clearly, let's see, this is not yet a recommendation that I can see from the Fool. So new one for us. I'm sure maybe some people looking at it. It's had a nice run up, Will. 205%, 206% increase in the last 5 years. So that's solid performance. I would put that on the good side of average, right? So we've got 300%. So it's tripled in the past 5 years. Very good. This is good performance for the business. They do commercial and architectural lighting, specialty lighting, integrated LED systems, energy efficient technology seems to be their focus, right? Catering to energy efficient lighting here, with a focus on sustainability in that lighting portfolio, though. So they have two segments: lighting and lighting controls. So the actual lighting itself and the control of the lighting, right? Or lighting control, and then the intelligent spaces group. Not quite sure what that one does. Decent amount of R&D. Will 100 million in fiscal 2024. Still mostly U.S. 85% of sales are in the U.S. So it's a U.S. Focused business, headquartered in Georgia. Been around for 24 years. So founded in 2001. It has grown to become the largest lighting manufacturer in North America. So this is a pretty big company. Pretty big in terms of the market. 3.84 billion in last fiscal year. So a little less than 4 billion in sales we're looking at. All right. So pretty good there. Let's see what their most recent earnings report was. Tim said they report later this week. So we'll pull up their, which I assuming is fiscal 2024 for them. Let's see. Okay. So as of the last fiscal year, so only a 2% increase in sales in last fiscal year. Profit margin 15.2%. That was an improvement of 430 basis points. So not solid improvement on the profit side. So becoming more efficient here with the business. 43% in diluted earnings per share increase. That's pretty solid there. That was for the quarter. So again, 2.8% for the full fiscal year in terms of revenue increase. A slight decrease for the fiscal year. So a slight decrease for the full fiscal year in revenue. Increase in profit though. So it looks like our focus has been mostly efficiency for the last year here. The Intelligent Spaces Group, that's the one I would dig into more to learn more about that. That saw a 17% increase, about $84 million in sales. So very, very small sales, but growing quickly, which is kind of what you expect, right? The smaller parts of the business, the new parts of the business, growing a little bit faster there. I don't know. So I would want to look at this a little more, Tim. It's looks like an interesting business, and I'm not as familiar with the market to know what that means and say that the largest manufacturer. I mean, 4 billion in sales. I have to imagine it's a lot bigger than that. So it seems like it's going to be a fragmented market if the largest is at 4 billion in this industry. Several brands that they have here. Can I do a quick screen share here, Will? Let me do a quick screen share. Let's show. I just want to show this to people while I'm talking through this and looking at this. So here are some of their brands, their bigger brands. Those of you who either work in the industry or maybe have recently remodeled your homes may know some of these brands. Lithonia, Peerless, Gotham, Holophane, some of their brands. And you can see like these all look kind of like LED, right? These LED solutions here. So look at some of their products here that they've got. Outdoor products, industrial, residential sector here. So you could just kind of take a look over here, see kind of the stuff they do. So all kinds of stuff that they're doing here. So it looks pretty well diversified in terms of product base. Thanks. My thoughts, Tim, are I like that they seem to be the market leader in the space. That's always a good thing. And my sense is it's a fairly fragmented space. And so so there's opportunity for continued growth, maybe for, I don't know that for sure, but potential consolidation here. The growth, the revenue from last year, you do want to see some higher growth there, right? So for in terms of the earnings that are coming up this week, you look at that growth number, right? I mean, they declined for the last fiscal year. We want to see that get a little bit higher, I think. So that's going to be a key focus, but you don't want them to fall back, Will, on the improvement they made on the profitability side, right? So what we want to see is incremental growth. I mean, I don't want to say I'm looking for 8%, right? That's unrealistic, but can we get 2 or 3%? That would be nice, I think, in revenue growth while maintaining or even additional improvements on that operating margin side would be nice to see there. So focus on those two things, I think, in this earnings report that they've got coming up. But thank you for the comment and question. Interesting little business that I would like to dig into a little more here.
Okay. Well, Newbie asked, how can we guess if DigitalOcean, symbol DOCN, would get acquired, and how soon is it possible? Well, I mean, the short answer is we can't guess, and it's possible at any time, quite frankly. But I'm not sure it's a great acquisition target, at least not for its direct competitors. So the way DigitalOcean works, it's a cloud provider, I guess a cloud and AI provider now for small and medium-sized businesses. And so what they approach it differently than a Microsoft Azure or an Amazon Web Services. They post all their pricing, so small businesses can just buy the services they need, and the prices are posted. So it's very cheap for a small or a medium-sized business to use DigitalOcean. Now, a lot of these small businesses, they may be just sole proprietorships where the entrepreneur is doing everything. So it maybe something without IT knowledge, or it may be a little bit bigger, but only have one IT guy. And so, in both situations, the quote unquote IT guy is not going to know everything. So DigitalOcean also offers the community. So this entails libraries of information where they can look up solutions to problems. They can also consult other DigitalOcean customers, and they can collaborate together to solve each other's problems. An Amazon Web Services or a Microsoft Azure typically serves bigger companies with big IT departments. They're not going to buy these a la carte services, and they're not going to turn to a community. And if an Amazon or Microsoft try to compete in this, they would probably lower their revenue because if they're giving small businesses some of these deals, they had to give it to the larger businesses. So I don't know that they would want to buy it out. So I think it could happen anytime. I'm just not sure who would do it, to be quite honest with you.
Yeah, I'm not sure who would be in the market either. Yeah, I don't know.
I do own this stock, and I bought it at the wrong time, unfortunately. So
when did you buy?
In 2021. So.
Oh yeah. So yeah.
So I was optimistic because I was really excited about this particular approach to the cloud, but unfortunately it hasn't panned out so far. Maybe with DeepSeek bringing lower cost AI models, that could be an opportunity that they could capitalize on. They have become more AI oriented over the last couple of years. So if they capitalize on it, that could be an opportunity for this company to finally drive more growth than it has.
I want to hit Jimbo's question again from 8 minutes ago. He asked, you try to get to a few percent of your portfolio in several purchases, depending on how much money you have. How long do you try to get that initial few percent position? That's a good question. Good question, Jimbo. I like to give myself about a year, right? And the reason for that, and it's different for different companies, right? Some if I can get there in the initial purchase, if I happen to have a chunk of cash lying around, it's fine, right? But I think an advantage for me in saying, all right, here's my initial purchase. I'm going to try to build. Maybe I'll do another purchase or two within the next year. That year time frame, what does it do? It gives me a full year of financials, right? And for companies that are cyclical, I think that can be important because you're watching the earnings reports for the full year. Think retail, think travel, right? Which tend to have those cycles, and you want to see a full year cycle, I think, from some of those companies to really get a full understanding of the business. And if you're telling yourself over the next year, here's where I'm going to get to in my purchases, you're going to be watching those earnings reports. You're going to be paying a little more close attention to that, and you're going to get yourself more immersed in the cycle of the business. So I think that can be useful. The flip side of that is if I find myself a year out and I haven't added to it yet, and it's not that 1 or 2% position, that either means I've lost interest. Usually I've lost interest, or something has happened to the business where it made me say, I don't know about this. They had a bad earnings report or something that made me pause that, right? And that's happened a few times in the past. One example, Traeger, right? When Traeger came public, I got excited about the business. I took a small position, Will, and I thought maybe I'll add some more. And I have not yet because the growth just didn't materialize the way I wanted it to. The business just hasn't looked great. And the stock has since come down from my first purchase. So that's one where I took an initial position expecting to add more, and then continued research suggested maybe there's better places for the money right now. And so I haven't built on that. I may at the future at some point, I haven't sold it. But that does happen sometimes because that first purchase, I just, for whatever reason, say it's actually not where I want to be putting my money. So it can happen.
Yeah, I've had similar experiences. I was Celsius more recently. I think within a couple of months, I had allocated everything I was going to put into that stock. Like I was telling you earlier with Trade Desk, it actually was a few years before I added my second position, because it went up soon after I bought, and then only recently come back down. So, and then there's C Limited. I intended to add to my position of C Limited. I never did. Now I've almost tripled my money on it. I may buy if it comes down significantly, but so far I have not, and I may never buy more of that. So we'll see how that one goes. But it's going to be different for different stocks depending on how things go, really.
Mm-hmm. Mm-hmm. All right, 10% or 10 minutes, rather, Will, that we've got left here for our hour. Anything you see that is particularly interesting that you want to hit while we still have some time?
Yeah, I'll take Jimbo's other question, because that one kind of intrigued me.
Oh, nice.
Before saying how much in cash you have, tell us what percent of your net worth is in stock, and if that includes this cash. Yeah, I'd say I'd have about 75% of my net worth in stocks. That a lot of that's cash. I did buy a bit stuff I would otherwise have in cash. I did put some of that in gold and silver, because this was a couple of years ago that I did that. I was kind of worried about inflation, but it keeps going up, and there's concerns out there that keep people buying gold. So I haven't really closed those positions. I kind of consider those cash, because as soon as I get out of those, they're going to be back to cash. I don't know. I don't think I'm going to be holding those forever, but I put some in there just as kind of a hedge in case my cash was losing value because of inflation, and that essentially worked out better than I thought. So I don't know whether to really call those cash or call those stocks. They're not exactly either, but I consider that liquidity, because I could sell them instantly and put them in stock if I wanted to. But I have not chosen to do that.
I'm probably around the same. I think somewhere between 70 and 75%. Maybe about 5% of that is cash, and then beyond that, I have some stuff in some commercial real estate partnerships. It's not a huge amount, but so that's a piece of it as well. But yeah, I think I'm about where you are, Will, somewhere around the 70 to 75, maybe 80% range, depending on the particular month and how things have done relative to each other.
75-ish. And like I said, I didn't put it. I probably have what I said was the 25%. That's maybe Well, maybe about half of that's gold and silver because that's gone up so much. But I wasn't quite intending for to do quite as well as I did in those. So and half of that's directly in cash.
Yeah, most of my net worth that's not in my house, or I should say, most of my investments, my investable net worth is stocks, publicly traded stocks.
Yeah,
that's by and large where it is. And then obviously there's the cash you have to have for living expenses, whatnot, right? The savings you have for vacations, that's a chunk as well around that.
Yeah. I didn't count that. I do have.
Yeah, right. Yeah,
I have my emergency fund. That's never going into the market because.
Exactly right. That's its own thing.
Yeah.
Most of what I have that's not like imminently needed for, or that's not either mid to shorter term living expenses or specific targets, right? Like that are longer term targets are. It's public markets is where I am for by and large. Matt asked me, is Airbus on my watch list right now? Not really. Is Airbus?
Isn't it on the over the counter in this country? I thought.
Yeah, so you have to trade over the counter here. It's traded on it's traded in Europe, right?
Yeah.
So it's not a. It trades on the Paris, actually, the Euronext Paris exchange. It's just it's not one that I'm super compelled to look at, Matt. I should also say Boeing is not either on my watch list. It's they got a nice gig going on. It's a duopoly in large part because of the CapEx requirements to get into it. You have some smaller players like Embraer in like the smaller jet size, but your bigger long haul jets, it's the two of them. And as we've seen from Boeing struggles, there's an advantage, Will, to being number two in a duopoly where no one else can really enter because of those high CapEx requirements.
Yeah.
If you had 3 or 4 players, I think Boeing would be dead, honestly, right now.
Yeah,
but you don't. And it is a duopoly. And if I'm a customer, if I am an airline, a big airline in the space, the last thing I want, Will, is a monopoly, right?
Yeah.
And so even if I think Boeing is borderline incompetent at what they do, I'm probably going to try to keep them afloat just so I can avoid a monopoly situation. I mean, that's the reality of the marketplace, I think.
Well, you look at Southwest. Part of their strategy was we're really going to have one type of plane, so we could get fix our airplanes more quickly and more efficiently. We don't we have to stock as many parts and that usually increases efficiency. So they're kind of stuck with Boeing unless
they're pretty reliant on them. And like, they come like what's what are they going to do? Buy an Airbus? I mean, they could, but there's probably more cost to that than there is to kind of just cutting Boeing a break every now and then.
Yeah.
And just dealing with quite frankly, the astonishing corporate mismanagement that we've seen.
I halfway wonder why companies like Embraer haven't stepped up their game and tried to upgrade to that.
You wonder about that. I think it's just hard. I think that the manufacturing facility that is required, there's just a lot that they would have to do to build one of those things, and you can't. It's like a chicken and egg thing. You can't really do it unless you have a firm commitment to buy your plane. Because that's a lot to invest in new manufacturing capabilities. But on the other hand, if you're Delta, are you going to say, "Oh yeah, I'll buy your new, wide-bodied long-haul aircraft"? Sure, sign me up for 10 planes and build your new facility. I don't think you can really do that, right? So it's a tough situation, I think, to break into that market. I would love to see someone do it, Embraer or someone else. I would love to see them do it. Because I think the commercial airliner market is in dire need of some competent competition, and it's just not there right now.
So, question from Larry Kekimpanos. Apologies if I'm mispronouncing that name. He asked about the trade desk. The trade desk symbol TTD has come down quite a bit. However, stock is still growing annually. Future prospects, I actually think their long-term prospects are quite good. For those of you who don't know, Trade Desk, they have software that manages digital ad campaigns for advertisers and ad agencies. And as we know, digital advertising is a secular growth market. It's going to be growing very quickly for the next few years as more ads grow digital. Yeah, after 30-some quarters, they missed their own revenue numbers, and they were very overvalued when they were up in that 130, 140 range. So, in a sense, it's kind of understandable they fell so far so fast. And even now, I would call them a cheap stock, but they're not quite as expensive as they used to be. But I actually took advantage of this, and I added to my trade desk position. Yeah, like I said, it's not a cheap price, but it's a much cheaper price. I think they're the leader in this industry. You get the service from a Google. Well, Google is an advertiser in itself, so of course they're going to be biased towards Google advertising. Whereas the Trade Desk is a more neutral player, so there's kind of an advantage to dealing with them for that reason. And they focused more on that technology too. Whereas Google is actually trying to reduce its dependence on advertising, even though it's still primarily an ad company. So there is a definite opportunity here. And I think this is a good time to add shares personally. Although it got to the low 60s, it's come back down a little bit. So it's going to be a process, I think. But I think longer term, I think you're going to do well with the Trade Desk stock.
Yeah. All right. We're about up at our time, guys. We have a couple minutes left. We can see if there's something really, really quickly we can hit. I don't know if there's one we can do justice with for the ones I'm looking at in a minute. When does Trade Desk report, Will? When do you know when they're?
Let me look. Looks like they're expected to report on May 14th, so we still have about 6 weeks.
We got some time. All right, so we have like a whole month of earnings before we get to them. Yeah, that'll be okay. So that's one to look. May 14th, guys. Put that on your calendar. Let's see if they can. We get some good news to turn the vibes around. It's all about vibes right now, right?
Yeah. Well, that was in the thick of the Q1 earnings season for most companies. So.
Yeah,
it'll be very busy day. I think Berkshire's 13F is going to drop that day, so we'll also find out when. Or no, that might be the 15th. But within a day of that, we find out when. What companies they might have acquired to see if they did something with some of that 334 billion in cash. So,
I'd be excited to hear that for sure.
Yeah.
I want my bold prediction to come true, Will.
Yes, I'm sure you do. And again, Dutch Brothers is going to be a big one too. So
right.
With their research.
All right. So we have. It looks like we've got. You're sticking around. So
I'm sticking around. Yes.
Yeah. So Bernd's going to come on with you, and here we go. So I'm gonna bow out now and let you guys keep it going for the next hour. Take care.
Thank you, Toby.
Thank you.
Yeah. Hey, Will. Good afternoon.
Good afternoon. How are you, Bernd?
I'm doing well. How are you?
Pretty good.
You had a really interesting discussion there. I would have loved to join, but I was just listening about portfolio construction and so on. And I think we'll make this hour as well for the fools who are watching. So keep your questions coming, fools. I love everything about portfolio construction. If you have questions about that, and maybe quickly, I'm a bit different from most fools in that I'm running crypto research at the Fool, so I'm very knee deep into crypto investing. Before that, I helped the Fool build the business in Germany, Motley Fool Germany. So I have had a lot of exposure in European stocks, quite different from most. But I'm happy to answer any questions that are coming that fools are interested in. Will, what is your focus?
I typically do technology and consumer stocks.
All right, I see. So
yeah,
that was quite a fitting conversation. I've also seen really interesting headlines. I'm following as a crypto investor. You have to look a bit at the macro landscape. So I'm following things like interest rates, gold just breaching $3,000 mark, or recession fears coming up. Goldman Sachs has just updated their recession probability from 20 to 35%. 25. It's a really interesting market environment at the moment.
Yeah. We're kind of in the lull with earnings season, but that's going to ramp up in a couple of weeks again. So there's going to be a lot going on. But yeah, with all the turmoil related to tariffs and other macro concerns, it's definitely a lot to follow and a lot to talk about.
Oh, absolutely. Yeah, cool. Keep your questions coming. I think Slido24 is the link.
Oh no, it's Slido.com, and then the code is Fool24.
Oh, wonderful. And if you don't mind, I'll pick up the last question that was there. I was wondering whether you pick it up and answer it. Is from Milner Time. He was asking, what do you consider when deciding how much to put in on your initial investment of a company? So I think, as I understand the question, is if you found a stock and you decide, yes, I want to buy that, how do you make the decision? How much money do you want to invest into that? How do you do that, Phil?
That's a good question. Well, as I was mentioning in the last hour, I used to be the all-in guy, and more times than not, that did not serve me well. And I'm a lot more diversified now. I typically put 1 to 1.5%, maybe 2%, but I would never, at this stage in my life, I don't think I'd go beyond that for an initial investment. But basically, I guess the short answer is I like something that's either first or second in its industry, or at least in its niche of the industry. I was just talking about Celsius in the last hour. That's the third most popular energy drink in the U.S. Behind Red Bull and Monster Beverage. But the quote unquote healthy part of the energy drink market, they are number one. They recently announced the acquisition to acquire Alani Nu, which was a more direct competitor of theirs. So but typically, at least in a niche, it will be one or two. And I look for a reasonable valuation. So I try not to buy at the top. I follow this index called the Shiller PE ratio. That's the S&P divided by the average of 10 years of earnings. It's not at a record high right now, but it's higher, much higher than historical averages. That tells me we're eventually going to have a downturn. Now, I don't know when that downturn is going to happen. It could be next week. It could be next year. I don't know, but just for that reason, we're dealing with a relatively expensive market, so I don't really want to buy anything. I don't want to overpay for anything, so I have to see a bargain. But I was talking about Celsius. That was down 75% from its 52-week high. Talking about the trade desk, that was down about 60% from its 52-week high. So yeah, those are kind of the characteristics I look for. And like I said, about now it'll be about 1% of my position, no more than 2%. And I'll look to maybe increase it to 2% or a little bit more at a later time, depending on how the initial purchase goes.
All right. Yes, I think that's a very super foolish strategy. Actually, don't overexpose yourself, especially in the beginning. Right. Yeah. Sometimes you feel really overconfident. You find something you really want to own it. At least that's how it is for me. And then you see the price going up, and you're trying to, okay, I own 2%. I need to own more because I'm missing out here.
Yeah.
In fact, for me, it is. I used to invest like that, and I just found like every investor is very individual, right? I think you and everybody should find their own way to invest. What is the right way for me? How do I feel comfortable? How do I avoid emotions to come into my investing, greed and fear especially? And what I found was that I don't like when the stock goes down, and I don't know why. And my portfolio had 20, 30 stocks back in like 5-10 years ago. And I realized I don't follow most of these companies anymore, and some were down 20-30%. And I don't know, do I want to hold on to them for the long term? And I didn't write down, that was one mistake I did. I didn't write down the investing thesis. But anyway, what I changed was, okay, I only want to invest what I can follow, what I want to follow, but I go big. So I probably start small, for me, 2-3% positions, but I have 3-4 core positions in my stock portfolio, which make 10% of the stock portfolio. And I keep the stock portfolio separate because I have a crypto portfolio, which fluctuates so wildly. It can be up 100% in a month last year, and now I'm down 70% since. So it's always difficult to adjust. I'm looking at these portfolios separately. So 10% of my stock portfolio could be a stock that would be, or my target allocation of a stock that I'm really convinced of, and then I'll go from there. But I'm not shy to indeed cut a loser when I think the fundamentals are not there.
Yeah, a lot of times you think that it's going to be a great investment thesis, and it just doesn't work out. I've had more than one of those. So, yeah, at that point, I'm willing to cut and run. And if something I think is in a bubble valuation, like I was talking about in the last hour, I owned Cisco back in 2000 when it was the world's biggest market cap and had no business being there. I really should have seen that was overvalued, because 25 years later it still has not returned to that all-time high. So some of those truly never return to that high either. So you know, anything can happen. I think you have to keep an open mind and be prepared to act when you need to.
Yes. Yeah, I agree. Do you feel comfortable? I pick up a crypto question.
Go ahead.
I can answer that quite quickly. Ed is asking Bitcoin versus Ethereum. Any opinion? I do have an opinion. I used to say, personally, I don't own much Bitcoin anymore. I own mostly what we follow at the Fool. We do have Bitcoin in there in our portfolio as well. And the Motley Fool, as most people know, it's public, owns quite a chunk of Bitcoin as well. I personally used to think Ethereum is the better investment because it's a real technology that is being built on top on. It's like the base layer for an economy that could function on top of this Ethereum blockchain. And Bitcoin is just this slow, call it boring blockchain where you can do nothing else but send one Bitcoin or a fraction of Bitcoin to somebody. And that's basically it. And it hasn't really found adoption in payments, for example, which was the original vision of Bitcoin. Peer-to-peer payment system, if you read the white paper from 2008 or 2009. And that hasn't really come to fruition. So I see Bitcoin now more as a store of value is the wrong term, but as a competitor to gold. It could be a digital gold. It could grow into something bigger than that. But Ethereum, this base layer, this economy that I thought would develop on top of, that has not really materialized. They have went into a strategy where they say, okay, we have a slow blockchain. I oversimplify, but it's basically, we have a slow blockchain, but we have a really, really secure blockchain, and we don't want to compromise our security, so we won't scale. Instead, let's have other people build on top and do the scaling on top of our blockchain and these so-called layer 2 solutions. There are many of them out there. Arbitrum, Optimism, Coinbase has one called Base. Polygon is another big one. And I think these are the ones that are now eating what Ethereum could have captured in value. And so right now, if I had to make a choice, I wouldn't buy Ethereum, I would buy Bitcoin.
Yeah, I think with the store of value, these especially Bitcoin and Ethereum, they've been almost like hyper deflationary in a way. So you can't. It's kind of a bit hard to really treat them as a currency just with a increase in value so much. You can't borrow against them, or at least it'd be very foolish to do so. Small and foolish, that is.
Yes, though I could imagine this can become a use case. I'm not really a big fan of this, but you see now the US government talking about a strategic reserve. There are other governments and institutions. There's pension funds and people with big pockets of money buying Bitcoin. I don't know what they plan to do with it, but if this becomes an asset like gold, where people just hold it as part of their portfolio, maybe long-term for stability or an inflation hedge, and in short-term that doesn't work with this incredible volatility that you have. But maybe long-term, I could imagine they're holding these and think, hey, we want to hold this for the next, call it 100 years, but maybe borrow against it, like you do with a house. Not so much in Germany, where I grew up in, but I believe in the US, people do that, right? You buy a house and maybe you pay down a lot of the debt, but you might take on additional cash out of this ATM.
There is a lot of that. There has been with interest rates, going back up over the last few years. That hasn't been so popular. But when you had these 3% mortgages, that you take it out at 3%, invest it, maybe get 10 or 11% in the S&P. That you were making money that way, so it made a lot more sense. Now that the interest rates are higher, I'm not sure that makes as much sense, and I don't hear about that happening as often now.
Yes, and I should also say I agree. I wouldn't take a lot of debt, even on my assets that I own in my portfolio.
Yeah, because it could definitely not work out. So it is a bit of a risk to do that. So exactly. Yeah, if you're not feeling, it's a very, very risky strategy to try that. So especially if you don't feel it, you probably should not do it. let's see. So other questions. We have a macro question. I think you're going to want to talk about macro a bit. So I'll go ahead and bring this up from Jimbo about 7 hours ago. Let's see. Oh, I'm sorry. Bear with me. I didn't. I almost lost that. Where did it go? Oh, here we go. Okay, I'm sorry. I hear more macro at the Motley Fool. Let's talk about recession, bear market. Why not stagflation? What do you say? Yeah, that we have been focusing a lot on macro, like Bernd said a couple of minutes ago. Goldman increased the odds for a recession, and we've had a bear market. Actually, the S&P is not in a bear market right now because a bear market. The formal definition is down 20% or more. I don't think we're there yet with the S&P, but since we're in a correction phase, that could be a danger. Stagflation could be a danger also if inflation picks up. I think the only time we really truly had stagflation was in the 1970s when inflation was much higher. But yet unemployment was rising. We don't have major issues with unemployment right now. Inflation, it might be ticking up, but it's still down from where it was in say 2022. I'm not worried about that one, at least not right now. Although I do watch it like I watch everything. So yeah, I mean, like we're kind of in a very weird place right now, and I think that's kind of the reason that investors are a little skittish. Plus with all the talk on tariffs, we don't know what the tariffs are going to be when they finally do come out. We don't know how that's going to affect the economy in the U.S. or across the globe. So there's just a lot of uncertainty right now. So I think that's why the market's kind of struggling right now. So it's you kind of have to roll with the punches as an investor, and I think this is yet another example of that.
I kind of agree on that, and I should say, well, personally I do follow macro because it does influence the crypto cycle a lot, and the crypto cycle is very, very wild. You don't want to be over or underexposed. However, I generally don't use the macro a lot for my investing decisions. I use it more as a direction where could the markets go, and maybe prepare for certain things. Like, do I want to have a bit more cash right now on the sideline? And right now, I agree. So inflation has come down, and I think we all understand that why the inflation came the last couple of years was this government spending that happened during the COVID crisis, when basically the economy was put to a halt. People were sent home to stay at home, were sent money from the government. That happened in the US, it happened in Europe where I was back then. And then people spent that money online or on stocks, on crypto. A lot went into the crypto market. But yeah, then eventually it came into the economy, and also the supply chains were kind of disrupted, right? So there were all these drivers driving inflation relatively high, and it's coming down at the moment. At the same time as, especially in the US with the new government, they're cutting spending quite widely. And I heard you talking about Boeing and Airbus before. I was following the airlines a little bit, which at the beginning of the year, when you listen to their predictions for 2025, they were very positive. We're going to expand earnings, we're going to grow. And just 2 months later, suddenly they have to announce we're going to have to basically cut our expectations for this year, because suddenly there's a lot less people flying. And apparently a lot is that US government or government's expenditure, they seem to be cutting on travel costs a lot. So this is going to hit the economy, I believe. And it's a lot in the hands of politics, right? Where you don't know. They can make one decision today and can make another decision next week that flips the whole script upside down, which is one reason why I don't plan to make this a big contributor into my investing decisions. But I believe the stars could be lining up indeed for a stagflationary environment, because the spending is going to be cut. The economy might either not grow relatively fast or really shrink even, while at the same time the debt levels are super, super high. And right now the interest rates are also high, and this debt will have to be refinanced. And this refinancing means, unless you roll down debt and you try to pay it down, which I don't know how that will work with these amounts in a short period of time. So what my expectation is that at some point the central banks are going to jump in and doing some quantitative easing, probably call it a bit differently from last time, so that they don't look as, oh, we're doing the same script again. But I believe that will will be it's a high probability that this is what's going to turn out. And this money that's going to be printed to refinance that, it's going to go into the economy. And the economy, while expenditure in real terms is going to be cut, in the nominally, people might have more cash in their pockets and spending that on the same amounts of goods and services, driving inflation up. So you might have a period with low growth but high inflation in the foreseeable future.
Yeah, it all depends on how the quantitative easing, and I agree that's probably what they're going to do, because that's what they always do. But yeah, I mean, what they did in the 2010s, the velocity of money was still pretty low, so it didn't impact inflation. Now that we've had higher inflation recently, I think it is more of a concern, and there is more of a danger that another round of QE will spark inflation. So that's probably not bad for stocks, but if they're not going up as fast as inflation, yeah, that could be a problem. So it might stop the market from falling technically, but yeah, we'll see if we have that inflation, is the growth going to match that or surpass that?
Actually, it's not such a bad time. There are stocks that are going to benefit from such type of environment, right? And there are others that are going to suffer more, especially those which don't have a lot of pricing power, maybe a high, not a good balance sheet structure, less flexibility in their business. But yeah, and actually, you mentioned before, I haven't followed that closely since I'm out of the stock world 4 or 5 years ago. But you mentioned the Schiller PE, and that was one that I used to follow in the long term, and you said it's close to an all-time high. While at the same time, I think I shared the chart with you some time ago, is right now the percentage of stocks in the portfolio of the U.S. consumer or U.S. households is also quite close to an all-time high at 29%, I believe. Yeah. So the average U.S. household portfolio is 29% stocks, and it used to be somewhere always between, call it 10 and 30%. So we're quite high on that range, and that's just another indicator. However, this, as you said before, you don't know. Is it today? Is it tomorrow? Is it next week? Next year? And this game could continue for 5 more years, as it has done, and I guess in the 20s, 100 years ago, into the 30s. Yeah, you don't know where it goes, and it might not have to be going crazy. It could also be a slow trickling down, right? The valuations coming down while maybe earnings decrease. We'll have to see and observe. But there are a few indicators pointing to that stocks are indeed relatively highly valued at the moment.
Yeah, I don't know that it would go back to the 1970s levels necessarily, where the market got hammered and then basically did nothing for approximately 10 years. The reason why is in 1978, that's when 401ks were established. And I think that kind of created a permanent sort of ownership of the stock market that probably wasn't there in, say, 1975. And I think because of that, because we all have to be in the stock market now to, at least in some form, to save for retirement. I don't think it's going to go back down as far as a lot of people expect the 1970s to repeat. I don't think that's exactly true, but there could be some echoes of that depending on how this goes.
Yeah, I think we'll find out. But I guess your guess is as good as my guess, is as good as anybody's guess. Nobody really knows, and there's probabilities. But yeah, it depends a lot also on the decisions individual people and countries are going to make, which we will not be able to really foresee. I think.
Yeah, you have no control and no ability to predict political decisions. That's why the tariff, all the tariff news is rattling investors.
Oh, yes. Right. I can answer another crypto question. Jimbo has questions. Asks, how do you make money with crypto? Do you trade it like fiat currencies? How can Bitcoin be a store of value when it correlates with growth tech stocks and is so volatile? Tackle the last one first, you're right. Right now, you wouldn't consider it a store of value for the short term anyway. I think for the long term, you could. Because of this argument, there's only 21 million Bitcoins out there. And nobody will ever increase that. And if you believe that governments and pension funds will continue to get more bullish, call it Bitcoin, more positive regarding Bitcoin, then I think you can. It's very reasonable to expect that value to grow over the long term. And because you can, somebody can change the code, right? But the expectation right now is that these 21 million Bitcoin are going to remain. And if the demand is going to grow, but the supply is staying constant, you can expect over the long term that this will at least store your value, call it 10 years, 20 years timeframes, right? Such as gold does as well. But yeah, in the short term, it correlates with tech stocks a lot, in fact, and it is even more volatile than the NASDAQ, for example. So you wouldn't buy Bitcoin as a store of value if you think you might need that money in the next, call it 2 to 5 years. That's not what I would do. And do you trade it like fiat currencies? People do that. I personally don't, and I think foolish investors generally don't do that. But you can make money, I think, in the same way that you do with stocks. And that's my goal, helping foolish investors and our members especially to find these cryptos, which we think have really kind of a mode, build something, a product that has a long-term potential to disrupt the market, maybe to create a market. I believe there will be new markets created, such as the internet created new markets 20, 30 years ago. And I believe the same thing is going to happen with this blockchain technology as a layer down there. So what we're looking at is just products or companies that utilize these technologies to create something unique, either to disrupt the market or to create a completely new market. And investing into these at prices that reflect the risk, I believe that's the way you can make money over the long term.
Yeah, so Chuck Wagon had an interesting question. Every time I hear how quote unquote high interest rates are now, I chuckle. I would think the mortgage rates have been on average for the last 40 years. Any comments? Yeah, I agree with you. Basically, with mortgage rates, the U.S. went through a 40-year, or I guess I should say with bonds, not mortgage rates, because the rates came down. But bonds went through basically what was a 40-year bull market. You know, when in 1980 or around there, mortgage rates were double digits, and they steadily fell through the next 4 decades, really until the 2020s, and you know, we started coming up from those sub 3% interest rates, and now we're back up to historical averages. But yeah, it's just high to us because there's not many people around who remember the 1970s. But yeah, if you're looking at a very, very long-term point of view, I would say they are average.
It's a good point. I'm glad the member brought it up. I forgot the name. Chuck, I actually agree with that. On the long-term perspective, it's absolutely true. I said relatively high because if you look at the last 10, 20 years, they have been so low and people have used it to pile on their debt, especially our governments. And so relative to the debt that the people have, the interest is actually very, very high. So the interest rate, yes, is maybe 5% is average, even below average, I guess, in the last 40 years. But the interest payments that result from that are very high. As we know in the US right now, I believe the government is spending more money on paying interest than the second highest budget, which is defense and military spending. And the US is the biggest military spend in the US, in the world. So rates are, while not high in long-term historical context, they are high compared to the levels of debt that people have to manage.
Yes. So Sergei Zychenko, I hope I'm pronouncing that right, actually had 2 questions. I'm going to address the second part of that question. The first part dealt with valuations declining. Were some solid companies that pay dividends greater than 5%, better than CDs, money markets. The second part of the question, what would be the disadvantage to buying high dividend paying blue chip stocks versus fixed income CDs, money market funds? Answering this, I am going in. I'm bordering on personal advice, which I'm not allowed to get into. The short answer is whether you want to earn money through dividend stocks or higher yielding, fixed income. That's going to be completely a personal decision. And I think you do have to have a higher risk tolerance by going with a dividend approach, because in theory, dividends can be taken away at any time. Now, yet there are stocks, like Dividend Kings and others that have increased their dividend every year for years or decades. I mean, they do that because, like I said, they can be taken away at any time. But if you increase your dividend for every year for 10, 20, 30 years, that starts to become an expectation. And if you suddenly go away from that expectation and cut your dividend, that tends to undermine confidence in your stock. And that happened with AT&T a couple of years ago when after 35 years of increases, they had a lot of cash flow issues through some very expensive and bad decisions, and they were forced to cut their payout. So that does happen. But if they have that long dividend increase streak, it certainly does reduce the odds that they're going to cut that dividend. So as for advantages or disadvantages, I do like those stocks that increase dividends every year because you're going to get more income every year from the same investment. That's going to help you deal with inflation. And you might even get ahead of inflation depending on how large the dividend increases are. So that can be a way to bring in cash flow into retirement if you have enough saved, that is, without having to sell all these stocks. So that is an advantage to going the dividend approach. But like I said, the disadvantage is that dividends can be cut at any time. So I think you have to have some expertise to kind of forecast when that dividend cut is coming. I brought up AT&T as an example. If you're being honest, you could probably see that dividend cut coming because they had all those multi-billion-dollar acquisitions that didn't pan out. They were forced to sell DirecTV and what was Warner Media for significant losses. That cut into their cash flow. So you can kind of see that they weren't going to be generating enough cash flow long term to pay that. But you really have to have the background knowledge, I think, and the motivation to look at statements at least every 3 months or 6 months or some period like that to follow the company and follow their ability to pay that dividend. Fixed income. I think fixed income is easier. That's guaranteed money. So that tends to appeal to conservative investors. Unfortunately, you're not going to have that increase unless you invest in fixed income. Then you reinvest your interest into the principal to get more interest. But then you're not really living off the cash at that point unless you just have a lot of cash. So it's a more conservative strategy in that there's not going to be as much opportunity for gains, but there's not as much opportunity for losses. So it's different approaches are going to work better for different people. And we have people listening to this podcast of all different risk tolerances. Don't push yourself to be a higher risk investor if that's just not in your comfort zone. You have to be able to sleep at night. If dividend stocks make it where you can't sleep at night, you probably want to go the fixed income route. But if you have a little bit of risk tolerance, I think and some basic knowledge to follow these companies, follow whether they're generating enough free cash flow to cover that dividend and the increases consistently. I would tend to go toward the dividend strategy. That's kind of what I'm doing with some of my retirement money. I bought Realty Income recently, which was paying it at the time almost a 6% dividend. That's known as the quote unquote monthly dividend company because, as the name implies, they do pay a dividend every month. And they do increase that dividend a few times a year nowadays. They've increased it at least one time a year since 1994. So they have a very long track record. And nowadays, none of those increases are by themselves or anything to write home about. They're not very significant. But over time, that will add up. So a stock like that that pays a solid increasing dividend, I think would be a great income investment, in my opinion.
Yeah, I believe you hit all the points. In summary, how I view it is maybe to say you don't need to go black and white, right? You need to say I need to prefer the one, and or dividend stocks are for some type of investors, and the other fixed income instruments are for another type of investors. That could be. I would rather view it as what do I need my money for? How do I plan to use that? Right? If I expect a big expenditure in the next 1, 2, 3 years, I know, do I plan to buy a car in 3 years, or is my daughter going to college and I need some funds? I would probably not go. I personally would not go with dividend stocks. But if I think, okay, I want to generate some income on the sidelines while having growth opportunity in long term, and I don't mind fluctuations. I don't expect that this is money that I need in the next 5 to 10 years. I'd probably personally prefer blue chip dividend stocks for such a purpose.
That's a good point on that. You don't have to go either or. You certainly can mix and match. I mean, put some in fixed income, others in other money in dividend stocks, depending on your comfort level.
Yes.
This looks like we have a few crypto questions. Do you want to tackle one of those?
I'm happy to do so. I just don't want to take over the hour, but yeah, if folks are interested. So Ed has a question: Bitcoin ETFs. What type of stocks are inside the ETFs? Is this a good way to get exposure to crypto? So a Bitcoin ETF actually doesn't have any stocks inside. It literally has Bitcoin inside it. So it's an ETF which issues shares that you can buy, and the ETFs then use that money to buy Bitcoin and get it custodied, typically by Coinbase or another provider. So there's literally the Bitcoin inside. So if you want to get exposure to purely Bitcoin, but you don't feel comfortable or you don't want to jump through the hoops of opening an account with a crypto exchange, don't know how to do, feel insecure, then a Bitcoin ETF is probably a quite good option. And I could imagine, I don't know too much, I'm outside of the US, but if you have retirement accounts, IRAs, I believe, you might be able to invest into Bitcoin ETFs while not be able to invest in Bitcoin itself. So for such purposes, I believe these ETFs could be an interesting exposure. And there's also, cryptos are different. Jimbo has questions asked. Cryptos are different than stocks. Yes, they are not businesses. Yes, well, stocks itself are not businesses, right? There are business behind these stocks. It's the same with cryptos or tokens. And crypto doesn't equal crypto. That's a whole big topic. And maybe one day I can make a session on that. But behind these cryptos are also organizations and sometimes companies, right? But yes, it's different. Like it's not. But I think what you mean is that stocks, they are basically correlated to the performance of a business, whereas cryptos or tokens might not necessarily be correlated to the performance of the project that is behind that. Ideally, it is, and that's what we foolish investors, I think, should focus on, where there is such a correlation, or at least there's a direct, call it value capture to the token from the business or the project that runs, has issued that token. So you can find these things, but many don't. And yes, in and out of itself, it is a bet on its increasing usage like a fiat currency. No, it depends. And that goes into crypto is not crypto question. For example, Bitcoin, yes. By Bitcoin is really its usage, or maybe people usage in a sense, do people want to spend it, which doesn't seem to be the case. I thought it could be a payment system, but no, so far it doesn't pan out. But Bitcoin could be people just adding it to their balance sheets, and that seems what's to be happening. So yes, there would be a correlation then how many people or institutions want to add Bitcoin to balance sheets, how do they hold it, etc. But there are other cryptos out there. I mentioned it, or we talked about Ethereum before. There's Ethereum competitors. I wouldn't even now call it competitors, but other layer one blockchains like Solana and Sui, people might have heard of, or Cardano is one that is oftentimes in the media. These are cryptos where it is not so much that people store them in their wallets, but it's indeed the usage. Solana, for example, Ethereum, I mentioned before, it's not the case anymore. It's a very slow blockchain. It's super secure, in my opinion. But the usage on Ethereum itself might not grow itself. It's rather the layer twos that build on top where the usage grows. And I think that's where the value accrues long term. But Solana is, call it an Ethereum competitor, where indeed there's projects building on top of Solana, call it lending applications, or there's a lot of decentralized physical infrastructure protocols. These are protocols, or call it organizations, that facilitate the build-up of real-world infrastructure, mobile cell phone towers, or real-time kinematics, satellite miners, like real-world infrastructure that is facilitated, the build-out of these, through a token. And a lot of these projects are building on Solana, and as this usage grows, I expect, the Solana price, if it grows, call it like this, there will be a correlation in my expectation between the usage on top of the Solana blockchain to the Solana token.
Yeah, so I saw, Bernd just brought up IRAs. I saw an IRA question that was very interesting from a Motley Fool. It was for Jeff, but I'll take it anyway. What age can you invest in a Roth? My son wants to mow yards, but is 11. He listened to Psychology of Money and wants to invest. Will Roth affect financial aid? So good news and bad news there. the good news is there's no minimum age to invest in a Roth. I don't think it affects financial aid. However, there might be some income requirements with the Roth. Most children don't earn income, so that could be a limitation. I'm not. You might want to consult an accountant on that one. If you can invest in a Roth, the advantage is you have 48 years until you're 59 and a half. So that kind of investing time frame, you can take a very small amount of money, and assuming you don't touch it for 48 years, you could have a decent amount for retirement just by investing in the S&P 500. Again, I'm not exactly a Roth IRA expert, so I'm not sure what are the rules for a child. But I do know there's no minimum age. That's one thing I do know. So if there's some way that the child can do it at 11, that's hugely advantageous. But I think you need to probably consult with like a CFP or something, a certified financial planner to see, or a CPA to see if you could do it. But if you could do it, it would be quite awesome.
In fact, yeah, I just want to say it's actually awesome that your son has read the book or heard about it and wants to invest right now.
Yeah,
it is really, really cool. And I'm not familiar with the structure of Roth IRAs or retirement accounts in general in the US. I suppose there are some risks that come with it. I don't know who manages it, right? And is the asset really yours? At least in Germany, I know that can be a question. But in general, my daughter is sitting opposite of me. And when she was born, I started investing just little, very tiny amounts of money every month into an account that I opened just for her. It's not a retirement account, and that's a disadvantage because whenever she sells, there will be tax benefits and tax liabilities. And also in the meantime, there can be liabilities from something like that. So if I had the opportunity, I didn't have it in Germany, I would have been quite happy to use a retirement account for my daughter's savings at this earlier an age. And Will, you mentioned it. You have 40 years or 50 years possible of compounding that your son can do, which can do miracles.
That's definitely enough time for that. But yeah, even if you can't do a Roth, you could just probably do a regular account. I probably consult a certified financial planner to see what exactly the ins and outs of that are. But assuming you could do it, that would be a huge advantage.
Yes. Jimbo has questions. Would have another crypto question. I can just tackle quickly while.
Oh, go ahead.
You seem to dig out really, really interesting and good questions. Maybe you'll find another one, Will.
Yeah.
But Jimbo asked, Bernd, beside crypto, what European stocks are you following? What do you think of SAP, SAAB, and NVO? Now I have to admit, SAP is the car company, I suppose. I think it's a Scandinavian car company, but I might mess this up. I was focused on German stocks and from German-speaking countries, Germany, Austria, Switzerland. But there was a lot of opportunity there already. But in the early years of the Motley Fool Germany, I did look a bit outside of this DACH, Germany, Austria, Switzerland region, and I found a lot of interesting Scandinavian stocks. They have a very interesting business attitude, especially in Sweden. There were companies, I was blown away. So one thing that I noticed that is really, really amazing in the US is just this business focus. People focus on the business, they have a strategy, and they want to grow the business. That's this growth mindset. They try to find markets, and they want to push themselves and the company into a big vision that they build. I mean, that's not always right. You still have to fight for this. But that's something I didn't really find a lot in Germany or Switzerland, for example, where companies, they focus on the product we want to have, which is also good. We have this really amazing product, but they're not thinking about how can I grow my business, right? I think I have this product, I want to sell this to my customers, and I want to improve this product and so that nobody else can compete with me on the product front, but the business might not grow, right? In Scandinavia, you kind of have a mix of these two cultures. That is how it felt for me in this little bit of time that I spent looking at it. So you have people with really great visions or have founded companies with big visions where they want to go, and they have this North Star marching towards, at the same time looking at the quality product. So I don't know if SAP and NVO might be Novo Nordisk. I'm not just guessing, which I also don't know too well. Not sure if they fit into this area, but in general, if somebody has the interest, I would indeed encourage Fools to look in Scandinavian companies. It's a small stock market also, so it doesn't take that much time to screen it and look through it compared to the US, for example. But it's definitely an interesting market to look at. Right now, the first question, what European stocks am I following? Not really many. I have a few in the portfolios, mainly in my daughter. These are smaller companies that we used to recommend in the Stock Advisor Germany, which I was running back then. Companies probably nobody knows outside of Germany. In fact, some people might know it, but they are typically also business B2B companies. This is what German companies, the German Mittelstand, these small and medium-sized enterprises, would call it 100 to 1,000 employees or revenues of, in the million, tens, maybe hundreds of millions. These are the types of companies we found a lot in Germany and focused on. And that's why you probably don't know them that well.
Yeah, so Ed asked earlier today, what do you think of a contrarian move now? Invest in tariff-related stocks before Wednesday. Well, I would personally advise against that. We were talking about political decisions earlier. Political decisions can be anything for any reason. We simply don't know. Yeah, I mean, there could be a tariff-related announcement before Wednesday. That's true. But I have and I don't think anyone really has an idea how that's going to affect the market. Here at the Fool, we're more about long-term investing decisions. We don't try to tell you what's going to happen in the next hour or next day or next week. In my opinion, that's just too hard to predict. None of us have a crystal ball. I simply don't know what's going to happen with any tariff-related announcement or tariff-related stock. So I personally stay away from those moves. Here at the Fool, we don't really encourage that kind of trading. Like I said, we want to buy things, to hold on to at least 5 years, if not longer. So, if you have a long-term investing horizon, 5, 10, 20 years, what happens in tariff-related moves before Wednesday probably isn't going to make much of a difference to your buy price, to be quite honest. So, I don't know what's going to happen. I'm not going to invest based on that.
I think that's the most foolish advice that you can give. I absolutely 100% share that. And I can add to that. Yeah, I have personal experience with similar situations where I tried to be smart and do something. And in fact, you might be right on the outcome, like the tariffs and which companies might be how well affected, but you might be completely wrong. Like the stock might just go the other way. Like, buy the rumor, sell the news, basically. And my experience is you try to do that, but there are people way smarter than us with way more information, which even focus on some such strategies, short-term strategies. There are hedge funds out there, I bet, which do that. They do also technical analysis and try to optimize their risk-return ratios that I personally, as an individual investor, wouldn't try to bet on exactly for that reason on such short-term moves. If you want to think long-term and maybe you have a company that you're interested in that you think is going to be affected and you think could be negatively affected in terms of stock price, but you're still interested because you have the long-term perspective, as opposed to all these short-term traders would think, oh no, next year this company is going to make 10% less earnings. Maybe there's a chance to speculate a bit on waiting before you're buying that. I personally still wouldn't do that. I would probably build a 50% position now. And if I'm lucky and the stock is 20% cheaper after this announcement or the news comes out, I'm happy to add to that.
Yeah. It's just best to think long-term rather than what's going to happen in the next minute or the next week or the next day or the next week. It's just, a lot of people call investing gambling, and I typically don't agree with that. They might have an argument, though, if you're talking about this very short-term trading, because you just don't know what's going to happen. And maybe as Bernd said, maybe you'll get lucky, but then again, maybe you won't. So, it's just not something that we really do here.
Yeah, long-term, you just want to shift the odds in your favor, right? And so you have to have a certain edge in the markets. And I mean, from the question, I assume that your and my edge is not in guessing how a stock is going to react to a certain type of news. There are people, they have that edge. Like I said, they have so deep information. People, they use satellite data to monitor the parking lots of Walmart stores and estimate the earnings of Walmart, right? And that has happened already 5, 6, 7 years ago. I don't know when this type of thing started. And I believe they do the same thing. You have all this artificial intelligence out there. You can monitor in real time basically what the internet is saying, what are people writing in forums or messaging in certain messaging apps, and catch the sentiment of people. And that way we can bet on these things. And I believe the edge that we have as individual investors who probably have normal jobs like you and I, or like real time, we work on something, but it's not 100% investing that we do with our free time. Our edges, I think, in the long-term perspective, looking 10 years out, thinking what company could produce better products, higher earnings 10 years out from now, and investing into these. Because most people don't do that. They want exactly this. They want to have a short-term gain by next Friday, and maybe 50% of the people will. I'd rather guess 20% of the people can do that. 80% will lose money. Even if you win money once, in the long term, if this is your strategy, you will really have to refine this with information, try to get an informational edge. And it takes a lot of effort and I believe money. I'd rather say, let's keep our edge in the long-term investing, which most people don't do, and suffer the short-term losses. It can be a lot of pain. I speak from experience, but over the long term, we do have an edge and so can beat the market.
Yeah. Even if you beat it once, I mean, are you going to do that every day? It's not that hard to beat it once, but to do it consistently or even get like right 75% of the time is a challenge that proves too much for most people. I don't think really most people last at that. If you do, it's a very rare quality, but I would not expect that the average investor certainly to have such luck or such skill as to be able to do that. So I think Bernd and I are in agreement that we should stick with the long term rather than short term moves.
Yes, 100% will. I saw another crypto question.
Oh, go ahead.
I'm trying to find it. Okay, here it is. Jeff M asked, Bernd, what is the story around Musk starting Dogecoin as a joke? Is the viable crypto option? And I can make the short and I can go deeper, but Musk didn't start Doge. But I don't even know the founding team behind Dogecoin. It was indeed started as a joke, just as a fun. But people bought into this fun. They liked it. Free markets. I don't know how that worked in that case, but more and more people started buying. And actually, Dogecoin outperformed Bitcoin, outperformed Ethereum, and outperformed most of all, even since the founding of take the first 5 years or 10 years of crypto, of Bitcoin and Ethereum, and take the first 5 years or whenever Dogecoin was founded and compare the performances. And I believe Dogecoin outperformed both of them, at least at the point when I checked that last year, which is crazy. But there's no real fundamental value. So we were talking about before, right? What is behind the token? And behind that token is really just a joke. And then Musk came around. When was it? 2-3 years ago, 4 years ago, maybe, where he was just saying, did he even say, oh, with Tesla, we buy Doge? I forgot what he said, but he basically said, I'm a fan of Doge, in my words. I'm paraphrasing now. And suddenly, people are buying that. And then, of course, you can speculate. Okay, if Musk says that, hey, he could use Dogecoin and just as for fun, because, he just has this crazy mind, which is thinking stuff that most people don't. Maybe he wants to use Dogecoin as a currency for Twitter to, I don't know, tip people or whatever he wants to implement, or even for Tesla. You can buy upgrades for your Tesla car with Dogecoin. And suddenly there's a use case behind Dogecoin, and there could be something. But this is very similar to what we were just talking about, speculating on tariffs. You're speculating on an outcome that may or may not happen. And if you have an opinion about the probabilities of this, if you think Musk is definitely going to do that, I think 80%, close to 100%, he's going to do that. Well, you could bet on that. And then I think Dogecoin might go up, and might go up anyway. However, from a foolish investor perspective, which is analyzing the project and the fundamental metrics behind the project, like is there some adoption coming? How many people are using a certain project? How many people are buying a certain token to use it for a certain purpose? You cannot do that with Dogecoin, and that's one reason why I've never owned it, and I don't plan to own it.
Yeah, just because you have a big name recommending something does not mean it's going to go up. I was reading a story a few weeks ago about how the president of Argentina recommended a cryptocurrency, and it pretty much crashed with the next couple days. So yeah. A lot of those recommendations are not
No,
are worthless in the end.
Yeah, look what's behind. I mean, this is a free market. On the one hand, I like it, right? Because it's a free market. And in my opinion, people should be able to do with their money whatever they want to. And people can go to Las Vegas and gamble on what we know is a losing game in the long term. So you let people lose money on purpose as a government, right? So I would be the last one who goes out and say we shouldn't allow this type of speculation or activity, meme coins happening. It's just a free market in place. And I believe, I didn't go as deep into the story, but I believe Milei, the Argentinian president, he was kind of fooled. He was told a story that didn't really come into fruition by someone who tried. I mean, it is a crazy story. Yeah, but as fools, we don't invest into these things, I would say. And I hope people learn their lessons. And I hope most people did that just as with the tariff thing. They wanted to speculate, okay, and they lost. That can happen. But it's not a foolish investing strategy because you cannot quantify, right? You cannot attach in my opinion, you cannot attach a real probability for a certain outcome and what is the magnitude of the outcome. In terms, for example, for a company, you can make your estimate. You will always be wrong looking into the future, but you can estimate what will be the profit, the revenue, or maybe the margins of a certain company in 5 years from now. You can make your guess, and then you can guess how much cash flow is it going to generate, how many dividends might be paid. And so, okay, if my forecast is going to come true, this is the price I'm willing to pay today. And that's something you can do with a lot of cryptos. With most, you cannot do, especially with these types of tokens, you cannot do that. And so, yeah, what's the value of it? I don't know.
Yeah. Okay. Like, is this Guayado? I hope I'm pronouncing that right. Should small-time retail investors focus on accumulating cash right now, or on consistent investing and dollar cost averaging? And I wanted to touch on that because we were talking about this earlier. I was talking about this with Toby, but how much cash should one hold right now? Again, that's going to be a personalized decision. That's so advising you would probably fall into personalized investing advice. I don't know anyone's individual investing situation, so the answer is probably going to be different for different people. As I was telling Toby, I do recommend having some cash that you hold back, keep some powder dry in case that market decline we were talking about actually happens. If something like that happens, that's usually an opportunity to buy very strong stocks at discount prices. So ideally, you want to have some cash available in case an opportunity like that comes up. And you never know when that opportunity is going to come. So I recommend having some cash personally to be prepared. Yeah, some fools do not agree with me on that. Some are fully invested. That's their choice. A lot of people, feel the market's going to keep going up and they want to keep putting all their money in. That's fine. That may work better for them. But personally, for me, I like to have some dry powder after going through all the investing that I've gone through over the years. But at the same time, consistent investing, dollar cost averaging. I think once you have that cash reserve on hand, I think that's a good strategy, especially if the market goes down. Assuming it doesn't stay down anyway, that usually works to your advantage because you're able to buy more stock at a lower price. So when that recovery does come, and every past downturn we've recovered from. So I assume we'll also recover from the next one. And if we don't, well, your biggest problem probably isn't your investing account. But yeah, assuming that recovery does come, you're gonna be glad you're able to pick up, that stock at a discount price. So I think once you have that cash reserve, in my opinion, it's a good strategy to take X amount every week or every month or whatever works for you and put it into your investments. So it's an individualized decision, but either strategy can work for you depending on how you approach it.
Yes, that's exactly the point. It really depends on the investor, right? It sounds like from the question that there's someone with a regular income, which would match my portfolio, my individual situation. So I personally, right now, I have more income than I have expenses, and I hope I continue to have that for 10 or 20 more years. And so my personal strategy is just to continue to call it dollar cost average. But I personally don't like to hold too much cash. Generally, though, I should add to that, whenever there are real bargains in the markets and I don't have cash, I miss that. So, and I think I should have done that. So I commend you, Will, for having this discipline to have a certain cash balance for such opportunities. And then you also have to have the strategy to really deploy it, right? Because these are the times when it can be really, really tough. When everybody's afraid and the world is going down again, apocalypse is coming, and most people then don't have the guts to then invest into that. But yeah, what I always recommend is writing down a strategy. But generally, I personally have an income. I do dollar cost average. I believe long term that is the best strategy that you can have. It also takes out the emotions a little bit, right? Like what did you talk? Exactly. When is the right time? Is now the right time? And I just like that. I should add though, I don't only have stocks and crypto. One part of my portfolio is gold, like literally physical gold and silver, and that is what I kind of consider as what maybe other people would consider a cash buffer, where I'm just adding also on a monthly, not quite on a monthly basis, but relatively regularly. I'm just adding to that account, and so my goal is, if there will be a time where stocks are super cheap, which I agree with you, Will. Well, the Schiller P is an objective measure to that. We don't know when it comes down. It can be 10 years from now. Maybe it will never come down. Maybe 100 years people look back and think it is cheap for whatever reason. What we see as a Schiller P right now is on average what we're going to see in the next 100 years. We just simply don't know. I think it's unrealistic. My goal would be that I then tap into my gold, my physical gold savings, assuming that their valuation has gone up, which is my expectation. With cash, it's also where do you hold it, right? There come certain risks with holding cash in bank accounts also,
that's
which
true.
and that's one reason why I tend to not hold too much cash.
Yeah, well, I was telling Toby the last hour, I like you, I keep some of the quote unquote cash in gold and silver, and I started that when the inflation took off, and I've kept to it because it keeps going up basically. But you at the same time you have Warren Buffett and Berkshire Hathaway. They have a record $334 billion in cash right now. That kind of tells that you never know, but that kind of tells you that maybe they would be well prepared if that downturn does come. Although if you're Berkshire Hathaway with that kind of cash, you could buy. There's only a very few number of stocks that you can't buy out with that kind of money. I mean, you can't buy out Nvidia or Apple, but a lot of the smaller large caps you could buy. You could probably buy a couple of those or a few of those depending on the stock with that kind of money. So I think you need to balance it though. Personally, yes, you should dollar cost average as Bernd recommends, but like I said, I do keep some money outside the market just in case that opportunity does arise.
I love that thought. Actually, look at Warren Buffett. I mean, we don't know. He won't be around that much longer, most likely. But if you want to get an opinion of how much cash should you hold, probably the best thing is look at the Berkshire Hathaway balance sheet and make a decision based on just following Warren Buffett for that. That could be something trying to do.
Well, he won't be around much longer probably, but his company will be. We'll see. I mean, he's 93, 94 right now. So yeah, you have to assume he's not going to be doing this much longer. But he has some younger lieutenants that will take his place, and they won't do exactly what he does. But I expect that will be a strong investment, at least for the foreseeable future. So with that, we are at the top of the hour. So thank you, Bernd. This is the first time we did this. This is a great hour. Love discussing. Hearing about the crypto, discussing the macro. So great discussion.
Thank you, Will. Yeah, I enjoyed that too. And I believe next week we have the most exciting show for the day. Or I haven't watched all of them, but we have bold predictions with Jose and Neil. And I'm really curious what comes out of that.
Yeah, and here they are.
Hey, fools.
Okay.
Hey, how's it going, gentlemen?
How's it going?
Hey, everyone. All good.
Well.
Ready to roll.
All right. Well, fool on.
Full on.
Good evening, fools, and welcome to the final hour here of Fool 24. Like always, this hour is going to be the bold prediction. And my name is Jose Najarro, and I am joined today by Neil. Good evening, good afternoon, Neil. How's it going?
All good, all good. I mean, we were going back to back with our bold prediction shows. We were here yesterday. I think it was a pretty good one. So we're back for another interesting hour.
Yeah, and for the fools not familiar, this hour Neil and I each come up with 3 different predictions, and throughout it's kind of like a back and forth, see if we can convince you, the viewers, and the other co-host if this prediction has a high chance of becoming true. And there will be a poll on Slido, so make sure to join us on Slido at Slido and the code Fool24. Neil, I feel maybe you should start again.
Okay, I'll start with, let's see which one I want to start off this episode with. Maybe I'll start with the Intel prediction, because we did have Lee Bhutan, the new CEO of Intel, talk at Intel Vision just I think an hour or 2 ago. So I'll start with that prediction right now. I think Intel will outperform the market under Lee Bhutan in the next 5 years. Now, it might seem like a no-brainer prediction for some, and yet for some others, it might seem a very bold prediction because Intel has been underperforming the market. Let's be honest, Intel has been underperforming not just the stock market, but in the semiconductor industry for many, many years. Now, I'm saying this not only because Lee Bhutan is now CEO. He has done an amazing job at Cadence for the 13 years that he's been there as a CEO. I think the stock went up over 3,000% under his tenure. So he definitely knows a thing or two on how to turn a company around. But I'm saying this because even before Pat left the company or was forced to leave the company, I felt like Intel was going in the right direction, even though we're not still seeing those clear signs in each and every earnings report. Now, going into the second half of 2025, we're going to have a big milestone, which is 18A, their next, well, let's call it their next technology when it comes to chip design, which is going to help, well, the Intel design side of things, but also the Intel Foundry side of things, which could attract more and more customers. Intel Foundry, for me as an investor, is a big deal. I do not want it to be spin-off. I do not want, well, Intel to lose control of that part. I think Lee Bhutan knows what he needs to do. He's not going to sugarcoat it. I don't think he's that type of guy that's going to be like, okay, we're Intel, it's nice, we are a $90 billion company or something like that. We need to change a couple of things here and there. No, I think it's going to be very, very clear that he's a guy that knows exactly what needs to be done. He's going to be making some difficult choices, I think, in the next couple of weeks and months, but those will be very, very necessary choices to take Intel back to, well, I'm not going to say the number one in the semiconductor industry because I don't think that can happen or will happen, but they will be taking Intel back to where they are very, very competitive, in my opinion. So I think outperforming the market in the next 5 years should be achievable for them.
Neil, this one's a pretty interesting one, and the poll, just for the full starting, the poll is starting right now. It's going to be open for the next 5 minutes. Again, the prediction is that Intel will outperform the market under the new CEO within the next 5 years. Neil, do you believe outperforming in the next 5 years? If you were to kind of make a guesstimate of, would it lag at least maybe the first half and we kind of start to see a bigger push in the second half? And what we heard, I think the CEO, I think we both listened to the new CEO earlier this afternoon, and he mentioned that 18A was on track. What are some things that you would really, really need to keep an eye out for this prediction to kind of keep holding weight?
Yeah, so when I say for the next 5 years, meaning if we take the next 5 years, we look at the performance of the stock, they will outperform, not each and every year. I don't think that's necessary. But for the next 5 years, looking at the performance of Intel and the market, if Intel beats over that period of time, that's fine by me. Now, with 18A, with the foundry side of things, I think it's going to be important for me to, well, and for the company, to see if they can attract the huge players in the tech space. And I think he did touch a little bit on that, talking about, well, maybe the big players, we can partner up with them. They can help us on the execution side of things as well, which makes sense. I think both of us have talked about that in past streams as well. I think partnerships, the partnership way, is going to be a necessary thing for Intel. We've seen that with the announcement of Amazon a year or so ago, and I think we're going to see that with some other players as well. Maybe a bold prediction inside the bold predictions. I think NVIDIA might be one of those names popping up maybe in the next 18 months or so. But maybe I'll use that bold prediction for another show. But keeping track of the relationship of Intel and some of the big players, foundry and non-foundry, I think that's going to be important for the success.
Yeah, and there, one final point. Usually in the semiconductor industry, it takes multiple years before you kind of see a turnaround. As let's say you want to design a new chip, it takes time for a new chip to come out and then for the market to adapt it and all that. So it could be something that could take 3 to 5 years. Do you think Intel right now has great chip design, and what is Liputan mainly changing at the moment? Is it more the design or the culture happening within the industry? And is that something that also takes about that 3 to 5 year time span to change?
Yeah, so I mean, the 3 to 5 year change, remember that's something that Pat Gelsinger was talking about. And well, he didn't really get his full 5 years, but he did change quite a lot of things, although I think Liputan is more of a straight shooter. I think he's not going to be messing around or wasting time. I think if he sees that teams and departments do need to be cut down, because he did say that he likes to work small teams, startup style, that's going to happen. That's going to happen fast. I actually think we're going to see results faster than the usual 3 to 5 years, because I do think that the roadmap that Pat put out when he came back is being executed on, and now we're towards the end of those 5 nodes in 4 years. So I think they are getting back on track. They're definitely, from a chip design standpoint, they're in a way better place today than they were in 2021. So it should be getting easier from here, in my opinion.
Yeah, Neil. So this is one I don't own Intel, but I was sad when the previous CEO, Pat, left. After listening to this new CEO, obviously only 14 days in his position right now, I believe it's 14 days. It actually gets me really excited for the future of Intel. He really wanted to kind of push with that engineering push. So, Neil, I think we only have like one more minute here on the poll, but I'm gonna have to say, Neil, I agree with you, and I believe this prediction to be true. It's most likely going to have like a really massive rally in the last year of this prediction, on the 5th or 4th year of this prediction. I think in the first years, there's still going to be a lot of changes. We're going to hear a lot of volatility, but the new CEO definitely seems like it was the right decision for Intel to go. And one of the things I enjoyed the most was he really wants to focus on that startup mentality. He believes that Intel, being the giant as it is, should focus on acting like a startup on day one.
Yeah, I think in the first year, so 2025, I think we're going to see big changes, drastic ones that needs to be done, right? You come in, you want to change stuff. I think we're going to still see some layoffs. Unfortunately, some restructurings. Astera is going to be spin off or sold off. That's what he said. That's what I understood. And then, yeah, I think year 2, 3, positive signs will already be seen. Year 4, 5, I do expect the stock to be already much, much higher than where we're at right now, unless something dramatically changes for the worse.
All right, Neil. So we did get the polls closed. And Neil, it seems your predictions are not that bold as they were on day one. 50% agree with you. I also did agree with you here, Neil. 38% disagree, and 13% need more information. Neil, I think for me, the biggest reason I agreed with you was the timeline. I think 5 years has enough opportunity for them to make a turnaround. If maybe you would have came here, maybe would have told me the next 3 years, I think my answer would have been different. But in 5 years, I am going to agree with this prediction. So Neil, I'm going to jump into my prediction next, and we're going to keep it here in the semiconductor space. So I believe SMH, which is an ETF that follows the top 25 holdings in semiconductor US companies, will easily outperform the S&P 500 and the Qs in the next 5 years. And let me just share screen really quick. Hopefully we can get that up super quick on my end here. But I wanted to show the overall performance of SMH and these other two. So it's not necessarily always a winner. We can see year to date, while all of these are down, VanEck is down roughly, or the semiconductor ETF is down about 12%, while the Qs are down 8%, and the S&P 500 is down 5% on a year-to-date basis. In the past year, I think we're going to see the same thing. Actually, in the past year, VanEck is the only one that is down right now, and the other two players are actually up. So it's but I'm gonna guess as we start to get further into time, things change. And yes, we can see kind of on a 3-year basis, VanEck outperforms by 57%, while Qs there's 30%. And just for one more further in the timeline, in the 5 years, we can see that SMH has completely outperformed the indexes. And this is total return, Neil. So this includes dividends that come from these indexes, and it also counts any forms of expense fees that are included. Obviously, an ETF like SMH tends to have higher expense fees than typically your index funds, ETFs like the Qs or the S&P 500. So Neil, the main reason is not because of historical results, as we saw the 3 and 5 years. The main reason I'm giving this is innovation is growing at rapid levels. And last year, a few years ago, it was the metaverse. Even though that didn't kind of came out to fruition, it was a driving force of new technology innovation. We have augmented reality a little bit closer. We have more virtual reality. This past 2 years have been artificial intelligence, Neil, right? And no matter what we have 2 years from now, if it's autonomous robotics, if it's autonomous vehicles, if it's robotics, if it's some form of airborne vehicle or drones entering or smarter home solutions or smart cities, whatever being the next technology phase, it's going to be driven by semiconductors. So semiconductors tend to have highly volatile prices, and we saw with those returns. But in the long term of things, I think innovation, at least for the moment, will continue to be driven by semiconductor companies. And those semiconductor companies are going to be the ones that benefit the most in the next 5 years.
I would agree. I would agree because that's the trend, right? That's the trend that we're going towards, have already started, especially since that ChatGPT moment at the end of 2022. And by the way, the poll is open, so you can go and vote on a Slido if you agree, if you disagree, or if you need more information. I agree because, well, I am also invested in a couple of semiconductor players. I am mostly invested in tech companies, so it does make sense. It does make sense, and these types of ETFs do offer that optionality, right? Of course, the top 10 holdings are probably going to change from time to time, but at least you get that exposure to the top players in that industry. And I think that industry is expected to grow faster than the overall market. You have companies like NVIDIA, like Broadcom, some other companies inside that ETF that are still expected to play a crucial role for many, many years to come. They're still expected to grow quite a lot. So yeah, I agree. I mean, today, if you ask growth investors, tech investors, what you like, what companies you like to follow, they'll probably mention a couple of semiconductor players. And so a semiconductor ETF following the best of the best does make sense for me to agree with you that it will outperform in the next 5 years. And I even think that it can outperform in each of the next 5 years, not just in the whole of the next 5 years. Maybe not this year, but you never know what might happen in the back half of the year. We can have quite a rapid rebound.
And Neil, like you mentioned, the poll is open, and I already see some coming in with more information. Fools, if you need any more information on certain topics that we are discussing, feel free to get them on Slido. If they kind of correspond with this topic at hand, we will gladly take the question or answer a little bit more about it. So Neil, I'm happy you agree. I want to say the only thing that makes me a little bit fearful of this of this prediction, even though I'm the one making, is the biggest risk I see is if during the next 5 years, at the end of the 5 years, we kind of enter maybe a negative cycle in kind of the consumer space, or maybe a negative cycle in enterprise. This is a market that is very cyclical to it, and it's very dependent on a lot of those markets. So the volatility, the price drops would be a lot heavier. I'm going to hope that doesn't happen, but I am very bullish in the overall trend. So I'm pretty excited about the semiconductor industry. And I'm pretty sure most fools know that, as I talk about that almost every show I'm on here.
Yeah, but I mean, to counter that a little bit, since it does hold companies like Broadcom and Nvidia, and those are pretty big companies, if those companies are down, that would take the market down probably as well.
And Neil, we got a very true, Neil, and we got a comment here from Jeff. Jeff, kind of with this topic, Jose, I like your thinking. Just think what SOXL will do, which is a 3 times leverage ETF. Jeff, I do want to say, just be careful sometimes with 3 times ETF. Remember, sometimes, Neil, these 3 times ETF, when you hold them for a long time, because they go up and down and a lot of decay and other things, sometimes they might even do very similar similar returns to just non-leverage ETF, especially when holding during long times. But Jeff, I do like where it's never you can never. There's never enough semiconductor companies to go around. If I could invest more, I would definitely do so. So we do have about 2 minutes left in this poll, Neil.
Currently, it's looking good for you. Huh?
Yeah.
Currently, it's looking good for you. 78% agree with you currently. 22% need more information, and nobody disagrees. I mean, that's a big achievement.
And Neil, I'm not gonna lie, I thought I was gonna get a little bit more pushback on this, just because, as we saw year to date, the stock, these are down. The SMH is down much higher than these indexes, and in the past year as well. The SMH is down a lot more than the indexes. But I'm happy to see other fools sharing the same bullish thesis here for the semiconductor industry.
Yeah, and I think as we near the close of the poll, nothing has changed. So we're still here. 78% agree, 22% need more information, and we have 0% disagree with Jose on this bold prediction. I think next time you need to be bolder.
Yeah, next time I should say, like, it should 3x or 4x outperform these indexes instead. Now I got to go bolder and bolder into these predictions. This one might have been a little too easy to go. So we are closing the poll. Like you mentioned, Neil, we have 78% agree, 0% disagree, and 22 need more information. So Neil, I think we're gonna cut this one maybe at this one and just jump into the next prediction that you are gonna share.
Sure. My next one, we move into the non-text, well, maybe text-based, but a bit less. I'm going to talk a little bit about Disney. So my prediction here is that Disney will outperform Netflix over the next 3 years. Okay, so Netflix right now has a market cap of just short of $400 billion, whereas the Walt Disney Company is at $178.4 billion. Now, PE-wise, forward PE-wise, also a very, very big difference. Basically, Netflix doubled that of Disney. So not only do we have here a market cap that is double that of the other, but the forward PE is also double that of the other. Netflix sits at 37.5 times at the moment, whereas Disney at 18.1 times. But if we look at the PEG ratio, price earnings to growth ratio, Disney is at 1.38, whereas Netflix just 1.55. So despite having a much higher PE, price earnings to growth 1.45, 1.55, well, clearly Netflix is growing faster than a Disney, or expected to grow faster than a Disney right now, which is probably why the market thinks it should be getting a premium on Disney. Now, Disney, I mean, I grew up on Disney content, but Disney today is not the same Disney as before, especially not with the rise of streaming services. So today, Disney's streaming side of things is just becoming more and more profitable. This is something that has hurt the company quite a lot since the launch of Disney Plus. Of course, you had the pandemic, so that increase in subscribers did grow quite rapidly, but then it got hit because the parks were closed. Then coming out of the pandemic, parks were doing quite well, streaming a little bit less, plus streaming was still losing a lot of money. That is changing. Streaming is becoming more and more profitable. And I mean, Netflix, the whole business is basically a streaming model business. And they are showing all the other companies, look, it's actually possible. It's actually possible to have a profitable streaming business. And I think that's what we're going to see with Disney here. I mean, already in fiscal 2025, they expect high single-digit adjusted EPS growth compared to fiscal 2024, approximately $15 billion in cash provided by operations. I mean, that continues to grow and grow. They're targeting $30 billion in stock repurchases. That's only in fiscal 2025. In fiscal 2026, they are still looking at double-digit adjusted EPS growth, double-digit growth in cash provided by operations as well. And then even into fiscal 2027, we already have some guidance there, double digits adjusted EPS growth. So this company might not grow as fast as a Netflix, especially not top-line growth, but it's definitely expected and becoming more and more profitable. So as they become more and more profitable, as they generate more and more free cash flow, I do believe they're going to buy back more shares, pay small dividends. The market is going to like the whole profile that Disney offers on the stock market. Parks wise, that's still doing quite well. Cruises doing well as well. Movies, some hits and misses still, but I'm pretty sure that they're focused more now on quality than quantity, as we've seen in previous years, although some of the most recent releases were big misses. But I think all in all, that's going to change. So yeah, that's basically the bold prediction here. Of course, the poll is open. You can go vote for the next couple of minutes.
Yeah, Neil, so for this one, I'm still torn between agreeing or disagreeing. One thing that I really do, even though I don't own either of these, one things that I would enjoy Netflix over Disney, as you mentioned, this is pretty much a streaming only company. So if there are any wild changes to consumer spending, I think Netflix will take a lesser hit, just because you only have kind of like that yearly fee, where Disney, right, it not only depends on that Disney Plus platform, it not only depends on just the movies, and also usually typically very low cost volume for low cost price items for a typical family, and are easy to maybe sometimes still digest a little bit even during volatile times, but they're also very dependent on some of their other experiences, like the Disney parks, which can go to some pricey, extremely pricey costs for families, and the cruises. Does that worry you that maybe some of these changes in consumer spending could happen within the next 3 years? And if they do, do you believe Disney will still outperform? Or will your thesis change or your prediction change if consumer spending changes as well?
Yeah, so it's always something to think of. If we go into a recession, I mean, my personal opinion currently is that the data doesn't show that we are, but it's always something that could happen in the future. The thing with Disney is that for some reason, I don't, other than the pandemic, I think the parks were always full, despite also the prices going up. So I guess they have pricing power, although they did say that, yeah, maybe prices have gone up a bit too fast more recently. So at least they know that. But yeah, it's something to think about. But currently, there are just so many people around the globe that want to go to a Disney park, and there are just a handful of those around the globe. So I think they're always going to be quite packed, to be honest. And as we enter this Gen AI type of, well, back half of the decade, I think Disney, with their investments, with their partnerships, and definitely with investment in Epic Games, for example, I think they're going to diversify more and more into more digital realms as well, where they can generate more revenue with super high margins there. So it's something to consider, but I think Disney parks, Disney cruises, to be honest, is a very, very strong competitive advantage compared to the others.
So, Thiel, would you like to see Disney, like you mentioned, they're doing great investments in kind of like digital experience type things like games, and they've always done that. Do you want that to maybe increase a little bit more, to also maybe increase some of the exposure outside of maybe your just hefty expensive experiences, or is that something that you don't see too much of an impact within the next few years?
No, I think they should be doing that as we go into VR, AR. I think they should partner with these types of companies, license their IP, so that, well, their brand doesn't disappear with the younger generation. Although I don't think it will, but why not? Why not license their IP to a Meta, for example, or something like that? And you can have like virtual worlds, virtual Disney worlds inside that device, because not everyone can go to a Disney park, to a Disney World, a Disneyland. So why not? Why not expand the optionality to the virtual worlds? I think it's a win-win.
All right, Neil, we have about 1 minute here left. And Neil, originally I was a little bit torn, and I'm going to hopefully try to share screen really quickly here on a pretty cool chart. And you mentioned this at the beginning, Neil, where Netflix is more than double the size of Walt Disney.